the sense of danger must not disappear. The way is certainly both short and steep. However gradual it looks from here. Look if you like, but you will have to leap. Welcome back to our audiobook channel Trade Like Champion. Today we have brought audiobook titled The Intelligent Investor Definitive Book on Value Investing by Benjamin Graham. A Note About Benjamin Graham, by Jason Zweig. The test of integrity is its blunt refusal to be compromised. Chinua Achebe 1. Who was Benjamin Graham, and why should you listen to him? Graham was one of the greatest investors who ever lived. He also was one of the smartest, and he may well have been the wisest point too. How great an investor was Graham? He didn't merely earn superior returns, he did so during some of the most difficult times investors have ever seen, including the end of the Great Depression. His Graham-Newman Corp beat the market by an average of roughly 5 percentage points annually between 1936 and 1956. Few other investors have ever rivaled so great a margin of outperformance over so long a career, foremost among them Warren Buffett, who learned how to invest from Graham himself. How smart was Graham? He entered Columbia University at age 17, he should have been admitted a year earlier, but the college bungled his paperwork. He finished in 2.5 years, ranked second in his class. Before Graham even graduated, Columbia offered him faculty positions in 3 different departments: philosophy, mathematics, and English. Needing to support his widowed mother, he took a better-paying job on Wall Street instead. Graham's book Security Analysis, written with David Dodd and published in 1934, became the foundational text for financial analysts worldwide. But his brilliance knew no bounds. When Graham was 23, the American Mathematical Monthly published his article on how to improve the teaching of calculus. He went on to patent 2 innovative handheld calculators. He wrote 2 books on how to stabilize global currencies and numerous articles on law, taxation, and unemployment. In his spare time, Graham wrote a Broadway play, taught himself Spanish and translated a Uruguayan novel, and read voraciously in French, ancient Greek, and Latin. Above all, Graham was wise. In his decades on Wall Street, he encountered every kind of scam and fraud: insider trading, promoters touting worthless stocks, dirty accounting tricks, companies shafting their own shareholders. He witnessed markets in which millions of people lost their minds, fooling themselves into thinking they were investing geniuses just because they had bought a few stocks that had gone up temporarily. He had also seen investors stripped of their wealth by listening to experts who told them they could get rich quick. Graham learned not only from the mistakes of others but from his own. He had chased hot stocks and gotten burned. He had traded too much and learned to be patient. He had taken too much risk and learned to be cautious. He had invested with borrowed money and never used leverage again. He had tried and tested countless investing methods and understood the pitfalls of attempting to predict the future with inadequate data from the past. Graham understood that investing is a lonely activity in which isolated individuals, yearning for connection and the approval of their peers, easily fall prey to manipulators and crooks. In recent years, the profoundly human desire to join the crowd has been hijacked by social media and smartphone brokerage apps until millions of people ended up trading the same stocks all at once, motivated by FOMO, the fear of missing out. Once you join such a financial flash mob, making a sensible plan and sticking to it become all but impossible. This book will help you think for yourself instead of letting millions of strangers tell you what to think. Graham also knew that even the most honest people aren't always honest with themselves. We all hate admitting our own shortcomings. Graham's advice focuses not only on what investors ought to do, but on what they can do. He never misleads his readers with bogus promises about the markets or themselves. This book will help you understand your own strengths and weaknesses, giving you the intellectual and emotional framework for making good investing decisions and, more importantly, for sticking with them. To stand out from the crowd, you must stand apart from the crowd. To be an intelligent investor, you must be disciplined and you must think differently. 4 cornerstones. Graham teaches 4 great principles. You can't be an investor without trading, but you can trade without ever investing. If you know nothing about a stock except that its price has gone up or everybody is buying it, you're not investing, you're speculating. The intelligent investor does thorough research and makes deliberate, consistent, measurable decisions. A stock isn't a ticker symbol or a pulsating series of prices on your smartphone, it's an ownership interest in a business with a fundamental value independent of its share price. The intelligent investor studies the business, not the stock. See Table 0.1. Most of the time, market prices are approximately right, but when they are wrong they can be abysmally wrong. Graham invented a character called Mr. Market, a mythical figure who goes wild with greed and euphoria when stocks go up but wallows in fear and misery when stocks go down. Point 4. The intelligent investor is a realist who sells to optimists and buys from pessimists. You must never let your emotions be taken hostage by Mr. Market's mood swings. Most investors commit their biggest mistakes when they focus on how much money they could make if they turn out to be right and forget to consider how much they could lose if they turn out to be wrong. The intelligent investor always maintains what Graham called a margin of safety, a cushion of humility that will allow you to survive your losses if your analysis is incorrect. Table 0-1, Stocks versus Businesses. The Intelligent Investor was first published in 1949. The goal of this commemorative 75th anniversary edition is to integrate Graham's classic insights with today's market realities. This edition, like the previous version published in 2003, follows Graham's own plan. The Intelligent Investor isn't, and Graham never intended it to be, a step-by-step guide to stock picking or an instructional handbook on how to analyze and evaluate businesses. Instead, it lays down the guidelines and principles that are the indispensable foundation for investing success. As Graham put it, comparatively little will be said here about the technique of analyzing securities. Attention will be paid chiefly to investment principles and investors' attitudes. All of Graham's original chapters remain intact. Point 5. I've also highlighted many of Graham's passages in boldface type to signal their importance. In the commentaries that accompany each of Graham's chapters, I've included recent examples that show how powerful his principles still are. The commentaries are printed in sans serif type, like this. Graham's original chapters are printed in serif type, like this. This book will help you build the habits and cultivate the discipline that are essential for succeeding as an investor. Warren Buffett calls The Intelligent Investor by far the best book about investing ever written because no one else has ever understood and conveyed these principles better than Graham. With this book in your hands, you are well on your way to becoming an intelligent investor. In the next chapter, we'll talk about what that means and what it takes. Preface to the Revised Edition, by Warren E. Buffett. I read the first edition of this book early in 1950, when I was 19. I thought then that it was by far the best book about investing ever written. I still think it is. To invest successfully over a lifetime does not require a stratospheric IQ, unusual business insights, or inside information. What's needed is a sound intellectual framework for making decisions and the ability to keep emotions from corroding that framework. This book precisely and clearly prescribes the proper framework. You must supply the emotional discipline. If you follow the behavioral and business principles that Graham advocates, and if you pay special attention to the invaluable advice in chapters 8 and 20, you will not get a poor result from your investments. That represents more of an accomplishment than you might think. Whether you achieve outstanding results will depend on the effort and intellect you apply to your investments, as well as on the amplitudes of stock market folly that prevail during your investing career. The sillier the market's behavior, the greater the opportunity for the business-like investor. Follow Graham and you will profit from folly rather than participate in it. To me, Ben Graham was far more than an author or a teacher. More than any other man except my father, he influenced my life. Shortly after Ben's death in 1976, I wrote the following short remembrance about him in the Financial Analyst's Journal. As you read the book, I believe you'll perceive some of the qualities I mentioned in this tribute. Benjamin Graham. 1894 to 1976. Several years ago Ben Graham, then almost 80, expressed to a friend the thought that he hoped every day to do something foolish, something creative, and something generous. The inclusion of that first whimsical goal reflected his knack for packaging ideas in a form that avoided any overtones of sermonizing or self-importance. Although his ideas were powerful, their delivery was unfailingly gentle. Readers of this magazine need no elaboration of his achievements as measured by the standard of creativity. It is rare that the founder of a discipline does not find his work eclipsed in rather short order by successors. But over 40 years after publication of the book that brought structure and logic to a disorderly and confused activity, it is difficult to think of possible candidates for even the runner-up position in the field of security analysis. In an area where much looks foolish within weeks or months after publication, Ben's principles have remained sound, their value often enhanced and better understood in the wake of financial storms that demolished flimsier intellectual structures. His counsel of soundness brought unfailing rewards to his followers, even to those with natural abilities inferior to more gifted practitioners who stumbled while following counsels of brilliance or fashion. A remarkable aspect of Ben's dominance of his professional field was that he achieved it without that narrowness of mental activity that concentrates all effort on a single end. It was, rather, the incidental byproduct of an intellect whose breadth almost exceeded definition. Certainly I have never met anyone with a mind of similar scope. Virtually total recall, unending fascination with new knowledge, and an ability to recast it in a form applicable to seemingly unrelated problems made exposure to his thinking in any field a delight. But his third imperative, generosity, was where he succeeded beyond all others. I knew Ben as my teacher, my employer, and my friend. In each relationship, just as with all his students, employees, and friends, there was an absolutely open-ended, no scores kept generosity of ideas, time, and spirit. If clarity of thinking was required, there was no better place to go. And if encouragement or counsel was needed, Ben was there. Walter Lippmann spoke of men who plant trees that other men will sit under. Ben Graham was such a man. Reprinted from the Financial Analyst's Journal, November/December 1976. What this book expects to accomplish. By Benjamin Graham. The purpose of this book is to supply, in a form suitable for laymen, guidance in the adoption and execution of an investment policy. Comparatively little will be said here about the technique of analyzing securities. Attention will be paid chiefly to investment principles and investors' attitudes. We shall, however, provide a number of condensed comparisons of specific securities, chiefly in pairs appearing side by side in the New York Stock Exchange list, in order to bring home in concrete fashion the important elements involved in specific choices of common stocks. But much of our space will be devoted to the historical patterns of financial markets, in some cases running back over many decades. To invest intelligently in securities, one should be forearmed with an adequate knowledge of how the various types of bonds and stocks have actually behaved under varying conditions, some of which, at least, one is likely to meet again in one's own experience. No statement is more true and better applicable to Wall Street than the famous warning of Santa Yana: those who do not remember the past are condemned to repeat it. Our text is directed to investors as distinguished from speculators, and our first task will be to clarify and emphasize this now all but forgotten distinction. We may say at the outset that this is not a how to make a million book. There are no sure and easy paths to riches on Wall Street or anywhere else. It may be well to point up what we have just said by a bit of financial history, especially since there is more than one moral to be drawn from it. In the climactic year 1929, John J. Raskob, a most important figure nationally as well as on Wall Street, extolled the blessings of capitalism in an article in the Ladies' Home Journal, entitled "Everybody Ought to Be Rich." His thesis was that savings of only $15 per month invested in good common stocks with dividends reinvested would produce an estate of $80,000 in 20 years against total contributions of only $3,600. If the General Motors tycoon was right, this was indeed a simple road to riches. How nearly right was he? Our rough calculation based on assumed investment in the 30 stocks making up the Dow Jones Industrial Average, DJIA, indicates that if Raskob's prescription had been followed during 1929 to 1948, the investors' holdings at the beginning of 1949 would have been worth about $8,500. This is a far cry from the great man's promise of $80,000, and it shows how little reliance can be placed on such optimistic forecasts and assurances. But, as an aside, we should remark that the return actually realized by the 20-year operation would have been better than 8% compounded annually, and this despite the fact that the investor would have begun his purchases with the DJIA at 300 and ended with a valuation based on the 1948 closing level of 177. This record may be regarded as a persuasive argument for the principle of regular monthly purchases of strong common stocks through thick and thin, a program known as dollar cost averaging. Since our book is not addressed to speculators, it is not meant for those who trade in the market. Most of these people are guided by charts or other largely mechanical means of determining the right moments to buy and sell. The one principle that applies to nearly all these so-called technical approaches is that one should buy because a stock or the market has gone up, and one should sell because it has declined. This is the exact opposite of sound business sense everywhere else, and it is most unlikely that it can lead to lasting success on Wall Street. In our own stock market experience and observation, extending over 50 years, we have not known a single person who has consistently or lastingly made money by thus following the market. We do not hesitate to declare that this approach is as fallacious as it is popular. We shall illustrate what we have just said, though, of course, this should not be taken as proof by a later brief discussion of the famous Dow theory for trading in the stock market *. Since its first publication in 1949, revisions of The Intelligent Investor have appeared at intervals of approximately 5 years. In updating the current version, we shall have to deal with quite a number of new developments since the 1965 edition was written. These include: 1. An unprecedented advance in the interest rate on high-grade bonds. 2. A fall of about 35% in the price level of leading common stocks, ending in May 1970. This was the highest percentage decline in some 30 years. Countless issues of lower quality had a much larger shrinkage. 3. A persistent inflation of wholesale and consumers' prices, which gained momentum even in the face of a decline of general business in 1970. 4. The rapid development of conglomerate companies, franchise operations, and other relative novelties in business and finance. These include a number of tricky devices such as letter stock, proliferation of stock option warrants, misleading names, use of foreign banks, and others. 5. Bankruptcy of our largest railroad, excessive short and long-term debt of many formerly strongly entrenched companies, and even a disturbing problem of solvency among Wall Street houses. 6. The advent of the performance vogue in the management of investment funds, including some bank-operated trust funds, with disquieting results. These phenomena will have our careful consideration, and some will require changes in conclusions and emphasis from our previous edition. The underlying principles of sound investment should not alter from decade to decade, but the application of these principles must be adapted to significant changes in the financial mechanisms and climate. The last statement was put to the test during the writing of the present edition, the first draft of which was finished in January 1971. At that time the DJIA was in a strong recovery from its 1970 low of 632 and was advancing toward a 1971 high of 951, with attendant general optimism. As the last draft was finished, in November 1971, the market was in the throes of a new decline, carrying it down to 797 with a renewed general uneasiness about its future. We have not allowed these fluctuations to affect our general attitude towards sound investment policy, which remains substantially unchanged since the first edition of this book in 1949. The extent of the market's shrinkage in 1969 to 70 should have served to dispel an illusion that had been gaining ground during the past 2 decades. This was that leading common stocks could be bought at any time and at any price, with the assurance not only of ultimate profit but also that any intervening loss would soon be recouped by a renewed advance of the market to new high levels. That was too good to be true. At long last the stock market has returned to normal, in the sense that both speculators and stock investors must again be prepared to experience significant and perhaps protracted falls as well as rises in the value of their holdings. In the area of many secondary and third-line common stocks, especially recently floated enterprises, the havoc wrought by the last market break was catastrophic. This was nothing new in itself. It had happened to a similar degree in 1961, 62, but there was now a novel element in the fact that some of the investment funds had large commitments in highly speculative and obviously overvalued issues of this type. Evidently it is not only the tyro who needs to be warned that while enthusiasm may be necessary for great accomplishments elsewhere, on Wall Street it almost invariably leads to disaster. The major question we shall have to deal with grows out of the huge rise in the rate of interest on first-quality bonds. Since late 1967 the investor has been able to obtain more than twice as much income from such bonds as he could from dividends on representative common stocks. At the beginning of 1972 the return was 7.19% on highest-grade bonds versus only 2.76% on industrial stocks. This compares with 4.4% and 2.92% respectively at the end of 1964. It is hard to realize that when we first wrote this book in 1949 the figures were almost the exact opposite. The bonds returned only 2.66% and the stocks yielded 6.82%. In previous editions we have consistently urged that at least 25% of the conservative investor's portfolio be held in common stocks, and we have favored in general a 50-50 division between the two media. We must now consider whether the current great advantage of bond yields over stock yields would justify an all-bond policy until a more sensible relationship returns, as we expect it will. Naturally, the question of continued inflation will be of great importance in reaching our decision here. A chapter will be devoted to this discussion. In the past we have made a basic distinction between two kinds of investors to whom this book was addressed: the defensive and the enterprising. The defensive, or passive, investor will place his chief emphasis on the avoidance of serious mistakes or losses. His second aim will be freedom from effort, annoyance, and the need for making frequent decisions. The determining trait of the enterprising, or active, or aggressive, investor is his willingness to devote time and care to the selection of securities that are both sound and more attractive than the average. Over many decades, an enterprising investor of this sort could expect a worthwhile reward for his extra skill and effort, in the form of a better average return than that realized by the passive investor. We have some doubt whether a really substantial extra recompense is promised to the active investor under today's conditions. But next year or the years after may well be different. We shall accordingly continue to devote attention to the possibilities for enterprising investment, as they existed in former periods and may return. It has long been the prevalent view that the art of successful investment lies first in the choice of those industries that are most likely to grow in the future, and then in identifying the most promising companies in these industries. For example, smart investors, or their smart advisors, would long ago have recognized the great growth possibilities of the computer industry as a whole and of international business machines in particular. And similarly for a number of other growth industries and growth companies. But this is not as easy as it always looks in retrospect. To bring this point home at the outset, let us add here a paragraph that we included first in the 1949 edition of this book. Such an investor may, for example, be a buyer of air transport stocks because he believes their future is even more brilliant than the trend the market already reflects. For this class of investor, the value of our book will lie more in its warnings against the pitfalls lurking in this favorite investment approach than in any positive technique that will help him along his path. The pitfalls have proved particularly dangerous in the industry we mentioned. It was, of course, easy to forecast that the volume of air traffic would grow spectacularly over the years. Because of this factor, their shares became a favorite choice of the investment funds. But despite the expansion of revenues at a pace even greater than in the computer industry, a combination of technological problems and overexpansion of capacity made for fluctuating and even disastrous profit figures. In the year 1970, despite a new high in traffic figures, the airlines sustained a loss of some $200 million for their shareholders. They had shown losses also in 1945 and 1961. The stocks of these companies once again showed a greater decline in 1969 to 70 than did the general market. The record shows that even the highly paid full-time experts of the mutual funds were completely wrong about the fairly short-term future of a major and non-sateric industry. On the other hand, while the investment funds had substantial investments and substantial gains in IBM, the combination of its apparently high price and the impossibility of being certain about its rate of growth prevented them from having more than, say, 3% of their funds in this wonderful performer. Hence the effect of this excellent choice on their overall results was by no means decisive. Furthermore, many if not most of their investments in computer industry companies other than IBM appear to have been unprofitable. From these two broad examples we draw two morals for our readers. 1. Obvious prospects for physical growth in a business do not translate into obvious profits for investors. 2. The experts do not have dependable ways of selecting and concentrating on the most promising companies in the most promising industries. The author did not follow this approach in his financial career as fund manager, and he cannot offer either specific counsel or much encouragement to those who may wish to try it. What then will we aim to accomplish in this book? Our main objective will be to guide the reader against the areas of possible substantial error and to develop policies with which he will be comfortable. We shall say quite a bit about the psychology of investors. For indeed, the investor's chief problem and even his worst enemy is likely to be himself. The fault, dear investor, is not in our stars and not in our stocks but in ourselves. This has proved the more true over recent decades as it has become more necessary for conservative investors to acquire common stocks and thus to expose themselves, willy-nilly, to the excitement and the temptations of the stock market. By arguments, examples, and exhortation, we hope to aid our readers to establish the proper mental and emotional attitudes toward their investment decisions. We have seen much more money made and kept by ordinary people who were temperamentally well suited for the investment process than by those who lacked this quality, even though they had an extensive knowledge of finance, accounting, and stock market lore. Additionally, we hope to implant in the reader a tendency to measure or quantify. For 99 issues out of 100 we could say that at some price they are cheap enough to buy and at some other price they would be so dear that they should be sold. The habit of relating what is paid to what is being offered is an invaluable trait in investment. In an article in a women's magazine many years ago we advised the readers to buy their stocks as they bought their groceries, not as they bought their perfume. The really dreadful losses of the past few years, and on many similar occasions before, were realized in those common stock issues where the buyer forgot to ask how much. In June 1970 the question how much could be answered by the magic figure 9.40%, the yield obtainable on new offerings of high-grade public utility bonds. This has now dropped to about 7.3%, but even that return tempts us to ask, why give any other answer? But there are other possible answers, and these must be carefully considered. Besides which, we repeat that both we and our readers must be prepared in advance for the possibly quite different conditions of, say, 1973 to 1977. We shall therefore present in some detail a positive program for common stock investment, part of which is within the purview of both classes of investors and part is intended mainly for the enterprising group. Strangely enough, we shall suggest as one of our chief requirements here that our readers limit themselves to issues selling not far above their tangible asset value. The reason for this seemingly outmoded counsel is both practical and psychological. Experience has taught us that, while there are many good growth companies worth several times net assets, the buyer of such shares will be too dependent on the vagaries and fluctuations of the stock market. By contrast, the investor in shares, say, of public utility companies at about their net asset value can always consider himself the owner of an interest in sound and expanding businesses, acquired at a rational price regardless of what the stock market might say to the contrary. The ultimate result of such a conservative policy is likely to work out better than exciting adventures into the glamorous and dangerous fields of anticipated growth. The art of investment has one characteristic that is not generally appreciated. A creditable, if unspectacular, result can be achieved by the lay investor with a minimum of effort and capability, but to improve this easily attainable standard requires much application and more than a trace of wisdom. If you merely try to bring just a little extra knowledge and cleverness to bear upon your investment program, instead of realizing a little better than normal results, you may well find that you have done worse. Since anyone by just buying and holding a representative list can equal the performance of the market averages, it would seem a comparatively simple matter to beat the averages, but as a matter of fact the proportion of smart people who try this and fail is surprisingly large. Even the majority of the investment funds, with all their experienced personnel, have not performed so well over the years as has the general market. Allied to the foregoing is the record of the published stock market predictions of the brokerage houses, for there is strong evidence that their calculated forecasts have been somewhat less reliable than the simple tossing of a coin. In writing this book we have tried to keep this basic pitfall of investment in mind. The virtues of a simple portfolio policy have been emphasized: the purchase of high-grade bonds plus a diversified list of leading common stocks which any investor can carry out with a little expert assistance. The adventure beyond this safe and sound territory has been presented as fraught with challenging difficulties, especially in the area of temperament. Before attempting such a venture the investor should feel sure of himself and of his advisors, particularly as to whether they have a clear concept of the differences between investment and speculation and between market price and underlying value. A strong-minded approach to investment, firmly based on the margin of safety principle, can yield handsome rewards. but a decision to try for these emoluments rather than for the assured fruits of defensive investment should not be made without much self-examination. A final retrospective thought. When the young author entered Wall Street in June 1914, no one had any inkling of what the next half-century had in store. The stock market did not even suspect that a world war was to break out in 2 months, and close down the New York Stock Exchange. Now, in 1972, we find ourselves the richest and most powerful country on earth, but beset by all sorts of major problems and more apprehensive than confident of the future. Yet if we confine our attention to American investment experience, there is some comfort to be gleaned from the last 57 years. Through all their vicissitudes and casualties, as earth-shaking as they were unforeseen, it remained true that sound investment principles produce generally sound results. We must act on the assumption that they will continue to do so. Note to the reader, this book does not address itself to the overall financial policy of savers and investors, it deals only with that portion of their funds which they are prepared to place in marketable, or redeemable, securities, that is, in bonds and stocks. Consequently, we do not discuss such important media as savings and time deposits, savings and loan association accounts, life insurance, annuities, and real estate mortgages or equity ownership. The reader should bear in mind that when he finds the word now, or the equivalent, in the text, it refers to late 1971 or early 1972 *. Commentary on the introduction. By Jason Zweig. I can't tell you how to get rich quickly. I can only tell you how to get poor quickly, by trying to get rich quickly. Andrei Kostolany 1. The investor's chief problem and even his worst enemy is likely to be himself. With these simple words, Graham signals what investing is all about. Our message in this book is that investing is the exact opposite of what you've been led to believe. Financial television, blogs, brokerage ads, and social media portray investing as a struggle for survival in a hostile wilderness. They want you to think you're locked in a lifelong battle against the stock market, hedge funds, central banks, or other dark and mysterious forces. Such propaganda stokes fear. It makes you feel you're in a competition that you can win only if everyone else loses. Conveniently for the people who spout this message, once you start believing it, you become willing to pay them high fees in a desperate quest to survive. You will also feel compelled to learn the secrets of successful investors, check the value of your investments every few minutes, get swept up in conspiracy theories about how the market is rigged, or trade obsessively at blazing speed. That way, it seems, you can beat the professionals at their own game. Yet they can't win it themselves. Roughly 3/4 of professional investors fail to beat the market even though they have decades of training and experience, command computers that can trade thousands of times per second, and get instantaneous access to all the market-moving news on Earth. If they can't win their game, why would you even want to play? The good news is that you don't have to. With Graham as your guide, you can forget all that nonsense about being in a fight to the death against the markets and forego all the stress, fees, and failure that go with it. However, you will have to wage another, even more challenging struggle. To be an intelligent investor, there is a dark and mysterious force you must conquer. But it isn't the market. It's yourself. You, not the market, are your own worst investing enemy. That's because the human mind is a brilliant mechanism for solving difficult problems, but it is even more adept at the simple task of self-deception. Millions of investors spend their entire lives fooling themselves, taking risks they don't understand, chasing the phantoms of past performance, selling their winning assets too soon, holding their losers too long, paying outlandish fees in pursuit of the unobtainable, bragging about beating the market without even measuring their returns. They are willfully blind to the fact that they are their own worst enemy. They preserve their self-esteem with self-delusion. They look in the mirror and see Warren Buffett. As an investor, if you know what you're doing, you can make more money than you ever dreamed possible. If you only think you know what you're doing, you will lose more money than you ever envisioned in your worst nightmares. Fooling yourself can be even more costly than being fooled by someone else. What is an intelligent investor? Conventional measures of intelligence have little to do with whether you can be what Graham calls an intelligent investor. In 1720, Sir Isaac Newton, one of the smartest people who ever lived, lost a fortune trading shares in the South Sea Co. In 1998, Long-Term Capital Management LP, a hedge fund run by mathematicians, computer scientists, and 2 Nobel laureates in economics, lost roughly 80% of its capital in a few weeks and had to be rescued in a $3.6 billion bailout. 3. No matter how brilliant you are, you can't be or become an intelligent investor unless you learn to be honest with yourself. In the first edition of this book, Graham wrote, "The word intelligent in our title will be used in its common and dictionary sense as meaning endowed with the capacity for knowledge and understanding. It will not be taken to mean smart or shrewd, or gifted with unusual foresight or insight. It is a trait more of the character than of the brain. 4. You don't need to be a rocket scientist," Warren Buffett has said. Investing is not a game where the guy with the 160 IQ beats the guy with the 130 IQ. Rationality is essential. Buffett and his partner, Charlie Munger, have repeatedly emphasized the vital importance of what they call temperament. The 7 virtues of great investors. Graham doesn't list all the character traits that constitute the temperament of an intelligent investor, but the great money managers I've met share a few indispensable qualities. I call them the 7 virtues. 5. Curiosity. Ordinary investors are afraid of what they don't know. Intelligent investors are also afraid of what they think they do know, because they realize it might be biased, incomplete, or wrong. So they never deviate from their relentless lifelong quest to learn more. They read constantly and never stop asking questions. They are learning machines. Skepticism. Wall Street purports to sell investments, but its real business is selling hopes and dreams to people who want to believe in magic. Save for retirement by getting in on the ground floor of the artificial intelligence revolution. Earn high income at low risk. Get exclusive access to the lucrative returns on alternative assets. In this book, you'll learn to sharpen your skepticism and recognize when an ostensible opportunity is too good to be true. Independence. The single most valuable investment asset you will ever have is your own mind. If you let other people do your thinking for you, you've traded away your greatest asset and made your emotions and your results captive to the whims of millions of strangers. Great investors like Graham, Buffett, and Munger don't try to step in with the crowd, they step away. The approval of others means nothing to them. Nor should it to you. As Graham writes in chapter 20, you are neither right nor wrong because the crowd disagrees with you. You are right because your data and reasoning are right. Humility. The most dangerous thing about buying any asset that goes up is that profit feels like proof. Making money makes you think you know what you're doing and what the future holds even when you're wrong. That's why hanging on to humility is so important. The more you learn, the more you should realize how little you know. The longer you invest, the more you should realize that your luck is bigger than you are. Many people think humility is about managing what others think of you, which would be easy. Instead, it's about being honest with yourself, which is hard. Discipline. To be an intelligent investor, you can't make things up as you go along, following your gut wherever it goes, trying a little of this and a little of that to see what happens. Instead, you need to impose discipline on yourself with policies, procedures, and rules you follow before making any decision. That way, you treat investing as a continuous process you can practice improving at every step, rather than a series of haphazard events. Discipline doesn't just mean consistently doing what you should do, when and how you should do it, it also means consistently not doing what you shouldn't do. Patience. Why bother trying to be patient in a world of instant gratification, an endless deluge of information and stocks and cryptocurrencies that go to the moon? Why not just try to get rich quick? Because almost nobody who gets rich quick stays rich for long. The money you make in a few months or weeks or days or hours will almost certainly disappear at least as fast as it came. Hot streaks go cold, good luck turns bad, surprises blow your profits to bits. To earn and keep long-term gains, you can't be a short-term thinker. You must build your wealth slowly and steadily. Courage. It's easy to say you'll buy more if the stock market falls, but being brave is a lot harder than saying you are. Courage is losing more than 55% of your money between late 2007 and early 2009 and then buying more stocks, not despite the global financial crisis, but because of it. Courage is losing 34% in only 5 weeks during the pandemic panic in February and March 2020 and then hanging on, not despite the fear and dread that surrounded you, but because of them. To be an investor you must believe in a better tomorrow. History shows that financial faith pays off the best after the times when it is hardest to hold. With Graham as your guide, you can acquire and cultivate these virtues. They will serve you well not only in investing but in life. With this book in hand, you can become a more intelligent investor and a wiser person. Read on, and learn. Chapter 1. Investment versus Speculation, Results to be Expected by the Intelligent Investor. By Benjamin Graham. Subscribe, like and share our audiobook channel Trade Like Champions for more such contents. Happy investing. This chapter will outline the viewpoints that will be set forth in the remainder of the book. In particular, we wish to develop at the outset our concept of appropriate portfolio policy for the individual, non-professional investor. Investment versus speculation. What do we mean by investor? Throughout this book the term will be used in contradistinction to speculator. As far back as 1934, in our textbook Security Analysis 1 we attempted a precise formulation of the difference between the two, as follows: an investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. While we have clung tenaciously to this definition over the ensuing 38 years, it is worthwhile noting the radical changes that have occurred in the use of the term investor during this period. After the great market decline of 1929 to 1932, all common stocks were widely regarded as speculative by nature. A leading authority stated flatly that only bonds could be bought for investment. Point 2, thus we had then to defend our definition against the charge that it gave too wide scope to the concept of investment. Now our concern is of the opposite sort. We must prevent our readers from accepting the common jargon which applies the term investor to anybody and everybody in the stock market. In our last edition we cited the following headline of a front-page article of our leading financial journal in June 1962. Small investors bearish, they are selling odd lots short. In October 1970 the same journal had an editorial critical of what it called reckless investors, who this time were rushing in on the buying side. These quotations well illustrate the confusion that has been dominant for many years in the use of the words investment and speculation. Think of our suggested definition of investment given above, and compare it with the sale of a few shares of stock by an inexperienced member of the public, who does not even own what he is selling, and has some largely emotional conviction that he will be able to buy them back at a much lower price. It is not irrelevant to point out that when the 1962 article appeared, the market had already experienced a decline of major size, and was now getting ready for an even greater upswing. It was about as poor a time as possible for selling short. In a more general sense, the later used phrase reckless investors could be regarded as a laughable contradiction in terms something like spendthrift misers, were this misuse of language not so mischievous. The newspaper employed the word investor in these instances because, in the easy language of Wall Street, everyone who buys or sells a security has become an investor, regardless of what he buys, or for what purpose, or at what price, or whether for cash or on margin. Compare this with the attitude of the public toward common stocks in 1948, when over 90% of those queried expressed themselves as opposed to the purchase of common stocks. 3 About half gave as their reason not safe, a gamble, and about half, the reason not familiar with. It is indeed ironical, though not surprising, that common stock purchases of all kinds were quite generally regarded as highly speculative or risky at a time when they were selling on a most attractive basis, and due soon to begin their greatest advance in history. Conversely, the very fact they had advanced to what were undoubtedly dangerous levels as judged by past experience later transformed them into investments, and the entire stock buying public into investors. The distinction between investment and speculation in common stocks has always been a useful one, and its disappearance is a cause for concern. We have often said that Wall Street as an institution would be well advised to reinstate this distinction and to emphasize it in all its dealings with the public. Otherwise, the stock exchanges may someday be blamed for heavy speculative losses, which those who suffered them had not been properly warned against. Ironically, once more, much of the recent financial embarrassment of some stock exchange firms seems to have come from the inclusion of speculative common stocks in their own capital funds. We trust that the reader of this book will gain a reasonably clear idea of the risks that are inherent in common stock commitments, risks which are inseparable from the opportunities of profit that they offer, and both of which must be allowed for in the investor's calculations. What we have just said indicates that there may no longer be such a thing as a Simon Pure investment policy comprising representative common stocks, in the sense that one can always wait to buy them at a price that involves no risk of a market or quotational loss large enough to be disquieting. In most periods, the investor must recognize the existence of a speculative factor in his common stock holdings. It is his task to keep this component within minor limits, and to be prepared financially and psychologically for adverse results that may be of short or long duration. 2 paragraphs should be added about stock speculation per se, as distinguished from the speculative component now inherent in most representative common stocks. Outright speculation is neither illegal, immoral, nor, for most people, fattening to the pocketbook. More than that, some speculation is necessary and unavoidable, for in many common stock situations there are substantial possibilities of both profit and loss, and the risks therein must be assumed by someone. There is intelligent speculation as there is intelligent investing. But there are many ways in which speculation may be unintelligent. Of these the foremost are, 1. Speculating when you think you are investing, 2. Speculating seriously instead of as a pastime, when you lack proper knowledge and skill for it, and 3. Risking more money in speculation than you can afford to lose. In our conservative view, every non-professional who operates on margin * should recognize that he is ipso facto speculating, and it is his broker's duty so to advise him. And everyone who buys a so-called hot common stock issue, or makes a purchase in any way similar thereto, is either speculating or gambling. Speculation is always fascinating, and it can be a lot of fun while you are ahead of the game. If you want to try your luck at it, put aside a portion, the smaller the better, of your capital in a separate fund for this purpose. Never add more money to this account just because the market has gone up and profits are rolling in. That's the time to think of taking money out of your speculative fund. Never mingle your speculative and investment operations in the same account, nor in any part of your thinking. Results to be expected by the defensive investor. We have already defined the defensive investor as one interested chiefly in safety plus freedom from bother. In general, what course should he follow and what return can he expect under average normal conditions if such conditions really exist? To answer these questions we shall consider first what we wrote on the subject 7 years ago, next what significant changes have occurred since then in the underlying factors governing the investor's expectable return, and finally what he should do and what he should expect under present-day, early 1972, conditions. 1. What we said 6 years ago. We recommended that the investor divide his holdings between high-grade bonds and leading common stocks, that the proportion held in bonds be never less than 25% or more than 75%, with the converse being necessarily true for the common stock component, that his simplest choice would be to maintain a 50-50 proportion between the two, with adjustments to restore the equality when market developments had disturbed it by as much as, say, 5%. As an alternative policy he might choose to reduce his common stock component to 25% if he felt the market was dangerously high, and conversely to advance it toward the maximum of 75% if he felt that a decline in stock prices was making them increasingly attractive. In 1965 the investor could obtain about 4.5% on high-grade taxable bonds and 3.14% on good tax-free bonds. The dividend return on leading common stocks, with the DJIA at 892, was only about 3.2%. This fact, and others, suggested caution. We implied that at normal levels of the market the investor should be able to obtain an initial dividend return of between 3.5% and 4.5% on his stock purchases, to which should be added a steady increase in underlying value, and in the normal market price, of a representative stock list of about the same amount, giving a return from dividends and appreciation combined of about 7.5% per year. The half-and-half division between bonds and stocks would yield about 6% before income tax. We added that the stock component should carry a fair degree of protection against a loss of purchasing power caused by large-scale inflation. It should be pointed out that the above arithmetic indicated expectation of a much lower rate of advance in the stock market than had been realized between 1949 and 1964. That rate had averaged a good deal better than 10% for listed stocks as a whole, and it was quite generally regarded as a sort of guarantee that similarly satisfactory results could be counted on in the future. Few people were willing to consider seriously the possibility that the high rate of advance in the past means that stock prices are now too high, and hence that the wonderful results since 1949 would imply not very good but bad results for the future. 2. What has happened since 1964? The major change since 1964 has been the rise in interest rates on first-grade bonds to record high levels, although there has since been a considerable recovery from the lowest prices of 1970. The obtainable return on good corporate issues is now about 7.5% and even more against 4.5% in 1964. In the meantime the dividend return on DJIA-type stocks had a fair advance also during the market decline of 1969-70, but as we write, with the Dow at 900, it is less than 3.5% against 3.2% at the end of 1964. The change in going interest rates produced a maximum decline of about 38% in the market price of medium-term, say 20-year, bonds during this period. There is a paradoxical aspect to these developments. In 1964 we discussed at length the possibility that the price of stocks might be too high and subject ultimately to a serious decline, but we did not consider specifically the possibility that the same might happen to the price of high-grade bonds. Neither did anyone else that we know of. We did warn, on p90 of the 1965 edition, that a long-term bond may vary widely in price in response to changes in interest rates. In the light of what has since happened, we think that this warning with attendant examples was insufficiently stressed. For the fact is that if the investor had a given sum in the DJIA at its closing price of 874 in 1964, he would have had a small profit thereon in late 1971, even at the lowest level, 631. In 1970 his indicated loss would have been less than that shown on good long-term bonds. On the other hand, if he had confined his bond-type investments to U.S. savings bonds, short-term corporate issues, or savings accounts, he would have had no loss in market value of his principal during this period, and he would have enjoyed a higher income return than was offered by good stocks. It turned out, therefore, that true cash equivalents proved to be better investments in 1964 than common stocks, in spite of the inflation experience that in theory should have favored stocks over cash. The decline in quoted principal value of good longer-term bonds was due to developments in the money market, an abstruse area which ordinarily does not have an important bearing on the investment policy of individuals. This is just another of an endless series of experiences over time that have demonstrated that the future of security prices is never predictable. Almost always bonds have fluctuated much less than stock prices, and investors generally could buy good bonds of any maturity without having to worry about changes in their market value. There were a few exceptions to this rule, and the period after 1964 proved to be one of them. We shall have more to say about change in bond prices in a later chapter. 3. Expectations and policy in late 1971 and early 1972. Toward the end of 1971 it was possible to obtain 8% taxable interest on good medium-term corporate bonds, and 5.7% tax-free on good state or municipal securities. In the shorter-term field, the investor could realize about 6% on U.S. government issues due in 5 years. In the latter case, the buyer need not be concerned about a possible loss in market value, since he is sure of full repayment, including the 6% interest return, at the end of a comparatively short holding period. The DJIA at its recurrent price level of 900 in 1971 yields only 3.5%. Let us assume that now, as in the past, the basic policy decision to be made is how to divide the fund between high-grade bonds, or other so-called cash equivalents, and leading DJIA-type stocks. What course should the investor follow under present conditions, if we have no strong reason to predict either a significant upward or a significant downward movement for some time in the future? First, let us point out that if there is no serious adverse change, the defensive investor should be able to count on the current 3.5% dividend return on his stocks and also on an average annual appreciation of about 4%. As we shall explain later, this appreciation is based essentially on the reinvestment by the various companies of a corresponding amount annually out of undistributed profits. On a before-tax basis, the combined return of his stocks would then average, say, 7.5%, somewhat less than his interest on high-grade bonds. On an after-tax basis, the average return on stocks would work out at some 5.3%. This would be about the same as is now obtainable on good tax-free medium-term bonds. These expectations are much less favorable for stocks against bonds than they were in our 1964 analysis. That conclusion follows inevitably from the basic fact that bond yields have gone up much more than stock yields since 1964. We must never lose sight of the fact that the interest and principal payments on good bonds are much better protected and therefore more certain than the dividends and price appreciation on stocks. Consequently, we are forced to the conclusion that now, toward the end of 1971, bond investment appears clearly preferable to stock investment. If we could be sure that this conclusion is right, we would have to advise the defensive investor to put all his money in bonds and none in common stocks until the current yield relationship changes significantly in favor of stocks. But of course we cannot be certain that bonds will work out better than stocks from today's levels. The reader will immediately think of the inflation factor as a potent reason on the other side. In the next chapter we shall argue that our considerable experience with inflation in the United States during this century would not support the choice of stocks against bonds at present differentials in yield. But there is always the possibility, though we consider it remote, of an accelerating inflation, which in one way or another would have to make stock equities preferable to bonds payable in a fixed amount of dollars. There is the alternative possibility, which we also consider highly unlikely, that American business will become so profitable, without stepped-up inflation, as to justify a large increase in common stock values in the next few years. Finally, there is the more familiar possibility that we shall witness another great speculative rise in the stock market without a real justification in the underlying values. Any of these reasons, and perhaps others we haven't thought of, might cause the investor to regret a 100% concentration on bonds even at their more favorable yield levels. Hence, after this foreshortened discussion of the major considerations, we once again enunciate the same basic compromise policy for defensive investors, namely that at all times they have a significant part of their funds in bond-type holdings and a significant part also in equities. It is still true that they may choose between maintaining a simple 50-50 division between the two components, or a ratio, dependent on their judgment, varying between a minimum of 25% and a maximum of 75% of either. We shall give our more detailed view of these alternative policies in a later chapter. Since at present the overall return envisaged from common stocks is nearly the same as that from bonds, the presently expectable return, including growth of stock values, for the investor would change little regardless of how he divides his fund between the two components. As calculated above, the aggregate return from both parts should be about 7.8% before taxes, or 5.5% on a tax-free, or estimated tax-paid, basis. A return of this order is appreciably higher than that realized by the typical conservative investor over most of the long-term past. It may not seem attractive in relation to the 14%, or so, return shown by common stocks during the 20 years of the predominantly bull market after 1949. But it should be remembered that between 1949 and 1969 the price of the DJIA had advanced more than fivefold while its earnings and dividends had about doubled. Hence the greater part of the impressive market record for that period was based on a change in investors' and speculators' attitudes rather than in underlying corporate values. To that extent it might well be called a bootstrap operation. In discussing the common stock portfolio of the defensive investor, we have spoken only of leading issues of the type included in the 30 components of the Dow Jones Industrial Average. We have done this for convenience, and not to imply that these 30 issues alone are suitable for purchase by him. Actually, there are many other companies of quality equal to or excelling the average of the Dow Jones list. These would include a host of public utilities, which have a separate Dow Jones average to represent them. But the major point here is that the defensive investor's overall results are not likely to be decisively different from one diversified or representative list than from another, or more accurately that neither he nor his advisors could predict with certainty whatever differences would ultimately develop. It is true that the art of skillful or shrewd investment is supposed to lie particularly in the selection of issues that will give better results than the general market. For reasons to be developed elsewhere, we are skeptical of the ability of defensive investors generally to get better than average results, which in fact would mean to beat their own overall performance. Our skepticism extends to the management of large funds by experts. Let us illustrate our point by an example that at first may seem to prove the opposite. Between December 1960 and December 1970 the DJIA advanced from 616 to 839, or 36%. But in the same period the much larger Standard & Poor's weighted index of 500 stocks rose from 58.11 to 92.15, or 58%. Obviously the second group had proved a better buy than the first. But who would have been so rash as to predict in 1960 that what seemed like a miscellaneous assortment of all sorts of common stocks would definitely outperform the aristocratic 30 tyrants of the Dow? All this proves, we insist, that only rarely can one make dependable predictions about price changes, absolute or relative. We shall repeat here without apology, for the warning cannot be given too often that the investor cannot hope for better than average results by buying new offerings, or hot issues of any sort, meaning thereby those recommended for a quick profit. The contrary is almost certain to be true in the long run. The defensive investor must confine himself to the shares of important companies with a long record of profitable operations and in strong financial condition. Any security analyst worth his salt could make up such a list. Aggressive investors may buy other types of common stocks, but they should be on a definitely attractive basis as established by intelligent analysis. To conclude this section, let us mention briefly 3 supplementary concepts or practices for the defensive investor. The first is the purchase of the shares of well-established investment funds as an alternative to creating his own common stock portfolio. He might also utilize one of the common trust funds, or commingled funds, operated by trust companies and banks in many states, or, if his funds are substantial, use the services of a recognized investment counsel firm. This will give him professional administration of his investment program along standard lines. The third is the device of dollar cost averaging, which means simply that the practitioner invests in common stocks the same number of dollars each month or each quarter. In this way he buys more shares when the market is low than when it is high, and he is likely to end up with a satisfactory overall price for all his holdings. Strictly speaking, this method is an application of a broader approach known as formula investing. The latter was already alluded to in our suggestion that the investor may vary his holdings of common stocks between the 25% minimum and the 75% maximum, in inverse relationship to the action of the market. These ideas have merit for the defensive investor, and they will be discussed more amply in later chapters. Results to be expected by the aggressive investor. Our enterprising security buyer, of course, will desire and expect to attain better overall results than his defensive or passive companion. But first he must make sure that his results will not be worse. It is no difficult trick to bring a great deal of energy, study, and native ability into Wall Street and to end up with losses instead of profits. These virtues, if channeled in the wrong directions, become indistinguishable from handicaps. Thus it is most essential that the enterprising investor start with a clear conception as to which courses of action offer reasonable chances of success and which do not. First, let us consider several ways in which investors and speculators generally have endeavored to obtain better than average results. These include: 1. Trading in the market. This usually means buying stocks when the market has been advancing and selling them after it has turned downward. The stocks selected are likely to be among those which have been behaving better than the market average. A small number of professionals frequently engage in short selling. Here they will sell issues they do not own but borrow through the established mechanism of the stock exchanges. Their object is to benefit from a subsequent decline in the price of these issues, by buying them back at a price lower than they sold them for. As our quotation from the Wall Street Journal here indicates, even small investors perish the term, sometimes try their unskilled hand at short selling. 2. Short-term selectivity. This means buying stocks of companies which are reporting or expected to report increased earnings, or for which some other favorable development is anticipated. 3. Long-term selectivity. Here the usual emphasis is on an excellent record of past growth, which is considered likely to continue in the future. In some cases also the investor may choose companies which have not yet shown impressive results, but are expected to establish a high earning power later. Such companies belong frequently in some technological area, e.g., computers, drugs, electronics, and they often are developing new processes or products that are deemed to be especially promising. We have already expressed a negative view about the investor's overall chances of success in these areas of activity. The first we have ruled out, on both theoretical and realistic grounds, from the domain of investment. Stock trading is not an operation which, on thorough analysis, offers safety of principal and a satisfactory return. More will be said on stock trading in a later chapter. In his endeavor to select the most promising stocks either for the near term or the longer future, the investor faces obstacles of two kinds, the first stemming from human fallibility and the second from the nature of his competition. He may be wrong in his estimate of the future, or even if he is right, the current market price may already fully reflect what he is anticipating. In the area of near-term selectivity, the current year's results of the company are generally common property on Wall Street. Next year's results, to the extent they are predictable, are already being carefully considered. Hence the investor who selects issues chiefly on the basis of this year's superior results, or on what he is told he may expect for next year, is likely to find that others have done the same thing for the same reason. In choosing stocks for their long-term prospects, the investor's handicaps are basically the same. The possibility of outright error in the prediction which we illustrated by our airlines example here is no doubt greater than when dealing with near-term earnings. Because the experts frequently go astray in such forecasts, it is theoretically possible for an investor to benefit greatly by making correct predictions when Wall Street as a whole is making incorrect ones. But that is only theoretical. How many enterprising investors could count on having the acumen or prophetic gift to beat the professional analysts at their favorite game of estimating long-term future earnings? We are thus led to the following logical if disconcerting conclusion: to enjoy a reasonable chance for continued better than average results, the investor must follow policies which are 1. Inherently sound and promising, and 2. Not popular on Wall Street. Are there any such policies available for the enterprising investor? In theory, once again, the answer should be yes, and there are broad reasons to think that the answer should be affirmative in practice as well. Everyone knows that speculative stock movements are carried too far in both directions, frequently in the general market and at all times in at least some of the individual issues. Furthermore, a common stock may be undervalued because of lack of interest or unjustified popular prejudice. We can go further and assert that in an astonishingly large proportion of the trading in common stocks, those engaged therein don't appear to know in polite terms one part of their anatomy from another. In this book we shall point out numerous examples of past discrepancies between price and value. Thus it seems that any intelligent person, with a good head for figures, should have a veritable picnic on Wall Street, battening off other people's foolishness. So it seems, but somehow it doesn't work out that simply. Buying a neglected and therefore undervalued issue for profit generally proves a protracted and patience-trying experience. And selling short a too popular and therefore overvalued issue is apt to be a test not only of one's courage and stamina but also of the depth of one's pocketbook. The principle is sound, its successful application is not impossible, but it is distinctly not an easy art to master. There is also a fairly wide group of special situations, which over many years could be counted on to bring a nice annual return of 20% or better, with a minimum of overall risk to those who knew their way around in this field. They include inter-security arbitrages, payouts or workouts in liquidations, protected hedges of certain kinds. The most typical case is a projected merger or acquisition which offers a substantially higher value for certain shares than their price on the date of the announcement. The number of such deals increased greatly in recent years, and it should have been a highly profitable period for the conoscenti. But with the multiplication of merger announcements came a multiplication of obstacles to mergers and of deals that didn't go through. Quite a few individual losses were thus realized in these once reliable operations. Perhaps, too, the overall rate of profit was diminished by too much competition *. The lessened profitability of these special situations appears one manifestation of a kind of self-destructive process akin to the law of diminishing returns which has developed during the lifetime of this book. In 1949 we could present a study of stock market fluctuations over the preceding 75 years, which supported a formula based on earnings and current interest rates for determining a level to buy the DJIA below its central or intrinsic value, and to sell out above such value. It was an application of the governing maxim of the Rothschilds, buy cheap and sell dear. And it had the advantage of running directly counter to the ingrained and pernicious maxim of Wall Street that stocks should be bought because they have gone up and sold because they have gone down. Alas, after 1949 this formula no longer worked. A second illustration is provided by the famous Dow theory of stock market movements, in a comparison of its indicated splendid results for 1897 to 1933 and its much more questionable performance since 1934. A third and final example of the golden opportunities not recently available, a good part of our own operations on Wall Street had been concentrated on the purchase of bargain issues easily identified as such by the fact that they were selling at less than their share in the net current assets, working capital, alone, not counting the plant account and other assets, and after deducting all liabilities ahead of the stock. It is clear that these issues were selling at a price well below the value of the enterprise as a private business. No proprietor or majority holder would think of selling what he owned at so ridiculously low a figure. Strangely enough, such anomalies were not hard to find. In 1957 a list was published showing nearly 200 issues of this type available in the market. In various ways practically all these bargain issues turned out to be profitable, and the average annual result proved much more remunerative than most other investments. But they too virtually disappeared from the stock market in the next decade, and with them a dependable area for shrewd and successful operation by the enterprising investor. However, at the low prices of 1970 there again appeared a considerable number of such sub-working capital issues, and despite the strong recovery of the market, enough of them remained at the end of the year to make up a full-sized portfolio. The enterprising investor under today's conditions still has various possibilities of achieving better than average results. The huge list of marketable securities must include a fair number that can be identified as undervalued by logical and reasonably dependable standards. These should yield more satisfactory results on the average than will the DJIA or any similarly representative list. In our view, the search for these would not be worth the investor's effort unless he could hope to add, say, 5% before taxes to the average annual return from the stock portion of his portfolio. We shall try to develop one or more such approaches to stock selection for use by the active investor. Commentary on Chapter 1. By Jason Zweig. If you don't know who you are, the stock market is an expensive place to find out. Adam Smith, George J. W. Goodman, 1. Before you buy any stock or other financial asset, the first thing to understand isn't what you are buying, but rather who you are. Are you an investor? The word invest comes from the Latin vestire, to clothe, surround, or envelop. To invest means to wrap yourself in a financial asset and hold it close. To do that, you should have a reasonable basis for confidence that you understand what you're doing based not on what other people say or do, but on your own careful research. As Graham writes, an investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. Point 2. Graham calls it an investment operation because investing is a process, not an event. It unfolds over years and decades. It depends on structured decision-making, in which every action you take conforms to criteria you have set in advance. It requires the discipline of thorough and consistent analysis, not just an impulsive swipe on your smartphone. The sources of return for an investment are intrinsic: the interest income of bonds, the earnings and dividends of stocks. An investor understands that a stock isn't a plaything, it's an ownership stake in an underlying business. And a stock can't go up persistently unless that business consistently generates more cash than it consumes. An investor never buys a stock merely because its price has been going up or sells it just because its price has been falling. An investor looks beyond the short-term behavior of the stock to evaluate the long-term health of the business. The investor asks, "What is this worth to me? How long can I hold it?" Are you a speculator? In the past few years, many investors lost their way. They became speculators, often without realizing it. To speculate comes from the Latin words speculum, mirror, and specula, watchtower. A speculator should look inward, in an act of self-reflection, as in a mirror, as well as forward into the future, like a sentry in a watchtower. Point 3. In practice, however, many speculators never look inward and barely look forward. Often, they buy just because other people are. Speculation unfolds over short horizons, months, weeks, sometimes hours, or even minutes. The sources of return for a speculation are extrinsic: who else owns an asset, how popular it is, whether its price has been rising or falling. The speculator asks, "What is this worth to somebody else? How soon can I sell it?" For many people, speculation is an endless cycle of emotional swings, beginning in doubt, progressing through hope and confidence to complacency and greed, falling into fear and despair, fading back into doubt, then starting all over again. It's a hamster wheel of trading on hunches, throwing money into stocks, options, and other assets and flipping them as soon as possible, just for the fun of it until it isn't fun anymore. All that is understandable. The urge to gamble is part of human nature. Our ancestors appear to have been gambling with dice at least 10,000 years ago. And speculation is exciting. Even a ridiculously remote chance of a big jackpot opens the gates of hope and possibility. Betting $1 on a 1 in a million long shot leaves you $1 poorer if you lose, as you almost certainly will. But if, against all odds, you happen to win, you will suddenly be $1 million richer and, you feel, your life will never be the same. What's more, the odds of making money speculating in the stock market are less adverse than the odds in a casino or the lottery. Investing as endeavor. To endeavor is to work conscientiously toward a specified goal or purpose. It is rooted in the French word devoir, or duty. Such a goal might be to buy a house, pay for your children's tuition, fund care for an aging parent, finance your retirement, or simply achieve the serenity of not needing to worry about money. You can't fulfill those purposes in a moment, with a single trade or one shrewd decision. Getting there takes years, even decades, of discipline and patience. That's why you should treat investing as an endeavor. Investing as entertainment. To be entertained is to have fun. And if you treat investing as entertainment, you probably will have fun for a while, anyway. But that joyride is likely to end in losses, leaving you farther away from your goals. Investing for entertainment can bring the thrill of a near miss, I came this close to being rich, or even the elation of hitting the jackpot. Part of what makes hitting the jackpot so exciting, though, is that losses occur much more often. The remote odds of nailing a giant winner can't provide the reliability you need to meet your long-term financial goals. The silence of the losers. Like eating and drinking and drugs and sex, speculation can be pleasurable in moderation. Overeat, though, and you can endanger your health. Drink too much, and you can become an alcoholic. Abuse drugs or sex, and you can become an addict or end up in prison. And if you speculate with more than a tiny portion of your money, you are likely to end up losing all of it. The odds in financial markets usually aren't fixed or predetermined. They depend partly on how many people are speculating and on how much money they are betting. The higher speculators drive the price of an asset in the present, the lower its returns are likely to be in the future. The more people speculate in the short run, the lower the odds that any one of them can profit in the long run. The more people start speculating, though, the more tempted you might be to give it a try. Everybody seems to be doing it, and some of them are getting rich. Most of the losers are too embarrassed to talk about their losses, while the winners all seem to be yelling through megaphones. Even if they don't know what they're talking about, people with extreme views seem more credible and trustworthy as they double down to escalate their commitment. After all, they put their money where their mouth is. So stories triumph over statistics. You can't avoid the boasting of the winners, while the evidence that most people have gotten wiped out never even comes to your attention. The hope of striking it rich feels especially appealing when big institutions that took reckless risks keep getting bailed out by the government. If they got away with taking shortcuts, why shouldn't you? If you're working hard but can't seem to get ahead, why not try gambling on stocks? And speculation is often habit-forming. The thrill of making money can quickly trap you in the cycle of addiction. Like someone with a substance abuse problem, you need a bigger fix each time to match the previous high, and losses simply make you crave gains even more. Every addict says, "I can quit anytime I want," but quitting can become all but impossible. Chasing the next short-term hit, you can lose sight of your long-term goals. You may end up flinging good money after bad until nothing is left. Free money. In 2020 and 2021, as the COVID pandemic raged, the stock market quickly turned into the biggest online video game ever played. More than 110 million people lost their jobs worldwide and were quarantined from their family and friends. Most businesses shut down, but stock markets were open. Governments squashed interest rates to zero and flooded the global economy with trillions of dollars in cash payments to individuals and companies. Trade-aholics. From the end of 2019 through early 2021, the online brokerage Robinhood grew from just over 5 million accounts to 18 million. That means roughly 13 million people, one out of every 25 Americans, opened a new account in 15 months. In the first quarter of 2021, those 18 million customers traded stocks, options, and cryptocurrencies an average of 7.6 million times per day. A Singapore-based online brokerage, Moomoo, reported in 2021 that its younger customers were trading an average of more than 140 times a year. According to Massachusetts regulators, Robinhood allowed one customer with no investment experience to make 12,748 trades in just over 6 months, an average of approximately 92 trades per day. 1. Even people who didn't trade as if their underpants were on fire had become obsessed. In 2020, Robinhood reported that customers who opened its app used it 7 times a day on average. Are you trading almost 150 times a year or checking on your accounts 7 times a day? Then you aren't an investor. You're an addict. You aren't just impairing your financial health, but your mental health as well. With nowhere to go and nothing to do with all that free money, people flung it into the financial markets. Everything went up. By late March 2021, the US stock market had gained 85% in 12 months, with the smallest stocks rising more than 120% on average. In fact, 96% of all US stocks had a positive total return over the prior 12 months. It was as if the stock market had become a slot machine that spewed out a jackpot on every play. Markets were roaring around the world. Over the year ending March 31, 2021, stocks in China gained 47%, Brazil 52%, Germany 67%, and India 84%. You could make good money on good stocks. You could make good money on bad stocks. Dogecoin, a cryptocurrency that was set up as a joke and served no practical purpose, gained more than 15,000% in the first 5 months of 2021. Why bother trying to distinguish good assets from bad? When knowing nothing pays off, why learn anything? I don't know what the F I'm doing. Such willful ignorance was typical. On the Reddit online forum Wall Street Bets, many members felt that carefully analyzing an investment made no sense, the group's founder, Jamie Rogozinski, said in 2020. They just regard the volatility as an opportunity for fun. They don't know what they're doing, and they don't care that they don't know what they're doing. In mid-2020, a sports blogger and self-described degenerate gambler named Dave Portnoy began live tweeting videos in which he bought any stock whose ticker symbol matched the letters he pulled randomly from a bag of Scrabble tiles. He often sold the stocks the same day he bought them, openly mocking the idea that learning anything about a company was worthwhile. 4. In early 2021, a bright-eyed young couple named Chad and Jenny became instant celebrities with a TikTok video on how to make money without working a 9-to-5 job. I see a stock going up and I buy it, said Chad with a cheerfully clueless shrug. And I just watch it until it stops going up, and then I sell it. And I do that over and over, and it pays for our whole lifestyle. I don't know what the F I'm doing, 22-year-old Danny Tran said in a TikTok video in January 2021. I just know I'm making money. He quickly racked up roughly 500,000 followers. Asked if he did any research before trading, Mr. Tran laughed, "When I tell you I don't know what the F I'm doing, I really mean it. It's all just a game to me." He added, "Knowing what you're doing would always be good, but in this market anything is possible. Something that is imitated." In 2020 and 2021, millions of novice traders stampeded into such meme stocks as AMC Entertainment Holdings, Bed Bath & Beyond, GameStop, and Virgin Galactic Holdings, regardless of the health of the underlying businesses. The term meme, coined by the biologist Richard Dawkins in 1976, is from the Greek mimema, something that is imitated. Everybody else was buying, and that was all that mattered. 5. For a few glorious months in 2020 and 2021, it worked. Then, one after another, these overpriced stocks shattered like overheated flashbulbs. While a few early buyers captured enormous profits, most people bought too late, paid too much, and bailed out near the bottom. One trader made $1.5 million treating the market like a casino only to lose it all, ending up working at a deli in Las Vegas for $14 an hour. 6. One of investing's few universal rules is this: whenever making money becomes effortlessly easy, keeping it is about to become extraordinarily hard. Protecting yourself from your worst enemy. I must warn you that attention runs throughout this book. Any attempt to beat the market is probably futile, especially when you can match the market with no effort and nearly no cost by buying and holding an index fund. On the other hand, it's human nature to hate settling for average, and trying to outweat the billion-brained market is an exciting challenge many people can't completely renounce. Our goal is to bridge that tension. You should feel no shame in settling for average. That makes you what Graham calls a defensive investor. Point 7. If, however, you are an enterprising investor who wants to try to outperform, you've set an improbable although not quite impossible goal. To stand a chance of achieving it, you will need to follow rules, policies, and procedures with rigorous discipline. If you still want to speculate, then the key is to contain it. See the sidebar here. Even the most cautious people can get a kick out of gambling every once in a while. That's fine, so long as you risk no more than you can afford to lose, and you are honest enough with yourself to know you probably will lose. But the heat of the moment can melt your resolve. That's why you must control your impulses and structure your decisions with the techniques we'll discuss in chapters 4, 5, 7, 11, and the accompanying commentaries. And what if you speculated and got burned so badly that you can finally admit you've hit bottom? Good for you. The rest of this book will map out how you can get on track as an investor and how to stay there. Mad money. If you have the urge to speculate, segregate it in a mad money account. Limit it to a maximum of 5% of your assets. That way, you can make a decent amount if any of your speculations pay off, but you won't lose a dangerous amount if they go to zero. Quarantine the mad money from the rest of your assets, in an isolated account at a different financial institution. No matter what happens, never add more money to it. Chapter 2. The Investor and Inflation. By Benjamin Graham. Subscribe, like and share our audiobook channel Trade Like Champions for more such contents. Happy investing. Inflation, and the fight against it, has been very much in the public's mind in recent years. The shrinkage in the purchasing power of the dollar in the past, and particularly the fear, or hope by speculators, of a serious further decline in the future, has greatly influenced the thinking of Wall Street. It is clear that those with a fixed dollar income will suffer when the cost of living advances, and the same applies to a fixed amount of dollar principal. Holders of stocks, on the other hand, have the possibility that a loss of the dollar's purchasing power may be offset by advances in their dividends and the prices of their shares. On the basis of these undeniable facts, many financial authorities have concluded that 1. Bonds are an inherently undesirable form of investment, and 2. Consequently, common stocks are by their very nature more desirable investments than bonds. We have heard of charitable institutions being advised that their portfolios should consist 100% of stocks and 0% of bonds. This is quite a reversal from the earlier days when trust investments were restricted by law to high-grade bonds, and a few choice preferred stocks. Our readers must have enough intelligence to recognize that even high-quality stocks cannot be a better purchase than bonds under all conditions, i.e., regardless of how high the stock market may be and how low the current dividend return compared with the rates available on bonds. A statement of this kind would be as absurd as was the contrary one too often heard years ago that any bond is safer than any stock. In this chapter we shall try to apply various measurements to the inflation factor, in order to reach some conclusions as to the extent to which the investor may wisely be influenced by expectations regarding future rises in the price level. In this matter, as in so many others in finance, we must base our views of future policy on a knowledge of past experience. Is inflation something new for this country, at least in the serious form it has taken since 1965? If we have seen comparable, or worse, inflations in living experience, what lessons can be learned from them in confronting the inflation of today? Let us start with Table 2 to 1, a condensed historical tabulation that contains much information about changes in the general price level and concomitant changes in the earnings and market value of common stocks. Our figures will begin with 1915, and thus cover 55 years, presented at 5-year intervals. We use 1946 instead of 1945 to avoid the last year of wartime price controls. The first thing we notice is that we have had inflation in the past, lots of it. The largest 5-year dose was between 1915 and 1920, when the cost of living nearly doubled. This compares with the advance of 15% between 1965 and 1970. In between, we have had 3 periods of declining prices and then 6 of advances at varying rates, some rather small. On this showing, the investor should clearly allow for the probability of continuing or recurrent inflation to come. Can we tell what the rate of inflation is likely to be? No clear answer is suggested by our table. It shows variations of all sorts. It would seem sensible, however, to take our cue from the rather consistent record of the past 20 years. The average annual rise in the consumer price level for this period has been 2.5%, that for 1965 to 1970 was 4.5%, that for 1970 alone was 5.4%. Official government policy has been strongly against large-scale inflation, and there are some reasons to believe that federal policies will be more effective in the future than in recent years. We think it would be reasonable for an investor at this point to base his thinking and decisions on a probable, far from certain, rate of future inflation of, say, 3% per annum. This would compare with an annual rate of about 2.5% for the entire period 1915-1970. 1. What would be the implications of such an advance? It would eat up, in higher living costs, about 1/2 the income now obtainable on good medium-term tax-free bonds, or our assumed after-tax equivalent from high-grade corporate bonds. This would be a serious shrinkage, but it should not be exaggerated. It would not mean that the true value, or the purchasing power, of the investor's fortune need be reduced over the years. If he spent half his interest income after taxes, he would maintain this buying power intact, even against a 3% annual inflation. But the next question, naturally, is, can the investor be reasonably sure of doing better by buying and holding other things than high-grade bonds, even at the unprecedented rate of return offered in 1970, 1971? Would not, for example, an all-stock program be preferable to a part bond, part stock program? Do not common stocks have a built-in protection against inflation, and are they not almost certain to give a better return over the years than will bonds? Have not in fact stocks treated the investor far better than have bonds over the 55-year period of our study? The answer to these questions is somewhat complicated. Common stocks have indeed done better than bonds over a long period of time in the past. The rise of the DJIA from an average of 77 in 1915 to an average of 753 in 1970 works out at an annual compounded rate of just about 4%, to which we may add another 4% for average dividend return. The corresponding figures for the S&P Composite are about the same. These combined figures of 8% per year are of course much better than the return enjoyed from bonds over the same 55-year period. But they do not exceed that now offered by high-grade bonds. This brings us to the next logical question: is there a persuasive reason to believe that common stocks are likely to do much better in future years than they have in the last 5.5 decades? Our answer to this crucial question must be a flat no. Common stocks may do better in the future than in the past, but they are far from certain to do so. We must deal here with 2 different time elements in investment results. The first covers what is likely to occur over the long-term future, say, the next 25 years. The second applies to what is likely to happen to the investor both financially and psychologically over short or intermediate periods, say 5 years or less. His frame of mind, his hopes and apprehensions, his satisfaction or discontent with what he has done, above all his decisions what to do next, are all determined not in the retrospect of a lifetime of investment but rather by his experience from year to year. On this point we can be categorical. There is no close time connection between inflationary, or deflationary, conditions and the movement of common stock earnings and prices. The obvious example is the recent period, 1966 to 1970. The rise in the cost of living was 22%, the largest in a 5-year period since 1946 to 1950. But both stock earnings and stock prices as a whole have declined since 1965. There are similar contradictions in both directions in the record of previous 5-year periods. Inflation and corporate earnings. Another and highly important approach to the subject is by a study of the earnings rate on capital shown by American business. This has fluctuated, of course, with the general rate of economic activity, but it has shown no general tendency to advance with wholesale prices or the cost of living. Actually, this rate has fallen rather markedly in the past 20 years in spite of the inflation of the period. To some degree the decline was due to the charging of more liberal depreciation rates. See Table 2-2. Our extended studies have led to the conclusion that the investor cannot count on much above the recent 5-year rate earned on the DJIA Group, about 10% on net tangible assets, book value, behind the shares. Point 2. Since the market value of these issues is well above their book value, say, 900 market versus 560 book in mid-1971, the earnings on current market price work out only at some 614%. This relationship is generally expressed in the reverse, or times earnings, manner, e.g., that the DJIA price of 900 equals 18 times the actual earnings for the 12 months ended June 1971. Our figures gear indirectly with the suggestion in the previous chapter * that the investor may assume an average dividend return of about 3.5% on the market value of his stocks, plus an appreciation of, say, 4% annually resulting from reinvested profits. Note that each dollar added to book value is here assumed to increase the market price by about $1.60. The reader will object that in the end our calculations make no allowance for an increase in common stock earnings and values to result from our projected 3% annual inflation. Our justification is the absence of any sign that the inflation of a comparable amount in the past has had any direct effect on reported per-share earnings. The cold figures demonstrate that all the large gain in the earnings of the DJIA unit in the past 20 years was due to a proportionately large growth of invested capital coming from reinvested profits. If inflation had operated as a separate favorable factor, its effect would have been to increase the value of previously existing capital. This in turn should increase the rate of earnings on such old capital and therefore on the old and new capital combined. But nothing of the kind actually happened in the past 20 years, during which the wholesale price level has advanced nearly 40%. Business earnings should be influenced more by wholesale prices than by consumer prices. The only way that inflation can add to common stock values is by raising the rate of earnings on capital investment. On the basis of the past record, this has not been the case. In the economic cycles of the past, good business was accompanied by a rising price level and poor business by falling prices. It was generally felt that a little inflation was helpful to business profits. This view is not contradicted by the history of 1950 to 1970, which reveals a combination of generally continued prosperity and generally rising prices. But the figures indicate that the effect of all this on the earning power of common stock capital, equity capital, has been quite limited. In fact, it has not even served to maintain the rate of earnings on the investment. Clearly there have been important offsetting influences which have prevented any increase in the real profitability of American corporations as a whole. Perhaps the most important of these have been, 1. A rise in wage rates exceeding the gains in productivity, and, 2. The need for huge amounts of new capital, thus holding down the ratio of sales to capital employed. Our figures in Table 2-2 indicate that so far from inflation having benefited our corporations and their shareholders, its effect has been quite the opposite. The most striking figures in our table are those for the growth of corporate debt between 1950 and 1969. It is surprising how little attention has been paid by economists and by Wall Street to this development. The debt of corporations has expanded nearly fivefold while their profits before taxes a little more than doubled. With the great rise in interest rates during this period, it is evident that the aggregate corporate debt is now an adverse economic factor of some magnitude and a real problem for many individual enterprises. Note that in 1950 net earnings after interest but before income tax were about 30% of corporate debt, while in 1969 they were only 13.2% of debt. The 1970 ratio must have been even less satisfactory. In sum, it appears that a significant part of the 11% being earned on corporate equities as a whole is accomplished by the use of a large amount of new debt costing 4% or less after tax credit. If our corporations had maintained the debt ratio of 1950, their earnings rate on stock capital would have fallen still lower, in spite of the inflation. The stock market has considered that the public utility enterprises have been a chief victim of inflation, being caught between a great advance in the cost of borrowed money and the difficulty of raising the rates charged under the regulatory process. But this may be the place to remark that the very fact that the unit costs of electricity, gas, and telephone services have advanced so much less than the general price index puts these companies in a strong strategic position for the future. 3. They are entitled by law to charge rates sufficient for an adequate return on their invested capital, and this will probably protect their shareholders in the future as it has in the inflations of the past. All of the above brings us back to our conclusion that the investor has no sound basis for expecting more than an average overall return of, say, 8% on a portfolio of DJIA-type common stocks purchased at the late 1971 price level. But even if these expectations should prove to be understated by a substantial amount, the case would not be made for an all-stock investment program. If there is one thing guaranteed for the future, it is that the earnings and average annual market value of a stock portfolio will not grow at the uniform rate of 4%, or any other figure. In the memorable words of the elder J.P. Morgan, they will fluctuate. This means, first, that the common stock buyer at today's prices or tomorrow's will be running a real risk of having unsatisfactory results therefrom over a period of years. It took 25 years for General Electric, and the DJIA itself, to recover the ground lost in the 1929-1932 debacle. Besides that, if the investor concentrates his portfolio on common stocks, he is very likely to be led astray either by exhilarating advances or by distressing declines. This is particularly true if his reasoning is geared closely to expectations of further inflation. For then, if another bull market comes along, he will take the big rise not as a danger signal of an inevitable fall, not as a chance to cash in on his handsome profits, but rather as a vindication of the inflation hypothesis and as a reason to keep on buying common stocks no matter how high the market level nor how low the dividend return. That way lies sorrow. Alternatives to common stocks as inflation hedges. The standard policy of people all over the world who mistrust their currency has been to buy and hold gold. This has been against the law for American citizens since 1935, luckily for them. In the past 35 years, the price of gold in the open market has advanced from $35 per ounce to $48 in early 1972, a rise of only 35%. but during all this time the holder of gold has received no income return on his capital, and instead has incurred some annual expense for storage. Obviously, he would have done much better with his money at interest in a savings bank, in spite of the rise in the general price level. The near-complete failure of gold to protect against a loss in the purchasing power of the dollar must cast grave doubt on the ability of the ordinary investor to protect himself against inflation by putting his money in things. Quite a few categories of valuable objects have had striking advances in market value over the years, such as diamonds, paintings by masters, first editions of books, rare stamps and coins, etc. But in many, perhaps most, of these cases there seems to be an element of the artificial or the precarious or even the unreal about the quoted prices. Somehow it is hard to think of paying $67,500 for a US silver dollar dated 1804, but not even minted that year, as an investment operation, for we acknowledge we are out of our depth in this area. Very few of our readers will find the swimming safe and easy there. The outright ownership of real estate has long been considered as a sound long-term investment, carrying with it a goodly amount of protection against inflation. Unfortunately, real estate values are also subject to wide fluctuations. Serious errors can be made in location, price paid, etc. There are pitfalls in salesmen's wiles. Finally, diversification is not practical for the investor of moderate means, except by various types of participations with others and with the special hazards that attach to new flotations not too different from common stock ownership. This too is not our field. All we should say to the investor is, be sure it's yours before you go into it. Conclusion. Naturally, we return to the policy recommended in our previous chapter. Just because of the uncertainties of the future, the investor cannot afford to put all his funds into one basket, neither in the bond basket, despite the unprecedentedly high returns that bonds have recently offered, nor in the stock basket, despite the prospect of continuing inflation. The more the investor depends on his portfolio and the income therefrom, the more necessary it is for him to guard against the unexpected and the disconcerting in this part of his life. It is axiomatic that the conservative investor should seek to minimize his risks. We think strongly that the risks involved in buying, say, a telephone company bond at yields of nearly 7.5% are much less than those involved in buying the DJIA at 900, or any stock list equivalent thereto. But the possibility of large-scale inflation remains, and the investor must carry some insurance against it. There is no certainty that a stock component will insure adequately against such inflation, but it should carry more protection than the bond component. This is what we said on the subject in our 1965 edition, p. 97, and we would write the same today. It must be evident to the reader that we have no enthusiasm for common stocks at these levels, 892 for the DJIA. For reasons already given, we feel that the defensive investor cannot afford to be without an appreciable proportion of common stocks in his portfolio, even if we regard them as the lesser of two evils, the greater being the risks in an all-bond holding. Commentary on Chapter 2. By Jason Zweig. A nickel ain't worth a dime anymore. Yogi Berra 1. For investors, inflation isn't an event. It's the environment. That was easy to forget over the long period, from 2009 to 2020, when the cost of living, at least as many governments measure it, barely budged. The money illusion. Investors tend to overreact to high inflation in the short run, while underreacting to low inflation in the long run. Most of us suffer from a fundamental misperception that psychologists call money illusion. Imagine three people, Amelia, Bella, and Charlotte. At different times, each inherited $500,000 and spent it all to buy a house, then sold the house 1 year later. During the year Amelia owned her house, severe deflation reduced the cost of living by 25%. At the end of that year, she sold the house for $385,000, or 23% less than she paid for it. During the year Bella owned her house, the cost of living didn't change, there was no inflation or deflation. At the end of that year, she sold the house for $495,000, or 1% less than she paid for it. During the year Charlotte owned her house, inflation ran at 25%. At the end of that year, she sold the house for $615,000, or 23% more than she paid for it. Who made the best deal? Who made the worst deal? Surveys suggest that most people will say Charlotte made out the best, followed by Bella, with Amelia coming out the worst. Yet Amelia did the best of all three. She's the only one who came out ahead after changes in the cost of living. Goods and services became 25% cheaper, but she sold her house for only 23% less than it cost her, leaving her 2% better off. That adjustment for the changing cost of living takes extra mental effort, whereas the nominal price unadjusted for inflation is obvious, simple, and salient. It's hard to ignore how much bigger $615,000 is than $500,000. Only if you stop to think about it, or grab a calculator, will you realize that Charlotte would have had to sell her house for $625,000 to break even after inflation. Point 2. Likewise, investors tend to forget that commonly cited investment returns don't adjust for inflation. Assuming that the cost of living will tend to rise by at least 3% per year in the long term, you should get in the habit of subtracting 3% annually from any expected return. Someone who projects that stocks will rise an average of 10% annually is really saying you should expect no more than 7% annually, net of inflation. To be an intelligent investor, you must counteract the money illusion. Keep your expectations realistic by always subtracting a plausible inflation rate from projected returns. But inflation never dies. The trick, for intelligent investors, is to defend against it without overreacting to it. Edges or hedges? Which financial assets provide the best protection against inflation? When inflation flares up, scary rhetoric can blind you to faulty logic, so be sure to base your decisions on statistics rather than stories. You are an egg. As you consider defending against inflation, sort your assets into 3 mental buckets. Financial capital consists of cash, bonds, stocks, publicly traded real estate, commodities, and other marketable assets. Some shield better than others against the rising costs of living. To protect you from inflation, financial capital should be liquid, or quickly and easily convertible into cash. Human capital is the present value of all the income that your job, career, and education will produce. By going back to school for another degree, studying for a professional certification, acquiring proficiency in a vital new skill, moonlighting in a part-time job, or starting your own business, you can augment your human capital and push the growth in your total income well past the rate of inflation. Don't invest too much of your financial capital in the same industry where your human capital is concentrated. When you're taking care not to put all your eggs in one basket, remember to count yourself among the eggs. Physical capital is your material possessions, your home, cars, farmland, or timberland, and fine collectibles like art, antiques, wine, jewelry, coins, or stamps. Over decades and even centuries, some physical or real assets have tended to hold their value during inflationary periods, particularly if they are high quality. They don't generate income, though. Don't forget to consider your human and physical capital when you're hedging against inflation. Otherwise, the investment industry's propaganda machine will fixate all your attention on your financial capital. That way, you'll be scared into buying funds tailored to look good and generate high fees when inflation heats up. Many such funds aren't liquid or don't generate income, limiting their usefulness as inflation fighters. Financial advisors and other investment marketers rarely remind clients of the basic fact. Graham emphasizes, an inflation hedging asset should earn consistently higher returns as the cost of living rises. By definition, then, it must earn consistently lower returns as the rate of inflation falls. An asset that does well when inflation is hot and when it is not would be an investment paradise. It's also an impossibility. Wall Street is not Shangri-La. Insurance isn't free. To insure against inflation, you must pay a price, just as you do to cover your car, home, and life. Here are the main ways to insure against inflation, each comes at a cost. Gold has served as a store of value for a remarkably long time. The same quantity of gold that a Roman centurion earned annually under Emperor Augustus, 27 BC to AD 14, would still have covered 1 year's pay for a U.S. Army captain more than 2,000 years later. 3. However, from 1900 through 2022, gold earned an average return of less than 0.8% annually after inflation, only slightly better than cash. 4. Had you invested $1,000 in gold on January 1, 1900, you'd have finished 2022 with about $2,500 compared with roughly $7,800 in US bonds and more than $2 million in stocks if you'd put the same $1,000 in each. Along the way, the price of gold swung up and down almost as erratically as stocks did, so it often lagged inflation instead of beating it. In 2021, as the cost of living surged, gold fell 3.5%. In 2022, with inflation breaking all modern records, the precious metal lost 0.4%. In 2023, as inflation fell, gold rose 13%. In the very long run, gold has been a good way to sustain purchasing power. In the shorter run, it's an unreliable way to hedge against inflation. I-bonds are savings bonds issued by the U.S. government whose interest rate adjusts twice a year to track the official rise in consumer prices. They are essentially risk-free. The U.S. Treasury guarantees to pay you your original money back, plus any inflation that has accrued along the way. That means your I-bonds will preserve their purchasing power for up to 30 years, no matter how much damage inflation does. They will not grow above the rate of inflation, though. I-bonds also have tax advantages. However, you can't easily invest more than $10,000 per year. They're available exclusively at treasurydirect.gov, and you aren't likely to be able to buy them unless you're a U.S. citizen or resident. You can't sell I-bonds at all for the first year, and you'll forfeit 3 months' interest if you sell within the first 5 years. While they offer excellent protection against inflation, I-bonds are imperfectly liquid and are hard to buy in bulk. 5. Inflation-linked bonds can also help cushion the rising cost of living. Called Treasury inflation-protected securities or TIPS in the U.S., linkers are issued by many other governments in Europe, Asia, Latin America, and elsewhere. Such bonds automatically adjust their principal, the amount that the issuer will repay you, by the maturity date as inflation rises and falls. Unfortunately, inflation-linked bonds can become overpriced and are hypersensitive to changes in interest rates. In 2022, U.S. TIPS lost 11%, and the longest-term TIPS, maturing in 30 years, fell more than 40%. In early 2024, though, long-term U.S. TIPS offered investors the opportunity to lock in a guaranteed return of at least 2% annually, after inflation, for the next 30 years. While that's a modest rate of growth above the rising cost of living, it was priced like an ultra-safe, Long-term insurance policy. If you're approaching retirement, when your wage income will cease and the value of your human capital will dwindle, inflation-protected bonds are an ideal way to guarantee that your financial capital will survive increases in the cost of living as you age. 6. Real estate is shelter, although it might not shelter you from inflation as well as you think. Between 1890 and 2014, the average growth rate of U.S. home prices was 0.3% annually after inflation, according to Yale University economist Robert Shiller. 7. Your house is a home, not a hedge. And commercial real estate is so sensitive to rising interest rates that it only partially protects against inflation. Stocks do fine when the cost of living rises moderately, up to about 4% annually. However, once inflation hits double digits, as it did in the US around the end of World Wars I and II and in the late 1970s, stocks perform abysmally, with real losses averaging more than 7% annually. The same has been true worldwide for more than a century, with stocks earning an average real return of less than 1% annually when inflation exceeds 7.5% and average real losses of nearly 10% annually when the cost of living rises in the high double digits. That certainly doesn't mean you should avoid stocks. An asset doesn't have to perform well all the time to perform well over time. When the rate of inflation moves up quickly and significantly, stocks will incur severe losses that can take years to recover from. Over very long periods, however, stocks have historically far outpaced the rise in consumer prices. 8. The all but certain short-term decline in the market value of stocks during an inflation spike is one price you must pay to capture their higher longer-term returns. Changes in the cost of living vary across time and nations, so it makes sense to keep a substantial portion of your stock portfolio in companies whose shares are listed in markets outside your home country. That can provide a source of return from assets whose values aren't being eroded as fast by inflation. Bitcoin has often been touted in recent years as a sort of digital terminator that can pulverize inflation. That's partly because the supply of this cryptocurrency is limited to 21 million units. After the last of those is created, no more will ever exist, which should mean that Bitcoin's value can't be diluted by too much issuance. By contrast, the supply of conventional, government-issued currencies is potentially unlimited, degrading their value over time. Fueled largely by such rhetoric, Bitcoin gained 94% in 2019, 308% in 2020, and 57% in 2021, according to Bitwise Asset Management. However, Bitcoin didn't even begin trading publicly until July 2010. You can't draw sweeping conclusions from returns over such a short history, especially because inflation was so low over most of that period. And in 2022, as inflation raged, Bitcoin fell far worse than most other assets, crashing by almost 2/3. At exactly the time when investors most urgently needed protection from inflation, Bitcoin deflated. In 2023, as inflation fell, Bitcoin soared more than 156% again, not what an inflation hedge should do. Will Bitcoin continue to provide high returns? That's anybody's guess. A superior cryptocurrency might arise later, making Bitcoin obsolete, although that seems unlikely. Software updates might introduce critical flaws, undermining confidence. Central banks could introduce their own digital currencies, marginalizing Bitcoin. Or its price might go into a protracted decline that feeds on itself, making Bitcoin's network less attractive. Rather than thinking of Bitcoin purely as money, consider it a scarce collectible that can also function as a currency, like gold. Possessing such a rare object gives collectors pride and pleasure even if the object no longer remains fashionable. That suggests that Bitcoin may retain some value even if it never becomes fully accepted as a currency. How much might it end up being worth? Bitcoin might turn out to be as stable a store of value, measured over centuries, as gold. Or it might resemble rare artwork, whose value tends to rise over time, but with extreme fluctuations along the way. Or Bitcoin might turn out to be almost as ephemeral as Beanie Babies, Cabbage Patch Kids, or pet rocks whose prices peaked in wild fads decades ago and have never recovered. Warren Buffett has joked that if he were teaching a class on valuing stocks, he would ask on the final exam how much a speculative internet company was worth. And anybody that gave me an answer, he quipped, I would flunk. By the same token, Bitcoin could someday end up being worth $1 million or more or next to nothing. That gamble just might pay off, but given Bitcoin's short history and wild volatility, its effectiveness as an inflation hedge remains unproven. Commodities are a popular but imperfect hedge. Leading commodity funds gained 20% to 30% or more in 2022, handily beating the rise in consumer prices. However, the returns on individual commodities vary wildly over time. Coal gained 161% in 2021, then lost 48% in 2022 and another 10% in 2023. Lithium lost 55% in 2019, fell another 38% in 2020, then gained an astonishing 443% in 2021 and another 72% in 2022. In 2023, it fell a ghastly 81%. Their popularity in recent years may have distorted the market in commodities, undermining their ability to combat future inflation. Over the longer run, a $1 investment in U.S. stocks in 1871 would have grown to $1,896 by the end of 2022. In commodities, it would have grown to only $744.90. In short, no single asset can fully protect against the rising cost of living. By supplementing a stock portfolio with a big slug of inflation-protected bonds, you can build your financial capital into a stronger bulwark. And your human capital and physical capital should bolster you, too. Chapter 3. A Century of Stock Market History, The Level of Stock Prices in Early 1972. By Benjamin Graham. Subscribe, like and share our audiobook channel Trade Like Champions for more such contents. Happy investing. The investor's portfolio of common stocks will represent a small cross-section of that immense and formidable institution known as the stock market. Prudence suggests that he have an adequate idea of stock market history, in terms particularly of the major fluctuations in its price level and of the varying relationships between stock prices as a whole and their earnings and dividends. With this background, he may be in a position to form some worthwhile judgment of the attractiveness or dangers of the level of the market as it presents itself at different times. By a coincidence, useful statistical data on prices, earnings, and dividends go back just 100 years, to 1871. The material is not nearly as full or dependable in the first half period as in the second, but it will serve. In this chapter we shall present the figures, in highly condensed form, with two objects in view. The first is to show the general manner in which stocks have made their underlying advance through the many cycles of the past century. The second is to view the picture in terms of successive 10-year averages, not only of stock prices but of earnings and dividends as well, to bring out the varying relationship between the three important factors. With this wealth of material as a background, we shall pass to a consideration of the level of stock prices at the beginning of 1972. The long-term history of the stock market is summarized in two tables and a chart. Table 3-1 sets forth the low and high points of 19 bear and bull market cycles in the past 100 years. We have used two indexes here. The first represents a combination of an early study by the Cowles Commission going back to 1870, which has been spliced onto and continued to date in the well-known Standard & Poor's Composite Index of 500 stocks. The second is the even more celebrated Dow Jones Industrial Average, the DJIA, or the Dow, which dates back to 1897. It contains 30 companies, of which one is American Telephone and Telegraph and the other 29 are large industrial enterprises. 1. Table 3-1 Major stock market swings between 1871 and 1971. Chart I, presented by courtesy of Standard & Poor's, depicts the market fluctuations of its 425 industrial stock index from 1900 through 1970. A corresponding chart available for the DJIA will look very much the same. The reader will note three quite distinct patterns, each covering about a third of the 70 years. The first runs from 1900 to 1924, and shows for the most part a series of rather similar market cycles lasting from 3 to 5 years. The annual advance in this period averaged just about 3%. We move on to the new era bull market, culminating in 1929, with its terrible aftermath of collapse, followed by quite irregular fluctuations until 1949. Comparing the average level of 1949 with that of 1924, we find the annual rate of advance to be a mere 1.5%, hence the close of our second period found the public with no enthusiasm at all for common stocks. By the rule of opposites, the time was ripe for the beginning of the greatest bull market in our history, presented in the last third of our chart. This phenomenon may have reached its culmination in December 1968 at 118 for Standard & Poor's 425 industrials, and 108 for its 500 stock composite. As Table 3-1 shows, there were fairly important setbacks between 1949 and 1968, especially in 1956-57 and 1961-62, but the recoveries therefrom were so rapid that they had to be denominated, in the long-accepted semantics, as recessions in a single bull market, rather than as separate market cycles. Between the low level of 162 for the Dow in mid-1949 and the high of 995 in early 1966, the advance had been more than six-fold in 17 years, which is at the average compounded rate of 11% per year, not counting dividends of, say, 3.5% per annum. The advance for the Standard & Poor's Composite Index was somewhat greater than that of the DJIA, actually from 14 to 96. These 14% and better returns were documented in 1963, and later, in a much publicized study *2, it created a natural satisfaction on Wall Street with such fine achievements, and a quite illogical and dangerous conviction that equally marvelous results could be expected for common stocks in the future. Few people seem to have been bothered by the thought that the very extent of the rise might indicate that it had been overdone. The subsequent decline from the 1968 high to the 1970 low was 36% for the Standard & Poor's Composite, and 37% for the DJIA, the largest since the 44% suffered in 1939 to 1942, which had reflected the perils and uncertainties after Pearl Harbor. In the dramatic manner so characteristic of Wall Street, the low level of May 1970 was followed by a massive and speedy recovery of both averages, and the establishment of a new all-time high for the Standard & Poor's Industrials in early 1972. The annual rate of price advance between 1949 and 1970 works out at about 9% for the S&P Composite, or the Industrial Index, using the average figures for both years. That rate of climb was, of course, much greater than for any similar period before 1950. But in the last decade the rate of advance was much lower, 5.14% for the S&P Composite Index and only the once familiar 3% for the DJIA. Chart 1. The record of price movements should be supplemented by corresponding figures for earnings and dividends, in order to provide an overall view of what has happened to our share economy over the 10 decades. We present a conspectus of this kind in our Table 3-2. It is a good deal to expect from the reader that he study all these figures with care, but for some we hope they will be interesting and instructive. Let us comment on them as follows. The full decade figures smooth out the year-to-year fluctuations and leave a general picture of persistent growth. Only 2 of the 9 decades after the first show a decrease in earnings and average prices, in 1891 to 1900 and 1931 to 1940, and no decade after 1900 shows a decrease in average dividends. But the rates of growth in all 3 categories are quite variable. In general, the performance since World War II has been superior to that of earlier decades, but the advance in the 1960s was less pronounced than that of the 1950s. Today's investor cannot tell from this record what percentage gain in earnings, dividends and prices he may expect in the next 10 years, but it does supply all the encouragement he needs for a consistent policy of common stock investment. However, a point should be made here that is not disclosed in our table. The year 1970 was marked by a definite deterioration in the overall earnings posture of our corporations. The rate of profit on invested capital fell to the lowest percentage since the World War years. Equally striking is the fact that a considerable number of companies reported net losses for the year, many became financially troubled, and for the first time in 3 decades there were quite a few important bankruptcy proceedings. These facts, as much as any others, have prompted the statement made above * that the Great Boom era may have come to an end in 1969 to 1970. A striking feature of Table 3-2 is the change in the price/earnings ratios since World War II. In June 1949 the S&P Composite Index sold at only 6.3 times the applicable earnings of the past 12 months, in March 1961 the ratio was 22.9 times. Similarly, the dividend yield on the S&P index had fallen from over 7% in 1949 to only 3% in 1961, a contrast heightened by the fact that interest rates on high-grade bonds had meanwhile risen from 2.6% to 4.5%. This is certainly the most remarkable turnabout in the public's attitude in all stock market history. To people of long experience and innate caution the passage from one extreme to another carried a strong warning of trouble ahead. They could not help thinking apprehensively of the 1926 to 1929 bull market and its tragic aftermath. But these fears have not been confirmed by the event. True, the closing price of the DJIA in 1970 was the same as it was 6½ years earlier, and the much heralded soaring 60s proved to be mainly a march up a series of high hills and then down again. But nothing has happened either to business or to stock prices that can compare with the bear market and depression of 1929 to 1932. Table 3-2 A picture of stock market performance, 1871, 1970. The following data based largely on figures appearing in N. Molodovsky's article, Stock Values and Stock Prices, Financial Analyst's Journal, May 1960. These, in turn, are taken from the Cowles Commission book Common Stock Indexes for years before 1926 and from the spliced-on Standard & Poor's 500 Stock Composite Index for 1926 to date. The annual growth rate figures are Molodovsky compilations covering successive 21-year periods ending in 1890, 1900, etc. See growth rate for 1968 to 1970 versus 1958 to 1960. These growth rate figures are for 1954 to 1956 versus 1947 to 1949. 1961 to 1963 versus 1954 to 1956, and for 1968 to 1970 versus 1958 to 1960. The stock market level in early 1972. With a century-long conspectus of stock, prices, earnings, and dividends before our eyes, let us try to draw some conclusions about the level of 900 for the DJIA and 100 for the S&P Composite Index in January 1972. In each of our former editions we have discussed the level of the stock market at the time of writing, and endeavored to answer the question whether it was too high for conservative purchase. The reader may find it informing to review the conclusions we reached on these earlier occasions. This is not entirely an exercise in self-punishment. It will supply a sort of connecting tissue that links the various stages of the stock market in the past 20 years and also a taken-from-life picture of the difficulties facing anyone who tries to reach an informed and critical judgment of current market levels. Let us, first, reproduce the summary of the 1948, 1953, and 1959 analyses that we gave in the 1965 edition. In 1948 we applied conservative standards to the Dow Jones level of 180, and found no difficulty in reaching the conclusion that it was not too high in relation to underlying values. When we approached this problem in 1953, the average market level for that year had reached 275, a gain of over 50% in 5 years. We asked ourselves the same question, namely, whether in our opinion the level of 275 for the Dow Jones Industrials was or was not too high for sound investment. In the light of the subsequent spectacular advance, it may seem strange to have to report that it was by no means easy for us to reach a definitive conclusion as to the attractiveness of the 1953 level. We did say, positively enough, that from the standpoint of value indications our chief investment guide, the conclusion about 1953 stock prices must be favorable. But we were concerned about the fact that in 1953, the averages had advanced for a longer period than in most bull markets of the past, and that its absolute level was historically high. Setting these factors against our favorable value judgment, we advised a cautious or compromise policy. As it turned out, this was not a particularly brilliant counsel. A good prophet would have foreseen that the market level was due to advance an additional 100% in the next 5 years. Perhaps we should add in self-defense that few if any of those whose business was stock market forecasting as ours was not had any better inkling than we did of what lay ahead. At the beginning of 1959 we found the DJIA at an all-time high of 584. Our lengthy analysis made from all points of view may be summarized in the following. From page 59 of the 1959 edition, in sum, we feel compelled to express the conclusion that the present level of stock prices is a dangerous one. It may well be perilous because prices are already far too high. But even if this is not the case, the market's momentum is such as inevitably to carry it to unjustifiable heights. Frankly, we cannot imagine a market of the future in which there will never be any serious losses, and in which every tyro will be guaranteed a large profit on his stock purchases. The caution we expressed in 1959 was somewhat better justified by the sequel than was our corresponding attitude in 1954. Yet it was far from fully vindicated. The DJIA advanced to 685 in 1961, then fell a little below our 584 level, to 566, later in the year, advanced again to 735 in late 1961, and then declined in near panic to 536 in May 1962, showing a loss of 27% within the brief period of 6 months. At the same time there was a far more serious shrinkage in the most popular growth stocks, as evidenced by the striking fall of the indisputable leader, International Business Machines, from a high of 607 in December 1961 to a low of 300 in June 1962. This period saw a complete debacle in a host of newly launched common stocks of small enterprises, the so-called hot issues, which had been offered to the public at ridiculously high prices and then had been further pushed up by needless speculation to levels little short of insane. Many of these lost 90% and more of the quotations asterisk in just a few months. The collapse in the first half of 1962 was disconcerting, if not disastrous, to many self-acknowledged speculators and perhaps to many more imprudent people who called themselves investors. But the turnabout that came later that year was equally unsuspected by the financial community. The stock market averages resumed their upward course, producing the following sequence. The recovery and new ascent of common stock prices was indeed remarkable and created a corresponding revision of Wall Street sentiment. At the low level of June 1962, predictions had appeared predominantly bearish, and after the partial recovery to the end of that year they were mixed, leaning to the skeptical side. But at the outset of 1964 the natural optimism of brokerage firms was again manifest, nearly all the forecasts were on the bullish side, and they so continued through the 1964 advance. We then approached the task of appraising the November 1964 levels of the stock market, 892 for the DJIA. After discussing it learnedly from numerous angles, we reached three main conclusions. The first was that old standards of valuation appear inapplicable, new standards have not yet been tested by time. The second was that the investor must base his policy on the existence of major uncertainties. The possibilities compass the extremes, on the one hand, of a protracted and further advance in the market's level, say by 50%, or to 1,350 for the DJIA, or, on the other hand, of a largely unheralded collapse of the same magnitude, bringing the average in the neighborhood of, say, 450, p. 63 of the 1965 edition. The third was expressed in much more definite terms. We said, speaking bluntly, if the 1964 price level is not too high, how could we say that any price level is too high? And the chapter closed as follows. What course to follow? Investors should not conclude that the 1964 market level is dangerous merely because they read it in this book. They must weigh our reasoning against the contrary reasoning they will hear from most competent and experienced people on Wall Street. In the end, each one must make his own decision and accept responsibility therefor. We suggest, however, that if the investor is in doubt as to which course to pursue, he should choose the path of caution. The principles of investment, as set forth herein, would call for the following policy under 1964 conditions, in order of urgency. 1. No borrowing to buy or hold securities. 2. No increase in the proportion of funds held in common stocks. 3. A reduction in common stock holdings where needed to bring it down to a maximum of 50% of the total portfolio. The capital gains tax must be paid with as good grace as possible, and the proceeds invested in first-quality bonds or held as a savings deposit. Investors who for some time have been following a bona fide dollar-cost averaging plan can in logic elect either to continue their periodic purchases unchanged or to suspend them until they feel the market level is no longer dangerous. We should advise rather strongly against the initiation of a new dollar averaging plan at the late 1964 levels, since many investors would not have the stamina to pursue such a scheme if the results soon after initiation should appear highly unfavorable. This time we can say that our caution was vindicated. The DJIA advanced about 11% further, to 995, but then fell irregularly to a low of 632 in 1970, and finished that year at 839. The same kind of debacle took place in the price of hot issues, i.e., with declines running as much as 90% as had happened in the 1961-62 setback. And, as pointed out in the introduction, the whole financial picture appeared to have changed in the direction of less enthusiasm and greater doubts. A single fact may summarize the story: the DJIA closed 1970 at a level lower than 6 years before, the first time such a thing had happened since 1944. Such were our efforts to evaluate former stock market levels. Is there anything we and our readers can learn from them? We considered the market level favorable for investment in 1948 and 1953, but too cautiously in the latter year, dangerous in 1959, at 584 for DJIA, and too high, at 892, in 1964. All of these judgments could be defended even today by adroit arguments. But it is doubtful if they have been as useful as our more pedestrian counsels in favor of a consistent and controlled common stock policy on the one hand, and discouraging endeavors to beat the market or to pick the winners on the other. Nonetheless, we think our readers may derive some benefit from a renewed consideration of the level of the stock market this time as of late 1971, even if what we have to say will prove more interesting than practically useful, or more indicative than conclusive. There is a fine passage near the beginning of Aristotle's Ethics that goes, "It is the mark of an educated mind to expect that amount of exactness which the nature of the particular subject admits. It is equally unreasonable to accept merely probable conclusions from a mathematician and to demand strict demonstration from an orator. The work of a financial analyst falls somewhere in the middle between that of a mathematician and of an orator." At various times in 1971 the Dow Jones Industrial Average stood at the 892 level of November 1964 that we considered in our previous edition. But in the present statistical study we have decided to use the price level and the related data for the Standard & Poor's Composite Index, or S&P 500, because it is more comprehensive and representative of the general market than the 30-stock DJIA. We shall concentrate on a comparison of this material near the 4 dates of our former editions, namely the year ends of 1948, 1953, 1958, and 1963 plus 1968. For the current price level we shall take the convenient figure of 100, which was registered at various times in 1971 and in early 1972. The salient data are set forth in Table 3-3. For our earnings figures we present both the last year's showing and the average of 3 calendar years. For 1971 dividends we use the last 12 months figures, and for 1971 bond interest and wholesale prices those of August 1971. The 3-year price/earnings ratio for the market was lower in October 1971 than at year-end 1963 and 1968. It was about the same as in 1958, but much higher than in the early years of the long bull market. This important indicator, taken by itself, could not be construed to indicate that the market was especially high in January 1972. But when the interest yield on high-grade bonds is brought into the picture, the implications become much less favorable. The reader will note from our table that the ratio of stock returns, earnings/price, to bond returns has grown worse during the entire period, so that the January 1972 figure was less favorable to stocks, by this criterion, than in any of the previous years examined. When dividend yields are compared with bond yields we find that the relationship was completely reversed between 1948 and 1972. In the early year stocks yielded twice as much as bonds. Now bonds yield twice as much, and more, than stocks. Our final judgment is that the adverse change in the bond yield/stock yield ratio fully offsets the better price/earnings ratio for late 1971, based on the 3-year earnings figures. Hence our view of the early 1972 market level would tend to be the same as it was some 7 years ago, i.e., that it is an unattractive one from the standpoint of conservative investment. This would apply to most of the 1971 price range of the DJIA, between, say, 800 and 950. In terms of historical market swings, the 1971 picture would still appear to be one of irregular recovery from the bad setback suffered in 1969 to 1970. In the past, such recoveries have ushered in a new stage of the recurrent and persistent bull market that began in 1949. This was the expectation of Wall Street generally during 1971. After the terrible experience suffered by the public buyers of low-grade common stock offerings in the 1968 to 1970 cycle, it is too early, in 1971, for another twirl of the new issue merry-go-round. Hence that dependable sign of imminent danger in the market is lacking now, as it was at the 892 level of the DJIA in November 1964, considered in our previous edition. Technically, then, the outlook would appear to favor another substantial rise far beyond the 900 DJIA level before the next serious setback or collapse. But we cannot quite leave the matter there, as perhaps we should. To us, the early 1971 market's disregard of the harrowing experiences of less than a year before is a disquieting sign. Can such heedlessness go unpunished? We think the investor must be prepared for difficult times ahead, perhaps in the form of a fairly quick replay of the 1969 to 1970 decline, or perhaps in the form of another bull market fling, to be followed by a more catastrophic collapse. Point 3. What course to follow? Turn back to what we said in the last edition, reproduced here. This is our view at the same price level, say 900 for the DJIA in early 1972 as it was in late 1964. Commentary on Chapter 3 by Jason Zweig. In my nearly 50 years of experience in Wall Street, I've found that I know less and less about what the stock market is going to do, but I know more and more about what investors ought to do. Benjamin Graham 1. What can the stock market's past tell us about the future? As Graham points out in Chapter 3, stocks generally go up over multi-decade periods, but the course is seldom smooth and never predictable. Reconciling yourself to that uncertainty can be troubling at first, but I promise to bring you hope in the end. Where you stand depends on where you sit. If you are in your working and saving years, you need to be accumulating wealth. Falling stock markets make it easier for you to buy more shares at lower prices for longer. Assuming stocks do ultimately recover, an early stretch of falling prices can function like rocket fuel to propel your wealth as you grow older. If you are retired and no longer earning a salary, however, you are decumulating, and a market decline can be a disaster. Unless you are able to rely on income from bonds, real estate, pensions, or Social Security or the equivalent, you will have to pay your expenses by selling some of your stocks. If you happen to sell into the teeth of a bear market, you will lock in permanent losses, and the more the market goes down, the more stocks you will have to sell to generate a constant stream of income. Stocks versus stocks. The problem with stocks is that the word contains the letter T. Take that away, and you have socks. If stocks were socks, people would view a 20% drop in price not as a sell-off but as a sale. Instead of panicking, people would be purchasing. When socks are 20% off, you don't feel a sudden urge to get rid of the ones you already own, you check your sock drawer to see if you need any. Young investors should learn to think of stocks like socks. Cape Fear. If you could determine when a crash will strike, you could sell at the top, step aside into the safety of cash, then buy back into stocks at the bottom. One measure has become a popular way to try making such predictions. This indicator, the cyclically adjusted price/earnings or CAPE ratio, divides the current price of the S&P 500 index by its average earnings over the past 10 years, adjusting both the price and the earnings for inflation. It was devised by Yale University finance professor Robert Shiller, partly inspired by Benjamin Graham himself. Many market commentators argue that when CAPE is higher than average, future returns will be below average. That makes intuitive sense. The more it costs you to buy stocks now, the less return you are likely to earn later. And a higher than average CAPE has tended to be followed by lower than average returns, as this scatter plot shows. Source: Robert Schiller, Yale University. That's a tendency, however. It isn't a law. As you can see in figure 3.1, after CAPE hit 40.4 in 1999, the lowest point at the far right, stocks went on to lose an average of 4.6% annually over the ensuing 10 years. And CAPE's 42.5 level in 2000, the second lowest point at the far right, preceded average annual losses of 3.5% over the following decade. Sometimes, though, high CAPEs foretell high not low returns. After the ratio hit 21.8 in 2011, stocks nevertheless gained an annual average of 11.4% in the next 10 years. This is one of several points clustered in the upper center of the figure, where both CAPE and subsequent long-term returns are above average. All these returns are after inflation. In late 2021, CAPE nearly reached 39, one of the highest levels on record and far above its average of 17.4 over its more than 140-year history. But that average has changed over time. Over the 30 years ending in 1910, CAPE averaged 17, over the next 3 decades, 12.7, over the 30 years after that, 15.7. Over the most recent 3 decades, it's averaged almost 27. History isn't static. It's unstable, changing continuously as the present gets absorbed into the past. So, when you compare CAPE to its past average, which past should you use? The last 140 years? The last 50? The last 30? The longer the period, the more you rely on data that might no longer be relevant. The shorter the period, the more the results will be skewed by the recent past, which could be an anomaly. The market is supposed to estimate the value of earnings, but the value of the earnings depends on people's perception of what they can sell it for, Professor Schiller says. Today's level might be high relative to history, he points out, but how do we know that history hasn't changed? Except for a brief period in late 2008 and early 2009, U.S. stocks have traded above their long-term average CAPE every month since late 1988. If you wanted stocks to become cheap again by the longest historical standards before you bought them, you would still be waiting more than 1/3 of a century later. In short, stocks that already seem overvalued can get even more expensive and stay that way for a bewilderingly long time. As Graham says, anyone who tries to reach an informed and critical judgment of current market levels faces extreme difficulties too. The simplest rule of thumb. To estimate the future long-term return on stocks, you can use the Gordon equation. Devised in the late 1950s by economist Myron Gordon, the formula assumes that market prices depend on the income and growth that stocks can produce. The stock market's future performance should approximate its current dividend yield plus the average rate at which dividends grow. In early 2024, the dividend yield on the S&P 500 index was 1.4%. Over the previous half-century, dividends grew 2.2% annually on average, adjusted for inflation. Add those two numbers and you get 3.6%. That's an imprecise but plausible estimate of the average annual return of stocks, after inflation, over the coming decades. While it's lower than the long-term historical average, it is likely to enable patient investors to reach their goals. 1. For further discussion, see William J. Bernstein, The 4 Pillars of Investing, McGraw-Hill, 2023. Stocks for the wrong run. Beginning in the 1990s, investors' minds were infected with a new belief: stocks aren't risky. By 2010, a survey of more than 2,200 investors found that 31% believed that stocks always do better than safe investments like cash and bonds over periods of 5 years or more. That notion is nonsense. It distorts history and misinterprets what risk means. Let's take the history first. In his book Stocks for the Long Run, first published in 1994, finance professor Jeremy Siegel argued that the risks in stocks are less than those found in bonds or even U.S. Treasury bills. He based his argument on data going back to 1802, suggesting that U.S. stocks had outperformed both bonds and cash over nearly every period of 20 years or more and had never lost money, after inflation, over such long periods. Point 3. That argument has at least 3 critical flaws. Inaccuracy. Correcting for survivorship bias, see sidebar here. Business professor Edward Macquarie has adjusted the historical record and found that stocks underperformed bonds in the US for most of the 19th century. Point 4. Bonds beat stocks in 1/3 of all 20-year periods since 1793, not in less than 1/10 of those periods, as Siegel claimed. In several other major markets around the world, bonds have outperformed stocks for decades on end. Incomparability. In the past, brokerage commissions and management fees were at least 10 times higher, and market tracking index funds didn't exist. Diversification was costly and cumbersome, making stocks riskier than they are now. Investors had to be compensated for that risk in the form of higher returns. Now that diversification is easy and cheap, stocks are less risky, so their future returns are likely to be lower. Impracticality. Historical rates of return assume that investors took the income from dividends and plowed it back into more shares, generating growth on top of growth. Until the late 1970s, though, investors rarely used their dividends to buy more shares. Instead, many took dividends as cash, which they saved or spent. It couldn't grow from being reinvested in the stock market. Point 5. Survivor. Imagine visiting a nursing home for retired lumberjacks and being struck by how old they are. You might conclude that the average worker in the logging industry lives to a ripe old age. What you should realize instead is that logging is one of the world's most dangerous occupations, and that you saw only the extreme outliers, the old and rare survivors, not a broad and typical sample. Your first impression was misleading, because you encountered no trace of the many loggers who tragically died young. Point 1. I'm describing survivorship bias, which overweights history's winners by overlooking the losers. It warps our perceptions of statistical evidence by painting an unrepresentative picture. It's like a rear-view mirror made of rose-colored glass. In the 19th century US, entire industries, such as wooden turnpikes and whale oil, steamboats, and stagecoaches, sprang up, shut down, and wiped investors out. Stock exchanges boomed and withered in Bisbee, Arizona, Charleston, South Carolina, Honolulu, Hawaii, Wheeling, West Virginia, and many other forgotten venues. Point 2. Investors lost real money, but the magic wand of survivorship waves those losses away. Correcting for this data bias would significantly reduce the early returns of stocks. Point 3. 1. According to the Bureau of Labor Statistics, bit.ly/43UD3TG, logging has the highest incidence of fatal job-related injuries of any occupation in the U.S. 2. Almost a century ago, scholars who tried tracking the earliest U.S. stocks warned that their cherry-picked indexes might fail to measure returns with the maximum accuracy desirable. Walter Buckingham Smith and Arthur Harrison Cole, Fluctuations in American Business, 1790 to 1860, bit.ly/3 nor y1a, pages 23 and 44. 3. From the start of the 20th century onward, stock market data and indexes like the S&P 500 are generally not contaminated with survivorship bias, although performance databases for mutual funds, as well as hedge funds and other alternative assets, often are. Risky business. History shows that the longer you hang on to stocks, the less their rate of return has varied. Over the long term, U.S. stocks have gone up by an average of roughly 10% annually, or about 7% after inflation. Even in the devastating bear market of 2007-09, when U.S. stocks fell more than 55%, their long-term average annual rate of return shrank only slightly, from 10.4% to 9.3%. If risk is the chance of deviating from the average historical rate of return, that has declined if you held stocks for decades. However, after a 55% crash, you need a 122% return just to get back to where you were. You are not going to be thinking, hey, stocks aren't risky. Their average rate of return since 1926 has only declined from 10.4% to 9.3%. Instead, you'll be thinking, if getting more than half my wealth eviscerated in 17 months isn't risk, what is? As we've seen from looking at CAPE, it's impossible to be certain when stocks are dangerously high. And if you buy at what turns out to be a peak, the long run might feel like eons. As Warren Buffett has noted about investing for the long run, people say that stocks have to be better than bonds, but I pointed out just the opposite, that all depends on the starting price. 6. People who bought the technology-heavy Nasdaq stock index in early 2000 didn't break even for more than 15 years. Japanese investors waited more than 3 decades to get back to that country's record-high stock prices of 1989. Worldwide, in such markets as France, Germany, Switzerland, Taiwan, and Thailand, stocks have sometimes earned negative returns after inflation for 20 years or more. 7. The belief that simply extending your holding period can eliminate the risk of stocks is bogus. Time might be your ally, but it also might turn out to be your enemy. A longer horizon gives you more opportunities to recover from crashes, but it also gives you more opportunities to experience them. You can't erase that risk, even if you hold stocks for a century. Investors hate uncertainty. Paradoxically, all this brings us to a place of hope. One of Wall Street's favorite sayings is investors hate uncertainty. But if you could ever be certain that stocks would have high returns, they wouldn't seem risky. And that perceived absence of risk would create more risk than ever. If stocks seemed certain to outperform, everyone would buy them, driving prices so high that there would be no room left for future growth, making a crash inevitable. That's exactly what happened in 1720 and 1929 and 2000, among many other occasions. Stocks are risky. Without any warning, after years of gains, you can lose an ungodly amount of money for an agonizingly long time. But the most subtle risk of owning stocks is that you can never be sure when they are overpriced or underpriced or how long it will take for them to return to normal. The only certainty you can derive from past financial data is that the future is always surprising. And it will most brutally surprise those who are the most certain they know what is about to happen. To be an intelligent investor, you must accept that stocks are likely but not certain to outperform over long periods. Instead of trying to build a portfolio that would thrive if what you think will happen does happen, strive to build a portfolio that should thrive no matter what happens. Stop fruitlessly trying to predict the unknowable. You will exert much more control by accepting how little you can control. That will free you up to establish policies and procedures to structure all the decisions over which you do have control. Chapter 4. General Portfolio Policy, The Defensive Investor. By Benjamin Graham. Subscribe, like and share our audiobook channel Trade Like Champions for more such contents. Happy investing. The basic characteristics of an investment portfolio are usually determined by the position and characteristics of the owner or owners. At one extreme we have had savings banks, life insurance companies, and so-called legal trust funds. A generation ago their investments were limited by law in many states to high-grade bonds and, in some cases, high-grade preferred stocks. At the other extreme we have the well-to-do and experienced businessman, who will include any kind of bond or stock in his security list provided he considers it an attractive purchase. It has been an old and sound principle that those who cannot afford to take risks should be content with a relatively low return on their invested funds. From this there has developed the general notion that the rate of return which the investor should aim for is more or less proportionate to the degree of risk he is ready to run. Our view is different. The rate of return sought should be dependent, rather, on the amount of intelligent effort the investor is willing and able to bring to bear on his task. The minimum return goes to our passive investor, who wants both safety and freedom from concern. The maximum return would be realized by the alert and enterprising investor who exercises maximum intelligence and skill. In 1965 we added, in many cases there may be less real risk associated with buying a bargain issue offering the chance of a large profit than with a conventional bond purchase yielding about 4.5%. This statement had more truth in it than we ourselves suspected, since in subsequent years even the best long-term bonds lost a substantial part of their market value because of the rise in interest rates. The basic problem of bond stock allocation. We have already outlined in briefest form the portfolio policy of the defensive investor. He should divide his funds between high-grade bonds and high-grade common stocks. We have suggested as a fundamental guiding rule that the investor should never have less than 25% or more than 75% of his funds in common stocks, with a consequent inverse range of between 75% and 25% in bonds. There is an implication here that the standard division should be an equal 1, or 50-50, between the two major investment mediums. According to tradition, the sound reason for increasing the percentage in common stocks would be the appearance of the bargain price levels created in a protracted bear market. Conversely, sound procedure would call for reducing the common stock component below 50% when in the judgment of the investor the market level has become dangerously high. These copybook maxims have always been easy to enunciate and always difficult to follow because they go against that very human nature which produces that excesses of bull and bear markets. It is almost a contradiction in terms to suggest as a feasible policy for the average stock owner that he lighten his holdings when the market advances beyond a certain point and add to them after a corresponding decline. It is because the average man operates, and apparently must operate, in opposite fashion that we have had the great advances and collapses of the past, and this writer believes we are likely to have them in the future. If the division between investment and speculative operations were as clear now as once it was, we might be able to envisage investors as a shrewd, experienced group who sell out to the heedless, hapless speculators at high prices and buy back from them at depressed levels. This picture may have had some verisimilitude in bygone days, but it is hard to identify it with financial developments since 1949. There is no indication that such professional operations as those of the mutual funds have been conducted in this fashion. The percentage of the portfolio held in equities by the two major types of funds, balanced and common stock, has changed very little from year to year. Their selling activities have been largely related to endeavors to switch from less to more promising holdings. If, as we have long believed, the stock market has lost contact with its old bounds, and if new ones have not yet been established, then we can give the investor no reliable rules by which to reduce his common stock holdings toward the 25% minimum and rebuild them later to the 75% maximum. We can urge that in general the investor should not have more than one-half in equities unless he has strong confidence in the soundness of his stock position and is sure that he could view a market decline of the 1969 to 70 type with equanimity. It is hard for us to see how such strong confidence can be justified at the levels existing in early 1972. Thus we would counsel against a greater than 50% apportionment to common stocks at this time. But, for complementary reasons, it is almost equally difficult to advise a reduction of the figure well below 50%, unless the investor is disquieted in his own mind about the current market level, and will be satisfied also to limit his participation in any further rise to, say, 25% of his total funds. We are thus led to put forward for most of our readers what may appear to be an oversimplified 50-50 formula. Under this plan, the guiding rule is to maintain as nearly as practicable an equal division between bond and stock holdings. When changes in the market level have raised the common stock component to, say, 55%, the balance would be restored by a sale of 1/11 of the stock portfolio and the transfer of the proceeds to bonds. Conversely, a fall in the common stock proportion to 45% would call for the use of 1/11 of the bond fund to buy additional equities. Yale University followed a somewhat similar plan for a number of years after 1937, but it was geared around a 35% normal holding in common stocks. In the early 1950s, however, Yale seems to have given up its once famous formula, and in 1969 held 61% of its portfolio in equities, including some convertibles. At that time the endowment funds of 71 such institutions, totaling $7.6 billion, held 60.3% in common stocks. The Yale example illustrates the almost lethal effect of the great market advance upon the once popular formula approach to investment. Nonetheless, we are convinced that our 50-50 version of this approach makes good sense for the defensive investor. It is extremely simple, it aims unquestionably in the right direction, it gives the follower the feeling that he is at least making some moves in response to market developments, most important of all. It will restrain him from being drawn more and more heavily into common stocks as the market rises to more and more dangerous heights. Furthermore, a truly conservative investor will be satisfied with the gains shown on half his portfolio in a rising market, while in a severe decline he may derive much solace from reflecting how much better off he is than many of his more venturesome friends. While our proposed 50-50 division is undoubtedly the simplest all-purpose program devisable, it may not turn out to be the best in terms of results achieved. Of course, no approach, mechanical or otherwise, can be advanced with any assurance that it will work out better than another. The much larger income return now offered by good bonds than by representative stocks is a potent argument for favoring the bond component. The investor's choice between 50% or a lower figure in stocks may well rest mainly on his own temperament and attitude. If he can act as a cold-blooded weigher of the odds, he would be likely to favor the low 25% stock component at this time, with the idea of waiting until the DJIA dividend yield was, say, 2/3 of the bond yield before he would establish his median 50-50 division between bonds and stocks. Starting from $900 for the DJIA and dividends of $36 on the unit, this would require either a fall in taxable bond yields from 7.5% to about 5.5% without any change in the present return on leading stocks, or a fall in the DJIA to as low as 660 if there is no reduction in bond yields and no increase in dividends. A combination of intermediate changes could produce the same buying point. A program of that kind is not especially complicated. The hard part is to adopt it and to stick to it, not to mention the possibility that it may turn out to have been much too conservative. The bond component. The choice of issues in the bond component of the investor's portfolio will turn about two main questions: should he buy taxable or tax-free bonds, and should he buy shorter or longer term maturities. The tax decision should be mainly a matter of arithmetic, turning on the difference in yields as compared with the investor's tax bracket. In January 1972, the choice in 20-year maturities was between obtaining, say, 7.5% on Grade A corporate bonds and 5.3% on prime tax-free issues. The term municipals is generally applied to all species of tax-exempt bonds, including state obligations. There was thus for this maturity a loss in income of some 30% in passing from the corporate to the municipal field. Hence, if the investor was in a maximum tax bracket higher than 30%, he would have a net saving after taxes by choosing the municipal bonds, the opposite, if his maximum tax was less than 30%. A single person starts paying a 30% rate when his income after deductions passes $10,000, for a married couple the rate applies when combined taxable income passes $20,000. It is evident that a large proportion of individual investors would obtain a higher return after taxes from good municipals than from good corporate bonds. The choice of longer versus shorter maturities involves quite a different question, viz., does the investor want to assure himself against a decline in the price of his bonds, but at the cost of 1. A lower annual yield and 2. Loss of the possibility of an appreciable gain in principal value? We think it best to discuss this question in Chapter 8. The investor and market fluctuations. For a period of many years in the past, the only sensible bond purchases for individuals were the U.S. savings issues. Their safety was and is unquestioned, they gave a higher return than other bond investments of first quality. They had a money-back option and other privileges which added greatly to their attractiveness. In our earlier editions we had an entire chapter entitled U.S. Savings Bonds, a boon to investors. As we shall point out, U.S. savings bonds still possess certain unique merits that make them a suitable purchase by any individual investor. For the man of modest capital with, say, not more than $10,000 to put into bonds, we think they are still the easiest and the best choice. But those with larger funds may find other mediums more desirable. Let us list a few major types of bonds that deserve investor consideration, and discuss them briefly with respect to general description, safety, yield, market price, risk, income tax status, and other features. 1. U.S. Savings Bonds, Series E and Series H. We shall first summarize their important provisions, and then discuss briefly the numerous advantages of these unique, attractive, and exceedingly convenient investments. The Series H bonds pay interest semi-annually, as do other bonds. The rate is 4.29% for the first year, and then a flat 5.1% for the next 9 years to maturity. Interest on the Series E bonds is not paid out, but accrues to the holder through increase in redemption value. The bonds are sold at 75% of their face value, and mature at 100% in 5 years 10 months after purchase. If held to maturity, the yield works out at 5%, compounded semi-annually. If redeemed earlier, the yield moves up from a minimum of 4.01% in the first year to an average of 5.2% in the next 4, 5, 6 years. Interest on the bonds is subject to federal income tax, but is exempt from state income tax. However, federal income tax on the Series E bonds may be paid at the holder's option either annually as the interest accrues, through higher redemption value, or not until the bond is actually disposed of. Owners of Series E bonds may cash them in at any time, shortly after purchase, at their current redemption value. Holders of Series H bonds have similar rights to cash them in at par value, cost. Series E bonds are exchangeable for Series H bonds, with certain tax advantages. Bonds lost, destroyed, or stolen may be replaced without cost. There are limitations on annual purchases, but liberal provisions for co-ownership by family members make it possible for most investors to buy as many as they can afford. Comment: there is no other investment that combines 1. Absolute assurance of principal and interest payments, 2. The right to demand full money back at any time, and 3. Guarantee of at least a 5% interest rate for at least 10 years. Holders of the earlier issues of Series E bonds have had the right to extend their bonds at maturity, and thus to continue to accumulate annual values at successively higher rates. The deferral of income tax payments over these long periods has been of great dollar advantage. We calculate it has increased the effective net after-tax rate received by as much as a third in typical cases. Conversely, the right to cash in the bonds at cost price or better has given the purchasers in former years of low interest rates complete protection against the shrinkage in principal value that befell many bond investors. Otherwise stated, it gave them the possibility of benefiting from the rise in interest rates by switching their low interest holdings into very high coupon issues on an even money basis. In our view, the special advantages enjoyed by owners of savings bonds now will more than compensate for their lower current return as compared with other direct government obligations. 2 other United States bonds. A profusion of these issues exists, covering a wide variety of coupon rates and maturity dates. All of them are completely safe with respect to payment of interest and principal. They are subject to federal income taxes but free from state income tax. In late 1971, the long-term issues over 10 years showed an average yield of 6.09%, intermediate issues, 3 to 5 years, returned 6.35%, and short issues returned 6.03%. In 1970 it was possible to buy a number of old issues at large discounts. Some of these are accepted at par in settlement of estate taxes. Example, the U.S. Treasury 3.5s due 1990 are in this category. They sold at 60 in 1970, but closed 1970 above 77. It is interesting to note also that in many cases the indirect obligations of the U.S. government yield appreciably more than its direct obligations of the same maturity. As we write, an offering appears of 7.05% of certificates fully guaranteed by the Secretary of Transportation of the Department of Transportation of the United States. The yield was fully 1% more than that on direct obligations of the U.S., maturing the same year, 1986. The certificates were actually issued in the name of the trustees of the Penn Central Transportation Co., but they were sold on the basis of a statement by the U.S. Attorney General that the guarantee brings into being a general obligation of the United States, backed by its full faith and credit. Quite a number of indirect obligations of this sort have been assumed by the U.S. government in the past, and all of them have been scrupulously honored. The reader may wonder why all this hocus-pocus, involving an apparently personal guarantee by our Secretary of Transportation, and a higher cost to the taxpayer in the end. The chief reason for the indirection has been the debt limit imposed on government borrowing by the Congress. Apparently guarantees by the government are not regarded as debts, a semantic windfall for shrewder investors. Perhaps the chief impact of this situation has been the creation of tax-free housing authority bonds, enjoying the equivalent of a U.S. guarantee, and virtually the only tax-exempt issues that are equivalent to government bonds. Another type of government-backed issues is the recently created new community debentures, offered to yield 7.6% in September 1971. 3 state and municipal bonds. These enjoy exemption from federal income tax. They are also ordinarily free of income tax in the state of issue but not elsewhere. They are either direct obligations of a state or subdivision, or revenue bonds dependent for interest payments on receipts from a toll road, bridge, building lease, etc. Not all tax-free bonds are strongly enough protected to justify their purchase by a defensive investor. He may be guided in his selection by the rating given to each issue by Moody's or Standard & Poor's. One of the three highest ratings by both services AAA, AA, or A should constitute a sufficient indication of adequate safety. The yield on these bonds will vary both with the quality and the maturity, with the shorter maturities giving the lower return. In late 1971 the issues represented in Standard & Poor's Municipal Bond Index averaged AA in quality rating, 20 years in maturity, and 5.78% in yield. A typical offering of Vineland, N.J., bonds, rated AA for A and gave a yield of only 3% on the 1-year maturity, rising to 5.8% to the 1995 and 1996 maturities. 1. 4 corporation bonds. These bonds are subject to both federal and state tax. In early 1972 those of highest quality yielded 7.19% for a 25-year maturity, as reflected in the published yield of Moody's AAA Corporate Bond Index. The so-called lower medium grade issues rated BAA returned 8.23% for long maturities. In each class shorter-term issues would yield somewhat less than longer-term obligations. Comment. The above summaries indicate that the average investor has several choices among high-grade bonds. Those in high income tax brackets can undoubtedly obtain a better net yield from good tax-free issues than from taxable ones. For others the early 1972 range of taxable yield would seem to be from 5% on U.S. savings bonds, with their special options, to about 7.5% on high-grade corporate issues. Higher yielding bond investments. By sacrificing quality an investor can obtain a higher income return from his bonds. Long experience has demonstrated that the ordinary investor is wiser to keep away from such high-yield bonds. While, taken as a whole, they may work out somewhat better in terms of overall return than the first quality issues, they expose the owner to too many individual risks of untoward developments, ranging from disquieting price declines to actual default. It is true that bargain opportunities occur fairly often in lower grade bonds, but these require special study and skill to exploit successfully. Asterisk. Perhaps we should add here that the limits imposed by Congress on direct bond issues of the United States have produced at least two sorts of bargain opportunities for investors in the purchase of government-backed obligations. One is provided by the tax-exempt new housing issues, and the other by the recently created, taxable, new community debentures. An offering of new housing issues in July 1971 yielded as high as 5.8%, free from both federal and state taxes, while an issue of taxable, new community debentures sold in September 1971 yielded 7.6%. Both obligations have the full faith and credit of the United States government behind them and hence are safe without question. And on a net basis they yield considerably more than ordinary United States bonds. Asterisk. Savings deposits in lieu of bonds. An investor may now obtain as high an interest rate from a savings deposit in a commercial or savings bank, or from a bank certificate of deposit, as he can from a first-grade bond of short maturity. The interest rate on bank savings accounts may be lowered in the future, but under present conditions they are a suitable substitute for short-term bond investment by the individual. Asterisk. Convertible issues. These are discussed in Chapter 16. The price variability of bonds in general is treated in Chapter 8, the investor and market fluctuations. Call provisions. In previous editions we had a fairly long discussion of this aspect of bond financing, because it involved a serious but little noticed injustice to the investor. In the typical case bonds were callable fairly soon after issuance. and at modest premiums, say 5% above the issue price *. This meant that during a period of wide fluctuations in the underlying interest rates, the investor had to bear the full brunt of unfavorable changes and was deprived of all but a meager participation in favorable ones. Example: our standard example has been the issue of American Gas and Electric 100-year 5% debentures, sold to the public at 101 in 1928. 4 years later, under near-panic conditions, the price of these good bonds fell to 62.5, yielding 8%. By 1946, in a great reversal, bonds of this type could be sold to yield only 3%, and the 5% issue should have been quoted at close to 160. But at that point the company took advantage of the call provision and redeemed the issue at a mere 106. The call feature in these bond contracts was a thinly disguised instance of heads I win, tails you lose. At long last, the bond-buying institutions refused to accept this unfair arrangement. In recent years, most long-term high-coupon issues have been protected against redemption for 10 years or more after issuance. This still limits their possible price rise, but not inequitably. In practical terms, we advise the investor in long-term issues to sacrifice a small amount of yield to obtain the assurance of non-callability, say for 20 or 25 years. Similarly, there is an advantage in buying a low-coupon bond * at a discount rather than a high-coupon bond selling at about par and callable in a few years. For the discount, e.g., of a 3.5% bond at 63.5%, yielding 7.85%, carries full protection against adverse call action. Straight, i.e., non-convertible preferred stocks. Certain general observations should be made here on the subject of preferred stocks. Really good preferred stocks can and do exist, but they are good in spite of their investment form, which is an inherently bad one. The typical preferred shareholder is dependent for his safety on the ability and desire of the company to pay dividends on its common stock. Once the common dividends are omitted, or even in danger, his own position becomes precarious, for the directors are under no obligation to continue paying him unless they also pay on the common. On the other hand, the typical preferred stock carries no share in the company's profits beyond the fixed dividend rate. Thus the preferred holder lacks both the legal claim of the bondholder, or creditor, and the profit possibilities of a common shareholder, or partner. These weaknesses in the legal position of preferred stocks tend to come to the fore recurrently in periods of depression. Only a small percentage of all preferred issues are so strongly entrenched as to maintain an unquestioned investment status through all vicissitudes. Experience teaches that the time to buy preferred stocks is when their price is unduly depressed by temporary adversity. At such times they may be well suited to the aggressive investor but too unconventional for the defensive investor. In other words, they should be bought on a bargain basis or not at all. We shall refer later to convertible and similarly privileged issues, which carry some special possibilities of profits. These are not ordinarily selected for a conservative portfolio. Another peculiarity in the general position of preferred stocks deserves mention. They have a much better tax status for corporation buyers than for individual investors. Corporations pay income tax on only 15% of the income they receive in dividends, but on the full amount of their ordinary interest income. Since the 1972 corporate rate is 48%, this means that $100 received as preferred stock dividends is taxed only $7.20, whereas $100 received as bond interest is taxed $48. On the other hand, individual investors pay exactly the same tax on preferred stock investments as on bond interest, except for a recent minor exemption. Thus, in strict logic, all investment-grade preferred stocks should be bought by corporations, just as all tax-exempt bonds should be bought by investors who pay income tax *. Security forms. The bond form and the preferred stock form, as hitherto discussed, are well understood and relatively simple matters. A bondholder is entitled to receive fixed interest and payment of principal on a definite date. The owner of a preferred stock is entitled to a fixed dividend, and no more, which must be paid before any common dividend. His principal value does not come due on any specified date. The dividend may be cumulative or non-cumulative. He may or may not have a vote. The above describes the standard provisions and, no doubt, the majority of bond and preferred issues, but there are innumerable departures from these forms. The best known types are convertible and similar issues, and income bonds. In the latter type, interest does not have to be paid unless it is earned by the company. Unpaid interest may accumulate as a charge against future earnings, but the period is often limited to 3 years. Income bonds should be used by corporations much more extensively than they are. Their avoidance apparently arises from a mere accident of economic history, namely, that they were first employed in quantity in connection with railroad reorganizations, and hence they have been associated from the start with financial weakness and poor investment status. But the form itself has several practical advantages, especially in comparison with and in substitution for the numerous, convertible, preferred stock issues of recent years. Chief of these is the deductibility of the interest paid from the company's taxable income, which in effect cuts the cost of that form of capital in half. From the investor's standpoint, it is probably best for him in most cases that he should have, 1. An unconditional right to receive interest payments when they are earned by the company, and, 2. A right to other forms of protection than bankruptcy proceedings if interest is not earned and paid. The terms of income bonds can be tailored to the advantage of both the borrower and the lender in the manner best suited to both. Conversion privileges can, of course, be included. The acceptance by everybody of the inherently weak preferred stock form and the rejection of the stronger income bond form is a fascinating illustration of the way in which traditional institutions and habits often tend to persist on Wall Street despite new conditions calling for a fresh point of view. With every new wave of optimism or pessimism, we are ready to abandon history and time-tested principles, but we cling tenaciously and unquestioningly to our prejudices. Commentary on Chapter 4. By Jason Zweig. Not being able to rule events, I rule myself, and adapt myself to them if they do not adapt themselves to me. Michel de Montaigne 1. The hardest part of being a defensive investor is defending yourself from yourself. Most conventional investing wisdom focuses on what to do. Intelligent investors focus most of their energy on what not to do. This is not a test. How much risk should you take? The conventional answer depends on what financial advisors call your risk tolerance, a nebulous concept they often measure by asking you as few as a half-dozen questions, including this nonsensical favorite: if the stock market dropped 20%, would you sell, hold, or buy more? When markets are calm, it's easy to say you'd buy more in a market crash, the same way you might say of course you'd rush into a burning building to rescue the people inside. However, saying you'll run into a burning building is a lot easier than running into a burning building. And saying you'll buy stocks in a market crash is a lot easier than doing it. A market crash is not a quiz. When every stock price is blazing blue red on your phone, the headlines are apocalyptic, market pundits are shrieking on television that you should sell everything before it's too late, and your family is begging you to stop throwing money into the flames, buying more isn't an act of bravado, it's terrifying. Your tolerance for risk doesn't stay constant most of your life. It might not even stay constant from hour to hour. That's why Graham warns against picking your portfolio based on how much risk you, or your financial advisor, think you can stomach. Your risk tolerance is out of control. Economists and psychologists have shown that how much financial risk you're willing to take at any moment depends on how well the stock market has done lately, how well your own investments have done lately, whether you're investing alone or as part of a group, whether you're feeling happy, angry, sad, anxious, fearful, or disgusted, how much money you had between the ages of 18 and 25, which country or culture you come from, whether stock prices end in the digits 4, 8, or 9, where you got the money you're investing, what time of year it is, what time of day it is, how well you slept, how long ago you last ate, whether the sun is shining, how recently you read about an airplane crash, whether your favorite sports team won or lost the big game. These are just a few of the factors that have been identified. They're all a reminder that, without policies and procedures to guide you, you will be at the mercy of the market's ever-changing moods and your own. Point 1. L.Q. Weber and Joaquin Clement, Risk Tolerance and Circumstances, bit.ly/45DJZP1. Defensive versus enterprising. Based on the faulty assumption that people's risk tolerance is stable, financial advisors often offer conservative, moderate, or aggressive portfolios whose riskiness is defined by their exposure to stocks. A conservative portfolio might have no more than 40% in stocks, a moderate allocation, 60%, an aggressive basket, 80% or more. Graham thinks this is ludicrous. When the stock market soars, conservative investors forget they ever wanted protection against loss. They become consumed with envy over the gains they would have earned if only they'd had more than that measly 40% in stocks. Desperate to make up for lost time, sick of listening to other people brag about getting rich, they buy stocks urgently right before a crash. After the market crashes, aggressive investors forget their original goal of making as much money as possible. Reeling from the wreckage of their wealth, they flee stocks and rush into the safety of cash. Brave as lions when stocks were expensive, they morph into mice when stocks become cheap. Instead of using phony notions about risk tolerance, Graham draws a different distinction. How much risk you should take depends on how much time and the amount of intelligent effort you're willing and able to put into investing. If you're too busy or don't feel qualified to put in much more time and effort than it takes to read this book, then Graham wants you to consider yourself a defensive investor. That means you don't have to bother working hard at it. That doesn't mean being a defensive investor is easy. You will need to muster the discipline to follow an investment policy statement, see here. You also must accept that bull markets will leave you behind, that someone you know will always be making more money than you, and above all that you don't know and don't care what the financial markets are going to do. But you should feel no shame whatsoever in deciding you're a defensive investor. It isn't a confession of weakness, an abdication of responsibility, or an admission that you aren't smart or skillful. It's simply a recognition that incurring higher fees and costs in pursuit of superior returns is a waste of money unless you can also commit the time and effort it takes to be an enterprising investor. On the other hand, if you enjoy studying businesses and analyzing financial statements, then you probably are an enterprising investor. You, too, will need a formal investment policy. And you will have to invest not only your money but also a lot of your time and energy. First, you will have to probe deeply into any investment before you make it, and so long as you continue to own it. You will have to analyze yourself even more deeply, creating a continuous learning environment that will enable you to identify your mistakes, benefit from feedback, and develop and follow consistent rules. Point 2. The beauty of Graham's distinction between defensive and enterprising investors is that unlike your purported risk tolerance, it isn't prone to change just because the markets make a big move up or down. A defensive investor is much less likely than a conservative investor to suffer the fear of missing out when stocks soar, and an enterprising investor is much more likely than an aggressive one to remain disciplined when stocks crumble. Better questions. Here are some questions that can help you start getting honest answers about how much money you should have in stocks. What are my circumstances, preferences, and objectives? Age. Marital status. Income or earnings potential of spouse or partner. Expected job security. Do I own, rent, or plan to buy a home? Do I or will I have children and tuition to pay? Will I inherit money or will I need to provide for my parents? How ample is my employer-sponsored retirement plan? How reliant am I on my investments to produce regular income? How much physical capital do I have? How much can I make my human capital grow? See here. What did I do during past down markets? The best guide to how you'll behave in the next crash is how you behaved in the last one. We all tend to rewrite our own history, making ourselves braver in memory than we were in reality. If you can recall the financial crisis of 2008-09, you may well believe you bought more stock when, in fact, you sold or froze. You might also feel you bought more during the COVID crash of 2020 when you were, in real time, too scared to do anything. Dig up your old account statements. If you sold or sat on your hands in past crashes, you probably will in the next one. Don't raise your stock exposure now above where it was then. How flexible are my goals? Your ability to withstand risk depends partly on how much money you have and can earn, but also on how much control you have over the timing of your future spending. If you can't defer buying that expensive house or your children must attend private schools, your capacity for taking risk is more limited than your cash balance might imply. Always having enough cash to cover at least 6 to 12 months of your spending needs will improve your flexibility. How well do I understand the risks in the rest of my portfolio? Many financial advisors have talked their clients into assets like emerging market debt, bank loan funds, and non-traded real estate. In a crisis, these income-producing but risky investments may go down at least as much as U.S. stocks. Long-term bonds, even U.S. Treasuries, will suffer steep losses if interest rates rise. Trendy holdings such as private equity, venture capital, hedge funds, and other alternative assets can be difficult to sell if you need cash in a hurry. If such investments have supplanted cash and short to medium-term government bonds in your portfolio, you're less able to withstand a stock crash than you think. Have I turned rules into habits? It's human nature to believe, when times are calm, that you will do the right thing in the heat of the moment. In a market crash, however, willpower is worthless. You can stay calm only if you have practiced beneficial rules until they've become good habits. If you check the value of your portfolio multiple times a day during a bull market, you've formed a toxic habit and you're kidding yourself if you think you won't freak out and sell during a bear market. The ABCs of an IPS. An investment policy statement, or IPS, is a formal document that spells out your investing circumstances, preferences, and goals. It explains how you plan to achieve your objectives, make significant decisions, and measure your progress. It also serves as a constant reminder of what you're committing not to do. Every IPS, like every investor, is unique. You should customize the following generic template to your own needs and circumstances, changing it as much as necessary. Point 3. Start with a mission statement. The primary objective of this portfolio is long-term growth. With an ultimate horizon of ______ years, to help fund the coming decade's expenses for ourselves, for our children, and for our grandchildren. We will pursue this goal with patience and prudence, taking no unnecessary risks and never seeking to maximize short-term returns. The secondary objective will be to provide regular income. The primary decision makers will be underscore 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 and underscore 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 underscore. Then spell out structure. The portfolio will be broadly diversified. Based on a careful review of our objectives, constraints, and reasonable expectations for returns on the following assets, it will allocate underscore underscore percent to cash, underscore underscore percent to bonds, underscore underscore percent to US stocks, underscore underscore percent to international stocks, underscore underscore percent to public real estate, and underscore underscore percent to underscore 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 underscore. Each allocation will be broadly diversified, with a minimum of underscore 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 underlying holdings. We will never use margin or other borrowed money. Point 4. We will maintain enough cash to cover at least 6 months of expenses. Then describe implementation. We will bolster our patience by rebalancing underscore 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 times per year and by dollar cost averaging. We will select mutual funds, ETFs, and other investments by the lowest cost, not by the highest return. Total annual expenses, including all fees and trading costs, must not exceed 1%. We will never buy any asset only because its price has gone up or sell only because its price has gone down. All purchases and sales must fully conform to the criteria in our checklist, which must be filled out before any trade. If we have a mad money account, it will be funded with no more than 5% of our financial capital and will be segregated at a separate financial institution from the rest of our assets. Under no circumstances of either gain or loss can we add more money to it. Point 5. Finally, discuss monitoring. We will update the value of all our holdings no more than 4 times a year. We will measure performance relative to the underscore 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 benchmarks, evaluating multi-year returns first and recent returns last. Once a year we will review this IPS to consider whether our circumstances, preferences, or objectives have changed. Any departure from this IPS must be justified in writing and agreed to by everyone who is a party to it. I've often suggested, only half-jokingly, that investors should keep the printed original of their IPS in one of those red emergency boxes labeled "in case of fire, break glass." If you can't rewrite any detail of the document unless you first smash open its glass case with a hammer, you'll hesitate before impulsively changing it the next time the market goes down. Passive or active? If you're a defensive investor, you shouldn't bother picking specific stocks or attempting to beat the market. If you can't commit the time and effort, there's no point trying to do something you won't succeed at. Fortunately, by choosing to admit that you're a defensive investor, you don't preclude the possibility of good results. Once you renounce attempting to pick specific stocks and trying to beat the market, you can own all the stocks and match the market. Index funds own practically everything in a benchmark like the S&P 500 or the MSCI All Country World Index. Through them, you own all the stocks all the time. The winners grow and the losers fade, and you never need to trade. Because index funds cost almost nothing to run, their low expenses mean nearly all the market's return flows through to you. That, in turn, means they outperform most investors who incur high trading and research expenses. Over time, index funds tend to earn higher returns than at least 2/3 of professional investors. Graham himself was one of the earliest advocates of indexing. Point 6. As a defensive investor, you could buy an index fund, hold it for the rest of your life, and almost never need to make another significant investing decision. Even better, you could rest assured that in the long run you'd do better than most professionals at a fraction of the cost and aggravation. Regaining your balance. As a defensive investor, you need yet another weapon in your arsenal. Buy low, sell high, that's one of the most basic principles of investing. But even if you own only index funds, you still might end up doing the opposite, buying high and selling low. The way the human brain works, buying high and selling low feel natural and necessary, while buying low and selling high feel frightening and wrong. Buying high can be thrilling, especially when you're on a hot streak. If the market flips on you, then selling low often feels like the only way to stop your wealth from being sucked into a black hole of loss. When we invest, our neural circuitry automatically makes some harmful actions easier than beneficial behavior. 7. To guard against that cycle of performance chasing, Graham suggests a simple rule: never have less than 25% or more than 75% of your assets in stocks. That also means you should never have more than 75% or less than 25% in bonds. You would hold more in stocks when they appear cheap by historical standards and less when they seem expensive. Most of the time, you would favor a 50-50 standard division between stocks and bonds. 8. Because, as I explained in the commentary on Chapter 3, you can never be certain that the stock market is overvalued or undervalued. Graham's rule prevents you from ever taking an all-or-nothing approach. When stocks have doubled or tripled and you might be tempted to put all your money in them because you're sure they're going up even more, his rule still requires you to stop at 75% just in case you're wrong. And even when the market is crashing and seems to be heading to oblivion, Graham's rule still won't permit you to go below 25% in stocks just in case you're wrong again. Today's equivalent of Graham's policy is rebalancing, a procedure that sets a target proportion of your total assets to keep in stocks. Once a year, or after any big rise or fall in the stock market, reset your holdings back to your targets by selling some of whichever asset has gone up the most and buying some of whichever has gone down the most. Adjust enough to restore your target percentages. The best place to rebalance is in your retirement account, where sales won't trigger immediate tax consequences. 9. For simplicity's sake, let's assume your assets consist of two broadly diversified exchange-traded index funds, one holding stocks and the other holding bonds. In your investment policy, you've set your target allocation at half in stocks, half in bonds. 10. If stocks fall 20% and bonds gain 20%, here's what rebalancing would look like. Rather than emotionally buying high and selling low, you're automatically buying low and selling high. And you're making the market your servant instead of your master. After all, the ultimate goal of being a defensive investor isn't freedom from effort, it's freedom from worry. Chapter 5. The Defensive Investor and Common Stocks. By Benjamin Graham. Subscribe, like and share our audiobook channel Trade Like Champions for more such contents. Happy investing. Investment merits of common stocks. In our first edition, 1949, we found it necessary at this point to insert a long exposition of the case for including a substantial common stock component in all investment portfolios. Common stocks were generally viewed as highly speculative and therefore unsafe. They had declined fairly substantially from the high levels of 1946, but instead of attracting investors to them because of their reasonable prices, this fall had had the opposite effect of undermining confidence in equity securities. We have commented on the converse situation that has developed in the ensuing 20 years, whereby the big advance in stock prices made them appear safe and profitable investments at record high levels, which might actually carry with them a considerable degree of risk. The argument we made for common stocks in 1949 turned on two main points. The first was that they had offered a considerable degree of protection against the erosion of the investor's dollar caused by inflation, whereas bonds offered no protection at all. The second advantage of common stocks lay in their higher average return to investors over the years. This was produced both by an average dividend income exceeding the yield on good bonds and by an underlying tendency for market value to increase over the years in consequence of the reinvestment of undistributed profits. While these two advantages have been of major importance and have given common stocks a far better record than bonds over the long-term past, we have consistently warned that these benefits could be lost by the stock buyer if he pays too high a price for his shares. This was clearly the case in 1929, and it took 25 years for the market level to climb back to the ledge from which it had abysmally fallen in 1929. 1932 Since 1957 common stocks have once again, through their high prices, lost their traditional advantage in dividend yield over bond interest rates. It remains to be seen whether the inflation factor and the economic growth factor will make up in the future for this significantly adverse development. It should be evident to the reader that we have no enthusiasm for common stocks in general at the 900 DJIA level of late 1971. For reasons already given, we feel that the defensive investor cannot afford to be without an appreciable proportion of common stocks in his portfolio, even if he must regard them as the lesser of two evils, the greater being the risks attached to an all-bond holding. Rules for the common stock component. The selection of common stocks for the portfolio of the defensive investor should be a relatively simple matter. Here we would suggest 4 rules to be followed. 1. There should be adequate though not excessive diversification. This might mean a minimum of 10 different issues and a maximum of about 30 *. 2. Each company selected should be large, prominent, and conservatively financed. Indefinite as these adjectives must be, their general sense is clear. Observations on this point are added at the end of the chapter. 3. Each company should have a long record of continuous dividend payments. All the issues in the Dow Jones Industrial Average met this dividend requirement in 1971. To be specific on this point, we would suggest the requirement of continuous dividend payments beginning at least in 1950 *. 4. The investor should impose some limit on the price he will pay for an issue in relation to its average earnings over, say, the past 7 years. We suggest that this limit be set at 25 times such average earnings, and not more than 20 times those of the last 12-month period. But such a restriction would eliminate nearly all the strongest and most popular companies from the portfolio. In particular, it would ban virtually the entire category of growth stocks, which have for some years past been the favorites of both speculators and institutional investors. We must give our reasons for proposing so drastic an exclusion. Growth stocks and the defensive investor. The term growth stock is applied to one which has increased its per-share earnings in the past at well above the rate for common stocks generally and is expected to continue to do so in the future. Some authorities would say that a true growth stock should be expected at least to double its per-share earnings in 10 years, i.e., to increase them at a compounded annual rate of over 7.1%. Obviously, stocks of this kind are attractive to buy and to own, provided the price paid is not excessive. The problem lies there, of course, since growth stocks have long sold at high prices in relation to current earnings and at much higher multiples of their average profits over a past period. This has introduced a speculative element of considerable weight in the growth stock picture and has made successful operations in this field a far from simple matter. The leading growth issue has long been international business machines, and it has brought phenomenal rewards to those who bought it years ago and held on to it tenaciously. But we have already pointed out that this best of common stocks actually lost 50% of its market price in a 6 months decline during 1961-62 and nearly the same percentage in 1969-70. Other growth stocks have been even more vulnerable to adverse developments, In some cases not only has the price fallen back but the earnings as well, thus causing a double discomfiture to those who own them. A good second example for our purpose is Texas Instruments, which in 6 years rose from 5 to 256, without paying a dividend, while its earnings increased from 40 cents to $3.91 per share. Note that the price advanced 5 times as fast as the profits. This is characteristic of popular common stocks. But 2 years later the earnings had dropped off by nearly 50% and the price by 4/5, to 49 asterisk. The reader will understand from these instances why we regard growth stocks as a whole as too uncertain and risky a vehicle for the defensive investor. Of course, wonders can be accomplished with the right individual selections, bought at the right levels, and later sold after a huge rise and before the probable decline. But the average investor can no more expect to accomplish this than to find money growing on trees. In contrast, we think that the group of large companies that are relatively unpopular, and therefore obtainable at reasonable earnings multipliers * offers a sound if unspectacular area of choice by the general public. We shall illustrate this idea in our chapter on portfolio selection. Portfolio changes. It is now standard practice to submit all security lists for periodic inspection in order to see whether their quality can be improved. This, of course, is a major part of the service provided for clients by investment counselors. Nearly all brokerage houses are ready to make corresponding suggestions, without special fee, in return for the commission business involved. Some brokerage houses maintain investment services on a fee basis. Presumably our defensive investor should obtain at least once a year the same kind of advice regarding changes in his portfolio as he sought when his funds were first committed. Since he will have little expertness of his own on which to rely, it is essential that he entrust himself only to firms of the highest reputation, otherwise he may easily fall into incompetent or unscrupulous hands. It is important, in any case, that at every such consultation he make clear to his advisor that he wishes to adhere closely to the 4 rules of common stock selection given earlier in this chapter. Incidentally, if his list has been competently selected in the first instance, there should be no need for frequent or numerous changes. Dollar cost averaging. The New York Stock Exchange has put considerable effort into popularizing its monthly purchase plan, under which an investor devotes the same dollar amount each month to buying one or more common stocks. This is an application of a special type of formula investment known as dollar cost averaging. During the predominantly rising market experience since 1949, the results from such a procedure were certain to be highly satisfactory, especially since they prevented the practitioner from concentrating his buying at the wrong times. In Lucille Tomlinson's comprehensive study of formula investment plans 1, the author presented a calculation of the results of dollar cost averaging in the group of stocks making up the Dow Jones Industrial Index. Tests were made covering 23 10-year purchase periods, the first ending in 1929, the last in 1952. Every test showed a profit either at the close of the purchase period or within 5 years thereafter. The average indicated profit at the end of the 23 buying periods was 21.5%, exclusive of dividends received. Needless to say, in some instances there was a substantial temporary depreciation at market value. Miss Tomlinson ends her discussion of this ultra-simple investment formula with the striking sentence, "No one has yet discovered any other formula for investing which can be used with so much confidence of ultimate success, regardless of what may happen to security prices, as dollar cost averaging." It may be objected that dollar cost averaging, while sound in principle, is rather unrealistic in practice, because few people are so situated that they can have available for common stock investment the same amount of money each year for, say, 20 years. It seems to me that this apparent objection has lost much of its force in recent years. Common stocks are becoming generally accepted as a necessary component of a sound savings investment program. Thus, systematic and uniform purchases of common stocks may present no more psychological and financial difficulties than similar continuous payments for United States savings bonds and for life insurance, to which they should be complementary. The monthly amount may be small, but the results after 20 or more years can be impressive and important to the saver. The investor's personal situation. At the beginning of this chapter we referred briefly to the position of the individual portfolio owner. Let us return to this matter, in the light of our subsequent discussion of general policy. To what extent should the type of securities selected by the investor vary with his circumstances? As concrete examples representing widely different conditions, we shall take, 1. A widow left $200,000 with which to support herself and her children. 2. A successful doctor in mid-career, with savings of $100,000 and yearly accretions of $10,000. And 3. A young man earning $200 per week and saving $1,000 a year. For the widow, the problem of living on her income is a very difficult one. On the other hand, the need for conservatism in her investments is paramount. A division of her fund about equally between United States bonds and first-grade common stocks is a compromise between these objectives and corresponds to our general prescription for the defensive investor. The stock component may be placed as high as 75% if the investor is psychologically prepared for this decision, and if she can be almost certain she is not buying at too high a level. Assuredly, this is not the case in early 1972. We do not preclude the possibility that the widow may qualify as an enterprising investor, in which case her objectives and methods will be quite different. The one thing the widow must not do is to take speculative chances in order to make some extra income. By this we mean trying for profits or high income without the necessary equipment to warrant full confidence in overall success. It would be far better for her to draw $2,000 per year out of her principal, in order to make both ends meet, than to risk half of it in poorly grounded, and therefore speculative, ventures. The prosperous doctor has none of the widow's pressures and compulsions, yet we believe that his choices are pretty much the same. Is he willing to take a serious interest in the business of investment? If he lacks the impulse or the flair, he will do best to accept the easy role of the defensive investor. The division of his portfolio should then be no different from that of the typical widow, and there would be the same area of personal choice in fixing the size of the stock component. The annual savings should be invested in about the same proportions as the total fund. The average doctor may be more likely than the average widow to elect to become an enterprising investor, and he is perhaps more likely to succeed in the undertaking. He has one important handicap, however, the fact that he has less time available to give to his investment education and to the administration of his funds. In fact, medical men have been notoriously unsuccessful in their security dealings. The reason for this is that they usually have an ample confidence in their own intelligence and a strong desire to make a good return on their money, without the realization that to do so successfully requires both considerable attention to the matter and something of a professional approach to security values. Finally, the young man who saves $1,000 a year and expects to do better gradually finds himself with the same choices, though for still different reasons. Some of his savings should go automatically into Series E bonds. The balance is so modest that it seems hardly worthwhile for him to undergo a tough educational and temperamental discipline in order to qualify as an aggressive investor. Thus, a simple resort to our standard program for the defensive investor would be at once the easiest and the most logical policy. Let us not ignore human nature at this point. Finance has a fascination for many bright young people with limited means. They would like to be both intelligent and enterprising in the placement of their savings, even though investment income is much less important to them than their salaries. This attitude is all to the good. There is a great advantage for the young capitalist to begin his financial education and experience early. If he is going to operate as an aggressive investor, he is certain to make some mistakes and to take some losses. Youth can stand these disappointments and profit by them. We urge the beginner in security buying not to waste his efforts and his money in trying to beat the market. Let him study security values and initially test out his judgment on price versus value with the smallest possible sums. Thus we return to the statement, made at the outset, that the kind of securities to be purchased and the rate of return to be sought depend not on the investor's financial resources but on his financial equipment in terms of knowledge, experience, and temperament. Note on the concept of risk. It is conventional to speak of good bonds as less risky than good preferred stocks and of the latter as less risky than good common stocks. From this was derived the popular prejudice against common stocks because they are not safe, which was demonstrated in the Federal Reserve Board's survey of 1948. We should like to point out that the words risk and safety are applied to securities in two different senses, with a resultant confusion in thought. A bond is clearly proved unsafe when it defaults its interest or principal payments. Similarly, if a preferred stock or even a common stock is bought with the expectation that a given rate of dividend will be continued, then a reduction or passing of the dividend means that it has proved unsafe. It is also true that an investment contains a risk if there is a fair possibility that the holder may have to sell at a time when the price is well below cost. Nevertheless, the idea of risk is often extended to apply to a possible decline in the price of a security, even though the decline may be of a cyclical and temporary nature and even though the holder is unlikely to be forced to sell at such times. These chances are present in all securities, other than United States savings bonds, and to a greater extent in the general run of common stocks than in senior issues as a class. But we believe that what is here involved is not a true risk in the useful sense of the term. The man who holds a mortgage on a building might have to take a substantial loss if he were forced to sell it at an unfavorable time. That element is not taken into account in judging the safety or risk of ordinary real estate mortgages, the only criterion being the certainty of punctual payments. In the same way, the risk attached to an ordinary commercial business is measured by the chance of its losing money, not by what would happen if the owner were forced to sell. In Chapter 8 we shall set forth our conviction that the bona fide investor does not lose money merely because the market price of his holdings declines, hence the fact that a decline may occur does not mean that he is running a true risk of loss. If a group of well-selected common stock investments shows a satisfactory overall return, as measured through a fair number of years, then this group investment has proved to be safe. During that period its market value is bound to fluctuate, and as likely as not it will sell for a while under the buyer's cost. If that fact makes the investment risky, it would then have to be called both risky and safe at the same time. This confusion may be avoided if we apply the concept of risk solely to a loss of value which either is realized through actual sale, or is caused by a significant deterioration in the company's position or, more frequently perhaps, is the result of the payment of an excessive price in relation to the intrinsic worth of the security. Point 2. Many common stocks do involve risks of such deterioration. But it is our thesis that a properly executed group investment in common stocks does not carry any substantial risk of this sort and that therefore it should not be termed risky merely because of the element of price fluctuation. But such risk is present if there is danger that the price may prove to have been clearly too high by intrinsic value standards, even if any subsequent severe market decline may be recouped many years later. Note on the category of large, prominent, and conservatively financed corporations. The quoted phrase in our caption was used earlier in the chapter to describe the kind of common stocks to which defensive investors should limit their purchases, provided also that they had paid continuous dividends for a considerable number of years. A criterion based on adjectives is always ambiguous. Where is the dividing line for size, for prominence, and for conservatism of financial structure? On the last point we can suggest a specific standard that, though arbitrary, is in line with accepted thinking. An industrial company's finances are not conservative unless the common stock, at book value, represents at least half of the total capitalization, including all bank debt. 3 For a railroad or public utility, the figure should be at least 30%. The words large and prominent carry the notion of substantial size combined with a leading position in the industry. Such companies are often referred to as primary. All other common stocks are then called secondary, except that growth stocks are ordinarily placed in a separate class by those who buy them as such. To supply an element of concreteness here, let us suggest that to be large in present-day terms, a company should have $50 million of assets or do $50 million of business. Again, to be prominent, a company should rank among the first quarter or first third in size within its industry group. It would be foolish, however, to insist upon such arbitrary criteria. They are offered merely as guides to those who may ask for guidance. But any rule which the investor may set for himself and which does no violence to the common sense meanings of large and prominent should be acceptable. By the very nature of the case, there must be a large group of companies that some will and others will not include among those suitable for defensive investment. There is no harm in such diversity of opinion and action. In fact, it has a salutary effect upon stock market conditions, because it permits a gradual differentiation or transition between the categories of primary and secondary stock issues. Commentary on Chapter 5 by Jason Zweig. Subscribe, like and share our audiobook channel Trade Like Champions for more such contents. Happy investing. The line I draw in the sand is that if an asset has cash flow or the likelihood of cash flow in the near term and is not purely dependent on what a future buyer might pay, then it's an investment. If an asset's value is totally dependent on the amount a future buyer might pay, then its purchase is speculation. Seth Klarman 1. The defensive investor, as Graham wrote in Chapter 4, wants to minimize the time and effort that investing takes and wants freedom from concern. The stock market isn't your only concern, though. You face two great external dangers as a defensive investor. First, you need to fend off the brokerage industry. Because defensive investors almost never trade, they generate no revenue for brokerage firms. What's called the democratization of investing, low-cost trading for anyone who has a smartphone with a brokerage app, is a compelling delusion. It sounds empowering, but it can transform defensive investors into hyperactive traders who make brokers rich. You also need to defend against social contagion. Once you let other people do your thinking for you, your single most valuable asset, your intellectual independence, is impaired. And once you lose part of your sense of self, losing financial wealth won't be far behind. By the time you recognize you've lost the ability to think for yourself, it will be too late. Gamification or gamblification. The companies behind such trading apps as eToro, Robinhood, Tastytrade, and Webull often describe them as gamification, but gamblification would be more accurate. We shouldn't liken trading apps to the games that can make education, fitness, dieting, and other activities more engaging and achievable. We should classify them with the poker, casino, and sports betting apps and gambling machines that exploit vulnerable users and addict many of them. A gamblified investing tool is fun to use, but it has three insidious features. It's designed to encourage short-term trading. It's potentially addictive. And it relies on manipulative techniques perfected by the gambling industry. 2. Among those are bright, energetic audiovisual displays that make stock prices resemble the spinning reels on a slot machine, highlighting the changes in your wealth, not the amount of your wealth. Scratch-off rewards resembling lottery tickets, giving you a share of a random stock when you first sign up, and the excitement of playing with what feels like free money. Frequent alerts notifying you of big moves and goading you to trade. Badges, trophies, or levels, silver, gold, platinum, getting your competitive juices flowing. Lists of the hottest or most popular stocks. Copying and liking, in which you can mimic or praise other people's trades, as they can yours. Leaderboards showing who's making the most money. Gamblified apps also goad users into trading options contracts, which are much riskier and generate far higher brokerage fees. Point 3. Casinos are designed to maximize what operators call TOD, or time on device. The longer you spend in front of a slot machine, the more certain you are to lose. You should immediately walk away if you hit the jackpot, but casinos have learned to glue you to your seat with hypnotic audiovisuals and nanomonetization, the ability to place many small bets simultaneously. Gamblified brokerage apps follow the same principle of maximizing TOD. In 2020, while testing Robinhood, I temporarily became a trading addict myself. Point 4. A study by the Ontario Securities Commission found that earning rewards prompted people to trade 39% more often. Seeing a weekly list of top traded stocks led participants to increase their trading of those same stocks by 14%. Gamblifying a brokerage app by adding badges, levels, and leaderboards can also change how investors think. Instead of seeking to fulfill their own financial goals, they will instead strive to beat everybody else, becoming up to twice as likely to buy a highly risky stock. Point 5. The faster you run, the behinder you get. The fast trading encouraged by brokerage apps provides short-term fun and long-term loss. Among more than 66,000 U.S. households using a major discount brokerage, those who traded the most underperformed those who traded the least by more than 7 percentage points annually. A study of roughly 20,000 retail brokerage customers in Brazil found that among those who kept making short-term trades for at least 300 days, 97% lost money. Fewer than 3% of active day traders in Taiwan earn a profit, although most can't stop trading. People with a history of losing money generate 75% of total trading. Contracts for difference, or CFDs, are a popular way to place short-term bets on whether an asset's price will move up or down. On average, 74% to 89% of customers who trade CFDs lose money. Point 6. The stock market should be what economists call a positive-sum game. As companies grow, their increasing earnings generate dividends and rising stock prices, enabling investors to build wealth. If you gamble instead of investing, however, you turn the stock market into a negative-sum game. You miss out on reaping the rewards of long-term ownership, create unnecessary trading costs, and generate punitive tax bills. Instead of going along for the ride, you get taken for a ride. Point 7. Is gamblification an education? Proponents of gamblified brokerage apps defend them with such arguments as making investing fun is a great way to get young people to try it, even if they lose money at first, or you have to take risks to learn how to manage them. Why should inexperienced investors have to behave dangerously to learn how to behave safely? We don't get teenagers to drink responsibly by challenging them to chug down 50 shots of whiskey. We don't instruct young people how to drive by urging them to crash cars into brick walls at 100 miles per hour, nor do we teach firearm safety by having novices take target practice by blasting shotguns at their own feet. Gamblified brokerage apps that encourage impressionable people to practice dangerous investing behaviors are terrible, if not tragic, training for life. The wisdom of crowds. It can seem rational to join the herd. Our everyday experience and our evolutionary history teach us that crowds are often correct. You probably wouldn't eat at a completely empty restaurant, purchase a product that has no positive online reviews, or buy a house that nobody else wants to bid on. Learning from other people facilitates cooperation and collective problem solving. Groups often know more than one person does. Also, it feels safer inside the herd. We all want to be popular, to belong to the in crowd. The bigger the group we belong to, the more compelling and irresistible its message will feel, and the size of an online crowd has no physical constraints. Millions can join. Own a soaring stock that you can chat about online with thousands of other people who all love it, and you will feel you belong to a pride of lions. Own a falling stock that nobody wants to touch, and you will feel like a skunk at a garden party. What's more, if you're acting alone and make a mistake, you have no one to blame but yourself. If you go along with the crowd and it turns out to be wrong, you can shrug and say, everybody else was wrong, too. Finally, a crowd can make things happen. Starting in 2020, swarms of investors coalescing on Reddit, Twitter, and Discord began to pool their buying power and drive up the prices of their favorite stocks: AMC Entertainment Holdings, GameStop, Bed Bath & Beyond, and many more. The leaders and early birds made profits hundreds of times larger than what they put in. By channeling the buying power of millions of small investors into a tiny number of stocks, they created a giant force that could send a company's shares soaring just by mentioning it online. Anyone could go along for the ride. Why not join the fun? The madness of crowds. Yet crowds aren't always right, and their errors are contagious. That can be catastrophic, as when millions of people fall under the spell of murderous rabble-rousers like Hitler or Mussolini. Or it can be insidious, as when conspiracy theories become mental epidemics and when baseless beliefs about investing go viral. What separates the wisdom from the madness of the crowd? In 1907, the statistician Francis Galton described the results of a contest at an agricultural fair in which nearly 800 visitors tried to guess the weight of an ox. Although many knew little or nothing about oxen and their guesses varied widely, the visitors' average estimate turned out to be the exact weight of the ox. 8. Francis Galton's guessers had a variety of viewpoints, sought to win a prize for the most accurate guess, didn't know other people's estimates, and had to pay an entry fee. The sponsors of the contest collected all the guesses and tallied them fairly. The judgments of that crowd were independent, confidential, diverse, incentivized, and aggregated and, therefore, remarkably accurate at estimating simple values. 9. In today's financial markets, online and social media mobs seethe with emotion, but valuable information is scarce. Predictions are made in public, with countless strangers trying to influence other people's opinions. Popular influencers can set off stampedes, crushing cognitive diversity as millions of people rush to embrace the same beliefs. There are no barriers to entry, no easy way to authenticate claims of expertise, and no registry of how accurate or how extreme the opinions are. All too often, the judgments of this sort of crowd are the opposite of Galton's: interdependent, public, homogenized, non-incentivized, and disaggregated. That can turn the wisdom of the crowd into madness. The weight of an ox doesn't change with people's estimates of it. However, if millions of speculators suddenly decide that a stock is worth $100,000, it will skyrocket, at least temporarily, even if it's worthless. Heard on the street. Learning what other people think changes how you think. When you find out that a group of your peers disagrees with you, your choices become up to 3 times more likely to match theirs, although you will have no conscious awareness of being influenced. A single exposure to an opinion from someone described as an expert enhances your memory of the information and how favorably you view it. And agreeing with your peers or with purported experts will activate the same regions of the brain that process the anticipation of reward. As information becomes more complex or ambiguous, you become more prone to interpret it the same way the crowd does. And social media, by design, amplifies views that resemble your own. One recent study found that investors on social media are 5 times more likely to follow users who agree with them and will see nearly 3 times as many messages they agree with than disagree with. Falling into this kind of echo chamber, the study showed, leads people to trade more and earn lower returns. Point 10. The more people like a post on social media, the higher the odds that you will like it as well. Liking a post already liked by lots of other people activates a key reward center in the human brain more intensely than liking a less popular post. On public brokerage platforms, having other people like your trades can lead you to trade 3 times more often than those who don't receive such feedback. Meanwhile, bucking the consensus engages circuits in the brain that generate pain, fear, anxiety, and disgust. If you've ever rooted against the home team in a crowded stadium or spoken up for your candidate in a room full of members of an opposing political party, you know how hard it feels not to fit in. The larger the group, the more painful standing alone becomes. Point 11. Worse, the algorithms embedded in social media platforms like Facebook, Twitter, and TikTok appear to be designed to maximize the time you spend on your device. They do that by fixating your attention on celebrities, on people who agree with you, and on information and imagery that inflame your emotions. That makes certain content seem more prevalent than it is and thus more persuasive than it should be. These algorithms are an invisible but pervasive force field that pulls you away from thinking for yourself. Point 12. Vaccinating yourself against contagion. Because you may never realize how much a group is influencing your behavior and decisions, it's vital to protect yourself before you join the crowd. First, don't join a group that has different values. You should marry your investments, not speed date them, and associating with people who trade promiscuously is bound to infect your behavior. Seek out patient, like-minded investors at such online communities as bogleheads.org, humbledolr.com, mutualfundobserver.com, or valueinvestorsclub.com. Look for posts that steer clear of hot takes on the latest headlines. Avoid anger, boasting, and mockery. And reveal their sources by linking to long-term data and peer-reviewed research, rather than just making assertions without evidence. If you have views about which asset or investing strategy is right for you, write down your reasons for those beliefs before you explore what some online group is saying. Take no action without reviewing your original rationale and determining that there's a reasonable basis for changing it, grounded in data and evidence, not just the opinions of random people online. Remember that the internet and social media are reality distortion fields. Likes and upvotes go to the loudest and brashest advice, not the best. Conflicts of interest abound but are often undisclosed. Automated bots skew which posts get the most attention. Paradoxically, the more expertise people have, the more often they will say "I don't know" or "it depends," leading them to sound as if they know less than those who are often wrong but never in doubt. The ones who admit the limits of their knowledge are the ones to listen to. Be an investing inchworm. To succeed as a defensive investor, you must be able to turn your back on the crowd, otherwise, you'll run the risk of almost constantly overreacting to news, opinion, and rumor. Don't speculate, automate. With dollar cost averaging, you can invest a fixed amount of money at predetermined intervals, every week, every month, every quarter, every year, whenever you can, whatever you can afford. Your brokerage or fund company will automatically move the money from your bank in an electronic transfer, so you don't have to lift a finger. Many corporate retirement plans and government pension systems do this for you, but using additional money of your own is another way to impose discipline on yourself. Rather than jumping in and out of the market in giant leaps, become an inchworm, steadily adding more no matter what the market does. Such an automatic investment plan can't guarantee you won't lose money. But it compels you to keep investing even when the stock market is crashing, and it prevents you from heaving money impulsively into the market when stocks are soaring. These automated purchases are out of sight, out of mind, so you aren't making frequent ad hoc decisions that you will second guess or regret later. By dollar cost averaging with a simple basket of index funds and trading only to rebalance, you can put your entire portfolio on multiple levels of autopilot. As Graham wrote about dollar cost averaging in 1962. Such a policy will pay off ultimately, regardless of when it is begun, provided that it is adhered to conscientiously and courageously under all intervening conditions. This presupposes that the dollar cost averager will not be subject to the alternations of exhilaration and deep gloom that have accompanied the gyrations of the stock market for generations past. In a speech the next year, he added, "That way you buy more shares of stocks when the market level is low and fewer shares when it's high. That method has worked out extremely well for those who have had, A. the money, B. the time, and C. the character necessary to pursue a consistent policy over the years regardless of whether the market has been going up or down. If you can do that, you are guaranteed satisfactory success in your investments." 13. Rather than following the herd, follow Graham's policies. In the short run, you'll miss out on a little fun; in the long run, you'll build a lot more wealth. Chapter 6. Portfolio Policy for the Enterprising Investor, Negative Approach. By Benjamin Graham. Subscribe, like and share our audiobook channel Trade Like Champions for more such contents. Happy investing. The aggressive investor should start from the same base as the defensive investor, namely, a division of his funds between high-grade bonds and high-grade common stocks bought at reasonable prices. He will be prepared to branch out into other kinds of security commitments, but in each case he will want a well-reasoned justification for the departure. There is a difficulty in discussing this topic in orderly fashion, because there is no single or ideal pattern for aggressive operations. The field of choice is wide. The selection should depend not only on the individual's competence and equipment but perhaps equally well upon his interests and preferences. The most useful generalizations for the enterprising investor are of a negative sort. Let him leave high-grade preferred stocks to corporate buyers. Let him also avoid inferior types of bonds and preferred stocks unless they can be bought at bargain levels, which means ordinarily at prices at least 30% under par for high coupon issues, and much less for the lower coupons. He will let someone else buy foreign government bond issues, even though the yield may be attractive. He will also be wary of all kinds of new issues, including convertible bonds and preferreds that seem quite tempting, and common stocks with excellent earnings confined to the recent past. For standard bond investments, the aggressive investor would do well to follow the pattern suggested to his defensive confrere, and make his choice between high-grade taxable issues, which can now be selected to yield about 7.14%, and good quality tax-free bonds, which yield up to 5.3% on longer maturities. Second-grade bonds and preferred stocks. Since in late 1971 it is possible to find first-rate corporate bonds to yield 7.14%, and even more, it would not make much sense to buy second-grade issues merely for the higher return they offer. In fact, corporations with relatively poor credit standing have found it virtually impossible to sell straight bonds, i.e., non-convertibles, to the public in the past 2 years. Hence their debt financing has been done by the sale of convertible bonds, or bonds with warrants attached, which place them in a separate category. It follows that virtually all the non-convertible bonds of inferior rating represent older issues which are selling at a large discount. Thus they offer the possibility of a substantial gain in principal value under favorable future conditions, which would mean here a combination of an improved credit rating for the company and lower general interest rates. But even in the matter of price discounts and resultant chance of principal gain, the second-grade bonds are in competition with better issues. Some of the well-entrenched obligations with old-style coupon rates, 2.5% to 4%, sold at about 50 cents on the dollar in 1970. Examples: American Telephone and Telegraph 258s, due 1986, sold at 51, Atchison Topeka and Santa Fe RR4s, due 1995, sold at 51, McGraw-Hill 378s, due 1992, sold at 51.5. Hence, under conditions of late 1971, the enterprising investor can probably get from good grade bonds selling at a large discount all that he should reasonably desire in the form of both income and chance of appreciation. Throughout this book we refer to the possibility that any well-defined and protracted market situation of the past may return in the future. Hence we should consider what policy the aggressive investor might have to choose in the bond field if prices and yields of high-grade issues should return to former normals. For this reason we shall reprint here our observations on that point made in the 1965 edition, when high-grade bonds yielded only 4.5%. Something should be said now about investing in second-grade issues, which can readily be found to yield any specified return up to 8% or more. The main difference between first and second grade bonds is usually found in the number of times the interest charges have been covered by earnings. Example: in early 1964 Chicago, Milwaukee, St. Paul, and Pacific 5% income debenture bonds, at 68, yielded 7.35%. But the total interest charges of the road, before income taxes, were earned only 1.5 times in 1963. Against our requirement of 5 times for a well-protected railroad issue. 1. Many investors buy securities of this kind because they need income and cannot get along with the meager return offered by top-grade issues. Experience clearly shows that it is unwise to buy a bond or a preferred which lacks adequate safety merely because the yield is attractive. Here the word merely implies that the issue is not selling at a large discount and thus does not offer an opportunity for a substantial gain in principal value. Where such securities are bought at full prices, that is, not many points under 100*, the chances are very great that at some future time the holder will see much lower quotations. For when bad business comes, or just a bad market, issues of this kind prove highly susceptible to severe sinking spells. Often interest or dividends are suspended or at least endangered, and frequently there is a pronounced price weakness even though the operating results are not at all bad. As a specific illustration of this characteristic of second-quality senior issues, let us summarize the price behavior of a group of 10 railroad income bonds in 1946 to 47. These comprise all of those which sold at 96 or more in 1946, their high prices averaging 102.5. By the following year the group had registered low prices averaging only 68, a loss of 1/3 of the market value in a very short time. Peculiarly enough, the railroads of the country were showing much better earnings in 1947 than in 1946, hence the drastic price decline ran counter to the business picture and was a reflection of the sell-off in the general market. But it should be pointed out that the shrinkage in these income bonds was proportionately larger than that in the common stocks in the Dow Jones Industrial List, about 23%. Obviously the purchaser of these bonds at a cost above 100 could not have expected to participate to any extent in a further rise in the securities market. The only attractive feature was the income yield, averaging about 4.25%, against 2.5% for first-grade bonds, an advantage of 1.75% in annual income. Yet the sequel showed all too soon and too plainly that for the minor advantage in annual income the buyer of these second-grade bonds was risking the loss of a substantial part of his principal. The above example permits us to pay our respects to the popular fallacy that goes under the sobriquet of a businessman's investment. That involves the purchase of a security showing a larger yield than is obtainable on a high-grade issue and carrying a correspondingly greater risk. It is bad business to accept an acknowledged possibility of a loss of principal in exchange for a mere 1 or 2% of additional yearly income. If you are willing to assume some risk, you should be certain that you can realize a really substantial gain in principal value if things go well. Hence a second-grade 5.5 or 6% bond selling at par is almost always a bad purchase. The same issue at 70 might make more sense, and if you are patient you will probably be able to buy it at that level. Second-grade bonds and preferred stocks possess two contradictory attributes which the intelligent investor must bear clearly in mind. Nearly all suffer severe sinking spells in bad markets. On the other hand, a large proportion recover their position when favorable conditions return. And these ultimately work out all right. This is true even of cumulative preferred stocks that fail to pay dividends for many years. There were a number of such issues in the early 1940s, as a consequence of the long depression of the 1930s. During the post-war boom period of 1945 to 1947, many of these large accumulations were paid off either in cash or in new securities, and the principal was often discharged as well. As a result, large profits were made by people who, a few years previously, had bought these issues when they were friendless and sold at low prices. Point 2. It may well be true that, in an overall accounting, the higher yields obtainable on second-grade senior issues will prove to have offset those principal losses that were irrecoverable. In other words, an investor who bought all such issues at their offering prices might conceivably fare as well, in the long run, as one who limited himself to first-quality securities, or even somewhat better. Point 3. But for practical purposes the question is largely irrelevant. Regardless of the outcome, the buyer of second-grade issues at full prices will be worried and discommoded when their prices decline precipitately. Furthermore, he cannot buy enough issues to assure an average result, nor is he in a position to set aside a portion of his larger income to offset or amortize those principal losses which prove to be permanent. Finally, it is mere common sense to abstain from buying securities at around 100 if long experience indicates that they can probably be bought at 70 or less in the next weak market. Foreign government bonds. All investors with even small experience know that foreign bonds, as a whole, have had a bad investment history since 1914. This was inevitable in the light of 2 world wars and an intervening world depression of unexampled depth. Yet every few years market conditions are sufficiently favorable to permit the sale of some new foreign issues at a price of about par. This phenomenon tells us a good deal about the working of the average investor's mind, and not only in the field of bonds. We have no concrete reason to be concerned about the future history of well-regarded foreign bonds such as those of Australia or Norway. But we do know that, if and when trouble should come, the owner of foreign obligations has no legal or other means of enforcing his claim. Those who bought Republic of Cuba for 1/2s as high as 117 in 1953 saw them default their interest and then sell as low as 20 cents on the dollar in 1963. The New York Stock Exchange bond list in that year also included Belgian Congo 514s at 36, Greek 7s at 30, and various issues of Poland as low as 7. How many readers have any idea of the repeated vicissitudes of the 8% bonds of Czechoslovakia, since they were first offered in this country in 1922 at 96 1/2? They advanced to 112 in 1928, declined to 6734 in 1932, recovered to 106 in 1936, collapsed to 6 in 1939, recovered, unbelievably, to 117 in 1946, fell promptly to 35 in 1948, and sold as low as 8 in 1970. Years ago an argument of sorts was made for the purchase of foreign bonds here on the grounds that a rich creditor nation such as ours was under moral obligation to lend abroad. Time, which brings so many revenges, now finds us dealing with an intractable balance of payments problem of our own, part of which is ascribable to the large-scale purchase of foreign bonds by American investors seeking a small advantage in yield. For many years past we have questioned the inherent attractiveness of such investments from the standpoint of the buyer. Perhaps we should add now that the latter would benefit both his country and himself if he declined these opportunities. New issues generally. It might seem ill-advised to attempt any broad statements about new issues as a class, since they cover the widest possible range of quality and attractiveness. Certainly there will be exceptions to any suggested rule. Our one recommendation is that all investors should be wary of new issues, which means, simply, that these should be subjected to careful examination and unusually severe tests before they are purchased. There are two reasons for this double caveat. The first is that new issues have special salesmanship behind them, which calls therefore for a special degree of sales resistance. The second is that most new issues are sold under favorable market conditions, which means favorable for the seller and consequently less favorable for the buyer. The effect of these considerations becomes steadily more important as we go down the scale from the highest quality bonds through second-grade senior issues to common stock flotations at the bottom. A tremendous amount of financing, consisting of the repayment of existing bonds at call price and their replacement by new issues with lower coupons, was done in the past. Most of this was in the category of high-grade bonds and preferred stocks. The buyers were largely financial institutions, amply qualified to protect their interests. Hence these offerings were carefully priced to meet the going rate for comparable issues, and high-powered salesmanship had little effect on the outcome. As interest rates fell lower and lower, the buyers finally came to pay too high a price for these issues, and many of them later declined appreciably in the market. This is one aspect of the general tendency to sell new securities of all types when conditions are most favorable to the issuer, but in the case of first-quality issues the ill effects to the purchaser are likely to be unpleasant rather than serious. The situation proves somewhat different when we study the lower-grade bonds and preferred stocks sold during the 1945–46 and 1960–61 periods. Here the effect of the selling effort is more apparent, because most of these issues were probably placed with individual and inexpert investors. It was characteristic of these offerings that they did not make an adequate showing when judged by the performance of the companies over a sufficient number of years. They did look safe enough, for the most part, if it could be assumed that the recent earnings would continue without a serious setback. The investment bankers who brought out these issues presumably accepted this assumption, and their salesmen had little difficulty in persuading themselves and their customers to a like effect. Nevertheless, it was an unsound approach to investment, and one likely to prove costly. Bull market periods are usually characterized by the transformation of a large number of privately owned businesses into companies with quoted shares. This was the case in 1945–46 and again beginning in 1960. The process then reached extraordinary proportions until brought to a catastrophic close in May 1962. After the usual swearing-off period of several years, the whole tragicomedy was repeated, step by step. In 1967, 1969 *. New common stock offerings. The following paragraphs are reproduced unchanged from the 1959 edition, with comment added. Common stock financing takes two different forms. In the case of companies already listed, additional shares are offered pro-rata to the existing stockholders. The subscription price is set below the current market, and the rights to subscribe have an initial money value *. The sale of the new shares is almost always underwritten by one or more investment banking houses, but it is the general hope and expectation that all the new shares will be taken by the exercise of the subscription rights. Thus, the sale of additional common stock of listed companies does not ordinarily call for active selling effort on the part of distributing firms. The second type is the placement with the public of common stock of what were formerly privately owned enterprises. Most of this stock is sold for the account of the controlling interests to enable them to cash in on a favorable market and to diversify their own finances. When new money is raised for the business, it comes often via the sale of preferred stock, as previously noted. This activity follows a well-defined pattern, which by the nature of the security markets must bring many losses and disappointments to the public. The dangers arise both from the character of the businesses that are thus financed and from the market conditions that make the financing possible. In the early part of the century, a large proportion of our leading companies were introduced to public trading. As time went on, the number of enterprises of first rank that remained closely held steadily diminished. Hence, original common stock flotations have tended to be concentrated more and more on relatively small concerns. By an unfortunate correlation, during the same period the stock buying public has been developing an ingrained preference for the major companies and a similar prejudice against the minor ones. This prejudice, like many others, tends to become weaker as bull markets are built up. The large and quick profits shown by common stocks as a whole are sufficient to dull the public's critical faculty, just as they sharpen its acquisitive instinct. During these periods, also, quite a number of privately owned concerns can be found that are enjoying excellent results, although most of these would not present too impressive a record if the figures were carried back, say, 10 years or more. When these factors are put together, the following consequences emerge. Somewhere in the middle of the bull market, the first common stock flotations make their appearance. These are priced not unattractively, and some large profits are made by the buyers of the early issues. As the market rise continues, this brand of financing grows more frequent, the quality of the companies becomes steadily poorer, the prices asked and obtained verge on the exorbitant. One fairly dependable sign of the approaching end of a bull swing is the fact that new common stocks of small and nondescript companies are offered at prices somewhat higher than the current level for many medium-sized companies with a long market history. It should be added that very little of this common stock financing is ordinarily done by banking houses of prime size and reputation. Asterisk. The heedlessness of the public and the willingness of selling organizations to sell whatever may be profitably sold can have only one result: price collapse. In many cases the new issues lose 75% and more of their offering price. The situation is worsened by the aforementioned fact that, at bottom, the public has a real aversion to the very kind of small issue that it bought so readily in its careless moments. Many of these issues fall, proportionately, as much below their true value as they formerly sold above it. An elementary requirement for the intelligent investor is an ability to resist the blandishments of salesmen offering new common stock issues during bull markets. Even if one or two can be found that can pass severe tests of quality and value, it is probably bad policy to get mixed up in this sort of business. Of course, the salesman will point to many such issues which have had good-sized market advances, including some that go up spectacularly the very day they are sold. But all this is part of the speculative atmosphere. It is easy money. For every dollar you make in this way, you will be lucky if you end up by losing only 2. Some of these issues may prove excellent buys a few years later, when nobody wants them and they can be had at a small fraction of their true worth. In the 1965 edition we continued our discussion of this subject as follows. While the broader aspects of the stock market's behavior since 1949 have not lent themselves well to analysis based on long experience, the development of new common stock flotations proceeded exactly in accordance with ancient prescription. It is doubtful whether we ever before had so many new issues offered, of such low quality, and with such extreme price collapses, as we experienced in 1960 to 1962. The ability of the stock market as a whole to disengage itself rapidly from that disaster is indeed an extraordinary phenomenon, bringing back long-buried memories of the similar invulnerability it showed to the great Florida real estate collapse in 1925. Must there be a return of the new stock offering madness before the present bull market can come to its definitive close? Who knows? But we do know that an intelligent investor will not forget what happened in 1962 and will let others make the next batch of quick profits in this area and experience the consequent harrowing losses. We followed these paragraphs in the 1965 edition by citing a horrible example, namely, the sale of stock of Aetna Maintenance Co. at $9 in November 1961. In typical fashion, the shares promptly advanced to $15, the next year they fell to $2.38, and in 1964 to $7.8. The later history of this company was on the extraordinary side, and illustrates some of the strange metamorphoses that have taken place in American business, great and small, in recent years. The curious reader will find the older and newer history of this enterprise in Appendix 5, see pages 575 to 576 of the 2003 edition. It is by no means difficult to provide even more harrowing examples taken from the more recent version of the same old story, which covered the years 1967 to 1970. Nothing could be more pat to our purpose than the case of AAA Enterprises, which happens to be the first company then listed in Standard & Poor's stock guide. The shares were sold to the public at $14 in 1968, promptly advanced to $28, but in early 1971 were quoted at a dismal 25 cents. Even this price represented a gross overvaluation of the enterprise, since it had just entered the bankruptcy court in a hopeless condition. There is so much to be learned, and such important warnings to be gleaned from the story of this flotation that we have reserved it for detailed treatment below, in Chapter 17. Commentary on Chapter 6. By Jason Zweig. If you can admit a mistake when it is the size of an acorn, it will be easier to repair than if you wait until it becomes the size of a tree, with deep, wide-ranging roots. Carol Tavris and Elliot Aronson 1. Even if you're an enterprising investor, you still need to be on the defensive both against those who want you to lock up your money and those who want you to keep it in constant motion. Focusing on what to do is fun, but focusing on what not to do is vital. Otherwise, as Graham warns, for every dollar you make as an enterprising investor, you will be lucky if you end up by losing only two. The alternative universe. One potential mistake of enterprising investors is locking money up for years at high fees in pursuit of big gains. What investors see often depends on its fee. The more bankers, brokers, and financial advisors can earn from an asset, the harder they'll push to sell it. In the 1980s and 1990s, that meant constant pressure on investors to buy high-cost mutual funds and annuities, as well as initial public offerings, IPOs. Point 2. Lately, the arm twisting has shifted to alternative assets such as hedge funds, private equity funds that buy out entire companies, venture capital that finances start-ups, private credit funds specializing in non-traded debt, and portfolios of private real estate. These assets are tantalizing for enterprising investors, promising potentially superior returns and the warm glow of owning funds that historically were available only to the elite. Prestige comes at a price. Between 2013 and 2022, private equity, venture capital, real estate, and other private funds raised a total of $11.7 trillion worldwide, according to PitchBook data. Investors paid managers and marketers hundreds of billions of dollars in cumulative fees and expenses. The costs investors pay at one popular fund of funds, a non-traded portfolio that invests in a bundle of other non-traded funds, are extreme but hardly unique. Here, two things are possible, and one is certain. You might get a good return. You might be able to get your money out when you need to. You will pay high fees. Alternative funds often don't trade publicly or even disclose exactly what they own. Many update their prices, and permit withdrawals, only monthly or quarterly, sometimes even less often. Promoters say these funds operate in private markets dominated by sophisticated investors immune to the short-term pressures of public markets. Therefore, the story goes, alternatives offer longer investment horizons, lower risks, and higher returns, making their fees worth paying. Let's think about that. Does the absence of public trading mean prices can't go down? Of course not. Venture capital funds slumped 65% as technology stocks collapsed in the early 2000s. Private real estate funds lost 63% during the global financial crisis in the late 2000s. Markets work best when they are both deep, with many participants, and wide, with strong differences of opinion. That's a good description of public trading in the stock market much of the time. Point 3. Private markets have far fewer participants, who tend to move in the same circles, share similar beliefs, and hold similar portfolios. Instead of being deep and wide, private markets are shallow and narrow. Rather than being independent, they're codependent. In such a clubby atmosphere, private market valuations can end up relying more on faith, guesswork, and groupthink than on original analysis. A survey of nearly 900 venture capitalists reported that when deciding which companies to invest in, 44% often make a gut decision, and 9% said they use no financial metrics at all. A survey of dozens of private equity executives found that whether a company is cheap isn't a major determinant of whether to invest, and very few evaluate companies by estimating future earnings or cash flows. Point 4. Look at the fiascos of blood testing startup Theranos Incorporated, office sharing firm WeWork, and cryptocurrency exchange FTX. The private venture capital market valued Theranos at $9 billion in 2014, FTX at $32 billion in 2022, and WeWork at $47 billion in 2018.5. Theranos shut down in 2018, its founder was sentenced to 11 years in prison for fraud. FTX and WeWork filed for bankruptcy protection in late 2022 and in 2023, respectively. FTX's founder Sam Bankman-Fried was sentenced in March 2024 to serve 25 years in prison for stealing billions of dollars from the exchange's customers. These flameouts were funded by some of the world's most renowned hedge funds and private equity and venture capital firms, which charged gigantic fees for due diligence they apparently didn't do. The public stock market makes absurd mistakes, too, but it doesn't pretend to be omniscient and doesn't charge an arm and a leg. To invest like Yale, be like Yale. The longtime head of Yale University's endowment, David Swensen, who died in 2021, pioneered investing in such alternatives as hedge funds, private equity, and non-traded real estate. Over his 35-year tenure, Yale's portfolio gained an average of 13.1% annually, far surpassing its peers and U.S. and global stock markets. Swensen explained that private assets were more risky and less liquid than stocks and bonds and, therefore, could earn higher returns. At the same time, he warned, the gap between winners and losers in private assets is much wider than in public markets. Therefore, the potentially superior returns in alternative funds can be captured only by specialized investors who can withstand higher risk and lower liquidity. Point 1. To invest like Yale, you must be like Yale. It has extraordinary advantages. Expertise. A large, experienced staff at Yale specializes in analyzing these funds. Do you or your advisors have long, deep experience studying alternative funds fees, managers, and methods of valuing assets? Time. Founded in 1701 and likely to survive for centuries more, Yale has the luxury of investing for decades at a time. Do you? Size. Yale's endowment exceeds $40 billion, granting it special access to the world's best alternative funds and enabling it to diversify across many at once. Can you? Resilience. As a perpetual institution, Yale can outlast severe interim, even permanent losses on its private funds. Can you survive deep losses and the inability to sell? Cash. Yale derives additional income from tuition, gifts, and grants, so it can cut spending if its portfolio underperforms. And it can deploy surplus capital when falling markets create bargains. Do you have multiple sources of ample income? If but only if you can answer yes to all 5 of those questions, alternative investments may be right for you. Point 2. 1. David F. Swenson, Pioneering Portfolio Management, Free Press, 2000. 2. Lawrence B. Siegel, Alternatives for the Masses, bit.ly/307T2YZ. Push back against what's being pushed. Pensions and endowments. The ultimate sophisticated investors have sunk 30% to 60% of their assets into alternative funds. As a result, investment consultant Richard Ennis estimates, these institutions have underperformed a simple portfolio of roughly 70% stocks and 30% bonds by as much as 2 percentage points annually since 2008.6. Yet promoters say you can use alternative funds to earn superior returns. Can you? In addition to the guidelines in To Invest Like Yale, Be Like Yale, you should rely on some of the virtues I described in the commentary on the introduction. Independence will tell you not to invest in alternatives just because everybody else is. Humility will counsel you that, as an individual investor, you're unlikely to be offered the opportunity to invest in the few superlative funds that welcome giants like Yale. Skepticism will remind you that private funds are hyped by salespeople earning fat fees, that survivorship bias skews the reported numbers, and that even most institutional investors don't come out ahead on alternative assets. Margin for error. While the financial industry pressured many enterprising investors to lock up money in alternative funds that will charge high fees in perpetuity, it was goading others into putting money into perpetual motion. During the boom of 2020 to 21, many inexperienced investors bought risky assets with margin debt, money they borrowed from their broker. Like all forms of leverage, margin increases your potential gains and magnifies your potential losses. Many trading apps encouraged newly minted investors to take on margin by describing it as a way of doubling your buying power. Margin also doubles your losing power. Imagine you buy 100 shares of stock at $50 using 50% margin, the regulatory limit in the US. Of the $5,000 you paid, $2,500 is your money, $2,500 came from your broker. If the stock goes up to $75, the shares are worth a total of $7,500, a gain of $2,500 or a 100% profit on the money you put in. If you'd put up the entire $5,000 yourself without borrowing, you'd have only a 50% gain. What happens if the stock goes down, not up, $25? If you'd used only your own money to buy it, your holding would be worth $2,500, a 50% loss. If you used margin, that $2,500 loss would incinerate your entire investment. Point 7. Ben Graham himself was nearly wiped out by margin debt in the Great Depression, a mistake he never repeated. "I haven't the slightest doubt," he said in 1963, "that 9 people out of 10 who have margin accounts with brokers are ipso facto speculators." 8. I believe what Graham meant is that using margin can transform you, unwittingly and unwillingly, from an investor into a speculator. Let's say, to use Graham's words from Chapter 1, that upon thorough analysis, you've decided a stock promises safety of principal and an adequate return, and you intend to hold it for years, even decades. If you bought that stock on margin and it goes down, it has become even cheaper than when you first bought it. But you might no longer be able to buy more. You'll have to add cash to your account just to keep your broker from seizing the stock from you in a margin call. Constant updates from the brokerage app on your phone may crank up your anxiety. See the sidebar here. Fear could make you freak out and sell a stock you intended to hold. In 2022, margin loans plunged from $519 billion to $371 billion. According to the Federal Reserve, probably because brokerage customers paid them off with panic selling of stock to prevent even worse losses. One final point: hedge funds, private equity and private credit funds, as well as other alternative portfolios, commonly use leverage. Even though you might not have borrowed to invest in them, if they borrowed to buy their assets, then you have effectively taken on margin through them. That makes your overall portfolio riskier, a handicap the promoters of alternatives almost never mention. Absorbed. Half the world's population is expected to suffer from myopia by 2050. Although the problem is too new to have been comprehensively studied, some vision scientists believe that excessive use of smartphones may be contributing to this worldwide epidemic of nearsightedness. Just as staring at that little screen for a few hours every day might retrain your eye away from easily focusing on distant objects, so it might retrain your mind away from setting and achieving long-term investing goals. Studies in Brazil, China, South Korea, and elsewhere have found that young people who can't put their smartphones down tend to make impulsive decisions. Smartphone addicts prefer smaller rewards sooner over larger rewards later. They also are relatively indifferent to losses and struggle to distinguish profitable from unprofitable gambles. Overusing your smartphone may also impair your ability to solve math problems and think creatively. The people who run your online brokerage know all this. That's why they want you to trade using smartphone apps. The more time you spend on that device, the more often you're likely to trade, making money for the brokerage regardless of whether you make any for yourself. In the old days, you had to talk with your stockbroker over the phone or face-to-face before a purchase or sale. That and your broker's punitively high commissions introduced a layer of friction between your impulses and your actions. Your stockbroker was out to pick your pocket, and you knew it. Nowadays, your stockbroker is in your pocket, on your phone. That could lead not just to visual myopia, but investing myopia as well. Speculative fever. Another temptation for enterprising investors is to be a player, to join forces with celebrities and glide along in their slipstream toward greater wealth. In recent years, such wealthy influencers as professional athletes Stephen Curry and Serena Williams, musicians Justin Bieber and Eminem, and actors Gwyneth Paltrow and Kevin Hart touted their NFTs, or non-fungible tokens, helping set off a buying frenzy in these digital assets. Among the hottest of NFTs were the Bored Ape Yacht Club, colorful electronic caricatures of weary-eyed, stubbly-faced primates in sailor suits, sometimes selling for more than $1 million. By late 2022, trading volume had collapsed, and many NFTs had fallen in price by more than 90%. Perhaps no recent investment benefited more from famous backers than special purpose acquisition companies. SPACs have no assets or earnings. They're a bet on something that doesn't exist yet, as they raise money through an IPO, or initial public offering of stock, to buy other firms by a predetermined deadline, often 24 months. In 2020-21, such celebrity entrepreneurs as airline and music magnate Richard Branson and former Facebook executive Kamath Palihapitiya attracted countless investors to buy shares in their SPACs. For a brief and shining moment, fame seemed to ensure fortune. In 2020, 248 SPACs raised a total of $83 billion in the US. In 2021, 613 raised more than $160 billion, mostly in the beginning of the year. Gains of more than 50% in a single day attracted swarms of new buyers. Unfortunately, as Graham warns in Chapter 6, large and quick profits are sufficient to dull the public's critical faculty, just as they sharpen its acquisitive instinct. You can't build long-term wealth with blind faith bets that billionaires will act in your best interest, or that assets and earnings will materialize out of thin air. And if the only research you did was to notice the presence of a famous name, you forgot Graham's injunction that enterprising investors must commit significant time and energy before buying any asset. SPACs bristle with conflicts of interest. Even a glance at the IPO prospectus, or disclosure document, of the typical offering should unfurl blazing red flags, including: insiders pay as little as a tenth of a penny per share to control 20% of the company. Insiders reserve the right to compete directly against the SPAC with their own companies. Managers potentially get paid by acquisition targets, giving them incentives to recommend deals they personally benefit from. Independent directors, meant to serve as watchdogs, receive tens of thousands of shares at a fraction of market value. No assurance that insiders will remain invested in the SPAC. No assurance that the SPAC will ever find a business to buy. SPACs are often called blank check companies because outside investors give the insiders carte blanche to spend the proceeds on just about anything. Investment banks earn fees of 2% to 5% or more. Source: The Wall Street Journal. When insiders can make hundreds of millions of dollars for pushing an asset onto the investing public, they have an incentive to push very hard and to get out while the getting's good. As deal after deal fizzled, SPACs imploded. Between February and August 2021, SPACs lost $100 billion in combined market value. 9 Seldom has any investment turned so fast from a success to a slaughterhouse. No shortcuts. The problem isn't that investors never learn a lesson. It's that they learn the wrong lessons. If you speculated on NFTs or SPACs and got wiped out, the lesson you learned was probably never speculate on NFTs or SPACs again. The lesson you should have learned, however, is never speculate again. That's because the next bout of market madness won't tempt you with NFTs or SPACs. It will be some new disruption or transformation that sounds completely different and utterly seductive. Every investing craze turns out to be another iteration of the same old story, the quest for the holy grail of high returns at low risk with no work. In the 1980s and early 1990s, it was mutual funds run by active managers. In the mid-1990s, it was emerging markets. In the late 1990s, it was internet stocks. In the early 2000s, it was real estate. Then it was inverse funds that benefit from falling markets. Next it was private alternatives, then cryptocurrency, NFTs, and SPACs. The quest for the investing holy grail is always futile. To earn higher than average returns, you must take extra risk and you must commit additional time and effort. You're kidding yourself if you think there's a shortcut. Chapter 7. Portfolio Policy for the Enterprising Investor, The Positive Side. By Benjamin Graham. Subscribe, like and share our audiobook channel Trade Like Champions for more such contents. Happy investing. The enterprising investor, by definition, will devote a fair amount of his attention and efforts toward obtaining a better than run-of-the-mill investment result. In our discussion of general investment policy, we have made some suggestions regarding bond investments that are addressed chiefly to the enterprising investor. He might be interested in special opportunities of the following kinds. 1. Tax-free new housing authority bonds effectively guaranteed by the United States government. 2. Taxable but high-yielding new community bonds, also guaranteed by the United States government. 3. Tax-free industrial bonds issued by municipalities, but serviced by lease payments made by strong corporations. References have been made to these unusual types of bond issues in Chapter 4*. At the other end of the spectrum there may be lower quality bonds obtainable at such low prices as to constitute true bargain opportunities. But these would belong in the special situation area, where no true distinction exists between bonds and common stocks. Operations in common stocks. The activities specially characteristic of the enterprising investor in the common stock field may be classified under 4 heads. 1. Buying in low markets and selling in high markets. 2. Buying carefully chosen growth stocks. 3. Buying bargain issues of various types. 4. Buying into special situations. General market policy formula timing. We reserve for the next chapter our discussion of the possibilities and limitations of a policy of entering the market when it is depressed and selling out in the advanced stages of a boom. For many years in the past this bright idea appeared both simple and feasible, at least from first inspection of a market chart covering its periodic fluctuations. We have already admitted ruefully that the market's action in the past 20 years has not lent itself to operations of this sort on any mathematical basis. The fluctuations that have taken place, while not inconsiderable in extent, would have required a special talent or feel for trading to take advantage of them. This is something quite different from the intelligence which we are assuming in our readers, and we must exclude operations based on such skill from our terms of reference. The 50-50 plan, which we propose to the defensive investor and described here, is about the best specific or automatic formula we can recommend to all investors under the conditions of 1972. But we have retained a broad leeway between the 25% minimum and the 75% maximum in common stocks, which we allow to those investors who have strong convictions about either the danger or the attractiveness of the general market level. Some 20 years ago it was possible to discuss in great detail a number of clear-cut formulas for varying the percentage held in common stocks, with confidence that these plans had practical utility. 1. The time seemed to have passed such approaches by, and there would be little point in trying to determine new levels for buying and selling out of the market patterns since 1949. That is too short a period to furnish any reliable guide to the future. Growth stock approach. Every investor would like to select the stocks of companies that will do better than the average over a period of years. A growth stock may be defined as one that has done this in the past and is expected to do so in the future. 2. Thus it seems only logical that the intelligent investor should concentrate upon the selection of growth stocks. Actually, the matter is more complicated, as we shall try to show. It is a mere statistical chore to identify companies that have outperformed the averages in the past. The investor can obtain a list of 50 or 100 such enterprises from his broker. Why, then, should he not merely pick out the 15 or 20 most likely looking issues of this group and lo, he has a guaranteed successful stock portfolio? There are 2 catches to this simple idea. The first is that common stocks with good records and apparently good prospects sell at correspondingly high prices. The investor may be right in his judgment of their prospects and still not fare particularly well, merely because he has paid in full, and perhaps overpaid, for the expected prosperity. The second is that his judgment as to the future may prove wrong. Unusually rapid growth cannot keep up forever. When a company has already registered a brilliant expansion, its very increase in size makes a repetition of its achievement more difficult. At some point the growth curve flattens out, and in many cases it turns downward. It is obvious that if one confines himself to a few chosen instances, based on hindsight, he could demonstrate that fortunes can readily be either made or lost in the growth stock field. How can one judge fairly of the overall results obtainable here? We think that reasonably sound conclusions can be drawn from a study of the results achieved by the investment funds specializing in the growth stock approach. The authoritative manual entitled Investment Companies, published annually by Arthur Wiesenberger and Company, members of the New York Stock Exchange, computes the annual performance of some 120 such growth funds over a period of years. Of these, 45 have records covering 10 years or more. The average overall gain for these companies unweighted for size of fund works out at 108% for the decade 1961 to 1970, compared with 105% for the S&P Composite and 83% for the DJIA.3 in the 2 years 1969 and 1970. The majority of the 126 growth funds did worse than either index. Similar results were found in our earlier studies. The implication here is that no outstanding rewards came from diversified investment in growth companies as compared with that in common stocks generally. There is no reason at all for thinking that the average intelligent investor, even with much devoted effort, can derive better results over the years from the purchase of growth stocks than the investment companies specializing in this area. Surely these organizations have more brains and better research facilities at their disposal than you do. Consequently, we should advise against the usual type of growth stock commitment for the enterprising investor. This is one in which the excellent prospects are fully recognized in the market and already reflected in a current price-earnings ratio of, say, higher than 20. For the defensive investor, we suggested an upper limit of purchase price at 25 times average earnings of the past 7 years. The two criteria would be about equivalent in most cases. The striking thing about growth stocks as a class is their tendency toward wide swings in market price. This is true of the largest and longest established companies such as General Electric and International Business Machines, and even more so of newer and smaller successful companies. They illustrate our thesis that the main characteristic of the stock market since 1949 has been the injection of a highly speculative element into the shares of companies which have scored the most brilliant successes, and which themselves would be entitled to a high investment rating. Their credit standing is of the best, and they pay the lowest interest rates on their borrowings. The investment caliber of such a company may not change over a long span of years, but the risk characteristics of its stock will depend on what happens to it in the stock market. The more enthusiastic the public grows about it, and the faster its advance as compared with the actual growth in its earnings, the riskier a proposition it becomes. But is it not true, the reader may ask, that the really big fortunes from common stocks have been garnered by those who made a substantial commitment in the early years of a company in whose future they had great confidence, and who held their original shares unwaveringly while they increased 100-fold or more in value? The answer is yes. But the big fortunes from single company investments are almost always realized by persons who have a close relationship with the particular company through employment, family connection, etc., which justifies them in placing a large part of their resources in one medium and holding on to this commitment through all vicissitudes, despite numerous temptations to sell out at apparently high prices along the way. An investor without such close personal contact will constantly be faced with the question of whether too large a portion of his funds are in this one medium asterisk. Each decline, however temporary it proves in the sequel, will accentuate his problem, and internal and external pressures are likely to force him to take what seems to be a goodly profit, but one far less than the ultimate bonanza. Point 4. Table 7:1 Average results of growth funds, 1961, 1970. 3 recommended fields for enterprising investment. To obtain better than average investment results over a long pull requires a policy of selection or operation possessing a twofold merit. 1. It must meet objective or rational tests of underlying soundness, and 2. It must be different from the policy followed by most investors or speculators. Our experience and study leads us to recommend 3 investment approaches that meet these criteria. They differ rather widely from one another, and each may require a different type of knowledge and temperament on the part of those who essay it. The relatively unpopular large company. If we assume that it is the habit of the market to overvalue common stocks which have been showing excellent growth or are glamorous for some other reason, it is logical to expect that it will undervalue relatively, at least companies that are out of favor because of unsatisfactory developments of a temporary nature. This may be set down as a fundamental law of the stock market, and it suggests an investment approach that should prove both conservative and promising. The key requirement here is that the enterprising investor concentrate on the larger companies that are going through a period of unpopularity. While small companies may also be undervalued for similar reasons, and in many cases may later increase their earnings and share price, they entail the risk of a definitive loss of profitability and also of protracted neglect by the market in spite of better earnings. The large companies thus have a double advantage over the others. First, they have the resources in capital and brain power to carry them through adversity and back to a satisfactory earnings base. Second, the market is likely to respond with reasonable speed to any improvement shown. A remarkable demonstration of the soundness of this thesis is found in studies of the price behavior of the unpopular issues in the Dow Jones Industrial Average. In these it was assumed that an investment was made each year in either the 6 or the 10 issues in the DJIA which were selling at the lowest multipliers of their current or previous year's earnings. These could be called the cheapest stocks in the list, and their cheapness was evidently the reflection of relative unpopularity with investors or traders. It was assumed further that these purchases were sold out at the end of holding periods ranging from 1 to 5 years. The results of these investments were then compared with the results shown in either the DJIA as a whole or in the highest multiplier, i.e., the most popular, group. The detailed material we have available covers the results of annual purchases assumed in each of the past 53 years. 5 In the early period, 1917 to 1933, this approach proved unprofitable. But since 1933 the method has shown highly successful results. In 34 tests made by Drexel and Company, now Drexel Firestone, of 1 year holding from 1937 through 1969, the cheap stocks did definitely worse than the DJIA in only 3 instances. The results were about the same in 6 cases, and the cheap stocks clearly outperformed the average in 25 years. The consistently better performance of the low multiplier stocks is shown, Table 7:2, by the average results for successive 5-year periods, when compared with those of the DJIA and of the 10 high multipliers. The Drexel computation shows further that an original investment of $10,000 made in the low multiplier issues in 1936, and switched each year in accordance with the principle, would have grown to $66,900 by 1962. The same operations in high multiplier stocks would have ended with a value of only $25,300, while an operation in all 30 stocks would have increased the original fund to $44,000. The concept of buying unpopular large companies and its execution on a group basis, as described above, are both quite simple. But in considering individual companies, a special factor of opposite import must sometimes be taken into account. Companies that are inherently speculative because of widely varying earnings tend to sell both at a relatively high price and at a relatively low multiplier in their good years, and conversely at low prices and high multipliers in their bad years. These relationships are illustrated in Table 7-3, covering fluctuations of Chrysler Corp common. In these cases, the market has sufficient skepticism as to the continuation of the unusually high profits to value them conservatively, and conversely when earnings are low or non-existent. Note that, by the arithmetic, if a company earns next to nothing, its shares must sell at a high multiplier of these minuscule profits. As it happens, Chrysler has been quite exceptional in the DJIA list of leading companies, and hence it did not greatly affect the low multiplier calculations. It would be quite easy to avoid inclusion of such anomalous issues in a low multiplier list by requiring also that the price be low in relation to past average earnings or by some similar test. While writing this revision, we tested the results of the DJIA low multiplier method applied to a group assumed to be bought at the end of 1968 and revalued on June 30, 1971. This time the figures proved quite disappointing, showing a sharp loss for the low multiplier 6 or 10 and a good profit for the high multiplier selections. This one bad instance should not vitiate conclusions based on 30-odd experiments, but its recent happening gives it a special adverse weight. Perhaps the aggressive investor should start with the low multiplier idea, but add other quantitative and qualitative requirements thereto in making up his portfolio. Purchase of bargain issues. We define a bargain issue as one which, on the basis of facts established by analysis, appears to be worth considerably more than it is selling for. The genus includes bonds and preferred stocks selling well under par, as well as common stocks. To be as concrete as possible, let us suggest that an issue is not a true bargain unless the indicated value is at least 50% more than the price. What kind of facts would warrant the conclusion that so great a discrepancy exists? How do bargains come into existence, and how does the investor profit from them? There are two tests by which a bargain common stock is detected. The first is by the method of appraisal. This relies largely on estimating future earnings and then multiplying these by a factor appropriate to the particular issue. If the resultant value is sufficiently above the market price and if the investor has confidence in the technique employed, he can tag the stock as a bargain. The second test is the value of the business to a private owner. This value also is often determined chiefly by expected future earnings, in which case the result may be identical with the first. But in the second test, more attention is likely to be paid to the realizable value of the assets, with particular emphasis on the net current assets or working capital. At low points in the general market, a large proportion of common stocks are bargain issues, as measured by these standards. A typical example was General Motors when it sold at less than 30 in 1941, equivalent to only 5 for the 1971 shares. It had been earning in excess of $4 and paying $3.50, or more, in dividends. It is true that current earnings and the immediate prospects may both be poor, but a level-headed appraisal of average future conditions would indicate values far above ruling prices. Thus the wisdom of having courage in depressed markets is vindicated not only by the voice of experience but also by application of plausible techniques of value analysis. The same vagaries of the marketplace that recurrently establish a bargain condition in the general list account for the existence of many individual bargains at almost all market levels. The market is fond of making mountains out of molehills and exaggerating ordinary vicissitudes into major setbacks. Even a mere lack of interest or enthusiasm may impel a price decline to absurdly low levels. Thus we have what appear to be two major sources of undervaluation: 1. Currently disappointing results, and 2. Protracted neglect or unpopularity. However, neither of these causes, if considered by itself alone, can be relied on as a guide to successful common stock investment. How can we be sure that the currently disappointing results are indeed going to be only temporary? True, we can supply excellent examples of that happening. The steel stocks used to be famous for their cyclical quality, and the shrewd buyer could acquire them at low prices when earnings were low and sell them out in boom years at a fine profit. A spectacular example is supplied by Chrysler Corporation, as shown by the data in Table 7-3. If this were the standard behavior of stocks with fluctuating earnings, then making profits in the stock market would be an easy matter. Unfortunately, we could cite many examples of declines in earnings and price which were not followed automatically by a handsome recovery of both. One such was Anaconda Wire and Cable, which had large earnings up to 1956. With a high price of $85 in that year. The earnings then declined irregularly for 6 years. The price fell to 23½ in 1962, and the following year it was taken over by its parent enterprise, Anaconda Corporation, at the equivalent of only 33. The many experiences of this type suggest that the investor would need more than a mere falling off in both earnings and price to give him a sound basis for purchase. He should require an indication of at least reasonable stability of earnings over the past decade or more, i.e., no year of earnings deficit plus sufficient size and financial strength to meet possible setbacks in the future. The ideal combination here is thus that of a large and prominent company selling both well below its past average price and its past average price/earnings multiplier. This would no doubt have ruled out most of the profitable opportunities in companies such as Chrysler, since their low price years are generally accompanied by high price/earnings ratios. But let us assure the reader now, and no doubt we shall do it again, that there is a world of difference between hindsight profits and real money profits. We doubt seriously whether the Chrysler type of roller coaster is a suitable medium for operations by our enterprising investor. We have mentioned protracted neglect or unpopularity as a second cause of price declines to unduly low levels. A current case of this kind would appear to be National Presto Industries. In the bull market of 1968 it sold at a high of 45, which was only 8 times the $5.61 earnings for that year. The per-share profits increased in both 1969 and 1970, but the price declined to only 21 in 1970. This was less than 4 times the record earnings in that year and less than its net current asset value. In March 1972 it was selling at 34, still only 5½ times the last reported earnings, and at about its enlarged net current asset value. Another example of this type is provided currently by Standard Oil of California, a concern of major importance. In early 1972 it was selling at about the same price as 13 years before, say 56. Its earnings had been remarkably steady, with relatively small growth but with only one small decline over the entire period. Its book value was about equal to the market price. With this conservatively favorable 1958-71 record, the company has never shown an average annual price as high as 15 times its current earnings. In early 1972 the price/earnings ratio was only about 10. A third cause for an unduly low price for a common stock may be the market's failure to recognize its true earnings picture. Our classic example here is Northern Pacific Railway, which in 1946-47 declined from 36 to 13½. The true earnings of the road in 1947 were close to $10 per share. The price of the stock was held down in great part by its $1 dividend. It was neglected also because much of its earnings power was concealed by accounting methods peculiar to railroads. The type of bargain issue that can be most readily identified is a common stock that sells for less than the company's net working capital alone, after deducting all prior obligations. This would mean that the buyer would pay nothing at all for the fixed assets, buildings, machinery, etc., or any goodwill items that might exist. Very few companies turn out to have an ultimate value less than the working capital alone, although scattered instances may be found. The surprising thing, rather, is that there have been so many enterprises obtainable which have been valued in the market on this bargain basis. A compilation made in 1957, when the market's level was by no means low, disclosed about 150 of such common stocks. In Table 7-4 we summarize the result of buying, on December 31, 1957, one share of each of the 85 companies in that list for which data appeared in Standard & Poor's monthly stock guide, and holding them for 2 years. By something of a coincidence, each of the groups advanced in the 2 years to somewhere in the neighborhood of the aggregate net current asset value. The gain for the entire portfolio in that period was 75%, against 50% for Standard & Poor's 425 industrials. What is more remarkable is that none of the issues showed significant losses, 7 held about even, and 78 showed appreciable gains. Our experience with this type of investment selection on a diversified basis was uniformly good for many years prior to 1957. It can probably be affirmed without hesitation that it constitutes a safe and profitable method of determining and taking advantage of undervalued situations. However, during the general market advance after 1957, the number of such opportunities became extremely limited, and many of those available were showing small operating profits or even losses. The market decline of 1969 to 70 produced a new crop of these sub-working capital stocks. We discuss this group in Chapter 15, on stock selection for the enterprising investor. We have defined a secondary company as one that is not a leader in a fairly important industry. Thus it is usually one of the smaller concerns in its field, but it may equally well be the chief unit in an unimportant line. By way of exception, any company that has established itself as a growth stock is not ordinarily considered secondary. In the great bull market of the 1920s, relatively little distinction was drawn between industry leaders and other listed issues, provided the latter were of respectable size. The public felt that a middle-sized company was strong enough to weather storms and that it had a better chance for really spectacular expansion than one that was already of major dimensions. The Depression years 1931 to 32, however, had a particularly devastating impact on the companies below the first rank, either in size or in inherent stability. As a result of that experience, investors have since developed a pronounced preference for industry leaders and a corresponding lack of interest most of the time in the ordinary company of secondary importance. This has meant that the latter group have usually sold at much lower prices in relation to earnings and assets than have the former. It has meant further that in many instances the price has fallen so low as to establish the issue in the bargain class asterisk. When investors rejected the stocks of secondary companies, even though these sold at relatively low prices, they were expressing a belief or fear that such companies faced a dismal future. In fact, at least subconsciously, they calculated that any price was too high for them because they were heading for extinction, just as in 1929 the companion theory for the blue chips was that no price was too high for them because their future possibilities were limitless. Both of these views were exaggerations and were productive of serious investment errors. Actually, the typical middle-sized listed company is a large one when compared with the average privately owned business. There is no sound reason why such companies should not continue indefinitely in operation, undergoing the vicissitudes characteristic of our economy but earning on the whole a fair return on their invested capital. This brief review indicates that the stock market's attitude towards secondary companies tends to be unrealistic and consequently to create in normal times innumerable instances of major undervaluation. As it happens, the World War II period and the post-war boom were more beneficial to the smaller concerns than to the larger ones, because then the normal competition for sales was suspended and the former could expand sales and profit margins more spectacularly. Thus by 1946 the market's pattern had completely reversed itself from that before the war. Whereas the leading stocks in the Dow Jones Industrial Average had advanced only 40% from the end of 1938 to the 1946 high, Standard & Poor's index of low-priced stocks had shot up no less than 280% in the same period. Speculators and many self-styled investors with the proverbial short memories of people in the stock market were eager to buy both old and new issues of unimportant companies at inflated levels. Thus the pendulum had swung clear to the opposite extreme. The very class of secondary issues that had formerly supplied by far the largest proportion of bargain opportunities was now presenting the greatest number of examples of overenthusiasm and overvaluation. In a different way this phenomenon was repeated in 1961 and 1968, the emphasis now being placed on new offerings of the shares of small companies of less than secondary character, and on nearly all companies in certain favored fields such as electronics, computers, franchise concerns, and others. As was to be expected, the ensuing market declines fell most heavily on these overvaluations. In some cases the pendulum swing may have gone as far as definite undervaluation. If most secondary issues tend normally to be undervalued, what reason has the investor to believe that he can profit from such a situation? For if it persists indefinitely, will he not always be in the same market position as when he bought the issue? The answer here is somewhat complicated. Substantial profits from the purchase of secondary companies at bargain prices arise in a variety of ways. First, the dividend return is relatively high. Second, the reinvested earnings are substantial in relation to the price paid and will ultimately affect the price. In a 5 to 7 year period these advantages can bulk quite large in a well-selected list. Third, a bull market is ordinarily most generous to low-priced issues, thus it tends to raise the typical bargain issue to at least a reasonable level. Fourth, even during relatively featureless market periods a continuous process of price adjustment goes on, under which secondary issues that were undervalued may rise at least to the normal level for their type of security. Fifth, the specific factors that in many cases made for a disappointing record of earnings may be corrected by the advent of new conditions, or the adoption of new policies, or by a change in management. An important new factor in recent years has been the acquisition of smaller companies by larger ones, usually as part of a diversification program. In these cases the consideration paid has almost always been relatively generous, and much in excess of the bargain levels existing not long before. When interest rates were much lower than in 1970, the field of bargain issues extended to bonds and preferred stocks that sold at large discounts from the amount of their claim. Currently we have a different situation in which even well-secured issues sell at large discounts if carrying coupon rates of, say, 4.5% or less. Example, American Telephone and Telegraph 258s, due 1986, sold as low as 51 in 1970, Deere & Co 4.5s, due 1983, sold as low as 62. These may well turn out to have been bargain opportunities before very long if ruling interest rates should decline substantially. For a bargain bond issue in the more traditional sense, perhaps we shall have to turn once more to the first mortgage bonds of railroads now in financial difficulties, which sell in the 20s or 30s. Such situations are not for the inexpert investor. Lacking a real sense of values in this area, he may burn his fingers. But there is an underlying tendency for market decline in this field to be overdone, Consequently, the group as a whole offers an especially rewarding invitation to careful and courageous analysis. In the decade ending in 1948, the billion-dollar group of defaulted railroad bonds presented numerous and spectacular opportunities in this area. Such opportunities have been quite scarce since then, but they seem likely to return in the 1970s. Special situations or workouts. Not so long ago, this was a field which could almost guarantee an attractive rate of return to those who knew their way around in it, and this was true under almost any sort of general market situation. It was not actually forbidden territory to members of the general public. Some who had a flair for this sort of thing could learn the ropes and become pretty capable practitioners without the necessity of long academic study or apprenticeship. Others have been keen enough to recognize the underlying soundness of this approach and to attach themselves to bright young men who handled funds devoted chiefly to these special situations. But in recent years, for reasons we shall develop later, the field of arbitrages and workouts became riskier and less profitable. It may be that in years to come conditions in this field will become more propitious. In any case, it is worthwhile outlining the general nature and origin of these operations, with one or two illustrative examples. The typical special situation has grown out of the increasing number of acquisitions of smaller firms by large ones, as the gospel of diversification of products has been adopted by more and more managements. It often appears good business for such an enterprise to acquire an existing company in the field it wishes to enter rather than to start a new venture from scratch. In order to make such acquisition possible, and to obtain acceptance of the deal by the required large majority of shareholders of the smaller company, it is almost always necessary to offer a price considerably above the current level. Such corporate moves have been producing interesting profit-making opportunities for those who have made a study of this field, and have good judgment fortified by ample experience. A great deal of money was made by shrewd investors not so many years ago through the purchase of bonds of railroads in bankruptcy bonds which they knew would be worth much more than their cost when the railroads were finally reorganized. After promulgation of the plans of reorganization, a when-issued market for the new securities appeared. These could almost always be sold for considerably more than the cost of the old issues which were to be exchanged therefor. There were risks of non-consummation of the plans or of unexpected delays, but on the whole such arbitrage operations proved highly profitable. There were similar opportunities growing out of the breakup of public utility holding companies pursuant to 1935 legislation. Nearly all these enterprises proved to be worth considerably more when changed from holding companies to a group of separate operating companies. The underlying factor here is the tendency of the security markets to undervalue issues that are involved in any sort of complicated legal proceedings. An old Wall Street motto has been, "Never buy into a lawsuit." This may be sound advice to the speculator seeking quick action on his holdings. But the adoption of this attitude by the general public is bound to create bargain opportunities in the securities affected by it, since the prejudice against them holds their prices down to unduly low levels. The exploitation of special situations is a technical branch of investment which requires a somewhat unusual mentality and equipment. Probably only a small percentage of our enterprising investors are likely to engage in it. And this book is not the appropriate medium for expounding its complications. 6. Broader implications of our rules for investment. Investment policy, as it has been developed here, depends in the first place on a choice by the investor of either the defensive, passive, or aggressive, enterprising, role. The aggressive investor must have a considerable knowledge of security values enough, in fact, to warrant viewing his security operations as equivalent to a business enterprise. There is no room in this philosophy for a middle ground, or a series of gradations, between the passive and aggressive status. Many, perhaps most, investors seek to place themselves in such an intermediate category, in our opinion that is a compromise that is more likely to produce disappointment than achievement. As an investor you cannot soundly become half a businessman, expecting thereby to achieve half the normal rate of business profits on your funds. It follows from this reasoning that the majority of security owners should elect the defensive classification. They do not have the time, or the determination, or the mental equipment to embark upon investing as a quasi-business. They should therefore be satisfied with the excellent return now obtainable from a defensive portfolio, and with even less, and they should stoutly resist the recurrent temptation to increase this return by deviating into other paths. The enterprising investor may properly embark upon any security operation for which his training and judgment are adequate and which appears sufficiently promising when measured by established business standards. In our recommendations and caveats for this group of investors we have attempted to apply such business standards. In those for the defensive investor we have been guided largely by the three requirements of underlying safety, simplicity of choice, and promise of satisfactory results, in terms of psychology as well as arithmetic. The use of these criteria has led us to exclude from the field of recommended investment a number of security classes that are normally regarded as suitable for various kinds of investors. These prohibitions were listed in our first chapter here. Let us consider a little more fully than before what is implied in these exclusions. We have advised against the purchase at full prices of three important categories of securities: 1. Foreign bonds, 2. Ordinary preferred stocks, and 3. Secondary common stocks, including, of course, original offerings of such issues. By full prices we mean prices close to par for bonds or preferred stocks, and prices that represent about the fair business value of the enterprise in the case of common stocks. The greater number of defensive investors are to avoid these categories regardless of price. The enterprising investor is to buy them only when obtainable at bargain prices, which we define as prices not more than 2/3 of the appraisal value of the securities. What would happen if all investors were guided by our advice in these matters? That question was considered in regard to foreign bonds, here, and we have nothing to add at this point. Investment-grade preferred stocks would be bought solely by corporations, such as insurance companies, which would benefit from the special income tax status of stock issues owned by them. The most troublesome consequence of our policy of exclusion is in the field of secondary common stocks. If the majority of investors, being in the defensive class, are not to buy them at all, the field of possible buyers becomes seriously restricted. Furthermore, if aggressive investors are to buy them only at bargain levels, then these issues would be doomed to sell for less than their fair value, except to the extent that they were purchased unintelligently. This may sound severe and even vaguely unethical. Yet in truth we are merely recognizing what has actually happened in this area for the greater part of the past 40 years. Secondary issues, for the most part, do fluctuate about a central level which is well below their fair value. They reach and even surpass that value at times, but this occurs in the upper reaches of bull markets, when the lessons of practical experience would argue against the soundness of paying the prevailing prices for common stocks. Thus we are suggesting only that aggressive investors recognize the facts of life as it is lived by secondary issues and that they accept the central market levels that are normal for that class as their guide in fixing their own levels for purchase. There is a paradox here, nevertheless. The average well-selected secondary company may be fully as promising as the average industrial leader. What the smaller concern lacks in inherent stability it may readily make up in superior possibilities of growth. Consequently it may appear illogical to many readers to term unintelligent the purchase of such secondary issues at their full enterprise value. We think that the strongest logic is that of experience. Financial history says clearly that the investor may expect satisfactory results, on the average, from secondary common stocks only if he buys them for less than their value to a private owner, that is, on a bargain basis. The last sentence indicates that this principle relates to the ordinary outside investor. Anyone who can control a secondary company, or who is part of a cohesive group with such control, is fully justified in buying the shares on the same basis as if he were investing in a close corporation or other private business. The distinction between the position, and consequent investment policy, of insiders and of outsiders becomes more important as the enterprise itself becomes less important. It is a basic characteristic of a primary or leading company that a single detached share is ordinarily worth as much as a share in a controlling block. In secondary companies, the average market value of a detached share is substantially less than its worth to a controlling owner. Because of this fact, the matter of shareholder management relations and of those between inside and outside shareholders tends to be much more important and controversial in the case of secondary than in that of primary companies. At the end of Chapter 5 we commented on the difficulty of making any hard and fast distinction between primary and secondary companies. The many common stocks in the boundary area may properly exhibit an intermediate price behavior. It would not be illogical for an investor to buy such an issue at a small discount from its indicated or appraisal value, on the theory that it is only a small distance away from a primary classification and that it may acquire such a rating unqualifiedly in the not-too-distant future. Thus the distinction between primary and secondary issues need not be made too precise, for, if it were, then a small difference in quality must produce a large differential in justified purchase price. In saying this, we are admitting a middle ground in the classification of common stocks, although we counseled against such a middle ground in the classification of investors. Our reason for this apparent inconsistency is as follows: no great harm comes from some uncertainty of viewpoint regarding a single security, because such cases are exceptional and not a great deal is at stake in the matter. But the investor's choice as between the defensive or the aggressive status is of major consequence to him, and he should not allow himself to be confused or compromised in this basic decision. Commentary on Chapter 7 by Jason Zweig. There's a person in my life I just do not trust. And that person is me. You should not trust yourself. Decisions. It's like handing over bubble wrap to a 5-year-old. You know what's going to happen. Senthil Mullainathan 1. Graham has already told us that even enterprising investors should never put 100% of their assets in stocks. Point 2. Risk is a function not only of the probabilities of being right, but of the consequences if you turn out to be wrong. No matter how bullish you feel, your judgments could still be mistaken. And by never putting all or none of your money in stocks, you protect yourself against the most extreme consequences of being wrong. You must also protect against less severe consequences, to those that arise from repeated and avoidable mistakes. The costs of unforced errors can turn what would have been superior returns into underperformance. Pretend portfolios. The first step for an enterprising investor is to test your ideas and train yourself. To do that, Graham urges, you should spend a full year studying and picking a few stocks, but don't buy any. Point 3. Just about every brokerage or investing website and app enables you to track stocks in a model portfolio without putting up any money. Creating a pretend portfolio in an online portfolio tracker is the equivalent of being an actor or musician rehearsing behind closed doors before a public performance. Use your pretend portfolio to see what works. The point isn't to make the most money in the shortest time you aren't using real money, but to see whether you can develop a system to identify good businesses whose stocks are undervalued. To assemble your portfolio, follow a checklist. See gut check in the commentary on Chapter 11. Hang on to all your picks for the full year, don't trade in and out. Judge your success less by how much your stock picks go up than by how many of them go up and why. Did they rise in price because the original rationale in your checklist was right or for reasons you didn't anticipate or understand? Over the course of the year, continue to read the company's financial statements, sample their products or services, and learn about their competitors. When the 12 months are up, take a hard look at your pretend portfolio. Compare its performance against that of a broad market index like the S&P 500. It should be obvious whether you are good at this, getting better, or have no aptitude. If your pretend portfolio's results are significantly worse than those of the benchmark, you have a lot more to learn about investing and might not be prepared to put in the time and effort that will take. Maybe you should concede that you're a defensive investor and you should feel no shame in doing so. Graham's final fund. Late in life, Graham advocated what he called a group approach, buying baskets of stocks that all met simple criteria of cheapness regardless of the industry and with very little attention to the individual company. Graham should be regarded as a pioneer of what today is often called factor or smart beta investing, holding bundles of stocks that all clear a set of statistical hurdles. After studying 50 years of data to determine the past performance of hypothetical portfolios of stocks with various characteristics, Graham recommended looking for companies with 1. Debt no greater than equity, 50% or less of total capital. 2. An annual dividend at least 2/3 as high as the yield on high-quality corporate bonds, then, a dividend of at least 5%, today, with investment-grade bonds yielding 5.5%, a dividend of at least 3.7%. 3. An earnings yield net income per share divided by price per share that was at least twice the yield on high-quality corporate bonds, in Graham's day, an earnings yield of 14, today, approximately 11.1. Graham's junior research partner, James Aurier, formed a fund in 1976 to pursue this approach. Its design was a bit odd. The fund would keep 1/3 of its portfolio in U.S. government bonds, 1/3 in companies whose shares were trading at less than net current asset value, and 1/3 in stocks that passed Graham's dividend and earnings tests. It would sell any holding after a 50% gain or after 2 years, whichever came first. Graham died a few months later. The Aurier-Graham fund earned robust gains for several years, then faded into obscurity. It seems to have faltered because it sold its winners too soon, held bonds in a time of rising inflation, and rejiggered its rules after Graham's death. To turn a pretend portfolio into a real one, consistency is key. 1. Earnings yield and the more commonly used price/earnings ratio are reciprocal. When a stock has an earnings yield of 11, its P/E ratio is 1/11*100 equals 9.1. When the P/E is 50, the earnings yield is 2. Weight watching. Another way to structure your decisions so you don't rely on gut feelings alone, keep a watch list of companies you're already familiar with and would like to own if their stock prices fall to bargain levels. Many brokerage websites permit you to set up notifications that will alert you whenever a stock falls below a target price, which you might set, for example, 25% below where it is now. If you've already analyzed the business thoroughly enough to be confident of the price range within which its stock would be attractive, mark your watch list to flag the stock for you if it falls to that range. While you wait, continue to read the company's financial reports to make sure it remains healthy. That way, if the stock takes a dive but the business is unimpaired, you will be ready to buy. A watch list helps override the instinctive, destructive tendency to buy high and sell low. It automatically compels you to consider buying low and to embrace a falling market rather than flee from it. Memorialize your mistakes. In the offices of Davis Advisors in New York, at least 12 framed stock certificates hang on what's called the mistake wall. Among them, American International Group, which fell 96% in 2008, and Lucent Technologies, which dropped 94% between 1999 and 2001. The mistake wall includes both sins of commission, or misinterpretations of available data, and sins of omission, or failures to take all relevant information into account. The stock certificates are unavoidable daily reminders that something went wrong, while brief descriptions of each explain what went wrong. Davis keeps even more records of its mistakes in extensive files on each of the companies. The idea, says Chairman Christopher Davis, is to shift the focus from outcome, how bad the decision was, to process, what led to the bad decision and how to avoid repeating it. That helps the firm recognize when it may be about to echo a mistake it's made before. It gives us a toolkit that makes it easier for people to change their minds, says Davis. It's a way to evaluate our work that helps keep us more focused on the North Star of valuing businesses versus just trading stocks. You should memorialize your mistakes, too. You don't need to use a stock certificate. Put a sample of a company's products in your home office, post an image of its logo on your wall, your computer monitor, or your desktop. Remember, too, that your mistakes aren't just the stocks you bought that you shouldn't have. If you're serious about being an enterprising investor, you'll use a portfolio tracker to monitor not only the stocks you hold but the stocks you sold. Are the companies you no longer own doing better than the ones you kept? Then you're probably making the common mistake of selling too soon. You'll also track the stocks you considered buying but didn't. Are the ones you almost bought doing better than those you did buy? Then you need to refine the criteria in your checklist and watch list. You can't be an investor without taking risks, and you can't take risks without making mistakes. But you can't learn from your mistakes if you never admit you make any. Only by studying your mistakes can you keep improving your policies and procedures. Making fewer mistakes will help you incur fewer and smaller losses. And that will give you more capital to work with, enabling you to make the most of your skills as they improve. Chapter 8. The Investor and Market Fluctuations. By Benjamin Graham. Subscribe, like and share our audiobook channel Trade Like Champions for more such contents. Happy investing. To the extent that the investor's funds are placed in high-grade bonds of relatively short maturity, say, of 7 years or less, he will not be affected significantly by changes in market prices and need not take them into account. This applies also to his holdings of U.S. savings bonds, which he can always turn in at his cost price or more. His longer-term bonds may have relatively wide price swings during their lifetimes, and his common stock portfolio is almost certain to fluctuate in value over any period of several years. The investor should know about these possibilities and should be prepared for them both financially and psychologically. He will want to benefit from changes in market levels, certainly through an advance in the value of his stock holdings as time goes on, and perhaps also by making purchases and sales at advantageous prices. This interest on his part is inevitable, and legitimate enough. But it involves the very real danger that it will lead him into speculative attitudes and activities. It is easy for us to tell you not to speculate, the hard thing will be for you to follow this advice. Let us repeat what we said at the outset: if you want to speculate, do so with your eyes open, knowing that you will probably lose money in the end. Be sure to limit the amount at risk and to separate it completely from your investment program. We shall deal first with the more important subject of price changes in common stocks, and pass later to the area of bonds. In Chapter 3 we supplied a historical survey of the stock market's action over the past 100 years. In this section we shall return to that material from time to time, in order to see what the past record promises the investor in either the form of long-term appreciation of a portfolio held relatively unchanged through successive rises and declines, or in the possibilities of buying near bear market lows and selling not too far below bull market highs. Market fluctuations as a guide to investment decisions. Since common stocks, even of investment grade, are subject to recurrent and wide fluctuations in their prices, the intelligent investor should be interested in the possibilities of profiting from these pendulum swings. There are two possible ways by which he may try to do this, the way of timing and the way of pricing. By timing we mean the endeavor to anticipate the action of the stock market to buy or hold when the future course is deemed to be upward, to sell or refrain from buying when the course is downward. By pricing we mean the endeavor to buy stocks when they are quoted below their fair value and to sell them when they rise above such value. A less ambitious form of pricing is the simple effort to make sure that when you buy you do not pay too much for your stocks. This may suffice for the defensive investor, whose emphasis is on long pull holding, but as such it represents an essential minimum of attention to market levels. 1. We are convinced that the intelligent investor can derive satisfactory results from pricing of either type. We are equally sure that if he places his emphasis on timing, in the sense of forecasting, he will end up as a speculator and with a speculator's financial results. This distinction may seem rather tenuous to the layman. And it is not commonly accepted on Wall Street. As a matter of business practice, or perhaps of thoroughgoing conviction, the stockbrokers and the investment services seem wedded to the principle that both investors and speculators in common stocks should devote careful attention to market forecasts. The farther one gets from Wall Street, the more skepticism one will find, we believe, as to the pretensions of stock market forecasting or timing. The investor can scarcely take seriously the innumerable predictions which appear almost daily and are his for the asking. Yet in many cases he pays attention to them and even acts upon them. Why? Because he has been persuaded that it is important for him to form some opinion of the future course of the stock market, and because he feels that the brokerage or service forecast is at least more dependable than his own asterisk. We lack space here to discuss in detail the pros and cons of market forecasting. A great deal of brain power goes into this field, and undoubtedly some people can make money by being good stock market analysts. But it is absurd to think that the general public can ever make money out of market forecasts. For who will buy when the general public, at a given signal, rushes to sell out at a profit? If you, the reader, expect to get rich over the years by following some system or leadership in market forecasting, you must be expecting to try to do what countless others are aiming at, and to be able to do it better than your numerous competitors in the market. There is no basis either in logic or in experience for assuming that any typical or average investor can anticipate market movements more successfully than the general public, of which he is himself a part. There is one aspect of the timing philosophy which seems to have escaped everyone's notice. Timing is of great psychological importance to the speculator because he wants to make his profit in a hurry. The idea of waiting a year before his stock moves up is repugnant to him. But a waiting period, as such, is of no consequence to the investor. What advantage is there to him in having his money uninvested until he receives some, presumably, trustworthy signal that the time has come to buy? He enjoys an advantage only if by waiting he succeeds in buying later at a sufficiently lower price to offset his loss of dividend income. What this means is that timing is of no real value to the investor unless it coincides with pricing, that is, unless it enables him to repurchase his shares at substantially under his previous selling price. In this respect the famous Dow theory for timing purchases and sales has had an unusual history. Briefly, this technique takes its signal to buy from a special kind of breakthrough of the stock averages on the upside, and its selling signal from a similar breakthrough on the downside. The calculated, not necessarily actual results of using this method showed an almost unbroken series of profits in operations from 1897 to the early 1960s. On the basis of this presentation, the practical value of the doubt theory would have appeared firmly established. The doubt, if any, would apply to the dependability of this published record as a picture of what a doubt theorist would actually have done in the market. A closer study of the figures indicates that the quality of the results shown by the doubt theory changed radically after 1938, a few years after the theory had begun to be taken seriously on Wall Street. Its spectacular achievement had been in giving a sell signal, at 306, about a month before the 1929 crash, and in keeping its followers out of the long bear market until things had pretty well righted themselves, at 84, in 1933. But from 1938 on, the doubt theory operated mainly by taking its practitioners out at a pretty good price but then putting them back in again at a higher price. For nearly 30 years thereafter, one would have done appreciably better by just buying and holding the DJIA.2. In our view, based on much study of this problem, the change in the doubt theory results is not accidental. It demonstrates an inherent characteristic of forecasting and trading formulas in the fields of business and finance. Those formulas that gain adherence and importance do so because they have worked well over a period, or sometimes merely because they have been plausibly adapted to the statistical record of the past. But as their acceptance increases, their reliability tends to diminish. This happens for two reasons. First, the passage of time brings new conditions which the old formula no longer fits. Second, in stock market affairs, the popularity of a trading theory has itself an influence on the market's behavior which detracts in the long run from its profit-making possibilities. The popularity of something like the doubt theory may seem to create its own vindication, since it would make the market advance or decline by the very action of its followers when a buying or selling signal is given. A stampede of this kind is, of course, much more of a danger than an advantage to the public trader. Buy low, sell high approach. We are convinced that the average investor cannot deal successfully with price movements by endeavoring to forecast them. Can he benefit from them after they have taken place, i.e., by buying after each major decline and selling out after each major advance? The fluctuations of the market over a period of many years prior to 1950 lent considerable encouragement to that idea. In fact, a classic definition of a shrewd investor was one who bought in a bear market when everyone else was selling, and sold out in a bull market when everyone else was buying. If we examine our chart I, covering the fluctuations of the Standard & Poor's Composite Index between 1900 and 1970, and the supporting figures in Table 3:1, we can readily see why this viewpoint appeared valid until fairly recent years. Between 1897 and 1949 there were 10 complete market cycles, running from bear market low to bull market high and back to bear market low. 6 of these took no longer than 4 years, 4 ran for 6 or 7 years, and one, the famous New Era cycle of 1921-1932, lasted 11 years. The percentage of advance from the lows to highs ranged from 44% to 500%, with most between about 50% and 100%. The percentage of subsequent declines ranged from 24% to 89%, with most found between 40% and 50%. It should be remembered that a decline of 50% fully offsets a preceding advance of 100%. Nearly all the bull markets had a number of well-defined characteristics in common, such as 1. A historically high price level, 2. High price/earnings ratios, 3. Low dividend yields as against bond yields, 4. Much speculation on margin, and 5. Many offerings of new common stock issues of poor quality. Thus to the student of stock market history it appeared that the intelligent investor should have been able to identify the recurrent bear and bull markets, to buy in the former and sell in the latter, and to do so for the most part at reasonably short intervals of time. Various methods were developed for determining buying and selling levels of the general market, based on either value factors or percentage movements of prices or both. But we must point out that even prior to the unprecedented bull market that began in 1949, there were sufficient variations in the successive market cycles to complicate and sometimes frustrate the desirable process of buying low and selling high. The most notable of these departures, of course, was the great bull market of the late 1920s, which threw all calculations badly out of gear even in 1949, therefore, it was by no means a certainty that the investor could base his financial policies and procedures mainly on the endeavor to buy at low levels in bear markets and to sell out at high levels in bull markets. It turned out, in the sequel, that the opposite was true. The market's behavior in the past 20 years has not followed the former pattern, nor obeyed what once were well-established danger signals, nor permitted its successful exploitation by applying old rules for buying low and selling high. Whether the old, fairly regular bull and bear market pattern will eventually return we do not know. But it seems unrealistic to us for the investor to endeavor to base his present policy on the classic formula, i.e., to wait for demonstrable bear market levels before buying any common stocks. Our recommended policy has, however, made provision for changes in the proportion of common stocks to bonds in the portfolio, if the investor chooses to do so, according as the level of stock prices appears less or more attractive by value standards. Formula plans. In the early years of the stock market rise that began in 1949 to 50, considerable interest was attracted to various methods of taking advantage of the stock market's cycles. These have been known as formula investment plans. The essence of all such plans, except the simple case of dollar averaging, is that the investor automatically does some selling of common stocks when the market advances substantially. In many of them a very large rise in the market level would result in the sale of all common stock holdings, others provided for retention of a minor proportion of equities under all circumstances. This approach had the double appeal of sounding logical, and conservative, and of showing excellent results when applied retrospectively to the stock market over many years in the past. Unfortunately, its vogue grew greatest at the very time when it was destined to work least well. Many of the formula planners found themselves entirely or nearly out of the stock market at some level in the middle 1950s. True, they had realized excellent profits, but in a broad sense the market ran away from them thereafter, and their formulas gave them little opportunity to buy back a common stock position. There is a similarity between the experience of those adopting the formula investing approach in the early 1950s and those who embraced the purely mechanical version of the Dow theory some 20 years earlier. In both cases the advent of popularity marked almost the exact moment when the system ceased to work well. We have had a like discomfiting experience with our own central value method of determining indicated buying and selling levels of the Dow Jones Industrial Average. The moral seems to be that any approach to money making in the stock market which can be easily described and followed by a lot of people is by its terms too simple and too easy to last. Spinoza's concluding remark applies to Wall Street as well as to philosophy: all things excellent are as difficult as they are rare. Market fluctuations of the investor's portfolio. Every investor who owns common stocks must expect to see them fluctuate in value over the years. The behavior of the DJIA since our last edition was written in 1964 probably reflects pretty well what has happened to the stock portfolio of a conservative investor who limited his stock holdings to those of large, prominent, and conservatively financed corporations. The overall value advanced from an average level of about 890 to a high of 995 in 1966, and 985 again in 1968, fell to 631 in 1970, and made an almost full recovery to 940 in early 1971. Since the individual issues set their high and low marks at different times, the fluctuations in the Dow Jones Group as a whole are less severe than those in the separate components. We have traced through the price fluctuations of other types of diversified and conservative common stock portfolios, and we find that the overall results are not likely to be markedly different from the above. In general, the shares of second-line companies * fluctuate more widely than the major ones, but this does not necessarily mean that a group of well-established but smaller companies will make a poorer showing over a fairly long period. In any case, the investor may as well resign himself in advance to the probability rather than the mere possibility that most of his holdings will advance, say, 50% or more from their low point and decline the equivalent 1/3 or more from their high point at various periods in the next 5 years *. A serious investor is not likely to believe that the day-to-day or even month-to-month fluctuations of the stock market make him richer or poorer. But what about the longer-term and wider changes? Here practical questions present themselves, and the psychological problems are likely to grow complicated. A substantial rise in the market is at once a legitimate reason for satisfaction and a cause for prudent concern, but it may also bring a strong temptation toward imprudent action. Your shares have advanced, good. You are richer than you were, good. But has the price risen too high, and should you think of selling? Or should you kick yourself for not having bought more shares when the level was lower? Or worst thought of all, should you now give way to the bull market atmosphere, become infected with the enthusiasm, the overconfidence, and the greed of the great public, of which, after all, you are a part, and make larger and dangerous commitments? Presented thus in print, the answer to the last question is a self-evident no, but even the intelligent investor is likely to need considerable willpower to keep from following the crowd. It is for these reasons of human nature, even more than by calculation of financial gain or loss, that we favor some kind of mechanical method for varying the proportion of bonds to stocks in the investor's portfolio. The chief advantage, perhaps, is that such a formula will give him something to do. As the market advances, he will from time to time make sales out of his stock holdings, putting the proceeds into bonds. As it declines, he will reverse the procedure. These activities will provide some outlet for his otherwise too pent-up energies. If he is the right kind of investor, he will take added satisfaction from the thought that his operations are exactly opposite from those of the crowd *. Business valuations versus stock market valuations. The impact of market fluctuations upon the investor's true situation may be considered also from the standpoint of the shareholder as the part owner of various businesses. The holder of marketable shares actually has a double status, and with it the privilege of taking advantage of either at his choice. On the one hand, his position is analogous to that of a minority shareholder or silent partner in a private business. Here his results are entirely dependent on the profits of the enterprise or on a change in the underlying value of its assets. He would usually determine the value of such a private business interest by calculating his share of the net worth as shown in the most recent balance sheet. On the other hand, the common stock investor holds a piece of paper, an engraved stock certificate, which can be sold in a matter of minutes at a price which varies from moment to moment when the market is open, that is, and often is far removed from the balance sheet value *. The development of the stock market in recent decades has made the typical investor more dependent on the course of price quotations and less free than formerly to consider himself merely a business owner. The reason is that the successful enterprises in which he is likely to concentrate his holdings sell almost constantly at prices well above their net asset value, or book value, or balance sheet value. In paying these market premiums, the investor gives precious hostages to fortune, for he must depend on the stock market itself to validate his commitments. This is a factor of prime importance in present-day investing, and it has received less attention than it deserves. The whole structure of stock market quotations contains a built-in contradiction. The better a company's record and prospects, the less relationship the price of its shares will have to their book value. But the greater the premium above book value, the less certain the basis of determining its intrinsic value, i.e., the more this value will depend on the changing moods and measurements of the stock market. Thus we reach the final paradox, that the more successful the company, the greater are likely to be the fluctuations in the price of its shares. This really means that, in a very real sense, the better the quality of a common stock, the more speculative it is likely to be, at least as compared with the unspectacular middle-grade issues. What we have said applies to a comparison of the leading growth companies with the bulk of well-established concerns. We exclude from our purview here those issues which are highly speculative because the businesses themselves are speculative. The argument made above should explain the often erratic price behavior of our most successful and impressive enterprises. Our favorite example is the monarch of them all, International Business Machines. The price of its shares fell from 607 to 300 in 7 months in 1962 to 63. After 2 splits its price fell from 387 to 219 in 1970. Similarly, Xerox, an even more impressive earnings gainer in recent decades, fell from 171 to 87 in 1962 to 63, and from 116 to 65 in 1970. These striking losses did not indicate any doubt about the future long-term growth of IBM or Xerox. They reflected instead a lack of confidence in the premium valuation that the stock market itself had placed on these excellent prospects. The previous discussion leads us to a conclusion of practical importance to the conservative investor in common stocks. If he is to pay some special attention to the selection of his portfolio, it might be best for him to concentrate on issues selling at a reasonably close approximation to their tangible asset value, say, at not more than 1/3 above that figure. Purchases made at such levels, or lower, may with logic be regarded as related to the company's balance sheet, and as having a justification or support independent of the fluctuating market prices. The premium over book value that may be involved can be considered as a kind of extra fee paid for the advantage of stock exchange listing and the marketability that goes with it. A caution is needed here. A stock does not become a sound investment merely because it can be bought at close to its asset value. The investor should demand, in addition, a satisfactory ratio of earnings to price, a sufficiently strong financial position, and the prospect that its earnings will at least be maintained over the years. This may appear like demanding a lot from a modestly priced stock, but the prescription is not hard to fill under all but dangerously high market conditions. Once the investor is willing to forego brilliant prospects, i.e., better than average expected growth, he will have no difficulty in finding a wide selection of issues meeting these criteria. In our chapters on the selection of common stocks, chapters 14 and 15, we shall give data showing that more than half of the DJIA issues met our asset value criterion at the end of 1970. The most widely held investment of all, American Tel and Tel, actually sells below its tangible asset value as we write. Most of the light and power shares, in addition to their other advantages, are now, early 1972, available at prices reasonably close to their asset values. The investor with a stock portfolio having such book values behind it can take a much more independent and detached view of stock market fluctuations than those who have paid high multipliers of both earnings and tangible assets. As long as the earning power of his holdings remains satisfactory, he can give as little attention as he pleases to the vagaries of the stock market. More than that, at times he can use these vagaries to play the master game of buying low and selling high. The A&P example. At this point we shall introduce one of our original examples, which dates back many years but which has a certain fascination for us because it combines so many aspects of corporate and investment experience. It involves the great Atlantic and Pacific TCO. Here is the story. A&P shares were introduced to trading on the curb market, now the American Stock Exchange, in 1929 and sold as high as 494. By 1932 they had declined to 104. Although the company's earnings were nearly as large in that generally catastrophic year as previously. In 1936 the range was between 111 and 131. Then in the business recession and bear market of 1938 the shares fell to a new low of 36. That price was extraordinary. It meant that the preferred and common were together selling for $126 million, although the company had just reported that it held $85 million in cash alone and a working capital, or net current assets, of $134 million. A&P was the largest retail enterprise in America, if not in the world, with a continuous and impressive record of large earnings for many years. Yet in 1938 this outstanding business was considered on Wall Street to be worth less than its current assets alone, which means less as a going concern than if it were liquidated. Why? First, because there were threats of special taxes on chain stores. Second, because net profits had fallen off in the previous year, and, third, because the general market was depressed. The first of these reasons was an exaggerated and eventually groundless fear, the other two were typical of temporary influences. Let us assume that the investor had bought A&P common in 1937 at, say, 12 times its 5-year average earnings, or about 80. We are far from asserting that the ensuing decline to 36 was of no importance to him. He would have been well advised to scrutinize the picture with some care, to see whether he had made any miscalculations. But if the results of his study were reassuring as they should have been, he was entitled then to disregard the market decline as a temporary vagary of finance, unless he had the funds and the courage to take advantage of it by buying more on the bargain basis offered. Sequel and Reflections. The following year, 1939, A&P shares advanced to 117.5, or 3 times the low price of 1938 and well above the average of 1937. Such a turnabout in the behavior of common stocks is by no means uncommon, but in the case of A&P it was more striking than most. In the years after 1949 the grocery chain's shares rose with the general market until in 1961 the split-up stock, 10-for-1, reached a high of 70.5, which was equivalent to 705 for the 1938 shares. This price of 70.5 was remarkable for the fact it was 30 times the earnings of 1961. Such a price-earnings ratio, which compares with 23 times for the DJIA in that year, must have implied expectations of a brilliant growth in earnings. This optimism had no justification in the company's earnings record in the preceding years, and it proved completely wrong. Instead of advancing rapidly, the course of earnings in the ensuing period was generally downward. The year after the 71.5 high the price fell by more than half to 34. But this time the shares did not have the bargain quality that they showed at the low quotation in 1938. After varying sorts of fluctuations the price fell to another low of 21.5 in 1970 and 18 in 1972, having reported the first quarterly deficit in its history. We see in this history how wide can be the vicissitudes of a major American enterprise in little more than a single generation, and also with what miscalculations and excesses of optimism and pessimism the public has valued its shares. In 1938 the business was really being given away, with no takers. In 1961 the public was clamoring for the shares at a ridiculously high price. After that came a quick loss of half the market value. And some years later a substantial further decline. In the meantime the company was to turn from an outstanding to a mediocre earnings performer. Its profit in the boom year 1968 was to be less than in 1958, it had paid a series of confusing small stock dividends not warranted by the current additions to surplus, and so forth. A&P was a larger company in 1961 and 1972 than in 1938, but not as well run, not as profitable, and not as attractive asterisk. There are two chief morals to this story. The first is that the stock market often goes far wrong, and sometimes an alert and courageous investor can take advantage of its patent errors. The other is that most businesses change in character and quality over the years, sometimes for the better, perhaps more often for the worse. The investor need not watch his company's performance like a hawk, but he should give it a good, hard look from time to time. Let us return to our comparison between the holder of marketable shares and the man with an interest in a private business. We have said that the former has the option of considering himself merely as the part owner of the various businesses he has invested in, or as the holder of shares which are saleable at any time he wishes at their quoted market price. But note this important fact: the true investor scarcely ever is forced to sell his shares, and at all other times he is free to disregard the current price quotation. He need pay attention to it and act upon it only to the extent that it suits his book, and no more. Thus the investor who permits himself to be stampeded or unduly worried by unjustified market declines in his holdings is perversely transforming his basic advantage into a basic disadvantage. That man would be better off if his stocks had no market quotation at all, for he would then be spared the mental anguish caused him by other persons' mistakes of judgment. Incidentally, a widespread situation of this kind actually existed during the Dark Depression days of 1931 to 1933. There was then a psychological advantage in owning business interests that had no quoted market. For example, people who owned first mortgages on real estate that continued to pay interest were able to tell themselves that their investments had kept their full value, there being no market quotations to indicate otherwise. On the other hand, many listed corporation bonds of even better quality and greater underlying strength suffered severe shrinkages in their market quotations, thus making their owners believe they were growing distinctly poorer. In reality, the owners were better off with the listed securities, despite the low prices of these. For if they had wanted to, or were compelled to, they could at least have sold the issues, possibly to exchange them for even better bargains. Or they could just as logically have ignored the market's action as temporary and basically meaningless. But it is self-deception to tell yourself that you have suffered no shrinkage in value merely because your securities have no quoted market at all. Returning to our A&P shareholder in 1938, we assert that as long as he held on to his shares he suffered no loss in their price decline, beyond what his own judgment may have told him was occasioned by a shrinkage in their underlying or intrinsic value. If no such shrinkage had occurred, he had a right to expect that in due course the market quotation would return to the 1937 level or better, as in fact it did the following year. In this respect his position was at least as good as if he had owned an interest in a private business with no quoted market for its shares. For in that case, too, he might or might not have been justified in mentally lopping off part of the cost of his holdings because of the impact of the 1938 recession, depending on what had happened to his company. Critics of the value approach to stock investment argue that listed common stocks cannot properly be regarded or appraised in the same way as an interest in a similar private enterprise, because the presence of an organized security market injects into equity ownership the new and extremely important attribute of liquidity. But what this liquidity really means is, first, that the investor has the benefit of the stock market's daily and changing appraisal of his holdings, for whatever that appraisal may be worth, and, second, that the investor is able to increase or decrease his investment at the market's daily figure if he chooses. Thus the existence of a quoted market gives the investor certain options that he does not have if his security is unquoted. But it does not impose the current quotation on an investor who prefers to take his idea of value from some other source. Let us close this section with something in the nature of a parable. Imagine that in some private business you own a small share that cost you $1,000. One of your partners, named Mr. Market, is very obliging indeed. Every day he tells you what he thinks your interest is worth and furthermore offers either to buy you out or to sell you an additional interest on that basis. Sometimes his idea of value appears plausible and justified by business developments and prospects as you know them. Often, on the other hand, Mr. Market lets his enthusiasm or his fears run away with him, and the value he proposes seems to you a little short of silly. If you are a prudent investor or a sensible businessman, will you let Mr. Market's daily communication determine your view of the value of a $1,000 interest in the enterprise? Only in case you agree with him, or in case you want to trade with him. You may be happy to sell out to him when he quotes you a ridiculously high price, and equally happy to buy from him when his price is low. But the rest of the time you will be wiser to form your own ideas of the value of your holdings, based on full reports from the company about its operations and financial position. The true investor is in that very position when he owns a listed common stock. He can take advantage of the daily market price or leave it alone, as dictated by his own judgment and inclination. He must take cognizance of important price movements, for otherwise his judgment will have nothing to work on. Conceivably they may give him a warning signal which he will do well to heed. This in plain English means that he is to sell his shares because the price has gone down, foreboding worse things to come. In our view such signals are misleading at least as often as they are helpful. Basically, price fluctuations have only one significant meaning for the true investor. They provide him with an opportunity to buy wisely when prices fall sharply and to sell wisely when they advance a great deal. At other times he will do better if he forgets about the stock market and pays attention to his dividend returns and to the operating results of his companies. Summary. The most realistic distinction between the investor and the speculator is found in their attitude towards stock market movements. The speculator's primary interest lies in anticipating and profiting from market fluctuations. The investor's primary interest lies in acquiring and holding suitable securities at suitable prices. Market movements are important to him in a practical sense, because they alternately create low price levels at which he would be wise to buy and high price levels at which he certainly should refrain from buying and probably would be wise to sell. It is far from certain that the typical investor should regularly hold off buying until low market levels appear, because this may involve a long wait, very likely the loss of income, and the possible missing of investment opportunities. On the whole, it may be better for the investor to do his stock buying whenever he has money to put in stocks, except when the general market level is much higher than can be justified by well-established standards of value. If he wants to be shrewd, he can look for the ever-present bargain opportunities in individual securities. Aside from forecasting the movements of the general market, much effort and ability are directed on Wall Street toward selecting stocks or industrial groups that in matter of price will do better than the rest over a fairly short period in the future. Logical as this endeavor may seem, we do not believe it is suited to the needs or temperament of the true investor, particularly since he would be competing with a large number of stock market traders and first-class financial analysts who are trying to do the same thing. As in all other activities that emphasize price movements first and underlying values second, the work of many intelligent minds constantly engaged in this field tends to be self-neutralizing and self-defeating over the years. The investor with a portfolio of sound stocks should expect their prices to fluctuate and should neither be concerned by sizable declines nor become excited by sizable advances. He should always remember that market quotations are there for his convenience, either to be taken advantage of or to be ignored. He should never buy a stock because it has gone up or sell one because it has gone down. He would not be far wrong if this motto read more simply: never buy a stock immediately after a substantial rise or sell one immediately after a substantial drop. An added consideration. Something should be said about the significance of average market prices as a measure of managerial competence. The shareholder judges whether his own investment has been successful in terms both of dividends received and of the long-range trend of the average market value. The same criteria should logically be applied in testing the effectiveness of a company's management and the soundness of its attitude toward the owners of the business. This statement may sound like a truism, but it needs to be emphasized. For as yet there is no accepted technique or approach by which management is brought to the bar of market opinion. On the contrary, managements have always insisted that they have no responsibility of any kind for what happens to the market value of their shares. It is true, of course, that they are not accountable for those fluctuations in price which, as we have been insisting, bear no relationship to underlying conditions and values. But it is only the lack of alertness and intelligence among the rank and file of shareholders that permits this immunity to extend to the entire realm of market quotations, including the permanent establishment of a depreciated and unsatisfactory price level. Good managements produce a good average market price, and bad managements produce bad market prices. Fluctuations in bond prices. The investor should be aware that even though safety of its principal and interest may be unquestioned, a long-term bond could vary widely in market price in response to changes in interest rates. In Table 8:1 we give data for various years back to 1902 covering yields for high-grade corporate and tax-free issues. As individual illustrations we add the price fluctuations of two representative railroad issues for a similar period. These are the Atchison, Topeka and Santa Fe General Mortgage 4s, due 1995, for generations one of our premier non-callable bond issues, and the Northern Pacific Re 3s, due 2047, originally a 150-year maturity, long a typical BAA-rated bond. Because of their inverse relationship, the low yields correspond to the high prices and vice versa. The decline in the Northern Pacific 3s in 1940 represented mainly doubts as to the safety of the issue. It is extraordinary that the price recovered to an all-time high in the next few years, and then lost two-thirds of its price chiefly because of the rise in general interest rates. There have been startling variations, as well, in the price of even the highest grade bonds in the past 40 years. Note that bond prices do not fluctuate in the same, inverse, proportion as the calculated yields, because their fixed maturity value of 100% exerts a moderating influence. However, for very long maturities, as in our Northern Pacific example, prices and yields change at close to the same rate. Since 1964, record movements in both directions have taken place in the high-grade bond market. Taking prime municipals, tax-free, as an example, their yield more than doubled, from 3.2% in January 1965 to 7% in June 1970. Their price index declined, correspondingly, from 110.8 to 67.5. In mid-1970 the yields on high-grade long-term bonds were higher than at any time in the nearly 200 years of this country's economic history. 25 years earlier, just before our protracted bull market began, bond yields were at their lowest point in history, long-term municipals returned as little as 1%, and industrials gave 2.4% compared with the 4.5 to 5% formerly considered normal. Those of us with a long experience on Wall Street had seen Newton's law of action and reaction, equal and opposite, work itself out repeatedly in the stock market, the most noteworthy example being the rise in the DJIA from 64 in 1921 to 381 in 1929, followed by a record collapse to 41 in 1932. But this time the widest pendulum swings took place in the usually staid and slow-moving array of high-grade bond prices and yields. Moral: nothing important on Wall Street can be counted on to occur exactly in the same way as it happened before. This represents the first half of our favorite dictum: the more it changes, the more it's the same thing. If it is virtually impossible to make worthwhile predictions about the price movements of stocks, it is completely impossible to do so for bonds. In the old days, at least, one could often find a useful clue to the coming end of a bull or bear market by studying the prior action of bonds, but no similar clues were given to a coming change in interest rates and bond prices. Hence the investor must choose between long-term and short-term bond investments on the basis chiefly of his personal preferences. If he wants to be certain that the market values will not decrease, his best choices are probably U.S. savings bonds, Series E or H, which were described here. Either issue will give him a 5% yield after the first year, the Series E for up to 6 years, the Series H for up to 10 years, with a guaranteed resale value of cost or better. If the investor wants the 7.5% now available on good long-term corporate bonds, or the 5.3% on tax-free municipals, he must be prepared to see them fluctuate in price. Banks and insurance companies have the privilege of valuing high-rated bonds of this type on the mathematical basis of amortized cost, which disregards market prices. It would not be a bad idea for the individual investor to do something similar. The price fluctuations of convertible bonds and preferred stocks are the resultant of three different factors: 1. Variations in the price of the related common stock, 2. Variations in the credit standing of the company, and 3. Variations in general interest rates. A good many of the convertible issues have been sold by companies that have credit ratings well below the best. 3. Some of these were badly affected by the financial squeeze in 1970. As a result, convertible issues as a whole have been subjected to triply unsettling influences in recent years, and price variations have been unusually wide. In the typical case, therefore, the investor would delude himself if he expected to find in convertible issues that ideal combination of the safety of a high-grade bond and price protection plus a chance to benefit from an advance in the price of the common. This may be a good place to make a suggestion about the long-term bond of the future. Why should not the effects of changing interest rates be divided on some practical and equitable basis between the borrower and the lender? One possibility would be to sell long-term bonds with interest payments that vary with an appropriate index of the going rate. The main results of such an arrangement would be: 1. The investor's bond would always have a principal value of about 100, if the company maintains its credit rating, but the interest received will vary, say, with the rate offered on conventional new issues. 2. The corporation would have the advantages of long-term debt being spared problems and costs of frequent renewals of refinancing, but its interest costs would change from year to year. 4. Over the past decade, the bond investor has been confronted by an increasingly serious dilemma: shall he choose complete stability of principal value, but with varying and usually low, short-term, interest rates? Or shall he choose a fixed interest income, with considerable variations, usually downward, it seems, in his principal value? It would be good for most investors if they could compromise between these extremes, and be assured that neither their interest return nor their principal value will fall below a stated minimum over, say, a 20-year period. This could be arranged, without great difficulty, in an appropriate bond contract of a new form. Important note: In effect, the US government has done a similar thing in its combination of the original savings bonds contracts with their extensions at higher interest rates. The suggestion we make here would cover a longer fixed investment period than the savings bonds, and would introduce more flexibility in the interest rate provisions *. It is hardly worthwhile to talk about non-convertible preferred stocks, since their special tax status makes the safe ones much more desirable holdings by corporations, e.g., insurance companies, than by individuals. The poorer quality ones almost always fluctuate over a wide range, percentage-wise, not too differently from common stocks. We can offer no other useful remark about them. Table 16-2 below gives some information on the price changes of lower-grade non-convertible preferreds between December 1968 and December 1970. The average decline was 17%, against 11.3% for the S&P Composite Index of common stocks. Commentary on Chapter 8. By Jason Zweig. When everyone is moving toward depravity, no one seems to be moving, but if someone stops, he shows up the others who are rushing on, by acting as a fixed point. Blaise Pascal 1. The true investor scarcely ever is forced to sell his shares, and at all other times he is free to disregard the current price quotation. He need pay attention to it and act upon it only to the extent that it suits his book, and no more. Thus the investor who permits himself to be stampeded or unduly worried by unjustified market declines in his holdings is perversely transforming his basic advantage into a basic disadvantage. That man would be better off if his stocks had no market quotation at all, for he would then be spared the mental anguish caused him by other persons' mistakes of judgment. In the previous edition, I wrote that those words in Chapter 8 may well be the single most important paragraph in Graham's entire book. I was wrong. Those words may well be the single most important paragraph about investing ever written. Meet Mr. Market. In this chapter, Graham introduces the brilliant metaphor of Mr. Market. Let's say you own a private business, perhaps a restaurant, a bike shop, a yoga studio, a clothing store, or a computer software consulting firm. Mr. Market is an imaginary partner in your business. Every day he knocks on your door and tells you what he thinks the business is worth. Mr. Market's moods are unstable, and his estimates of value are determined as much by how he is feeling as by how your business is doing. He normally names a number that sounds about right. But some days Mr. Market is euphoric and puts a value on the business that's ridiculously high. Other days, Mr. Market is miserable and names a number that's absurdly low. Before he knocks on your door, you never know how Mr. Market will be feeling. The more extreme his mood swings, the more intensely he will pressure you to trade with him at the wacky prices he comes up with. Should you let either your own mood, or your appraisal of what the business is worth, be determined by this guy? Should you buy from him when he wants to sell? Should you sell to him when he wants to buy? Mr. Market, of course, is more than a metaphor. He is the stock market, a collective beast made up of millions of minds, usually sensible, but sometimes giddy and sometimes grim. You cannot be an intelligent investor, either defensive or enterprising, if you let yourself become his emotional hostage. Individuals versus institutions. In this sentence, thus the investor who permits himself to be stampeded or unduly worried by unjustified market declines in his holdings is perversely transforming his basic advantage into a basic disadvantage. What does Graham mean by the investor's basic advantage? He means that listening to Mr. Market is an option, not an obligation. You don't have to trade with him because he wants you to, and you don't have to let his outlook become yours. Why is that your basic advantage? Professional investors aren't in the business of maximizing the returns on the portfolios they manage. They are in the business of maximizing the fees on the portfolios they manage. You are a principal, an investment manager is only your agent. An agent has different incentives and preferences than you do. Decades ago, institutions had the edge over individuals. They could trade at lower cost and diversify more easily. They could obtain privileged access to companies' managers and unearth original research beyond the reach of individual investors. Those days are gone. Because institutions run giant portfolios, they often need to buy millions of dollars worth of the typical stock to build a position big enough to make a meaningful contribution to performance. Their purchases drive up the price of the stock they want to own before they can finish buying it. Conversely, when they sell, they drive down the price before they can get out. Individuals can buy and sell nearly any stock without affecting the price at all. They can diversify completely, at extremely low cost, with a total stock market index fund. Regulatory reforms long ago eliminated the selective disclosures that gave institutions an informational edge. Point 2. Because clients give more money to portfolio managers when markets are hot and withdraw it when returns are poor, the professionals are compelled to buy stocks as they get more expensive and sell as they get cheaper. You are free to do the opposite. Small companies generate their best returns as they grow into big companies. Many portfolio managers are forced to sell too soon, because small stock funds aren't supposed to own large stocks. Point 3. You can hang on indefinitely. Big funds regularly dump stocks on which they incurred big losses, lest their clients blame them for blundering. You can hang on to losers you expect will recover. Institutions also tend not to buy stocks that have suffered severe recent losses. You can. In the short term, an investment firm that ignores Mr. Market is all but certain to generate returns that deviate widely from average, which will spook clients into withdrawing money, reducing the firm's management fees. In the long term, to have any chance of outperforming, a portfolio manager should be eccentric, unconventional, and rash in the eyes of average opinion, the economist John Maynard Keynes wrote in 1936. However, Keynes added, if he is successful, that will only confirm the general belief in his rashness, and if in the short run he is unsuccessful, which is very likely, he will not receive much mercy. Worldly wisdom teaches fund managers that it is better for reputation to fail conventionally than to succeed unconventionally. Point 4. This simple matrix in figure 8:1 shows how clients compare a portfolio manager's decisions to the rest of the market. A manager who follows the herd in picking either a good or bad stock, see the right column, isn't likely to be criticized or fired. But clients will view a manager who stands alone in picking a good stock, upper left, as either lucky or eccentric, while if an unorthodox stock pick loses money, lower left, they will regard the manager as dangerous. Professional investors never want to be in the bottom left corner, wrong and alone, where clients might desert them. So they go along with the crowd, thereby minimizing the chance that their clients can ever outperform, but maximizing the odds that their own fees won't be impaired. You, however, don't have to cave to that kind of pressure. Point 5. As markets move faster and trading becomes more volatile, the basic advantage of individuals looms even larger. No one can fire you for buying an unpopular stock. You are free to seek value in the most obscure companies and to find hope in the darkest hour. Your ability to invest for the long term in a short-term world is a superpower. Point 6. You can outperform the professionals, because you don't have their handicaps of size, myopia, rigidity, conformity, and high cost. To beat the professionals, however, you can't play their game. You must play your own game. You must put Mr. Market in his place by trading only when it is in your interest, not his. How Mr. Market messes with your mind. Listening to Mr. Market will obliterate your individuality. Once you begin to conform with the crowd, your mind is no longer entirely your own. If you were investing on a desert island, you would care only about the probabilities and consequences of your decisions. But you aren't on a desert island, so you probably also care about other people's decisions, what they think about your decisions, and what they think about you. How to turn your basic advantage into a disadvantage. The great investor Charlie Munger, vice chairman of Berkshire Hathaway until his death in 2023, liked to solve problems by inverting them. To figure out how you can succeed, think about what it would take to fail. If the option of cheap trading makes you feel you have an obligation to trade as often as professionals do, you'll end up sandpapering your money away and jacking up your tax bill. If the option of diversifying cheaply creates the sense of obligation to diversify indiscriminately, you'll end up owning a triple leveraged fund that uses artificial intelligence to pick socially responsible lithium start UPS based in southeastern Western Sahara. Point 1. If you let the option of being able to ignore Mr. Market turn into an obligation to act on every whim, you'll end up feeding your own ego and forgetting the importance of making structured decisions. The Nobel Prize winning economist James Tobin once wrote that the trustees of an endowment, such as a university or charitable foundation, are the guardians of the future against the claims of the present. Their task is to preserve equity among generations too. Likewise, you are the guardian of your future against the claims of the present. You, too, must preserve equity among generations. To meet those responsibilities, you must distinguish between options and obligations. Otherwise, you turn your basic advantages into crippling disadvantages. 1. For leveraged funds, see the commentary on Chapter 9. 2. James Tobin, What is Permanent Endowment Income, bit.ly/30newbr3. Being part of the crowd feels safer, especially if you're a novice, facing unfamiliar challenges, or taking on high risks. You may tend to defer to the consensus even more when decisions are harder, because being able to deflect blame over big mistakes feels even better. When you pay attention to the same thing at the same time as other people, you will remember it better, feel intensified emotions, make more extreme judgments, and be more motivated to act. Think of the difference between watching a sporting event by yourself on a delayed video feed at home and attending it live in a stadium or even just watching it live on your phone. Point 7. The internet and social media create borderless communities in which thousands, even millions, can focus together on the same topic or event. When everyone has simultaneous mutual access to information, each can immediately see and hear that all are paying attention to the same thing at the same time. In this state of shared attention, you can feel other people's minds converging with your own. Your experience is collective. Your confidence surges from knowing you're not alone in what you believe. You become we. Humans evolved to cooperate in clans or small groups. The ability for countless people, no matter how widely dispersed, to coalesce into one collective mind is unprecedented in human history. Our individual brains haven't learned how to cope with it yet. Technology has turned Mr. Market into a monster. The individuals who flocked to buy such meme stocks as AMC Entertainment and GameStop in 2020 and 2021 exemplify the pitfalls of this phenomenon. Wall Street Bets, the online forum, ended December 2020 with 1.8 million subscribers. A month later it had 8.4 million. On January 26, 2021, the day Elon Musk tweeted GameStonk, Wall Street Bet subscribers posted an astounding 352,597 comments, mostly about GameStop. On January 28, Wall Street Bets generated more than 271 million page views, making it the third most visited website in the world that day, behind only Google and YouTube. From its closing price on January 21 to its high on January 28, GameStop stock rose more than 1,020%. 0.8. A few people, who sold at the top, made money. Most hung on, hoping for more. They incurred massive losses as the stock went into a kamikaze dive in February, losing 69%. With shared attention intensifying their memory, emotions, and motivation, many still remember every twitch in the prices of their stocks, remain outraged over their losses, believe discredited conspiracy theories, and refuse to sell even though their holdings have shriveled before their eyes. How Mr. Market messes with your heart. The emotional mood swings of the stock market can wreak havoc on your feelings. Psychologists have shown that emotions shape both our perceptions and our actions, creating unconscious biases that can govern our behavior even if we're never aware of it. Even a faint whiff of emotion can skew your decisions. Anger fires up urgency, confidence, and the sensation of being in control. Angry people rely more on snap judgments. They also think good things are more likely and bad things less likely to happen to them than to others. Angry people, especially men, take greater risks. 0.9. Anxiety makes you more sensitive to the magnitude of a possible reward than to the probability of receiving it. Long shot bets look better when you're anxious, especially if you've been losing money. 0.10. Loneliness can make you less likely to seek out information that could contradict what you already believe. It also can increase your anxiety, impair your reasoning, and shred your attention span. Cabin fever can undermine your self-control and make you more impulsive. 0.11. Sadness makes people prefer smaller rewards sooner over larger rewards later. It also can raise the price you're willing to pay to buy something you don't own. Feeling sad makes riskier bets more attractive and deferring gratification more difficult. Sadness is emotional poison for patience. 0.12. Stress impairs working memory and makes focusing on long-term goals difficult. It can lead to perseveration, in which people follow the same failing behaviors regardless of feedback. Under stress, you might jump to conclusions and neglect novel solutions to problems. Stress can also trigger increased risk-taking. 0.13. Is it any wonder that, during the COVID pandemic, when hundreds of millions of people felt angry, anxious, lonely, sad, and stressed, tens of millions started impetuously trading stocks? Talking back to Mr. Market. Today the stock market crashed more than 30%. Your phone is flaring with news alerts, electronic stock tickers are an endless crawl of crimson, the president is urging the public to remain calm, television pundits are shrieking that everyone should sell everything, friends and family are texting you to dump your stocks while you still can. Whether you realize it or not, your heart is racing, your muscles are tense, your palms are sweating. Mr. Market is red in the face as he bangs on your door, yelling that every dollar you had in stocks yesterday is worth less than 70 cents today. How do you answer him? You have the option to sell, but the obligation to think before you act. Go to a quiet room and imagine that somebody else had just suffered these losses and is asking you for advice. That should prompt you to reflect on questions like these. Other than stock prices, which specific aspects of the businesses you own have changed? How large a tax bill would you incur if you sell? If this stock or fund were a gift rather than a purchase, would you return it to the person who gave it to you now that it's fallen in price? Has this stock or fund ever gone down this much before? If so, would you have done better if you had sold out or if you had bought more? If you like this asset well enough to buy it at a higher price, shouldn't you like it more now that the price has fallen? Such questions will take some research to answer, which is as it should be. This way, you stop Mr. Market's overreaction to a change in price from contaminating your view of underlying value. He might be right, he might be wrong. Only by comparing price against value will you be able to tell. You can use the same approach whether a single stock, an industry, or the entire market collapses. You can also invert the questions whenever prices go up farther and faster than you expected. Sooner or later, Mr. Market will go off the rails. Be prepared, so you can stay on track. Chapter 9. Investing in Investment Funds. By Benjamin Graham. Subscribe, like and share our audiobook channel Trade Like Champions for more such contents. Happy investing. One course open to the defensive investor is to put his money into investment company shares. Those that are redeemable on demand by the holder, at net asset value, are commonly known as mutual funds, or open-end funds. Most of these are actively selling additional shares through a corps of salesmen. Those with non-redeemable shares are called closed-end companies or funds. The number of their shares remains relatively constant. All of the funds of any importance are registered with the Securities and Exchange Commission, SEC, and are subject to its regulations and controls. The industry is a very large one. At the end of 1970 there were 383 funds registered with the SEC, having assets totaling $54.60 billions. Of these 356 companies with $50.60 billions, were mutual funds, and 27 companies with $4.0 billions, were closed-end asterisk. There are different ways of classifying the funds. One is by the broad division of their portfolio. They are balanced funds if they have a significant, generally about 1/3, component of bonds, or stock funds if their holdings are nearly all common stocks. There are some other varieties here, such as bond funds, hedge funds, letter stock funds, etc. Asterisk another is by their objectives, as their primary aim is for income, price stability, or capital appreciation, growth. Another distinction is by their method of sale. Load funds add a selling charge, generally about 9% of asset value on minimum purchases, to the value before charge. 1 Others, known as no-load funds, make no such charge. The managements are content with the usual investment counsel fees for handling the capital. Since they cannot pay salesmen's commissions, the size of the no-load funds tends to be on the low side. Asterisk the buying and selling prices of the closed-end funds are not fixed by the companies, but fluctuate in the open market as does the ordinary corporate stock. Most of the companies operate under special provisions of the income tax law, designed to relieve the shareholders from double taxation on their earnings. In effect, the funds must pay out virtually all their ordinary income, i.e., dividends and interest received, less expenses. In addition, they can pay out their realized long-term profits on sales of investments in the form of capital gains dividends, which are treated by the shareholder as if they were his own security profits. There is another option here, which we omit to avoid clutter. Asterisk nearly all the funds have but one class of security outstanding. A new wrinkle, introduced in 1967, divides the capitalization into a preferred issue, which will receive all the ordinary income, and a capital issue, or common stock, which will receive all the profits on security sales. These are called dual-purpose funds. Asterisk. Many of the companies that state their primary aim is for capital gains concentrate on the purchase of the so-called growth stocks, and they often have the word growth in their name. Some specialize in a designated area such as chemicals, aviation, overseas investments. This is usually indicated in their titles. The investor who wants to make an intelligent commitment in fund shares has thus a large and somewhat bewildering variety of choices before him, not too different from those offered in direct investment. In this chapter we shall deal with some major questions, viz. 1. Is there any way by which the investor can assure himself of better than average results by choosing the right funds? Sub-question, what about the performance funds? Asterisk. 2. If not, how can he avoid choosing funds that will give him worse than average results? 3. Can he make intelligent choices between different types of funds, e.g., balanced versus all stock, open-end versus closed-end, load versus no load? Investment fund performance as a whole. Before trying to answer these questions, we should say something about the performance of the fund industry as a whole. Has it done a good job for its shareholders? In the most general way, how have fund investors fared as against those who made their investments directly? We are quite certain that the funds in the aggregate have served a useful purpose. They have promoted good habits of savings and investment. They have protected countless individuals against costly mistakes in the stock market. They have brought their participants income and profits commensurate with the overall returns from common stocks. On a comparative basis, we would hazard the guess that the average individual who put his money exclusively in investment fund shares in the past 10 years has fared better than the average person who made his common stock purchases directly. The last point is probably true, even though the actual performance of the funds seems to have been no better than that of common stocks as a whole, and even though the cost of investing in mutual funds may have been greater than that of direct purchases. The real choice of the average individual has not been between constructing and acquiring a well-balanced common stock portfolio or doing the same thing, a bit more expensively, by buying into the funds. More likely his choice has been between succumbing to the wiles of the doorbell-ringing mutual fund salesman on the one hand, as against succumbing to the even wheelier and much more dangerous peddlers of second and third-rate new offerings. We cannot help thinking, too, that the average individual who opens a brokerage account with the idea of making conservative common stock investments is likely to find himself beset by untoward influences in the direction of speculation and speculative losses. These temptations should be much less for the mutual fund buyer. But how have the investment funds performed as against the general market? This is a somewhat controversial subject, but we shall try to deal with it in simple but adequate fashion. Table 9:1 gives some calculated results for 1961 to 1970 of our 10 largest stock funds at the end of 1970, but choosing only the largest one from each management group. It summarizes the overall return of each of these funds for 1961 to 1965, 1966 to 1970, and for the single years 1969 and 1970. We also give average results based on the sum of one share of each of the 10 funds. These companies had combined assets of over $15 billion at the end of 1969, or about one-third of all the common stock funds. Thus they should be fairly representative of the industry as a whole. In theory, there should be a bias in this list on the side of better than industry performance, since these better companies should have been entitled to more rapid expansion than the others, but this may not be the case in practice. Some interesting facts can be gathered from this table. First, we find that the overall results of these 10 funds for 1961 to 1970 were not appreciably different from those of the Standard & Poor's 500 stock composite average, or the S&P 425 industrial stock average. But they were definitely better than those of the DJIA. This raises the intriguing question as to why the 30 giants in the DJIA did worse than the much more numerous and apparently rather miscellaneous list used by Standard & Poor's. A second point is that the fund's aggregate performance as against the S&P index has improved somewhat in the last 5 years, compared with the preceding 5. The fund's gain ran a little lower than S&P's in 1961 to 1965 and a little higher than S&P's in 1966 to 1970. The third point is that a wide difference exists between the results of the individual funds. These are the stock funds with the largest net assets at the end of 1970, but using only one fund from each management group. Data supplied by Wiesenberger Financial Services. We do not think the mutual fund industry can be criticized for doing no better than the market as a whole. Their managers and their professional competitors administer so large a portion of all marketable common stocks that what happens to the market as a whole must necessarily happen, approximately, to the sum of their funds. Note that the trust assets of insured commercial banks included $181 billion of common stocks at the end of 1969. If we add to this the common stocks in accounts handled by investment advisors, plus the $56 billion of mutual and similar funds, we must conclude that the combined decisions of these professionals pretty well determine the movements of the stock averages, and that the movement of the stock averages pretty well determines the fund's aggregate results. Are there better than average funds, and can the investor select these so as to obtain superior results for himself? Obviously all investors could not do this, since in that case we would soon be back where we started, with no one doing better than anyone else. Let us consider the question first in a simplified fashion. Why shouldn't the investor find out what fund has made the best showing of the lot over a period of sufficient years in the past, assume from this that its management is the most capable and will therefore do better than average in the future, and put his money in that fund? This idea appears the more practicable because, in the case of the mutual funds, he could obtain this most capable management without paying any special premium for it as against the other funds. By contrast, among non-investment corporations, the best managed companies sell at correspondingly high prices in relation to their current earnings and assets. The evidence on this point has been conflicting over the years. But our Table 9:1 covering the 10 largest funds indicates that the results shown by the top 5 performers of 1961 to 1965 carried over on the whole through 1966 to 1970, even though 2 of the set did not do as well as 2 of the other 5. Our studies indicate that the investor in mutual fund shares may properly consider comparative performance over a period of years in the past, say at least 5, provided the data do not represent a large net upward movement of the market as a whole. In the latter case, spectacularly favorable results may be achieved in unorthodox ways, as will be demonstrated in our following section on performance funds. Such results in themselves may indicate only that the fund managers are taking undue speculative risks, and getting away with same for the time being. Performance funds. One of the new phenomena of recent years was the appearance of the cult of performance in the management of investment funds, and even of many trust funds. We must start this section with the important disclaimer that it does not apply to the large majority of well-established funds, but only to a relatively small section of the industry which has attracted a disproportionate amount of attention. The story is simple enough. Some of those in charge set out to get much better than average, or DJIA, results. They succeeded in doing this for a while, garnering considerable publicity and additional funds to manage. The aim was legitimate enough. Unfortunately, it appears that, in the context of investing really sizable funds, the aim cannot be accomplished without incurring sizable risks. And in a comparatively short time the risks came home to roost. Several of the circumstances surrounding the performance phenomenon caused ominous head shaking by those of us whose experience went far back even to the 1920s and whose views, for that very reason, were considered old-fashioned and irrelevant to this, second, new era. In the first place, and on this very point, nearly all these brilliant performers were young men in their 30s and 40s whose direct financial experience was limited to the all but continuous bull market of 1948 to 1968. Secondly, they often acted as if the definition of a sound investment was a stock that was likely to have a good rise in the market in the next few months. This led to large commitments in newer ventures at prices completely disproportionate to their assets or recorded earnings. They could be justified only by a combination of naive hope in the future accomplishments of these enterprises with an apparent shrewdness in exploiting the speculative enthusiasms of the uninformed and greedy public. This section will not mention people's names. But we have every reason to give concrete examples of companies. The performance fund most in the public's eye was undoubtedly Manhattan Fund Incorporated, organized at the end of 1965. Its first offering was of 27 million shares at $9.25 to $10 per share. The company started out with $247 million of capital. Its emphasis was, of course, on capital gains. Most of its funds were invested in issues selling at high multipliers of current earnings, paying no dividends, or very small ones, with a large speculative following and spectacular price movements. The fund showed an overall gain of 38.6% in 1967, against 11% for the S&P Composite Index. But thereafter its performance left much to be desired, as is shown. The portfolio of Manhattan Fund at the end of 1969 was unorthodox to say the least. It is an extraordinary fact that two of its largest investments were in companies that filed for bankruptcy within 6 months thereafter, and a third faced creditors' actions in 1971. It is another extraordinary fact that shares of at least one of these doomed companies were bought not only by investment funds but by university endowment funds, the trust departments of large banking institutions, and the like. A third extraordinary fact was that the founder-manager of Manhattan Fund sold his stock in a separately organized management company to another large concern for over $20 million in its stock. At that time the management company sold had less than $1 million in assets. This is undoubtedly one of the greatest disparities of all times between the results for the manager and the manages. A book published at the end of 19,692 provided profiles of 19 men who are tops at the demanding game of managing billions of dollars of other people's money. The summary told us further that they are young, some earn more than $1 million a year, they are a new financial breed, they all have a total fascination with the market and a spectacular knack for coming up with winners. A fairly good idea of the accomplishments of this top group can be obtained by examining the published results of the funds they manage. Such results are available for funds directed by 12 of the 19 persons described in the Money Managers. Typically enough, they showed up well in 1966, and brilliantly in 1967. In 1968 their performance was still good in the aggregate, but mixed as to individual funds. In 1969 they all showed losses, with only one managing to do a bit better than the S&P Composite Index. In 1970 their comparative performance was even worse than in 1969. We have presented this picture in order to point a moral, which perhaps can best be expressed by the old French proverb, plus c'est change, plus c'est la même chose. Bright, energetic people, usually quite young, have promised to perform miracles with other people's money since time immemorial. They have usually been able to do it for a while, or at least to appear to have done it, and they have inevitably brought losses to their public in the end. About a half-century ago the miracles were often accompanied by flagrant manipulation, misleading corporate reporting, outrageous capitalization structures, and other semi-fraudulent financial practices. All this brought on an elaborate system of financial controls by the SEC, as well as a cautious attitude toward common stocks on the part of the general public. The operations of the new money managers in 1965 to 1969 came a little more than one full generation after the shenanigans of 1926, 1929 *. The specific malpractices banned after the 1929 crash were no longer resorted to. They involved the risk of jail sentences. But in many corners of Wall Street they were replaced by newer gadgets and gimmicks that produced very similar results in the end. Outright manipulation of prices disappeared, but there were many other methods of drawing the gullible public's attention to the profit possibilities in hot issues. Blocks of letter stock 3 could be bought well below the quoted market price, subject to undisclosed restrictions on their sale. They could immediately be carried in the reports at their full market value, showing a lovely and illusory profit. And so on. It is amazing how, in a completely different atmosphere of regulation and prohibitions, Wall Street was able to duplicate so much of the excesses and errors of the 1920s. No doubt there will be new regulations and new prohibitions. The specific abuses of the late 1960s will be fairly adequately banned from Wall Street. But it is probably too much to expect that the urge to speculate will ever disappear, or that the exploitation of that urge can ever be abolished. It is part of the armament of the intelligent investor to know about these extraordinary popular delusions, and to keep as far away from them as possible. The picture of most of the performance funds is a poor one if we start after their spectacular record in 1967. With the 1967 figures included, their overall showing is not at all disastrous. On that basis, one of the money managers' operators did quite a bit better than the S&P Composite Index, 3 did distinctly worse, and 6 did about the same. Let us take as a check another group of performance funds, the 10 that made the best showing in 1967, with gains ranging from 84% up to 301% in that single year. Of these, 4 gave a better overall 4-year performance than the S&P index, if the 1967 gains are included, and 2 excelled the index in 1968 to 1970. None of these funds was large, and the average size was about $60 million. Thus, there is a strong indication that smaller size is a necessary factor for obtaining continued outstanding results. The foregoing account contains the implicit conclusion that there may be special risks involved in looking for superior performance by investment fund managers. All financial experience up to now indicates that large funds, soundly managed, can produce at best only slightly better than average results over the years. If they are unsoundly managed, they can produce spectacular, but largely illusory, profits for a while, followed inevitably by calamitous losses. There have been instances of funds that have consistently outperformed the market averages for, say, 10 years or more. But these have been scarce exceptions, having most of their operations in specialized fields, with self-imposed limits on the capital employed and not actively sold to the public. Closed-end versus open-end funds. Almost all the mutual funds or open-end funds, which offer their holders the right to cash in their shares at each day's valuation of the portfolio, have a corresponding machinery for selling new shares. By this means most of them have grown in size over the years. The closed-end companies, nearly all of which were organized a long time ago, have a fixed capital structure, and thus have diminished in relative dollar importance. Open-end companies are being sold by many thousands of energetic and persuasive salesmen. The closed-end shares have no one especially interested in distributing them. Consequently, it has been possible to sell most mutual funds to the public at a fixed premium of about 9% above net asset value, to cover salesmen's commissions, etc., while the majority of closed-end shares have been consistently obtainable at less than their asset value. This price discount has varied among individual companies, and the average discount for the group as a whole has also varied from one date to another. Figures on this point for 1961 to 1970 are given in Table 9-3. It does not take much shrewdness to suspect that the lower relative price for closed-end as against open-end shares has very little to do with the difference in the overall investment results between the two groups. That this is true is indicated by the comparison of the annual results for 1961 to 1970 of the two groups included in Table 9-3. Thus we arrive at one of the few clearly evident rules for investors' choices. If you want to put money in investment funds, buy a group of closed-end shares at a discount of, say, 10% to 15% from asset value, instead of paying a premium of about 9% above asset value for shares of an open-end company. Assuming that the future dividends and changes in asset values continue to be about the same for the two groups, you will thus obtain about 1/5 more for your money from the closed-end shares asterisk. The mutual fund salesman will be quick to counter with the argument, but if you own closed-end shares you can never be sure what price you can sell them for. The discount can be greater than it is today, and you will suffer from the wider spread. With our shares you are guaranteed the right to turn in your shares at 100% of asset value, never less. Let us examine this argument a bit. It will be a good exercise in logic and plain common sense. Question: assuming that the discount on closed-end shares does widen, how likely is it that you will be worse off with those shares than with an otherwise equivalent purchase of open-end shares? This calls for a little arithmetic. Assume that investor A buys some open-end shares at 109% of asset value, and investor B buys closed-end shares at 85% thereof, plus 1/2% commission. Both sets of shares earn and pay 30% of this asset value in, say, 4 years, and end up with the same value as at the beginning. Investor A redeems his shares at 100% of value, losing the 9% premium he paid. His overall return for the period is 30% less 9%, or 21% on asset value. This, in turn, is 19% on his investment. How much must investor B realize on his closed-end shares to obtain the same return on his investment as investor A? The answer is 73%, or a discount of 27% from asset value. In other words, the closed-end man could suffer a widening of 12 points in the market discount, about double, before his return would get down to that of the open-end investor. An adverse change of this magnitude has happened rarely, if ever, in the history of closed-end shares. Hence it is very unlikely that you will obtain a lower overall return from a representative, closed-end company, bought at a discount, if its investment performance is about equal to that of a representative mutual fund. If a small load, or no load, fund is substituted for one with the usual 8.5% load, the advantage of the closed-end investment is of course reduced, but it remains an advantage. The fact that a few closed-end funds are selling at premiums greater than the true 9% charge on most mutual funds introduces a separate question for the investor. Do these premium companies enjoy superior management of sufficient proven worth to warrant their elevated prices? If the answer is sought in the comparative results for the past 5 or 10 years, the answer would appear to be no. 3 of the 6 premium companies have mainly foreign investments. A striking feature of these is the large variation in prices in a few years' time. At the end of 1971 sold at only 1/4 of its high, another at 1/3. Another at less than half. If we consider the 3 domestic companies selling above asset value, we find that the average of their 10-year overall returns was somewhat better than that of 10 discount funds, but the opposite was true in the last 5 years. A comparison of the 1961 to 1970 record of Lehman Corp and of General American Investors, 2 of our oldest and largest closed-end companies, is given in Table 9-5. One of these sold 14% above and the other 7.6% below its net asset value at the end of 1970. The difference in price to net asset relationships did not appear warranted by these figures. Investment in balanced funds. The 23 balanced funds covered in the Wiesenberger report had between 25% and 59% of their assets in preferred stocks and bonds, the average being just 40%. The balance was held in common stocks. it would appear more logical for the typical investor to make his bond-type investments directly, rather than to have them form part of a mutual fund commitment. The average income return shown by these balanced funds in 1970 was only 3.9% per annum on asset value, or say 3.6% on the offering price. The better choice for the bond component would be the purchase of United States savings bonds, or corporate bonds rated A or better, or tax-free bonds, for the investor's bond portfolio. Commentary on Chapter 9. By Jason Zweig. Fund managers allocate the funds between themselves and their clients in the ancient classic manner, i.e., at the close of the day's business they take all the money and throw it up in the air. Everything that sticks to the ceiling belongs to the clients. Fred Schwed, Jr. 1. For decades, the fund industry had the investing public fooled. Beginning in the 1920s, fund managers masqueraded as miracle workers who could minimize risk, find winners and shun losers, and beat the market to a bloody pulp, making big commissions and fat annual fees seem worth paying. Only after the global financial crisis of 2008-09 did the public finally wake up. The futility of the funds. Year after year, well-educated, highly trained professionals, armed with vast quantities of data and computing power, attempt to pick investments that will earn higher returns than a market average like the S&P 500 index. Year after year, most of these actively managed funds fail. In 2022, 43% of actively managed U.S. mutual funds and ETFs outperformed their respective market average, according to Morningstar, down from 47% the year before. Only 10.5% of funds investing in large U.S. stocks survived for the full 10 years ending June 30, 2023, and beat their benchmark. Among those mutual funds that do beat the market one year, almost none go on to repeat. Three main handicaps cripple fund managers and their investors. Asset elephantiasis. As funds grow bigger, buying smaller stocks becomes harder. A fund with $100 million can put 1% in any stock, that's only $1 million. A fund with $10 billion putting 1% in a stock has to buy $100 million of it, a prohibitively huge hunk of most small companies. Trading costs may also go up as a fund becomes a giant. And the more money investors add, the greater the pressure to buy something, anything, that can put all that new cash to work. Fees. In the US, the average stock fund charged 1.15% in annual expenses as of 2022, according to the Investment Company Institute. Trading costs. Imagine a fund has a portfolio turnover rate of 100%, meaning the managers hold its typical stock for 1 year. Let's say it incurs 0.25% in brokerage costs to buy and to sell a stock. Trading would cost this fund's investors 0.5% annually. If a fund charges 1.15% in expenses and racks up 0.5% in brokerage costs, that's a 1.65% annual drag. If the market goes up 10% in a year, the fund must gain 11.65% before expenses just to match the market's return after expenses. That means the fund must perform 16.5% better, before fees, to avoid underperforming after fees, too. It isn't just beating the market that's hard for fund managers. Even matching the market is hard. When average is better than average. Graham understood all this decades before most other people. As early as 1951 he suggested that investors would be better off if they could invest in a market average. Graham emphasized the idea repeatedly until he died in 1976. That same year, John C. Bogle of Vanguard Group introduced the Index Mutual Fund. Point 3. Index funds hold practically every investment in a market benchmark like the S&P 500, MSCI All Country World Index, or Bloomberg U.S. Aggregate Bond Index. They seek to match the market's return, before fees, not to beat it. They don't need to spend lavish sums on research or pay high trading costs, because they aren't trying to pick the best investments and avoid the worst but only to buy and hold them all. Automatically, the winners will grow and the losers shrink, with no need for the manager to analyze or trade them. Total costs at an index fund can be below 0.05% per year, well under 1/10 the cost of traditional funds seeking to beat the market. And, because they trade so seldom, index funds rarely generate high tax bills. By settling for average, you end up doing much better than average. If one investor gains on a trade, another must have lost by the same amount. Across the entire market, all that activity nets out to zero. And that's before costs. After the expenses of research and trading, most investors trying to beat the market get beaten by it. Own an index fund instead, and you will match the market before costs, thereby surpassing almost all the amateurs and professionals trying to beat it, after they pay their much higher expenses. Thus, by settling for average you can secure above average results. Point 4. Extremely tempting funds. You can index your portfolio with mutual funds or exchange-traded funds. Unlike mutual funds, which in the US you can buy or sell only at one price at the end of the trading day, you can trade ETFs anytime. ETFs are remarkably cheap, with expenses as low as 0.03%, or only $3 per year on a $10,000 investment. Index mutual funds can be almost as cheap. But a traditional mutual fund seeking to beat the market that charges an average of 1.15% annually is nearly 40 times more expensive. Decades of research show that the single most important determinant of a fund's success is whether its fees are low. The peril of ETFs is that you can trade them all day long, and many people do. If you used ETFs this way, you would turn your basic advantage into a disadvantage. Why would you want to take an asset that you can hold at near zero cost for decades and turn it into a short-term trading toy? Another potential problem: you can find an ETF for every conceivable purpose, and some inconceivable ones too. In 2023, various ETFs offered exposure to Korean media companies, owned nickel mining stocks, bought only stocks traded by Democratic members of the U.S. Congress, lost 2% for every 1% daily gain in Brazilian stocks, offered between 25% and 200% exposure to nothing but Tesla Incorporated stock, depending on market conditions, used artificial intelligence to pick agriculture companies, sought to generate returns that are the opposite of those earned by financial television pundit Jim Cramer, captured the performance of stocks during the night but not during the day, or used borrowed money to trade marijuana stocks. As December 31, 2023, the U.S. had 3,383 ETFs, and related products, with assets of $8.12 trillion, according to EFGI, a research firm in London. The rest of the world had 8,486 ETFs with assets of $3.51 trillion. Many ETFs fill narrow niches, owning few holdings rather than the broadest possible swath of securities. They often are based on indexes with short track records, making past performance an even poorer guide than usual. Because they tend to be small, they charge much higher fees and are far more likely to go out of business. Point 5. Many such ETFs are inverse or leveraged. Inverse funds generate the opposite of a benchmark's return, for example, gaining 1% on a day when the underlying index loses 1%. Leveraged funds use borrowed money or other techniques to amplify their gains and losses. A leveraged fund might double or even triple the daily gain of a market average. It will, by design, also double or triple any daily loss. If you don't know what you're doing, experimenting with these funds is like playing with matches in a warehouse full of dynamite. Instead of diversifying your portfolio, these specialized ETFs do what Peter Lynch, the former manager of Fidelity Magellan Fund, calls diversifying. They clutter your portfolio with risky clusters of weird assets. You have the option to buy eccentric ETFs. You do not have an obligation. How to pick an ETF? With thousands of ETFs, how should you pick one that's right for you? Elizabeth Koshner, head of Global Fund Analytics at FactSet Research Systems, suggests a simple mnemonic: efficiency, tradability, and fit. Efficiency means low annual expenses, preferably 0.1% or less. The longer you plan to hold the ETF, the more this cost matters, says Koshner, because expenses are a perennial drag on performance. Tradability measures how much it costs to buy or sell an ETF. In the US, at least $250,000 of a fund's shares should trade daily. The bid/ask spread, or the gap between what buyers are willing to pay and what sellers will accept, should be 0.05% or less, ideally, 0.01%. The longer you plan to hold the ETF, the less this cost matters, says Koshner, because it's a one-time cost you won't have to pay again until you ultimately sell the fund. Trade only with a limit order that specifies the highest price you're willing to pay if you're buying and the lowest you'll accept if you're selling. Fit is another word for diversification. You want your fund to wrap itself snugly around the broadest possible bundle of assets. Total market ETFs are ideal. One covering your home country and another covering the rest of the world will serve you well, says Koshner. The narrower the index the ETF tracks, the less money you should invest in it. If a smidgen of a narrow ETF belongs anywhere, it belongs in your Mad Money account. 6. Traditional index mutual funds work as well as ETFs, assuming their fees are as low. An actively managed mutual fund or ETF might make sense if, but only if, its fees are also low, it holds stocks for years on end, and its portfolio is drastically different from the market. Extremely sanctimonious gimmicks? The latest craze on Wall Street is ESG funds, which purport to make businesses and the world environmentally cleaner, socially fairer, and governed better. They enable you to do good and do well at the same time, marketers say. Owning an ESG fund will give you that righteous glow from feeling you're on the side of the angels, and some studies suggest ESG funds have performed about as well as conventional portfolios. Unfortunately, you might or might not do good, but you will pay more to feel good. As James McIntosh showed in a brilliant series of columns in the Wall Street Journal, ESG funds overpromise and underdeliver. Polluters and other bad corporate citizens have already sold their shares to the public, so refusing to buy their stock has no direct effect on them. If every good company divests its bad assets, then mines, oil wells, and factories will end up in the hands of operators that don't care about public opinion, producing more harm than ever. And the intense popularity of ESG helped drive the stock prices of many of the movement's darlings, like electric vehicle manufacturer Tesla, to such unearthly heights that future returns are bound to be lower. What's more, many ESG funds don't even pretend to own good companies, they own the least bad. With the demand from investors far exceeding the supply of ESG companies, the firms that screen companies end up promoting the greenest within a dirty industry. In 2021, a big holding in MSCI's Global Pollution Prevention Index and many ESG funds was a company that had been sued by the state of New Jersey for allegedly releasing such putrid odors that nearby residents suffered migraines. Other ESG funds race to invest in a company mining the ocean floor for rare metals, even though environmentalists consider that an abomination. 7. Finally, many ESG funds barely differ from the rest of the market. A team of economists found in 2022 that 68% of the holdings of ESG funds overlap perfectly with those of conventional funds. That means you pay high fees on 100% of your investment, even though only a third of it is customized. That's like paying a triple fee estimated by the economists at 0.63% annually. Overall, ESG funds probably don't do much to make the world a better place. Maybe, however, you don't expect a fund to make the world better, you just don't want any of your money in companies you feel are making the world worse. In that case, you're buying the fund not because it's a good value but because it enables you to feel you're acting on your good values. Fair enough so long as you avoid high fees, confirm that the fund doesn't own any companies you disapprove of, and can live with returns that might be lower. You should also realize that if you want to make the world a better place, you'll have to take action yourself. Mutual funds and ETFs are baskets of investments, they aren't magical healers that can cure what ails the planet. When investments make money and investors don't. Imagine a fund that starts the year at $10 a share. It also finishes the year at $10. It fluctuated during the year, but didn't pay a dividend. That's an annual return of 0%. Did all its investors have a 0% return? Of course not. Some bought the fund when it was trading below $10, whereas others paid more than $10. Still others sold before year-end, some at a profit and some at a loss. How well the fund's investors fared depends not only on the fund's returns, but on their actions. If most of them bought at a market high or sold at a market low, they will collectively earn lower returns than the fund's portfolio itself. In extreme cases, investors can lose billions of dollars in a fund that made money. Few examples have ever been more extreme than the ARK funds run by stock-picking celebrity Cathie Wood. ARK Innovation, the flagship ETF in this fleet, gained 87% in 2017. It then was tiny, with only $12 million in assets at the beginning of the year, so that enormous gain was earned by only a few investors. ARK Innovation returned an astounding 153% in 2020. But even by the beginning of that year it had just $1.9 billion in total assets. Finally, in 2020, the public poured money in. The fund's assets tripled to $6 billion between March and July 2020. From September 2020 through March 2021, investors inundated ARK Innovation with $13 billion in new money. Right on cue, performance peaked. ARK Innovation lost 23% in 2021 and a blood-curdling 67% in 2022. The few early bird investors who captured the fund's biggest gains were dwarfed by the flocks of latecomers who suffered its worst losses. Collectively, ARK Innovation's shareholders lost as much as $10 billion even though the fund had racked up some of the biggest gains in history, and even after the fund went on to go up 68% in 2022.8. The lessons. It's investors, not investments, that make or lose money. How your fund behaves is much less important than how you behave. And if you chase hot performance, you will get burned. Chapter 10. The Investor and His Advisors. By Benjamin Graham. Subscribe, like and share our audiobook channel Trade Like Champions for more such contents. Happy investing. The investment of money in securities is unique among business operations in that it is almost always based in some degree on advice received from others. The great bulk of investors are amateurs. Naturally, they feel that in choosing their securities they can profit by professional guidance. Yet there are peculiarities inherent in the very concept of investment advice. If the reason people invest is to make money, then in seeking advice they are asking others to tell them how to make money. That idea has some element of naivete. Businessmen seek professional advice on various elements of their business, but they do not expect to be told how to make a profit. That is their own bailiwick. When they, or non-business people, rely on others to make investment profits for them, they are expecting a kind of result for which there is no true counterpart in ordinary business affairs. If we assume that there are normal or standard income results to be obtained from investing money in securities, then the role of the advisor can be more readily established. He will use his superior training and experience to protect his clients against mistakes and to make sure that they obtain the results to which their money is entitled. It is when the investor demands more than an average return on his money, or when his advisor undertakes to do better for him, that the question arises whether more is being asked or promised than is likely to be delivered. Advice on investments may be obtained from a variety of sources. These include: 1. A relative or friend, presumably knowledgeable in securities. 2. A local, commercial, banker. 3. A brokerage firm or investment banking house. 4. A financial service or periodical. And 5. An investment counselor. The miscellaneous character of this list suggests that no logical or systematic approach in this matter has crystallized, as yet, in the minds of investors. Certain common sense considerations relate to the criterion of normal or standard results mentioned above. Our basic thesis is this: if the investor is to rely chiefly on the advice of others in handling his funds, then either he must limit himself and his advisors strictly to standard, conservative, and even unimaginative forms of investment, or he must have an unusually intimate and favorable knowledge of the person who is going to direct his funds into other channels. But if the ordinary business or professional relationship exists between the investor and his advisors, he can be receptive to less conventional suggestions only to the extent that he himself has grown in knowledge and experience and has therefore become competent to pass independent judgment on the recommendations of others. He has then passed from the category of defensive or unenterprising investor into that of aggressive or enterprising investor. Investment counsel and trust services of banks. The truly professional investment advisors, that is, the well-established investment counsel firms, who charge substantial annual fees, are quite modest in their promises and pretensions. For the most part they place their clients' funds in standard interest and dividend-paying securities, and they rely mainly on normal investment experience for their overall results. In the typical case it is doubtful whether more than 10% of the total fund is ever invested in securities other than those of leading companies, plus government bonds, including state and municipal issues, nor do they make a serious effort to take advantage of swings in the general market. The leading investment counsel firms make no claim to being brilliant, they do pride themselves on being careful, conservative, and competent. Their primary aim is to conserve the principal value over the years and produce a conservatively acceptable rate of income. Any accomplishment beyond that, and they do strive to better the goal they regard in the nature of extra service rendered. Perhaps their chief value to their clients lies in shielding them from costly mistakes. They offer as much as the defensive investor has the right to expect from any counselor serving the general public. What we have said about the well-established investment counsel firms applies generally to the trust and advisory services of the larger banks. Financial services. The so-called financial services are organizations that send out uniform bulletins, sometimes in the form of telegrams, to their subscribers. The subjects covered may include the state and prospects of business, the behavior and prospect of the securities markets, and information and advice regarding individual issues. There is often an inquiry department which will answer questions affecting an individual subscriber. The cost of the service averages much less than the fee that investment counselors charge their individual clients. Some organizations, notably Babsons and Standard & Poor's, operate on separate levels as a financial service and as investment counsel. Incidentally, other organizations such as Scudder, Stevens & Clark operate separately as investment counsel and as one or more investment funds. The financial services direct themselves, on the whole, to a quite different segment of the public than do the investment counsel firms. The latter's clients generally wish to be relieved of bother and the need for making decisions. The financial services offer information and guidance to those who are directing their own financial affairs or are themselves advising others. Many of these services confine themselves exclusively, or nearly so, to forecasting market movements by various technical methods. We shall dismiss these with the observation that their work does not concern investors as the term is used in this book. On the other hand, some of the best known, such as Moody's Investment Service and Standard & Poor's, are identified with statistical organizations that compile the voluminous statistical data that form the basis for all serious security analysis. These services have a varied clientele, ranging from the most conservative-minded investor to the rankest speculator. As a result, they must find it difficult to adhere to any clear-cut or fundamental philosophy in arriving at their opinions and recommendations. An old established service of the type of Moody's and the others must obviously provide something worthwhile to a broad class of investors. What is it? Basically, they address themselves to the matters in which the average active investor-speculator is interested. And their views on these either command some measure of authority or at least appear more reliable than those of the unaided client. For years the financial services have been making stock market forecasts without anyone taking this activity very seriously. Like everyone else in the field, they are sometimes right and sometimes wrong. Wherever possible, they hedge their opinions so as to avoid the risk of being proved completely wrong. There is a well-developed art of Delphic phrasing that adjusts itself successfully to whatever the future brings. In our view, perhaps a prejudiced one, this segment of their work has no real significance except for the light it throws on human nature in the securities markets. Nearly everyone interested in common stocks wants to be told by someone else what he thinks the market is going to do. The demand being there, it must be supplied. Their interpretations and forecasts of business conditions, of course, are much more authoritative and informing. These are an important part of the great body of economic intelligence which is spread continuously among buyers and sellers of securities and tends to create fairly rational prices for stocks and bonds under most circumstances. Undoubtedly, the material published by the financial services adds to the store of information available and fortifies the investment judgment of their clients. It is difficult to evaluate their recommendations of individual securities. Each service is entitled to be judged separately, and the verdict could properly be based only on an elaborate and inclusive study covering many years. In our own experience, we have noted among them a pervasive attitude which we think tends to impair what could otherwise be more useful advisory work. This is their general view that a stock should be bought if the near-term prospects of the business are favorable and should be sold if these are unfavorable regardless of the current price. Such a superficial principle often prevents the services from doing the sound analytical job of which their staffs are capable, namely, to ascertain whether a given stock appears over or undervalued at the current price in the light of its indicated long-term future earning power. The intelligent investor will not do his buying and selling solely on the basis of recommendations received from a financial service. Once this point is established, the role of the financial service then becomes the useful one of supplying information and offering suggestions. Advice from brokerage houses. Probably the largest volume of information and advice to the security-owning public comes from stockbrokers. These are members of the New York Stock Exchange, and of other exchanges, who execute buying and selling orders for a standard commission. Practically all the houses that deal with the public maintain a statistical or analytical department, which answers inquiries and makes recommendations. A great deal of analytical literature, some of it elaborate and expensive, is distributed gratis to the firm's customers, more impressively referred to as clients. A great deal is at stake in the innocent appearing question whether customers or clients is the more appropriate name. A business has customers, a professional person or organization has clients. The Wall Street brokerage fraternity has probably the highest ethical standards of any business. But it is still feeling its way toward the standards and standing of a true profession *. In the past, Wall Street has thrived mainly on speculation, and stock market speculators as a class were almost certain to lose money. Hence it has been logically impossible for brokerage houses to operate on a thoroughly professional basis. To do that would have required them to direct their efforts toward reducing rather than increasing their business. The farthest that certain brokerage houses have gone in that direction and could have been expected to go is to refrain from inducing or encouraging anyone to speculate. Such houses have confined themselves to executing orders given them, to supplying financial information and analyses, and to rendering opinions on the investment merits of securities. Thus, in theory at least, they are devoid of all responsibility for either the profits or the losses of their speculative customers *. Most stock exchange houses, however, still adhere to the old-time slogans that they are in business to make commissions and that the way to succeed in business is to give the customers what they want. Since the most profitable customers want speculative advice and suggestions, the thinking and activities of the typical firm are pretty closely geared to day-to-day trading in the market. Thus it tries hard to help its customers make money in a field where they are condemned almost by mathematical law to lose in the end *. By this we mean that the speculative part of their operations cannot be profitable over the long run for most brokerage house customers. But to the extent that their operations resemble true investing, they may produce investment gains that more than offset the speculative losses. The investor obtains advice and information from stock exchange houses through two types of employees, now known officially as customers brokers, or account executives, and financial analysts. The customers broker, also called a registered representative, formerly bore the less dignified title of customer's man. Today he is for the most part an individual of good character and considerable knowledge of securities, who operates under a rigid code of right conduct. Nevertheless, since his business is to earn commissions, he can hardly avoid being speculation-minded. Thus the security buyer who wants to avoid being influenced by speculative considerations will ordinarily have to be careful and explicit in his dealing with his customer's broker. He will have to show clearly, by word and deed, that he is not interested in anything faintly resembling a stock market tip. Once the customer's broker understands clearly that he has a real investor on his hands, he will respect this point of view and cooperate with it. The financial analyst, formerly known chiefly as security analyst, is a person of particular concern to the author, who has been one himself for more than 5 decades and has helped educate countless others. At this stage we refer only to the financial analysts employed by brokerage houses. The function of the security analyst is clear enough from his title. It is he who works up the detailed studies of individual securities, develops careful comparisons of various issues in the same field, and forms an expert opinion of the safety or attractiveness or intrinsic value of all the different kinds of stocks and bonds. By what must seem a quirk to the outsider, there are no formal requirements for being a security analyst. Contrast with this the facts that a customer's broker must pass an examination, meet the required character tests, and be duly accepted and registered by the New York Stock Exchange. As a practical matter, nearly all the younger analysts have had extensive business school training, and the oldsters have acquired at least the equivalent in the school of long experience. In the great majority of cases, the employing brokerage house can be counted on to assure itself of the qualifications and competence of its analysts. The customer of the brokerage firm may deal with the security analysts directly, or his contact may be an indirect one via the customer's broker. In either case, the analyst is available to the client for a considerable amount of information and advice. Let us make an emphatic statement here. The value of the security analyst to the investor depends largely on the investor's own attitude. If the investor asks the analyst the right questions, he is likely to get the right or at least valuable answers. The analysts hired by brokerage houses, we are convinced, are greatly handicapped by the general feeling that they are supposed to be market analysts as well. When they are asked whether a given common stock is sound, the question often means, is this stock likely to advance during the next few months? As a result, many of them are compelled to analyze with one eye on the stock ticker, a pose not conducive to sound thinking or worthwhile conclusions. In the next section of this book we shall deal with some of the concepts and possible achievements of security analysis. A great many analysts working for stock exchange firms could be of prime assistance to the bona fide investor who wants to be sure that he gets full value for his money, and possibly a little more. As in the case of the customer's brokers, what is needed at the beginning is a clear understanding by the analyst of the investor's attitude and objectives. Once the analyst is convinced that he is dealing with a man who is value-minded rather than quotation-minded, there is an excellent chance that his recommendations will prove of real overall benefit. The CFA Certificate for Financial Analysts. An important step was taken in 1963 toward giving professional standing and responsibility to financial analysts. The official title of Chartered Financial Analyst, CFA, is now awarded to those senior practitioners who pass required examinations and meet other tests of fitness. 1. The subjects covered include security analysis and portfolio management. The analogy with the long-established professional title of Certified Public Accountant, CPA, is evident and intentional. This relatively new apparatus of recognition and control should serve to elevate the standards of financial analysts and eventually to place their work on a truly professional basis. Dealings with brokerage houses. One of the most disquieting developments of the period in which we write this revision has been the financial embarrassment, in plain words, bankruptcy or near bankruptcy, of quite a few New York Stock Exchange firms, including at least two of considerable size. This is the first time in half a century or more that such a thing has happened, and it is startling for more than one reason. For many decades the New York Stock Exchange has been moving in the direction of closer and stricter controls over the operations and financial condition of its members, including minimum capital requirements, surprise audits, and the like. Besides this, we have had 37 years of control over the exchanges and their members by the Securities and Exchange Commission. Finally, the stock brokerage industry itself has operated under favorable conditions, namely, a huge increase in volume, fixed minimum commission rates, largely eliminating competitive fees, and a limited number of member firms. The first financial troubles of the brokerage houses, in 1969, were attributed to the increase in volume itself. This, it was claimed, overtaxed their facilities, increased their overhead, and produced many troubles in making financial settlements. It should be pointed out this was probably the first time in history that important enterprises have gone broke because they had more business than they could handle. In 1970, as brokerage failures increased, they were blamed chiefly on the falling off in volume. A strange complaint when one reflects that the turnover of the NYSE in 1970 totaled 2,937 million shares, the largest volume in its history and well over twice as large as in any year before 1965. During the 15 years of the bull market ending in 1964, the annual volume had averaged only 712 million shares, 1/4 of the 1970 figure, but the brokerage business had enjoyed the greatest prosperity in its history. If, as it appears, the member firms as a whole had allowed their overhead and other expenses to increase at a rate that could not sustain even a mild reduction in volume during part of a year, this does not speak well for either their business acumen or their financial conservatism. A third explanation of the financial trouble finally emerged out of a mist of concealment, and we suspect that it is the most plausible and significant of the three. It seems that a good part of the capital of certain brokerage houses was held in the form of common stocks owned by the individual partners. Some of these seem to have been highly speculative and carried at inflated values. When the market declined in 1969, the quotations of such securities fell drastically and a substantial part of the capital of the firms vanished with them. 2. In effect, the partners were speculating with the capital that was supposed to protect the customers against the ordinary financial hazards of the brokerage business, in order to make a double profit thereon. This was inexcusable, we refrain from saying more. The investor should use his intelligence not only in formulating his financial policies but also in the associated details. These include the choice of a reputable broker to execute his orders. Up to now, it was sufficient to counsel our readers to deal only with a member of the New York Stock Exchange, unless he had compelling reasons to use a non-member firm. Reluctantly, we must add some further advice in this area. We think that people who do not carry margin accounts, and in our vocabulary this means all non-professional investors, should have the delivery and receipt of their securities handled by their bank. When giving a buying order to your brokers, you can instruct them to deliver the securities bought to your bank against payment therefor by the bank. Conversely, when selling, you can instruct your bank to deliver the securities to the broker against payment of the proceeds. These services will cost a little extra, but they should be well worth the expense in terms of safety and peace of mind. This advice may be disregarded, as no longer called for, after the investor is sure that all the problems of stock exchange firms have been disposed of, but not before. Investment bankers. The term investment banker is applied to a firm that engages to an important extent in originating, underwriting, and selling new issues of stocks and bonds. To underwrite means to guarantee to the issuing corporation, or other issuer, that the security will be fully sold. A number of the brokerage houses carry on a certain amount of underwriting activity. Generally, this is confined to participating in underwriting groups formed by leading investment bankers. There is an additional tendency for brokerage firms to originate and sponsor a minor amount of new issue financing, particularly in the form of smaller issues of common stocks when a bull market is in full swing. Investment banking is perhaps the most respectable department of the Wall Street community, because it is here that finance plays its constructive role of supplying new capital for the expansion of industry. In fact, much of the theoretical justification for maintaining active stock markets, notwithstanding their frequent speculative excesses, lies in the fact that organized security exchanges facilitate the sale of new issues of bonds and stocks. If investors or speculators could not expect to see a ready market for a new security offered them, they might well refuse to buy it. The relationship between the investment banker and the investor is basically that of the salesman to the prospective buyer. For many years past, the great bulk of the new offerings in dollar value has consisted of bond issues that were purchased in the main by financial institutions such as banks and insurance companies. In this business, the security salesmen have been dealing with shrewd and experienced buyers. Hence, any recommendations made by the investment bankers to these customers have had to pass careful and skeptical scrutiny. Thus, these transactions are almost always effected on a business-like footing. But a different situation obtains in a relationship between the individual security buyer and the investment banking firms, including the stockbrokers acting as underwriters. Here the purchaser is frequently inexperienced and seldom shrewd. He is easily influenced by what the salesman tells him, especially in the case of common stock issues, since often his unconfessed desire in buying is chiefly to make a quick profit. The effect of all this is that the public investor's protection lies less in his own critical faculty than in the scruples and ethics of the offering houses. Point 3. It is a tribute to the honesty and competence of the underwriting firms that they are able to combine fairly well the discordant roles of advisor and salesman. But it is imprudent for the buyer to trust himself to the judgment of the seller. In 1959 we stated at this point, the bad results of this unsound attitude show themselves recurrently in the underwriting field and with notable effects in the sale of new common stock issues during periods of active speculation. Shortly thereafter this warning proved urgently needed. As already pointed out, the years 1960 to 61 and, again, 1968 to 69 were marked by an unprecedented outpouring of issues of lowest quality, sold to the public at absurdly high offering prices and in many cases pushed much higher by heedless speculation and some semi-manipulation. A number of the more important Wall Street houses have participated to some degree in these less than creditable activities, which demonstrates that the familiar combination of greed, folly, and irresponsibility has not been exorcised from the financial scene. The intelligent investor will pay attention to the advice and recommendations received from investment banking houses, especially those known by him to have an excellent reputation, but he will be sure to bring sound and independent judgment to bear upon these suggestions, either his own, if he is competent, or that of some other type of advisor. Other advisors. It is a good old custom, especially in the smaller towns, to consult one's local banker about investments. A commercial banker may not be a thoroughgoing expert on security values, but he is experienced and conservative. He is especially useful to the unskilled investor, who is often tempted to stray from the straight and unexciting path of a defensive policy and needs the steadying influence of a prudent mind. The more alert and aggressive investor, seeking counsel in the selection of security bargains, will not ordinarily find the commercial banker's viewpoint to be especially suited to his own objectives. We take a more critical attitude toward the widespread custom of asking investment advice from relatives or friends. The inquirer always thinks he has good reason for assuming that the person consulted has superior knowledge or experience. Our own observation indicates that it is almost as difficult to select satisfactory lay advisors as it is to select the proper securities unaided. Much bad advice is given free. Summary. Investors who are prepared to pay a fee for the management of their funds may wisely select some well-established and well-recommended investment counsel firm. Alternatively, they may use the investment department of a large trust company or the supervisory service supplied on a fee basis by a few of the leading New York Stock Exchange houses. The results to be expected are in no wise exceptional, but they are commensurate with those of the average well-informed and cautious investor. Most security buyers obtain advice without paying for it specifically. It stands to reason, therefore, that in the majority of cases they are not entitled to and should not expect better than average results. They should be wary of all persons, whether customers, brokers, or security salesmen, who promise spectacular income or profits. This applies both to the selection of securities and to guidance in the elusive, and perhaps elusive, art of trading in the market. Defensive investors, as we have defined them, will not ordinarily be equipped to pass independent judgment on the security recommendations made by their advisors. But they can be explicit and even repetitiously so in stating the kind of securities they want to buy. If they follow our prescription, they will confine themselves to high-grade bonds and the common stocks of leading corporations, preferably those that can be purchased at individual price levels that are not high in the light of experience and analysis. The security analyst of any reputable stock exchange house can make up a suitable list of such common stocks and can certify to the investor whether or not the existing price level therefore is a reasonably conservative one as judged by past experience. The aggressive investor will ordinarily work in active cooperation with his advisors. He will want their recommendations explained in detail, and he will insist on passing his own judgment upon them. This means that the investor will gear his expectations and the character of his security operations to the development of his own knowledge and experience in the field. Only in the exceptional case, where the integrity and competence of the advisors have been thoroughly demonstrated, should the investor act upon the advice of others without understanding and approving the decision made. There have always been unprincipled stock salesmen and fly-by-night stockbrokers, and as a matter of course we have advised our readers to confine their dealings, if possible, to members of the New York Stock Exchange. But we are reluctantly compelled to add the extra cautious counsel that security deliveries and payments be made through the intermediary of the investor's bank. The distressing Wall Street brokerage house picture may have cleared up completely in a few years, but in late 1971 we still suggest, better safe than sorry. Commentary on Chapter 10. By Jason Zweig. The prudent are crowned with knowledge. Proverbs 14:18. A good financial advisor can make or save you a fortune by preventing you from being your own worst enemy. Good advisors can deter you from buying high and selling low. They can help you figure out how to afford to buy a house, pay for college, provide for your aging parents, and navigate the Kafkaesque complexities of tax, estate, and retirement planning. They can help you avoid scams and frauds. Many defensive and enterprising investors could benefit from the counsel of a good advisor. If you carry too much debt, struggle to get your spending under control, lost a ton of money trading stocks, are juggling a jumble of assets that don't seem to work together, or just can't face difficult financial decisions, a good advisor can be a godsend. Finding the right one is nowhere near as easy as it should be, however. Can't see the forest for the fees. As Graham warns, most security buyers obtain advice without paying for it specifically. It stands to reason, therefore, that in the majority of cases they are not entitled to and should not expect better than average results. Imagine two people going to the same dentist. Afterward, they discover that one patient's bill is 5 times higher, even though they received the same treatment. When the patient with the higher bill demands an explanation, the office assistant says, "Your investment portfolio is 5 times bigger. Should you go robo?" Digital advisory firms, which use software to assemble investment portfolios online at low cost, have become popular. These robo-advisors arose over the past decade and manage roughly $750 billion in the U.S. Fees generally are about 0.25% annually. Clients get a portfolio of ETFs, periodic rebalancing, and selective sales of losing positions to maximize tax efficiency. Such bare-bones service may make sense for defensive investors who have zero spare time or energy to monitor their own portfolios. 1. Some robo-advisors also offer financial planning advice, typically from a human staffer. However, such firms specialize in automated portfolio management, so personalized financial planning is a lower priority. Eventually, artificial intelligence may bridge that gap. In professional chess, centaurs, the combination of a human and a computer, have tended to be able to beat either the best of human chess players or a well-trained computer. Financial planning might ultimately employ its own centaurs, an experienced financial planner coupled with an artificial intelligence tool that can generate accurate and helpful advice. For now, however, most clients prefer to have a human do their financial planning. If you're reading this book, you probably aren't that defensive. Would anyone, including the patient who paid less, think that's fair? Yet that's how the financial advice business works. Most advisors don't charge fees based on the services they provide, for example, to calculate your projected income during retirement or to review your estate plans. Instead, they charge an annual fee based on assets under management, or AUM, how much money they oversee for you. AUM fees give an advisor an interest in how well your investment portfolio performs. The more it goes up, the more your advisor earns. That might be better than paying brokers a commission for every transaction, which can create an incentive to trade as often as possible. But AUM fees also create perverse incentives by rewarding advisors not for how good their advice is, but for how much money you have. Creating pressure to take risks and actions, necessary or not, to justify earning those fees. Encouraging advisors to push in-house investments that are often inferior. Compensating advisors for providing investment management, which is a commodity available through index funds at virtually no cost, while paying them nothing for personalized financial planning, which can be extraordinarily valuable. Expressed as a percentage, 1% sounds like a teeny number. But, on a $1 million account, it's $10,000 annually. If investors clearly understood how much they are paying, they surely would shop around for lower fees. 1. Separate surveys of more than 1,000 financial advisors in the U.S. by industry analysts Bob Veras and Michael Kitties, in 2020 and 2022 respectively, found that advisors were charging a median of 0.9% to 1% annually to advise accounts of up to $1 million. Even accounts with $5 million paid 0.6% to 0.7%. These fees have barely budged in decades, even though, over the past few decades, the cost of investing through mutual funds and ETFs has fallen 90% or more. That puts investors in the absurd position of having to pay far more to someone who picks funds than to the people who manage them. You can buy index mutual funds or ETFs for well under 0.1% annually and then leave them undisturbed for decades. Why should you pay an advisor 1% every year for that? And why should complex financial advice be free but simple fund picking so expensive? None of that makes any sense. Look for an advisor who charges fees for service, pricing each task by how much time and expertise it takes, not by how much money you have. Some advisors charge by the hour, accept retainers, or even charge monthly subscription fees. Many will negotiate their fees if you ask. Meet Max, the top financial planner who didn't even have a desk. Chances are, your doctor, lawyer, or accountant has only one or two framed documents hanging on the office wall, a medical or law degree, a CPA, or other accountancy certificate. Financial advisors, though, often display an entire wall full of framed, diploma-like certificates and awards. Because there are no national public standards of knowledge, competence, and professional ethics for financial advisors, private organizations claiming to confer official recognition have proliferated. Some, like chartered financial analyst or certified public accountant, require years of rigorous study and training. Others, such as certified financial planner, take less onerous but still diligent preparation. Many, though, are meaningless. Some organizations will award a financial designation, suitable for framing, to anyone with a pulse willing to fork over a few $100s. If you have a relevant license or degree and 3 years of related work experience, then the certificate for a Master Financial Planner or MFP is yours for $349, plus $29 shipping. No studying or exam is required. 1. Job descriptions are also elastic. Wealth manager sounds impressive but is merely a self-appointed, self-important title with no legal definition. Finally, awards are remarkably easy to get. Honored as one of America's top financial planners in 2009, Maxwell Tailwager won the accolade after financial planner Alan Roth of Colorado Springs, Colorado, nominated him by sending in a check for $183. In exchange, Max received an impressive plaque that he could display prominently on his desk if, that is, he'd had a desk. Consumers Research Council of America, which purported to help educate and assist consumers in obtaining the finest professional services, bestowed the award on Max even though he wasn't a financial planner at all. Max was Mr. Roth's 6-month-old dachshund puppy. 1C FINRA, Professional Designations, bit.ly/470 Joses, Jason Zweig and Mary Pilon, is your advisor pumping up his credentials, bit.ly/3kvrq. Searching for an advisor. The first step in getting good financial advice is knowing what you need. Do you want an advisor who will mainly manage your investments? Probably not, unless you are an extremely defensive investor. Or do you want an advisor who can help primarily with the intricacies of financial planning? Second, insist on an advisor who will act as a fiduciary, with obligations to provide advice in your best interest, to disclose all material facts about costs and conflicts of interest, and to ensure that conflicts don't corrupt the quality of the advice. Hiring a fiduciary doesn't guarantee that you'll get good guidance, but it's the basic prerequisite for a relationship built on trust. In the US, start by visiting napfa.org and letsemakaaplan.org, which enable you to search for a financial planner in your geographic area. Once you find a handful of advisors who seem like possible matches, do a quick background check. Go to brokercheck.finra.org and advisorinfo.sec.gov to see whether they have a disciplinary history. Look up the advisors and their firms. Watch for customer complaints, lawsuits, and arbitrations, punishments from regulators, criminal cases, and personal bankruptcies. Then download the Form ADV Part 2 brochure, available by searching for the name of the person or firm at advisorinfo.sec.gov. If fees are 1% or more, the disciplinary information doesn't match what you saw on brokercheck.finra.org, the advisor runs a commission-based insurance agency, or the advisor takes extra payments for referring clients into certain investments, find someone else. Search the document for frequent use of the terms annuities, charting, technical analysis, tactical, and private funds. Annuities insurance contracts that produce income, usually over time after an upfront purchase, are seldom appropriate. They're one of the last bastions of fat fees, sometimes carrying commissions up to 10% and annual expenses that can exceed 2%. A few advisors use annuities judiciously. Others cram them down clients' throats like foie gras farmers stuffing feed pellets down the gullets of geese. Charting, like technical analysis, attempts to predict future prices by studying the pattern of past prices. These are abstruse arts that are barely credible when practiced by trained specialists. In the amateur hands of many financial advisors, they create higher fees, unnecessary tax bills, and lousy performance. Tactical advisors trade in and out. If they could reliably predict when markets are going to rise or fall, would they be sitting in some piddly office trying to get their mitts on your money? Or would they be on a yacht, counting their own? Private funds, as we saw in the commentary on Chapter 6, are extortionately expensive and riddled with conflicts. Financial advisors who offer proprietary private funds have a powerful disincentive to recommend other investments, even if just about anything else would be better for you. With rare exceptions, private funds are another strike against a potential advisor. Asking the right questions. Once you've winnowed down your list of possible advisory candidates to 3 to 5, Make appointments to interview them in person. Ask each the same set of questions. Here are a few that are critical, followed by the preferable answer. Will you always act as a fiduciary, and will you state that in writing? Yes. Do you focus mainly on investment management? Or do you also advise on taxes, estates, and retirement, budgeting, debt management, or insurance? Here, your own needs will determine which answer is correct. Do you earn more, in cash or other incentives, for recommending certain products or services? No. Do you earn fees to advise a private fund or other investments you may recommend to clients? No. Are your fees negotiable, and will you charge by the hour or by the service, rather than on assets under management? Yes. Have clients filed written complaints or arbitration claims against you or your firm? Have you or your firm been sued by clients? Number 2. Do you believe you can beat the market? No. What's a reasonable expectation for future average annual returns on my portfolio, after expenses, your fees, inflation, and taxes? 4% at most. Anyone who gives a much higher number is either a fool or trying to fool you. Point 3. Who manages your money? I do, and I invest in the same assets I recommend to my clients. If asking so many questions in person feels awkward, submit them by email in advance. Ask each advisor to reply by email, they can always provide extra detail when you meet in person. In advance, prepare a notepad or a spreadsheet to keep track of your questions and the advisor's responses. Rate each answer on a numerical scale from 1, lowest, to 5, best. By scoring all the answers on the same scale, you prevent yourself from arbitrarily overweighting a particular response. Score each as soon as the advisor answers. If possible, you and your spouse or partner, or your closest friend or relative if you're unattached, should rate the answers independently. Point 4. Words of warning. When you interview a potential advisor, be on the alert for words and phrases intended to stoke fear or greed, to invoke the illusion of certainty, and to prod you into taking urgent action. Does the advisor keep changing the subject away from your goals and circumstances to catch phrases like these? Our proprietary algorithms. Our timing model. Our model portfolios. Options strategy. Guaranteed. It's a sure thing. Monthly returns. Our exclusive private funds. In this market, you have to have alternative investments. We can get you access. Institutional quality. We understand the markets. We know how to identify. Our stock recommendations are up ___%. Less volatility, lower risk, higher return. We've done all the work for you. Everyone else is investing in this. Don't miss out on this opportunity. You need to hurry. This will be the best decision you can make. The upside is potentially unlimited. Give us the chance to show what we can do for you. We have no conflicts of interest. 5. After you've met with the advisor, assign 2 more grades on the same 5-point scale, 1 for communication, 1 for your overall impression. Did the advisor bombard you with cliches? Or did you get clear, specific explanations of fees, strategies, and conflicts? Rate that on the same 1 to 5 scale. Now rate your gut feelings about how competent, caring, and trustworthy the advisor is. Don't overthink it, close your eyes and quickly score your intuitive impression from 1 to 5. After you've interviewed the advisors and recorded all your ratings, forget about your gut feelings, you've just accounted for them in your tally. Add up each advisor's scores and hire the one with the highest total. You shouldn't view all this as more work than it's worth, You're about to consign your current wealth and financial future into this person's hands. Instead of picking that person by a hunch or by relying on a random referral, shouldn't you use a careful and deliberate process? Chapter 11. Security Analysis for the Lay Investor, General Approach. By Benjamin Graham. Subscribe, like and share our audiobook channel Trade Like Champions for more such contents. Happy investing. Financial analysis is now a well-established and flourishing profession, or semi-profession. The various societies of analysts that make up the National Federation of Financial Analysts have over 13,000 members, most of whom make their living out of this branch of mental activity. Financial analysts have textbooks, a code of ethics, and a quarterly journal. They also have their share of unresolved problems. In recent years there has been a tendency to replace the general concept of security analysis by that of financial analysis. The latter phrase has a broader implication and is better suited to describe the work of most senior analysts on Wall Street. It would be useful to think of security analysis as limiting itself pretty much to the examination and evaluation of stocks and bonds, whereas financial analysis would comprise that work, plus the determination of investment policy, portfolio selection, plus a substantial amount of general economic analysis. Point 1. In this chapter we shall use whatever designation is most applicable, with chief emphasis on the work of the security analyst proper. The security analyst deals with the past, the present, and the future of any given security issue. He describes the business, he summarizes its operating results and financial position, he sets forth its strong and weak points, its possibilities and risks, he estimates its future earning power under various assumptions, or as a best guess. He makes elaborate comparisons of various companies, or of the same company at various times. Finally, he expresses an opinion as to the safety of the issue, if it is a bond or investment-grade preferred stock, or as to its attractiveness as a purchase, if it is a common stock. In doing all these things the security analyst avails himself of a number of techniques, ranging from the elementary to the most abstruse. He may modify substantially the figures in the company's annual statements, even though they bear the sacred imprimatur of the certified public accountant. He is on the lookout particularly for items in these reports that may mean a good deal more or less than they say. The security analyst develops and applies standards of safety by which we can conclude whether a given bond or preferred stock may be termed sound enough to justify purchase for investment. These standards relate primarily to past average earnings, but they are concerned also with capital structure, working capital, asset values, and other matters. In dealing with common stocks the security analyst until recently has only rarely applied standards of value as well defined as were his standards of safety for bonds and preferred stocks. Most of the time he contented himself with a summary of past performances, a more or less general forecast of the future with particular emphasis on the next 12 months and a rather arbitrary conclusion. The latter was, and still is, often drawn with one eye on the stock ticker or the market charts. In the past few years, however, much attention has been given by practicing analysts to the problem of valuing growth stocks. Many of these have sold at such high prices in relation to past and current earnings that those recommending them have felt a special obligation to justify their purchase by fairly definite projections of expected earnings running fairly far into the future. Certain mathematical techniques of a rather sophisticated sort have perforce been invoked to support the valuations arrived at. We shall deal with these techniques, in foreshortened form, a little later. However, we must point out a troublesome paradox here, which is that the mathematical valuations have become most prevalent precisely in those areas where one might consider them least reliable. For the more dependent the valuation becomes on anticipations of the future and the less it is tied to a figure demonstrated by past performance, the more vulnerable it becomes to possible miscalculation and serious error. A large part of the value found for a high multiplier growth stock is derived from future projections which differ markedly from past performance except perhaps in the growth rate itself. Thus it may be said that security analysts today find themselves compelled to become most mathematical and scientific in the very situations which lend themselves least auspiciously to exact treatment *. Let us proceed, nonetheless, with our discussion of the more important elements and techniques of security analysis. The present highly condensed treatment is directed to the needs of the non-professional investor. At the minimum, he should understand what the security analyst is talking about and driving at. Beyond that, he should be equipped, if possible, to distinguish between superficial and sound analysis. Security analysis for the lay investor is thought of as beginning with the interpretation of a company's annual financial report. This is a subject which we have covered for laymen in a separate book, entitled The Interpretation of Financial Statements. Point 2. We do not consider it necessary or appropriate to traverse the same ground in this chapter, especially since the emphasis in the present book is on principles and attitudes rather than on information and description. Let us pass on to two basic questions underlying the selection of investments. What are the primary tests of safety of a corporate bond or preferred stock? What are the chief factors entering into the valuation of a common stock? Bond analysis. The most dependable and hence the most respectable branch of security analysis concerns itself with the safety, or quality, of bond issues and investment-grade preferred stocks. The chief criterion used for corporate bonds is the number of times that total interest charges have been covered by available earnings for some years in the past. In the case of preferred stocks, it is the number of times that bond interest and preferred dividends combined have been covered. The exact standards applied will vary with different authorities. Since the tests are at bottom arbitrary, there is no way to determine precisely the most suitable criteria. In the 1961 revision of our textbook, Security Analysis, we recommend certain coverage standards, which appear in Table 11-1*. Our basic test is applied only to the average results for a period of years. Other authorities require also that a minimum coverage be shown for every year considered. We approve a poorest year test as an alternative to the 7-year average test. It would be sufficient if the bond or preferred stock met either of these criteria. It may be objected that the large increase in bond interest rates since 1961 would justify some offsetting reduction in the coverage of charges required. Obviously, it would be much harder for an industrial company to show a 7 times coverage of interest charges at 8% than at 4.5%. To meet this changed situation, we now suggest an alternative requirement related to the percent earned on the principal amount of the debt. These figures might be 33% before taxes for an industrial company, 20% for a public utility, and 25% for a railroad. It should be borne in mind here that the rate actually paid by most companies on their total debt is considerably less than the current 8% figure, since they have the benefit of older issues bearing lower coupons. The poorest year requirement could be set at about 2/3 of the 7-year requirement. B. For investment-grade preferred stocks. The same minimum figures as above are required to be shown by the ratio of earnings before income taxes to the sum of fixed charges plus twice preferred dividends. Note, the inclusion of twice the preferred dividends allows for the fact that preferred dividends are not income tax deductible, whereas interest charges are so deductible. See other categories of bonds and preferreds. The standards given above are not applicable to 1. Public utility holding companies, 2. Financial companies, 3. Real estate companies. Requirements for these special groups are omitted here. In addition to the earnings coverage test, a number of others are generally applied. These include the following. 1. Size of enterprise. there is a minimum standard in terms of volume of business for a corporation varying as between industrials, utilities, and railroads and of population for a municipality. 2. Stock/equity ratio. This is the ratio of the market price of the junior stock issues * to the total face amount of the debt, or the debt plus preferred stock. It is a rough measure of the protection, or cushion, afforded by the presence of a junior investment that must first bear the brunt of unfavorable developments. This factor includes the market's appraisal of the future prospects of the enterprise. 3. Property value. The asset values, as shown on the balance sheet or as appraised, were formerly considered the chief security and protection for a bond issue. Experience has shown that in most cases safety resides in the earning power, and if this is deficient the assets lose most of their reputed value. Asset values, however, retain importance as a separate test of ample security for bonds and preferred stocks in 3 enterprise groups: public utilities, because rates may depend largely on the property investment, real estate concerns, and investment companies. At this point the alert investor should ask, how dependable are tests of safety that are measured by past and present performance, in view of the fact that payment of interest and principal depends upon what the future will bring forth? The answer can be founded only on experience. Investment history shows that bonds and preferred stocks that have met stringent tests of safety, based on the past, have in the great majority of cases been able to face the vicissitudes of the future successfully. This has been strikingly demonstrated in the major field of railroad bonds, a field that has been marked by a calamitous frequency of bankruptcies and serious losses. In nearly every case the roads that got into trouble had long been overbonded, had shown an inadequate coverage of fixed charges in periods of average prosperity, and would thus have been ruled out by investors who applied strict tests of safety. Conversely, practically every road that has met such tests has escaped financial embarrassment. Our premise was strikingly vindicated by the financial history of the numerous railroads reorganized in the 1940s and in 1950. All of these, with one exception, started their careers with fixed charges reduced to a point where the current coverage of fixed interest requirements was ample, or at least respectable. The exception was the New Haven Railroad, which in its reorganization year, 1947, earned its new charges only about 1.1 times. In consequence, while all the other roads were able to come through rather difficult times with solvency unimpaired, the New Haven relapsed into trusteeship, for the third time, in 1961. In Chapter 17 below we shall consider some aspects of the bankruptcy of the Penn Central Railroad, which shook the financial community in 1970. An elementary fact in this case was that the coverage of fixed charges did not meet conservative standards as early as 1965, hence a prudent bond investor would have avoided or disposed of the bond issues of the system long before its financial collapse. Our observations on the adequacy of the past record to judge future safety apply, and to an even greater degree, to the public utilities, which constitute a major area for bond investment. Receivership of a soundly capitalized, electric, utility company or system is almost impossible. Since Securities and Exchange Commission control was instituted * along with the breakup of most of the holding company systems, public utility financing has been sound and bankruptcies unknown. The financial troubles of electric and gas utilities in the 1930s were traceable almost 100% to financial excesses and mismanagement, which left their imprint clearly on the company's capitalization structures. Simple but stringent tests of safety, therefore, would have warned the investor away from the issues that were later to default. Among industrial bond issues the long-term record has been different. Although the industrial group as a whole has shown a better growth of earning power than either the railroads or the utilities, it has revealed a lesser degree of inherent stability for individual companies and lines of business. Thus in the past, at least, there have been persuasive reasons for confining the purchase of industrial bonds and preferred stocks to companies that not only are of major size but also have shown an ability in the past to withstand a serious depression. Few defaults of industrial bonds have occurred since 1950, but this fact is attributable in part to the absence of a major depression during this long period. Since 1966 there have been adverse developments in the financial position of many industrial companies. Considerable difficulties have developed as the result of unwise expansion. On the one hand, this has involved large additions to both bank loans and long-term debt. On the other, it has frequently produced operating losses instead of the expected profits. At the beginning of 1971 it was calculated that in the past 7 years the interest payments of all non-financial firms had grown from $9.8 billion in 1963 to $26.1 billion in 1970, and that interest payments had taken 29% of the aggregate profits before interest and taxes in 1971, against only 16% in 1963.3. Obviously, the burden on many individual firms had increased much more than this. Overbonded companies have become all too familiar. There is every reason to repeat the caution expressed in our 1965 edition. We are not quite ready to suggest that the investor may count on an indefinite continuance of this favorable situation, and hence relax his standards of bond selection in the industrial or any other group. Common stock analysis. The ideal form of common stock analysis leads to a valuation of the issue which can be compared with the current price to determine whether or not the security is an attractive purchase. This valuation, in turn, would ordinarily be found by estimating the average earnings over a period of years in the future and then multiplying that estimate by an appropriate capitalization factor. The now standard procedure for estimating future earning power starts with average past data for physical volume, prices received, and operating margin. Future sales in dollars are then projected on the basis of assumptions as to the amount of change in volume and price level over the previous base. These estimates, in turn, are grounded first on general economic forecasts of gross national product, and then on special calculations applicable to the industry and company in question. An illustration of this method of valuation may be taken from our 1965 edition and brought up to date by adding the sequel. The Value Line, a leading investment service, makes forecasts of future earnings and dividends by the procedure outlined above, and then derives a figure of price potentiality, or projected market value, by applying a valuation formula to each issue based largely on certain past relationships. In Table 11-2 we reproduce the projections for 1967 to 1969 made in June 1964, and compare them with the earnings, and average market price actually realized in 1968, which approximates the 1967 to 1969 period. The combined forecasts proved to be somewhat on the low side, but not seriously so. The corresponding predictions made 6 years before had turned out to be over-optimistic on earnings and dividends, but this had been offset by use of a low multiplier, with the result that the price potentiality figure proved to be about the same as the actual average price for 1963. The reader will note that quite a number of the individual forecasts were wide of the mark. This is an instance in support of our general view that composite or group estimates are likely to be a good deal more dependable than those for individual companies. Ideally, perhaps, the security analyst should pick out the 3 or 4 companies whose future he thinks he knows the best, and concentrate his own and his client's interest on what he forecasts for them. Unfortunately, it appears to be almost impossible to distinguish in advance between those individual forecasts which can be relied upon and those which are subject to a large chance of error. At bottom, this is the reason for the wide diversification practiced by the investment funds. For it is undoubtedly better to concentrate on one stock that you know is going to prove highly profitable, rather than dilute your results to a mediocre figure, merely for diversification's sake. But this is not done, because it cannot be done dependably. Point 4. The prevalence of wide diversification is in itself a pragmatic repudiation of the fetish of selectivity, to which Wall Street constantly pays lip service. Factors affecting the capitalization rate. Though average future earnings are supposed to be the chief determinant of value, the security analyst takes into account a number of other factors of a more or less definite nature. Most of these will enter into his capitalization rate, which can vary over a wide range, depending upon the quality of the stock issue. Thus, although two companies may have the same figure of expected earnings per share in 1973, 1975, say $4, the analyst may value one as low as 40 and the other as high as 100. Let us deal briefly with some of the considerations that enter into these divergent multipliers. 1. General long-term prospects. No one really knows anything about what will happen in the distant future, but analysts and investors have strong views on the subject just the same. These views are reflected in the substantial differentials between the price/earnings ratios of individual companies and of industry groups. At this point we added in our 1965 edition. For example, at the end of 1963 the chemical companies in the DJIA were selling at considerably higher multipliers than the oil companies, indicating stronger confidence in the prospects of the former than of the latter. Such distinctions made by the market are often soundly based, but when dictated mainly by past performance they are as likely to be wrong as right. We shall supply here, in Table 11-3, the 1963 year-end material on the chemical and oil company issues in the DJIA, and carry their earnings to the end of 1970. It will be seen that the chemical companies, despite their high multipliers, made practically no gain in earnings in the period after 1963. The oil companies did much better than the chemicals and about in line with the growth implied in their 1963 multipliers. 5. Thus our chemical stock example proved to be one of the cases in which the market multipliers were proven wrong. 2. Management. On Wall Street a great deal is constantly said on this subject, but little that is really helpful. Until objective, quantitative, and reasonably reliable tests of managerial competence are devised and applied, this factor will continue to be looked at through a fog. It is fair to assume that an outstandingly successful company has unusually good management. This will have shown itself already in the past record, it will show up again in the estimates for the next 5 years. And once more in the previously discussed factor of long-term prospects. The tendency to count it still another time as a separate bullish consideration can easily lead to expensive overvaluations. The management factor is most useful, we think, in those cases in which a recent change has taken place that has not yet had the time to show its significance in the actual figures. 2 spectacular occurrences of this kind were associated with the Chrysler Motor Corporation. The first took place as far back as 1921, when Walter Chrysler took command of the almost moribund Maxwell Motors, and in a few years made it a large and highly profitable enterprise, while numerous other automobile companies were forced out of business. The second happened as recently as 1962, when Chrysler had fallen far from its once high estate and the stock was selling at its lowest price in many years. Then new interests, associated with consolidation coal, took over the reins. The earnings advanced from the 1961 figure of $1.24 per share to the equivalent of $17 in 1963, and the price rose from a low of 8.5 in 1962 to the equivalent of nearly 200 the very next year. 6. 3. Financial strength and capital structure. Stock of a company with a lot of surplus cash and nothing ahead of the common is clearly a better purchase, at the same price, then another one with the same per share earnings but large bank loans and senior securities. Such factors are properly and carefully taken into account by security analysts. A modest amount of bonds or preferred stock, however, is not necessarily a disadvantage to the common, nor is the moderate use of seasonal bank credit. Incidentally, a top-heavy structure too little common stock in relation to bonds and preferred may under favorable conditions make for a huge speculative profit in the common. This is the factor known as leverage. 4. Dividend record. One of the most persuasive tests of high quality is an uninterrupted record of dividend payments going back over many years. We think that a record of continuous dividend payments for the last 20 years or more is an important plus factor in the company's quality rating. Indeed, the defensive investor might be justified in limiting his purchases to those meeting this test. 5. Current dividend rate. This, our last additional factor, is the most difficult one to deal with in satisfactory fashion. Fortunately, the majority of companies have come to follow what may be called a standard dividend policy. This has meant the distribution of about 2/3 of their average earnings, except that in the recent period of high profits and inflationary demands for more capital the figure has tended to be lower. In 1969 it was 59.5% for the stocks in the Dow Jones Average, and 55% for all American corporations. Where the dividend bears a normal relationship to the earnings, the valuation may be made on either basis without substantially affecting the result. For example, a typical secondary company with expected average earnings of $3 and an expected dividend of $2 may be valued at either 12 times its earnings or 18 times its dividend, to yield a value of 36 in both cases. However, an increasing number of growth companies are departing from the once standard policy of paying out 60% or more of earnings in dividends, on the grounds that the shareholders' interests will be better served by retaining nearly all the profits to finance expansion. The issue presents problems and requires careful distinctions. We have decided to defer our discussion of the vital question of proper dividend policy to a later section, Chapter 19, where we shall deal with it as a part of the general problem of management-shareholder relations. Capitalization rates for growth stocks. Most of the writing of security analysts on formal appraisals relates to the valuation of growth stocks. Our study of the various methods has led us to suggest a foreshortened and quite simple formula for the valuation of growth stocks, which is intended to produce figures fairly close to those resulting from the more refined mathematical calculations. Our formula is value equals current, normal, earnings times 8.5 plus twice the expected annual growth rate. The growth figure should be that expected over the next 7 to 10 years. 7. The difference between the implicit 32.4% annual growth rate for Xerox and the extremely modest 2.8% for General Motors is indeed striking. It is explainable in part by the stock market's feeling that General Motors' 1963 earnings, the largest for any corporation in history, can be maintained with difficulty and exceeded only modestly at best. The price-earnings ratio of Xerox, on the other hand, is quite representative of speculative enthusiasm fastened upon a company of great achievement and perhaps still greater promise. The implicit or expected growth rate of 5.1% for the DJIA compares with an actual annual increase of 3.4%, compounded, between 1951 to 1953 and 1961 to 1963. We should have added a caution somewhat as follows: the valuations of expected high-growth stocks are necessarily on the low side, if we were to assume these growth rates will actually be realized. In fact, according to the arithmetic, if a company could be assumed to grow at a rate of 8% or more indefinitely in the future, its value would be infinite, and no price would be too high to pay for the shares. What the valuer actually does in these cases is to introduce a margin of safety into his calculations, somewhat as an engineer does in his specifications for a structure. On this basis the purchases would realize his assigned objective, in 1963, a future overall return of 7.5% per annum, even if the growth rate actually realized proved substantially less than that projected in the formula. Of course, then, if that rate were actually realized, the investor would be sure to enjoy a handsome additional return. There is really no way of valuing a high-growth company, with an expected rate above, say, 8% annually, in which the analyst can make realistic assumptions of both the proper multiplier for the current earnings and the expectable multiplier for the future earnings. As it happened, the actual growth for Xerox and IBM proved very close to the high rates implied from our formula. As just explained, this fine showing inevitably produced a large advance in the price of both issues. The growth of the DJIA itself was also about as projected by the 1963 closing market price. But the moderate rate of 5% did not involve the mathematical dilemma of Xerox and IBM. It turned out that the 23% price rise to the end of 1970, plus the 28% in aggregate dividend return received, gave not far from the 7.5% annual overall gain posited in our formula. In the case of the other four companies, it may suffice to say that their growth did not equal the expectations implied in the 1963 price and that their quotations failed to rise as much as the DJIA. Warning: this material is supplied for illustrative purposes only, and because of the inescapable necessity in security analysis to project the future growth rate for most companies studied. Let the reader not be misled into thinking that such projections have any high degree of reliability or, conversely, that future prices can be counted on to behave accordingly as the prophecies are realized, surpassed, or disappointed. We should point out that any scientific, or at least reasonably dependable, stock evaluation based on anticipated future results must take future interest rates into account. A given schedule of expected earnings, or dividends, would have a smaller present value if we assume a higher than if we assume a lower interest structure. Such assumptions have always been difficult to make with any degree of confidence, and the recent violent swings in long-term interest rates render forecasts of this sort almost presumptuous. Hence we have retained our old formula above, simply because no new one would appear more plausible. Industry analysis. Because the general prospects of the enterprise carry major weight in the establishment of market prices, it is natural for the security analyst to devote a great deal of attention to the economic position of the industry and of the individual company in its industry. Studies of this kind can go into unlimited detail. They are sometimes productive of valuable insights into important factors that will be operative in the future and are insufficiently appreciated by the current market. Where a conclusion of that kind can be drawn with a fair degree of confidence, it affords a sound basis for investment decisions. Our own observation, however, leads us to minimize somewhat the practical value of most of the industry studies that are made available to investors. The material developed is ordinarily of a kind with which the public is already fairly familiar and that has already exerted considerable influence on market quotations. Rarely does one find a brokerage house study that points out, with a convincing array of facts, that a popular industry is heading for a fall or that an unpopular one is due to prosper. Wall Street's view of the longer future is notoriously fallible, and this necessarily applies to that important part of its investigations which is directed toward the forecasting of the course of profits in various industries. We must recognize, however, that the rapid and pervasive growth of technology in recent years is not without major effect on the attitude and the labors of the security analyst. More so than in the past. The progress or retrogression of the typical company in the coming decade may depend on its relation to new products and new processes, which the analyst may have a chance to study and evaluate in advance. Thus there is doubtless a promising area for effective work by the analyst, based on field trips, interviews with research men, and on intensive technological investigation on his own. There are hazards connected with investment conclusions derived chiefly from such glimpses into the future, and not supported by presently demonstrable value. Yet there are perhaps equal hazards in sticking closely to the limits of value set by sober calculations resting on actual results. The investor cannot have it both ways. He can be imaginative and play for the big profits that are the reward for vision proved sound by the event, but then he must run a substantial risk of major or minor miscalculation. Or he can be conservative, and refuse to pay more than a minor premium for possibilities as yet unproved, but in that case he must be prepared for the later contemplation of golden opportunities foregone. A two-part appraisal process. Let us return for a moment to the idea of valuation or appraisal of a common stock, which we began to discuss here. A great deal of reflection on the subject has led us to conclude that this had better be done quite differently than is now the established practice. We suggest that analysts work out first what we call the past performance value, which is based solely on the past record. This would indicate what the stock would be worth absolutely, or as a percentage of the DJIA or of the S&P composite if it is assumed that its relative past performance will continue unchanged in the future. This includes the assumption that its relative growth rate, as shown in the last 7 years, will also continue unchanged over the next 7 years. This process could be carried out mechanically by applying a formula that gives individual weights to past figures for profitability, stability, and growth, and also for current financial condition. The second part of the analysis should consider to what extent the value based solely on past performance should be modified because of new conditions expected in the future. Such a procedure would divide the work between senior and junior analysts as follows: 1. The senior analyst would set up the formula to apply to all companies generally for determining past performance value. 2. The junior analysts would work up such factors for the designated companies pretty much in mechanical fashion. 3. The senior analyst would then determine to what extent a company's performance absolute or relative is likely to differ from its past record, and what change should be made in the value to reflect such anticipated changes. It would be best if the senior analyst's report showed both the original valuation and the modified one, with his reasons for the change. Is a job of this kind worth doing? Our answer is in the affirmative, but our reasons may appear somewhat cynical to the reader. We doubt whether the valuations so reached will prove sufficiently dependable in the case of the typical industrial company, great or small. We shall illustrate the difficulties of this job in our discussion of Aluminum Company of America, Alcoa, in the next chapter. Nonetheless, it should be done for such common stocks. Why? First, many security analysts are bound to make current or projected valuations as part of their daily work. The method we propose should be an improvement on those generally followed today. Secondly, because it should give useful experience and insight to the analysts who practice this method. Thirdly, because work of this kind could produce an invaluable body of recorded experience, as has long been the case in medicine, that may lead to better methods of procedure and a useful knowledge of its possibilities and limitations. The public utility stocks might well prove an important area in which this approach will show real pragmatic value. Eventually, the intelligent analyst will confine himself to those groups in which the future appears reasonably predictable or where the margin of safety of past performance value over current price is so large that he can take his chances on future variations as he does in selecting well-secured senior securities. In subsequent chapters we shall supply concrete examples of the application of analytical techniques. But they will only be illustrations. If the reader finds the subject interesting, he should pursue it systematically and thoroughly before he considers himself qualified to pass a final buy or sell judgment of his own on a security issue. Commentary on Chapter 11 by Jason Zweig. If you want to buy the same thing that is popular with your friends or popular with the investment analysts, you can't get a bargain. If you buy the same thing they buy, you will get the same performance they get. If you are going to have a superior performance, you've got to buy what the other people are not buying or even what those are selling. Sir John Templeton 1. As an intelligent investor, if you hope to succeed at analyzing stocks in an always competitive and usually efficient market, you must follow Graham's essential principles: be different from the crowd, and be disciplined. You can't achieve either of those goals by acting on whims. If, however, you can become disciplined and stay that way, then you will be different from the crowd by definition. Point 2. Kind versus wicked. Start by understanding that how much any of us can learn from our experience depends on the quality of the feedback we get. Robin Hogarth, a psychologist at Universitat Pompeu Fabra in Barcelona, described two types of learning environments. A kind setting provides prompt, accurate, unambiguous feedback on whether what you're doing works. A wicked environment offers feedback that is delayed, inaccurate, and ambiguous. Point 3. The stock market is among the most wicked learning environments in the world, with murky feedback in constant flux. Let's say you're convinced a company is worth $14 to $16 a share. You buy the stock at 11:42 a.m. for $10. By 11:48 a.m., it's at $10.87, the market already agrees with me. An hour later, the stock has fallen to $9.94, the market is wrong. The next day, trading opens and closes at $10, well, at least I'm breaking even. A week later, the stock is at $11.50, yes. It's up 15%. The week after that, it sinks to $9, then to $8.50, then to $8, no. I've lost 20%. Over the next month the stock sinks to $6.66, at which point you panic and sell before you lose even more than a third of your money. Later that day, a competitor announces it's buying the company for $14 per share. Were you right? Were you wrong? You won't be able to tell unless you documented your reasoning. That's the only way to get kind feedback out of a wicked learning environment. Before you buy, make a record of your rationale. What specific evidence do you understand about the company that other investors are overlooking, and why did they miss it? Why do you think the company is worth $14 to $16 a share? How long should it take to reach that price? How confident are you that you're correct? Are you 90% certain? 80%? 50%? 100%? Gut check. One of the best ways to create a record of your rationale and structure your feedback is with a checklist. By imposing a rule on yourself, I will never buy a stock without first completing a checklist, you can avoid the heartache that comes from selling in a panic after buying on an impulse. And you can help determine whether you were right for the right reasons, or whether you just got lucky. A checklist can't work miracles, it won't, all by itself, enable you to find the next Amazon or Apple. But it takes much of the wickedness out of the stock market's feedback. It compels you to be consistent and ensures that you don't underemphasize or overlook factors you intend to rely on. Above all, it enables you to learn what works, what doesn't, and how to improve your analyses. Point 4. Every investor's checklist will be different. It should be based partly on what you've learned from your successes and mistakes, and not every company or industry can be analyzed the same way. At a minimum, though, Your checklist must refocus your attention away from the stock and onto the business. It might include such elements as these. Have I read at least the last 3 annual reports and the past year's quarterly reports? A company's financial reports consist of 3 key components: the balance sheet, the income statement, and the cash flow statement. Do I understand the balance sheet well enough to determine whether the company is dangerously in debt? Can I tell from the income statement whether costs are under control and profits are rising? What does the statement of cash flows indicate about how the company generates and consumes cash? Is the business consistently generating more cash over time from its operations? From the narrative portion of the company's reports, what can I learn about the company's biggest competitors? How dependent is it on a few sources of raw materials, sales in one geographical region, or a handful of large customers? Has it grown by acquiring other companies or by expanding internally? Does management allocate surplus capital wisely, or has the company repeatedly taken accounting write-offs to cover the costs of investments or acquisitions that went bad? 5. Have I read the latest proxy statement? Relative to other firms in the same industry, is this company's management compensated fairly? Are managers engaging in extensive related party transactions or receiving lavish perks that raise troubling conflicts of interest? Do the directors have significant stock holdings? Are top executives using their own cash to buy shares, or simply being granted a free ride with stock options? Is incentive compensation tied to sensible measures of long-term profitability and financial soundness, such as growth in return on equity or book value per share over multi-year horizons, or purely to the raw share price or to make-believe metrics like growth in adjusted EBITDA? 6. Does the company have durable advantages? As Warren Buffett has said, the key to investing is determining the competitive advantage of any given company and, above all, the durability of that advantage. How dominant are its brands, and why? Does it have patents or other intellectual property that insulate it from competition? Does it continuously undercut its rivals' prices, providing consumers with compelling value? Does the business generate network effects, in which its products or services become more valuable as more people use them? If the company disappeared tomorrow, how hard would it be for customers to find a comparable provider? 7. Are the managers operators or promoters? Do the top executives say what they will do and do what they say? Do they underpromise and overdeliver? Do they readily admit mistakes? Do they consistently follow conservative accounting rules, or do they repeatedly change how the company reports its financial results? Are they focused on the long-term value of the business or the short-term price of the stock? Have I conducted a pre-mortem? Do I understand the business well enough to imagine the competitive weaknesses that could kill it? Pretend it's 1 year from now and the company just filed for bankruptcy protection. What went wrong? Did new management fail to turn the business around? Did rising interest rates turn its debt into an unbearable burden? Did consumers abandon a hot product on which the company was overdependent? Did an acquisition turn into a debacle? What is my itch? What, exactly, do I understand about this company that most other investors are missing, and why? What are the odds? Based on my experience, how confident am I that I'm right? How long do I estimate the stock will take to reach my target? If the stock market shut down for the next 5 years, would I be happy owning a piece of this company? Write down 3 to 5 reasons having nothing to do with the stock price why this is a good business that should be even better 5 years from now. Above all, live by this rule: if I haven't followed all the steps in my checklist, I can't buy this investment. Point 8. If complying with all the steps in a checklist sounds like too much work, you should reconsider whether you're an enterprising investor after all. Unless you're ready and willing to commit many hours of time and effort to analyzing a company before you invest, you're a defensive investor. And there's nothing wrong with that. Chapter 12. Things to Consider About Per Share Earnings. By Benjamin Graham. Subscribe, like and share our audiobook channel Trade Like Champions for more such contents. Happy investing. This chapter will begin with two pieces of advice to the investor that cannot avoid being contradictory in their implications. The first is, don't take a single year's earnings seriously. The second is, if you do pay attention to short-term earnings, look out for booby traps in the per-share figures. If our first warning were followed strictly, the second would be unnecessary. But it is too much to expect that most shareholders can relate all their common stock decisions to the long-term record and the long-term prospects. The quarterly figures, and especially the annual figures, receive major attention in financial circles, and this emphasis can hardly fail to have its impact on the investor's thinking. He may well need some education in this area, for it abounds in misleading possibilities. As this chapter is being written, the earnings report of Aluminum Company of America, Alcoa, for 1970 appears in the Wall Street Journal. The first figures shown are. The little at the outset is explained in a footnote to refer to primary earnings, before special charges. There is much more footnote material. In fact, it occupies twice as much space as do the basic figures themselves. For the December quarter alone, the earnings per share are given as $1.58 in 1970 against $1.56 in 1969. The investor or speculator interested in Alcoa shares, reading those figures, might say to himself, "Not so bad. I knew that 1970 was a recession year in aluminum." But the fourth quarter shows a gain over 1969, with earnings at the rate of $6.32 per year. Let me see. The stock is selling at 62. Why, that's less than 10 times earnings. That makes it look pretty cheap, compared with 16 times for International Nickel, etc., etc. But if our investor speculator friend had bothered to read all the material in the footnote, he would have found that instead of one figure of earnings per share for the year 1970, there were actually four, viz. For the fourth quarter alone, only two figures are given. What do all these additional earnings mean? Which earnings are true earnings for the year and the December quarter? If the latter should be taken at 70 cents, the net income after special charges, the annual rate would be $2.80 instead of $6.32, and the price 62 would be 22 times earnings, instead of the 10 times we started with. Part of the question as to the true earnings of Alcoa can be answered quite easily. The reduction from $5.20 to $5.01, to allow for the effects of dilution, is clearly called for. Alcoa has a large bond issue convertible into common stock. To calculate the earning power of the common, based on the 1970 results, it must be assumed that the conversion privilege will be exercised if it should prove profitable to the bondholders to do so. The amount involved in the Alcoa picture is relatively small, and hardly deserves detailed comment. But in other cases, making allowance for conversion rights and the existence of stock purchase warrants can reduce the apparent earnings by half, or more. We shall present examples of a really significant dilution factor below, here. The financial services are not always consistent in their allowance for the dilution factor in their reporting and analyses. Asterisk. Let us turn now to the matter of special charges. This figure of $18,800,000, or 88 cents per share, deducted in the fourth quarter, is not unimportant. Is it to be ignored entirely, or fully recognized as an earnings reduction, or partly recognized and partly ignored? The alert investor might ask himself also, how does it happen that there was a virtual epidemic of such special charge-offs appearing after the close of 1970, but not in previous years? Could there possibly have been some fine Italian hands asterisk at work with the accounting, but always, of course, within the limits of the permissible? When we look closely, we may find that such losses, charged off before they actually occur, can be charmed away, as it were, with no unhappy effect on either past or future primary earnings. In some extreme cases they might be availed of to make subsequent earnings appear nearly twice as large as in reality by a more or less prestidigitous treatment of the tax credit involved. In dealing with Alcoa's special charges, the first thing to establish is how they arose. The footnotes are specific enough. The deductions came from 4 sources, viz. 1. Management's estimate of the anticipated costs of closing down the manufactured products division. 2. Ditto for closing down Alcoa Castings Co.'s plants. 3. Ditto for losses in phasing out Alcoa Credit Co. 4. Also, estimated costs of $5.3 million associated with completion of the contract for a curtain wall. All of these items are related to future costs and losses. It is easy to say that they are not part of the regular operating results of 1970, but if so, where do they belong? Are they so extraordinary and non-recurring as to belong nowhere? A widespread enterprise such as Alcoa, doing a $1.5 billion business annually, must have a lot of divisions, departments, affiliates, and the like. Would it not be normal rather than extraordinary for one or more to prove unprofitable, and to require closing down? Similarly for such things as a contract to build a wall. Suppose that any time a company had a loss on any part of its business, it had the bright idea of charging it off as a special item, and thus reporting its primary earnings per share so as to include only its profitable contracts and operations. Like King Edward VII's sundial that marked only the sunny hours. Asterisk. The reader should know 2 ingenious aspects of the Alcoa procedure we have been discussing. The first is that by anticipating future losses, the company escapes the necessity of allocating the losses themselves to an identifiable year. They don't belong in 1970, because they were not actually taken in that year. And they won't be shown in the year when they are actually taken, because they have already been provided for. Neat work, but might it not be just a little misleading? The Alcoa footnote says nothing about the future tax saving from these losses. Most other statements of the sort state specifically that only the after-tax effect has been charged off. If the Alcoa figure represents future losses before the related tax credit, then not only will future earnings be freed from the weight of these charges, as they are actually incurred, but they will be increased by a tax credit of some 50% thereof. It is difficult to believe that the accounts will be handled that way. But it is a fact that certain companies which have had large losses in the past have been able to report future earnings without charging the normal taxes against them, in that way making a very fine profits appearance indeed, based paradoxically enough on their past disgraces. Tax credits resulting from past years' losses are now being shown separately as special items, but they will enter into future statistics as part of the final net income figure. However, a reserve now set up for future losses, if net of expected tax credit, should not create an addition of the sort to the net income of later years. The other ingenious feature is the use by Alcoa and many other companies of the 1970 year-end for making these special charge-offs. The stock market took what appeared to be a bloodbath in the first half of 1970. Everyone expected relatively poor results for the year for most companies. Wall Street was now anticipating better results in 1971, 1972, etc. What a nice arrangement, then, to charge as much as possible to the bad year, which had already been written off mentally and had virtually receded into the past, leaving the way clear for nicely fattened figures in the next few years. Perhaps this is good accounting, good business policy, and good for management-shareholder relationships. But we have lingering doubts. The combination of widely, or should it be wildly, diversified operations with the impulse to clean house at the end of 1970 has produced some strange-looking footnotes to the annual reports. The reader may be amused by the following explanation given by a New York Stock Exchange company, which shall remain unnamed, of its special items aggregating $2,357,000, or about a third of the income before charge-offs, consists of provision for closing Spalding United Kingdom operations, provision for reorganizational expenses of a division, costs of selling a small baby pants and bib manufacturing company, disposing of part interest in a Spanish car leasing facility, and liquidation of a ski boot operation. Asterisk. Years ago the strong companies used to set up contingency reserves out of the profits of good years to absorb some of the bad effects of depression years to come. The underlying idea was to equalize the reported earnings, more or less, and to improve the stability factor in the company's record. A worthy motive, it would seem, but the accountants quite rightly objected to the practice as misstating the true earnings. They insisted that each year's results be presented as they were, good or bad, and the shareholders and analysts be allowed to do the averaging or equalizing for themselves. We seem now to be witnessing the opposite phenomenon, with everyone charging off as much as possible against forgotten 1970, so as to start 1971 with a slate not only clean but specially prepared to show pleasing per-share figures in the coming years. It is time to return to our first question. What then were the true earnings of Alcoa in 1970? The accurate answer would be, the $5.01 per share, after dilution, less that part of the 82 cents of special charges that may properly be attributed to occurrences in 1970. But we do not know what that portion is, and hence we cannot properly state the true earnings for the year. The management and the auditors should have given us their best judgment on this point, but they did not do so. And furthermore, the management and the auditors should have provided for deduction of the balance of these charges from the ordinary earnings of a suitable number of future years, say, not more than 5. This evidently they will not do either, since they have already conveniently disposed of the entire sum as a 1970 special charge. The more seriously investors take the per-share earnings figures as published, the more necessary it is for them to be on their guard against accounting factors of one kind and another that may impair the true comparability of the numbers. We have mentioned 3 sorts of these factors: the use of special charges, which may never be reflected in the per-share earnings, the reduction in the normal income tax deduction by reason of past losses, and the dilution factor implicit in the existence of substantial amounts of convertible securities or warrants. 1. A fourth item that has had a significant effect on reported earnings in the past is the method of treating depreciation chiefly as between the straight line and the accelerated schedules. We refrain from details here. But as an example current as we write, let us mention the 1970 report of Train County. This firm showed an increase of nearly 20% in per-share earnings over 1969, $3.29 versus $2.76, but half of this came from returning to the older straight-line depreciation rates, less burdensome on earnings than the accelerated method used the year before. The company will continue to use the accelerated rate on its income tax return, thus deferring income tax payments on the difference. Still another factor, important at times, is the choice between charging off research and development costs in the year they are incurred or amortizing them over a period of years. Finally, let us mention the choice between the FIFO, first in first out, and LIFO, last in first out, methods of valuing inventories. An obvious remark here would be that investors should not pay any attention to these accounting variables if the amounts involved are relatively small. But Wall Street being as it is, even items quite minor in themselves can be taken seriously. 2 days before the Alcoa report appeared in the Wall Street Journal, the paper had quite a discussion of the corresponding statement of Dow Chemical. It closed with the observation that many analysts had been troubled by the fact that Dow had included a 21-cent item in regular profits for 1969, instead of treating it as an item of extraordinary income. Why the fuss? Because, evidently, evaluations of Dow Chemical involving many millions of dollars in the aggregate seemed to depend on exactly what was the percentage gain for 1969 over 1968, in this case either 9% or 4.5%. This strikes us as rather absurd. It is very unlikely that small differences involved in one year's results could have any bearing on future average profits or growth, and on a conservative, realistic valuation of the enterprise. By contrast, consider another statement also appearing in January 1971. This concerned Northwest Industries Incorporated's report for 1970. The company was planning to write off, as a special charge, not less than $264 million in one fell swoop. Of this, $200 million represents the loss to be taken on the proposed sale of the railroad subsidiary to its employees, and the balance a write-down of a recent stock purchase. These sums would work out to a loss of about $35 per share of common before dilution offsets, or twice its then current market price. Here we have something really significant. If the transaction goes through, and if the tax laws are not changed, this loss provided for in 1970 will permit Northwest Industries to realize about $400 million of future profits, within 5 years, from its other diversified interests without paying income tax thereon. What will then be the real earnings of that enterprise, should they be calculated with or without provision for the nearly 50% in income taxes which it will not actually have to pay? In our opinion, the proper mode of calculation would be first to consider the indicated earning power on the basis of full income tax liability, and to derive some broad idea of the stock's value based on that estimate. To this should be added some bonus figure, representing the value per share of the important but temporary tax exemption the company will enjoy. Allowance must be made, also, for a possible large-scale dilution in this case. Actually, the convertible preferred issues and warrants would more than double the outstanding common shares if the privileges are exercised. All this may be confusing and wearisome to our readers, but it belongs in our story. Corporate accounting is often tricky, security analysis can be complicated, stock valuations are really dependable only in exceptional cases. For most investors it would be probably best to assure themselves that they are getting good value for the prices they pay, and let it go at that. Use of average earnings. In former times analysts and investors paid considerable attention to the average earnings over a fairly long period in the past, usually from 7 to 10 years. This mean figure was useful for ironing out the frequent ups and downs of the business cycle, and it was thought to give a better idea of the company's earning power than the results of the latest year alone. One important advantage of such an averaging process is that it will solve the problem of what to do about nearly all the special charges and credits. They should be included in the average earnings. For certainly most of these losses and gains represent a part of the company's operating history. If we do this for Alcoa, the average earnings for 1961 to 1970, 10 years, would appear as $3.62, and for the 7 years 1964 to 1970 as $4.62 per share. If such figures are used in conjunction with ratings for growth and stability of earnings during the same period, they could give a really informing picture of the company's past performance. Calculation of the past growth rate. It is of prime importance that the growth factor in a company's record be taken adequately into account. Where the growth has been large, the recent earnings will be well above the 7 or 10-year average, and analysts may deem these long-term figures irrelevant. This need not be the case. The earnings can be given in terms both of the average and the latest figure. We suggest that the growth rate itself be calculated by comparing the average of the last 3 years with corresponding figures 10 years earlier. Where there is a problem of special charges or credits, it may be dealt with on some compromise basis. Note the following calculation for the growth of Alcoa as against that of Sears Roebuck and the DJIA Group as a whole. Comment: these few figures could be made the subject of a long discussion. They probably show, as well as any others, derived by elaborate mathematical treatment, the actual growth of earnings for the long period 1958 to 1970. But how relevant is this figure, generally considered central in common stock valuations, to the case of Alcoa? Its past growth rate was excellent, actually a bit better than that of acclaimed Sears Roebuck and much higher than that of the DJIA Composite. But the market price at the beginning of 1971 seemed to pay no attention to this fine performance. Alcoa sold at only 11.5 times the recent 3-year average, while Sears sold at 27 times and the DJIA itself at 15+ times. How did this come about? Evidently Wall Street has fairly pessimistic views about the future course of Alcoa's earnings, in contrast with its past record. Surprisingly enough, the high price for Alcoa was made as far back as 1959. In that year it sold at 116, or 45 times its earnings. This compares with the 1959 adjusted high price of 25.5 for Sears Roebuck, or 20 times its then earnings. Even though Alcoa's profits did show excellent growth thereafter, it is evident that in this case the future possibilities were greatly overestimated in the market price. It closed 1970 at exactly half of the 1959 high, while Sears tripled in price and the DJIA moved up nearly 30%. It should be pointed out that Alcoa's earnings on capital funds * had been only average or less, and this may be the decisive factor here. High multipliers have been maintained in the stock market only if the company has maintained better than average profitability. Let us apply at this point to Alcoa the suggestion we made in the previous chapter for a two-part appraisal process. Such an approach might have produced a past performance value for Alcoa of 10% of the DJIA, or $84 per share relative to the closing price of $840 for the DJIA in 1970. On this basis the shares would have appeared quite attractive at their price of $5714. To what extent should the senior analyst have marked down the past performance value to allow for adverse developments that he saw in the future? Frankly, we have no idea. Assume he had reason to believe that the 1971 earnings would be as low as $2.50 per share, a large drop from the 1970 figure, as against an advance expected for the DJIA. Very likely the stock market would take this poor performance quite seriously, but would it really establish the once mighty Aluminum Company of America as a relatively unprofitable enterprise, to be valued at less than its tangible assets behind the shares? In 1971 the price declined from a high of 70 in May to a low of 36 in December, against a book value of 55. Alcoa is surely a representative industrial company of huge size, but we think that its price and earnings history is more unusual, even contradictory, than that of most other large enterprises. Yet this instance supports, to some degree, the doubts we expressed in the last chapter as to the dependability of the appraisal procedure when applied to the typical industrial company. Commentary on Chapter 12. By Jason Zweig. It's not a paranoid delusion the issuers of financial statements really are out to get you. Martin S. Fridson 1. When companies announce their earnings, One question matters above all: do these reported numbers fairly represent the profitability of the underlying business? If only the question were as easy to answer as it is to ask. Mind the GAAP. Under generally accepted accounting principles, or GAAP, income and expenses are typically booked within the fiscal period in which they occur. That sounds sensible, but it can paint a misleading picture. Imagine an industrial company that bought a manufacturer of chemicals last year. This year, environmental regulators fined the company $80 million to clean up pollution at the site of a factory that its newly acquired subsidiary shut down 17 years ago. It no longer even makes the chemical that contaminated the factory site. Under GAAP rules, that fine for activities in years past is an expense that reduces net earnings this year. However, it is, or at least should be, a one-time or non-recurring expense, rather than a perennial cost of doing business. Such a cost says little about the company's fundamental health this year and next to nothing about its ability to generate cash and profits in future years. Likewise, let's say a company wins $1 billion in a patent infringement lawsuit against its only major competitor. That will inflate GAAP income, but it's almost certainly a one-time event. You'd be foolish to count on its recurrence. Because GAAP isn't perfect, companies increasingly rely on non-GAAP reporting in which they exclude various items from expenses or income. Companies report these alternative numbers in their earnings announcements, parts of their financial statements, and conference calls. Analysts and investors rely on them. Corporate executives' compensation often does. 2.2. The shadow numbers have become at least as important as the real ones. The entire system has been conditioned to accept these non-GAAP notions as legitimate measures, says Lauren Taylor Wolfe, managing partner of Impactive Capital, an investment firm in New York. As the U.S. Securities and Exchange Commission has said, whether a non-GAAP adjustment to expenses or income is fair or misleading depends on a company's individual facts and circumstances. The SEC says non-GAAP financial statements should treat items consistently over time, shouldn't subtract normal, recurring, cash operating expenses, and shouldn't include non-recurring gains if non-recurring charges are excluded in the same period. In principle, non-GAAP numbers should remove any unusual or extraordinary costs or income, creating a clearer picture of how well the company is doing and how profitable it is likely to be in the future. In practice, non-GAAP numbers have become the devil's workshop. No regulatory or accounting standards determine exactly what can be excluded, when, and why. Companies can change their non-GAAP metrics whenever they want, without warning or explanation. How much of which types of income or expenses should be adjusted? What constitutes a normal cost of doing business? What defines whether a source of income is unlikely to recur? How should a company decide and communicate whether its adjustments are fair, sensible, and consistent? All that is up to each company's executives, the judgments are theirs to make, and the story is theirs to tell. Welcome to non-GAAP land. Naturally, when companies become storytellers, many choose to tell fairy tales. These fantasies are set in a place I call non-GAAP land. In this magical world, every frog is a prince, every beanstalk grows into the stratosphere, and the emperor always has clothes. In non-GAAP land, companies can make expenses vanish and ephemeral income appear as durable as marble. In 2011, Groupon Incorporated concocted a non-GAAP measure of profitability called ACSWA, or Adjusted Consolidated Segment Operating Income. In the 3 years ended December 31, 2010, Groupon lost $423 million under GAAP rules. Using its ACSWA measure, however, the company earned $63 million. In non-GAAP land, Groupon, an online marketing company, decided it was fair to exclude online marketing expenses from its measure of earnings. The SEC later compelled Groupon to include them. In 2018, WeWork COS, the office-sharing startup, created a measure of purported profitability called Community-Adjusted EBITDA. That waived away the costs of sales, marketing, and administration. It also effectively treated upfront discounts from landlords as a perennial, rather than transitory, source of income. In the real world, under GAAP rules, the company lost $933 million the year before. In non-GAAP land, WeWork earned $233 million. WeWork bungled its attempted stock offering in 2019, after finally going public in 2021, the company filed for bankruptcy protection in late 2023. Year after year, measures of non-GAAP income at such pharmaceutical giants as Bristol Myers Squibb Co., Eli Lilly & Co., and Pfizer Incorporated excluded a portion of research and development costs, even though researching and developing new drugs is the heart of their business. That added billions of dollars to their earnings in non-GAAP land. In 2022, under pressure from regulators, the companies finally changed that practice. 4. Do you believe in magic? Elsewhere in non-GAAP land, some airlines exclude a portion of the cost of renting airplanes, energy companies strip out some of the cost of exploring for oil and gas, software firms wipe away part of the cost of developing software. Because you don't live in non-GAAP land, you're probably thinking, I can't pretend that my expenses don't reduce my income. Why should a business get to do that? The answer: professional investors go along with the charade. If no one powerful questions a business practice, more businesses will practice it. Once stocks go up because of apparent earnings growth, demanding actual earnings growth seems like nitpicking. And when a rising tide lifts all boats, no one wants to rock any boat. Yet people know better. A survey of 169 chief financial officers of public companies asked what made reported earnings high quality. Fully 94% of the CFOs said earnings should reflect consistent reporting choices over time. More than two-thirds said earnings shouldn't include one-time or special items. In a separate survey, more than half of professional analysts and investors said many non-GAAP adjustments are sometimes or always inappropriate. Yet many of these CFOs oversee the production of financial reports that present a fantasy, and many of these professional investors own the very companies whose accounting they consider inadequate. The survey of CFOs found that 93% believe that companies misrepresenting earnings do so to support their stock price and to satisfy outside pressure for ever higher reported profits. And 89% think companies misrepresenting earnings want to influence, i.e., to inflate executive compensation. 5. Research also indicates that companies that habitually exclude items from non-GAAP earnings tend to be younger and smaller. They have wide institutional ownership, high recent stock returns, and thus great expectations for more hot returns in the future. 6. Companies tell fairy tales because their audience doesn't want the spell to be broken. When investors want to believe in magic, companies will make wishes seem to come true. We swear it won't happen ever again. Until next year. One way companies can polish their performance is to exclude restructuring charges from non-GAAP results. A business can incur such costs when it sells assets at a loss, shuts down a division, or lays off employees. In the real world, those are expenses. In non-GAAP land, they can disappear. In principle, a healthy company shouldn't be chronically dumping assets and jettisoning workers. Overpaying for acquisitions and overexpanding the workforce aren't part of the ordinary cost of doing business. In practice, however, every company needs to change course occasionally, so restructuring charges do crop up every few years. Excluding them from your assessment of a company's profitability can make sense. A cost that occurs sporadically in the short term isn't likely to constrict profits in the long term. But if restructuring charges recur often, then they start to resemble a regular feature of how the business operates, in which case, you would be naive to overlook them. Many companies, however, are telling investors to do just that. According to CalcBench, a financial data firm, 68 companies in the S&P 500 took restructuring charges every year from 2013 to 2022. Of those, 36 adjusted their numbers in 2022 by adding restructuring charges back into their reported measures of non-GAAP income. These companies are effectively taunting investors with the attitude of Chico Marx in the classic movie Duck Soup. Well, who are you gonna believe, me or your own eyes? Look with your own eyes at HP Incorporation. Over the 10 years through 2023, HP took restructuring charges 10 times. It also took acquisition and divestiture charges in every one of those years, although only for $1 million in 2015. Those charges totaled nearly $5.10 billion, an eighth of HP's $42.7 billion in cumulative operating profits, by the conventional GAAP measure. After HP cleansed those charges in its financial statements, the company reported a cumulative $49.5 billion in non-GAAP operating income. HP says such charges cover non-recurring costs that are inconsistent in amount and frequency and unrepresentative of expected future operating expenses. After recurring year after year after year, that's a bit like saying the lyrics of Happy Birthday to You aren't repetitive because not every person has the same name. Stocking up earnings. Another item that bloats measures of income in non-GAAP land is stock-based compensation, the cost companies incur to pay employees and executives with shares or options. Especially among software and other technology companies, that's a huge and regular cost of doing business. At many, it's the dominant component of pay. Over the 10 fiscal years ending in May 2023, Oracle Corp's cumulative non-GAAP operating income of $178.9 billion was more than one-third higher than the operating earnings it reported under GAAP rules. That's partly because the software giant paid $15.6 billion of stock-based compensation to its management and employees and added that expense back into its non-GAAP operating income. Source: HP Earnings Presentations, SEC.gov. Oracle concedes in its earnings reports that stock-based compensation expenses will recur in future periods, but we continue to evaluate our business performance excluding stock-based compensation expenses. Over the same period, another software giant, Salesforce Incorporated, reported $25.6 billion of cumulative operating income in its non-GAAP reports. Yet the company's cumulative operating income, as measured conventionally by GAAP, totaled just $3.1 billion. How did Salesforce earn more than 8 times as much in non-GAAP land than it did in the real world? By taking the $14.1 billion it had paid employees and management in stock-based compensation expense and declaring that it wasn't an expense. Salesforce has explained that it adds stock-based compensation, and other expenses, into its non-GAAP calculations of income because such costs aren't incurred to increase revenue in a particular period, but instead for the company's long-term benefit over multiple periods. Yet, over the same 10-year stretch, Microsoft Corp paid out an enormous $48.1 billion in stock-based compensation. How much of that expense did Microsoft shovel into its non-GAAP income? 0. By doing so, Microsoft recognized stock-based compensation as what it is, a normal, recurring cost of doing business that companies and investors shouldn't be adding back into a fairy tale measure of income. As Warren Buffett wrote in 2016, I once defined income statement as the part of a company's financial statements in which it may exaggerate its income and understate its expenses. 8. The plague of non-GAAP adjustments has made that little joke deadly serious. Some companies, to their credit, do use non-GAAP numbers to clarify rather than to camouflage or confuse. Far too many don't. One of the most important and challenging tasks for enterprising investors is figuring out whether the non-GAAP numbers paint a fair picture or a fantasy. 9. Chapter 13. A Comparison of 4 Listed Companies. By Benjamin Graham. Subscribe, like and share our audiobook channel Trade Like Champions for more such contents. Happy investing. In this chapter we should like to present a sample of security analysis in operation. We have selected, more or less at random, 4 companies which are found successively on the New York Stock Exchange list. These are Eltra Corp., a merger of Electric Autolite and Mergent Holler Linotype Enterprises; Emerson Electric Co., a manufacturer of electric and electronic products; Emery Air Freight, a domestic forwarder of air freight; and Emert Corp., originally a maker of bottling machinery only, but now also in builders' hardware. There are some broad resemblances between the 3 manufacturing firms, but the differences will seem more significant. There should be sufficient variety in the financial and operating data to make the examination of interest. In Table 13:1 we present a summary of what the 4 companies were selling for in the market at the end of 1970, and a few figures on their 1970 operations. We then detail certain key ratios, which relate on the one hand to performance and on the other to price. Comment is called for on how various aspects of the performance pattern agree with the relative price pattern. Finally, we shall pass the 4 companies in review, suggesting some comparisons and relationships and evaluating each in terms of the requirements of a conservative common stock investor. The most striking fact about the 4 companies is that the current price/earnings ratios vary much more widely than their operating performance or financial condition. 2 of the enterprises, Eltra and Emert, were modestly priced at only 9.7 times and 12 times the average earnings for 1968 to 1970, as against a similar figure of 15.5 times for the DJIA. The other 2, Emerson and Emery, showed very high multiples of 33 and 45 times such earnings. There is bound to be some explanation of a difference such as this, and it is found in the superior growth of the favored company's profits in recent years, especially by the freight forwarder. But the growth figures of the other 2 firms were not unsatisfactory. For more comprehensive treatment, let us review briefly the chief elements of performance as they appear from our figures. 1. Profitability. A. All the companies show satisfactory earnings on their book value, but the figures for Emerson and Emery are much higher than for the other 2. A high rate of return on invested capital often goes along with a high annual growth rate in earnings per share. All the companies except Emery showed better earnings on book value in 1969 than in 1961, but the Emery figure was exceptionally large in both years. B. For manufacturing companies, the profit figure per dollar of sales is usually an indication of comparative strength or weakness. We use here the ratio of operating income to sales, as given in Standard & Poor's listed stock reports. Here again the results are satisfactory for all 4 companies, with an especially impressive showing by Emerson. The changes between 1961 and 1969 vary considerably among the companies. 2. Stability. This we measure by the maximum decline in per-share earnings in any one of the past 10 years, as against the average of the 3 preceding years. No decline translates into 100% stability, and this was registered by the two popular concerns. But the shrinkages of Ultra and Emert were quite moderate in the poor year 1970, amounting to only 8% each by our measurement, against 7% for the DJIA. 3. Growth. The two low multiplier companies show quite satisfactory growth rates, in both cases doing better than the Dow Jones Group. The Ultra figures are especially impressive when set against its low price/earnings ratio. The growth is of course more impressive for the high multiplier pair. 4. Financial position. The three manufacturing companies are in sound financial condition, having better than the standard ratio of $2 of current assets for $1 of current liabilities. Emery Air Freight has a lower ratio, but it falls in a different category, and with its fine record it would have no problem raising needed cash. All the companies have relatively low long-term debt. Dilution note: Emerson Electric had $163 million of market value of low-dividend convertible preferred shares outstanding at the end of 1970. In our analysis we have made allowance for the dilution factor in the usual way by treating the preferred as if converted into common. This decreased recent earnings by about 10 cents per share, or some 4%. 5. Dividends. What really counts is the history of continuance without interruption. The best record here is Emhart's, which has not suspended a payment since 1902. Ultra's record is very good, Emerson's quite satisfactory, Emery Freight is a newcomer. The variations in payout percentage do not seem especially significant. The current dividend yield is twice as high on the cheap pair as on the dear pair, corresponding to the price/earnings ratios. 6. Price history. The reader should be impressed by the percentage advance shown in the price of all four of these issues, as measured from the lowest to the highest points during the past 34 years. In all cases the low price has been adjusted for subsequent stock splits. Note that for the DJIA the range from low to high was on the order of 11 to 1, for our companies the spread has varied from only 17 to 1 for Emert to no less than 528 to 1 for Emery Air Freight *. These manifold price advances are characteristic of most of our older common stock issues. And they proclaim the great opportunities of profit that have existed in the stock markets of the past. But they may indicate also how overdone were the declines in the bear markets before 1950 when the low prices were registered. Both Ultra and Emert sustained price shrinkages of more than 50% in the 1969-70 price break. Emerson and Emery had serious, but less distressing, declines. The former rebounded to a new all-time high before the end of 1970, the latter in early 1971. General observations on the four companies. Emerson Electric has an enormous total market value, dwarfing the other three companies combined. It is one of our goodwill giants, to be commented on later. A financial analyst blessed, or handicapped, with a good memory will think of an analogy between Emerson Electric and Zenith Radio, and that would not be reassuring. For Zenith had a brilliant growth record for many years. It too sold in the market for $1.7 billion, in 1966, but its profits fell from $43 million in 1968 to only half as much in 1970, and in that year's big sell-off its price declined to 22.5 against the previous top of 89. High valuations entail high risks. Emery Air Freight must be the most promising of the four companies in terms of future growth, if the price/earnings ratio of nearly 40 times its highest reported earnings is to be even partially justified. The past growth, of course, has been most impressive. But these figures may not be so significant for the future if we consider that they started quite small, at only $570,000 of net earnings in 1958. It often proves much more difficult to continue to grow at a high rate after volume and profits have already expanded to big totals. The most surprising aspect of Emory's story is that its earnings and market price continued to grow apace in 1970, which was the worst year in the domestic air passenger industry. This is a remarkable achievement indeed, but it raises the question whether future profits may not be vulnerable to adverse developments, through increased competition, pressure for new arrangements between forwarders and airlines, etc. An elaborate study might be needed before a sound judgment could be passed on these points, but the conservative investor cannot leave them out of his general reckoning. Emert and Eltra. Emert has done better in its business than in the stock market over the past 14 years. In 1958 it sold as high as 22 times the current earnings, about the same ratio as for the DJIA. Since then its profits tripled, as against a rise of less than 100% for the Dow, but its closing price in 1970 was only a third above the 1958 high, versus 43% for the Dow. The record of Eltra is somewhat similar. It appears that neither of these companies possesses glamour, or sex appeal, in the present market, but in all the statistical data they show up surprisingly well. Their future prospects? We have no sage remarks to make here, but this is what Standard & Poor's had to say about the four companies in 1971. Eltra long-term prospects: certain operations are cyclical, but an established competitive position and diversification are offsetting factors. Emerson Electric, while adequately priced, at 71, on the current outlook, the shares have appeal for the long term. A continued acquisition policy together with a strong position in industrial fields and an accelerated international program suggests further sales and earnings progress. Emory Air Freight, the shares appear amply priced, at 57, on current prospects, but are well worth holding for the long pull. Emert, although restricted this year by lower capital spending in the glass container industry, earnings should be aided by an improved business environment in 1972. The shares are worth holding, at 34. Conclusions: many financial analysts will find Emerson and Emory more interesting and appealing stocks than the other two, primarily, perhaps, because of their better market action, and secondarily because of their faster recent growth in earnings. Under our principles of conservative investment, the first is not a valid reason for selection, that is something for the speculators to play around with. The second has validity, but within limits. Can the past growth and the presumably good prospects of Emory Air Freight justify a price more than 60 times its recent earnings? Our answer would be, maybe, for someone who has made an in-depth study of the possibilities of this company and come up with exceptionally firm and optimistic conclusions. But not for the careful investor who wants to be reasonably sure in advance that he is not committing the typical Wall Street error of over-enthusiasm for good performance in earnings and in the stock market. The same cautionary statements seem called for in the case of Emerson Electric, with a special reference to the market's current valuation of over $1 billion for the intangible, or earning power, factor here. We should add that the electronics industry, once a fair-haired child of the stock market, has in general fallen on disastrous days. Emerson is an outstanding exception, but it will have to continue to be such an exception for a great many years in the future before the 1970 closing price will have been fully justified by its subsequent performance. By contrast, both Eltra at 27 and Emert at 33 have the earmarks of companies with sufficient value behind their price to constitute reasonably protected investments. Here the investor can, if he wishes, consider himself basically a part owner of these businesses, at a cost corresponding to what the balance sheet shows to be the money invested therein. The rate of earnings on invested capital has long been satisfactory, the stability of profits also, the past growth rate surprisingly so. The two companies will meet our 7 statistical requirements for inclusion in a defensive investor's portfolio. These will be developed in the next chapter, but we summarize them as follows. 1. Adequate size. 2. A sufficiently strong financial condition. 3. Continued dividends for at least the past 20 years. 4. No earnings deficit in the past 10 years. 5. 10-year growth of at least 1/3 in per-share earnings. 6. Price of stock no more than 1.5 times net asset value. 7. Price no more than 15 times average earnings of the past 3 years. We make no predictions about the future earnings performance of Ultra or Emert. In the investor's diversified list of common stocks there are bound to be some that prove disappointing, and this may be the case for one or both of this pair. But the diversified list itself, based on the above principles of selection, plus whatever other sensible criteria the investor may wish to apply, should perform well enough across the years. At least, long experience tells us so. A final observation: an experienced security analyst, even if he accepted our general reasoning on these 4 companies, would have hesitated to recommend that a holder of Emerson or Emery exchange his shares for Ultra or Emert at the end of 1970 unless the holder understood clearly the philosophy behind the recommendation. There was no reason to expect that in any short period of time the low multiplier duo would outperform the high multipliers. The latter were well thought of in the market and thus had a considerable degree of momentum behind them, which might continue for an indefinite period. The sound basis for preferring Ultra and Emert to Emerson and Emery would be the client's considered conclusion that he preferred value-type investments to glamour-type investments. Thus, to a substantial extent, common stock investment policy must depend on the attitude of the individual investor. This approach is treated at greater length in our next chapter. Commentary on Chapter 13. By Jason Zweig. As a scientist I believe in proof without certainty, while other people tend to believe in certainty without proof. Ashley Montague 1. In Chapter 13, Graham reminds you to shift your focus from the superficial to the fundamental. As an intelligent investor, you must look past the price of the stock to the performance of the business it represents. Graham maps out 6 dimensions on which you can measure performance: profitability, stability, growth, financial position, dividends, and price history. Only the last has anything to do with the stock directly, all the others require you to learn about the business. 4 paths. Of the 4 companies Graham compared in this chapter, only Emerson Electric still exists independently. Let's see what we can learn from looking at Emerson and 3 other contemporary companies whose names begin with the letter E: Energizer Holdings Incorporated, Eastman Kodak Co., and Exact Sciences Corp. Emerson is a manufacturing and engineering giant with more than $15 billion in annual revenue and a stock market value that exceeded $54 billion in early 2024. It produces essential tools and technologies: valves, electric motors, temperature sensors, seismic analysis, laser-based welding equipment, process control software, heavy-duty vacuums, and many other devices and services. Like many conglomerates, Emerson frequently buys other companies and often sells some, too. It is continually remaking and redesigning itself. Emerson has been in the S&P 500 index since 1965. Energizer is headquartered only 20 miles away from Emerson near St. Louis, Missouri, and its ticker symbol, ENR, is almost an exact match for Emerson's, EMR. But the 2 companies are far from twins. Energizer's primary business is manufacturing batteries under the Energizer, Eveready, and Rayovac brands. It also makes waxes, fragrances, and fuel additives for cars and trucks. The battery business has been losing power for years as smartphones have superseded cameras, clocks, calculators, flashlights, radios, video game consoles, and audio and video recorders. As of 2024, Energizer was focused on trying to return to stable profitability, largely by cutting costs. Eastman Kodak was the colossus of the photo industry for more than a century. Then it faded like a snapshot left out in the sun. After inventing digital photography in 1975, Kodak took nearly 2 decades to market its own electronic cameras to consumers. Making most of its money selling photographic film, the company was reluctant to advance a product that didn't use any. Rivals raced past Kodak. Later, smartphones turned traditional cameras into dinosaurs and film into a fossil. Between 1993 and 2022, Kodak's annual revenues shrank by 93%. In 2012, the company filed for bankruptcy protection, then staggered on. By early 2020, Kodak's accountants were warning that it might not survive. Exact Sciences, which develops cancer screening tests, first sold stock to the public in early 2001. In its early years, it spent massively on research and development, as well as on sales and marketing. In its first 8 years as a public company, Exact Sciences generated only $21 million in sales but $149 million in cumulative net losses. By the end of 2008, its stock market value had dwindled below $20 million. Not until 2014 did the U.S. Food and Drug Administration finally approve Exact Sciences' Cologuard screening test for colorectal cancer. At that point, the business exploded, with annual revenues soaring from less than $2 million in 2014 to $454 million in 2018. The company also produces tests that can detect breast cancer, prostate cancer, and the COVID-19 virus. 6 dimensions. Now let's briefly analyze each company along Graham's 6 dimensions. 1. Profitability. Although Emerson was profitable every year between 1993 and 2022, its growth was somewhat spasmodic. Earnings per share from continuing operations expanded by only 8% cumulatively over the 5 fiscal years ended in 2023 and barely surpassed their level in 2015. Return on equity was 13.8% in 2022, down from an average of more than 26% over the previous 5 years, partly because the sale of discontinued operations swelled Emerson's equity in 2023. Energizer's profits have been erratic. The company earned $201 million in 2017, only to lose $231 million in 2022. In 2023, it earned a $141 million net profit. Worse, the company issued new stock along the way. Its earnings had to be parceled out across a roughly 20% greater number of shares. Energizer's return on equity was wildly volatile, swinging from more than 700% in 2017 to negative 95% in 2022 to positive 82% in 2023, according to FactSet. Eastman Kodak lost $3.3 billion over the past 2 decades and was profitable in only 8 of those years. In 2022 it squeaked out a profit, earning a razor-thin return on equity of 1.4%. In the first 9 months of 2023, Eastman Kodak earned $70 million, up from $19 million in the first 3 quarters of 2022. Like many fast-growing technology companies, Exact Sciences sacrificed near-term earnings to pursue long-term growth and profitability. By 2023, its annual revenues had boomed to $2.5 billion, up more than 1,000-fold in a decade. Over that period, Exact Sciences' cumulative losses exceeded $3.10 billion, a sum that will seem like a pittance if, but only if, the company's growth continues. 2. Stability. Graham defines stability as no decline in earnings, measured against the average of the prior 3 years, in any of the past 10 years. None of our 4 companies passed that test, with Kodak and Exact Sciences faring the worst. 3. Growth. Here, Graham wants us to compare the rates at which companies' earnings per share grew over multi-year periods. That way, we account for expansion and contraction in the global economy. We also minimize the effects of short bursts of outperformance, or underperformance, that might be the result of luck or unrepeatable causes. We'll use 2 5-year periods, 2014 to 18 and 2019 to 23. The first consisted almost entirely of an economic boom. The second includes both the pandemic-induced near depression of 2020 to 21 and the rapid recovery afterward. Emerson's earnings per share from continuing operations grew by a sluggish average of 2% annually from 2014 through 2018, then finished 2023 at $3.72, no higher than the $3.74 figure in 2019. From 2015, its first year of independence from its former parent company, through 2018, Energizer's earnings grew from a loss of 6 cents per share to a $1.52 gain. Then, between 2019 through 2023, they wobbled from a 58-cent gain to a $3.37 loss to a $1.94 gain. Eastman Kodak's losses per share moderated from a ghastly $2.95 per share in 2014 to a grim 84 cents in 2018. It lost $2.74 and $9.77 per share in 2019 and 2020, then was thinly profitable from 2021 on, with a modest gain projected for 2023. At Exact Sciences, from 2014 through 2018, losses widened at an average annual rate of almost 3%. They peaked, so far anyway, at more than $820 million in 2020. By late 2023, it looked as if the company might be able to report its first annual profit before much longer. 4. Financial position. Emerson has total assets of nearly $43 billion and book value of nearly $21 billion, although much of that is attributable to intangible assets such as goodwill, the excess above net worth that Emerson paid for many of its acquisitions. Its total debt of $16 billion looks manageable. Energizer's $3.3 billion in long-term debt is substantial, especially on its small base of $211 million in shareholders' equity and $223 million in cash. The company did pay down well over $200 million in debt during 2023. Eastman Kodak was able to increase its cash on hand by $29 million in the first 9 months of 2023, although it was still carrying more than $450 million in long-term debt. Exact Sciences has more than $700 million in cash. It has more than $2.3 billion in convertible notes, which are likely to be turned into new shares of common stock eventually, that will diffuse future earnings over a larger number of shares, leaving less for each stockholder. The company otherwise has little debt. 5. Dividends. Emerson has increased its dividend every year since 1956. Energizer raised its dividend from 25 cents in 2015 to $1.20 in 2019 and has sustained it since. Kodak hasn't paid a dividend since 2003, Exact Sciences has never paid one. 6. Price history. After a long period of outperformance, Emerson has strained to keep up. Over the decade ending in 2023, it underperformed the S&P 500 index by 5.7 percentage points annually. Energizer has gained an average of 2% annually since it became an independent company in 2015, falling far behind the market. Eastman Kodak's returns were punctuated by two absurdities. In early 2018, the stock more than doubled in a day when Kodak announced it would launch its own cryptocurrency, a venture it soon abandoned. In 2020, Kodak's shares shot from $2 to as high as $60 in 3 days when word leaked that the U.S. government might loan the company $765 million to develop a pharmaceutical division, money that never materialized. Over the decade ending in 2023, Kodak's shares fell more than 88%. Exact Sciences stock returned an average of more than 20% annually over the 10 years ending in 2023. It did so in stupendous swoops of interim gains and losses. From 2017 through early September 2019, the stock rose 817%. It then proceeded to fall 55% by March 2020. Next, it gained 180% in less than a year after celebrity stock picker Cathie Wood amassed more than 5 million shares for her ARK funds. Then, in 2021 and 2022, Exact Sciences lost more than 80% in an 18-month stretch before partially recovering. In 2023 it soared 49%. Evolution. Companies are artificial organizations of physical assets, but they resemble natural living organisms. They are born, they grow fast, their expansion slows, they become heavy, they grow old, and often they die. Newly sprouted plants and newborn animals can grow extraordinarily fast if they evade the ever-present risks of dying from disease, perishing in extreme weather, or being eaten by predators. Some creatures, like sharks, tortoises, and bristlecone pines, can live for centuries or even millennia. Emerson, founded in 1890, is reshaping itself in hopes of a burst of rejuvenating growth. Energizer, whose heritage also dates back to the 1890s, may have to reconcile itself to stagnation. Eastman Kodak, incorporated in 1892, is struggling to survive without any significant remnants of its original business. Exact Sciences barely outlasted childhood. After only 7 years, its stock was nearly delisted from trading in 2009. Early in 2024 its stock had a market capitalization of $12 billion. Recently, the stocks of all 4 companies have shot up, at least temporarily. If you focused only on the momentum of the share price, you could easily have gotten carried away extrapolating a trend of growth that often turned out to be an illusion. When you instead evaluate a company along Graham's 6 dimensions, you reorient your focus from the stock price to the underlying business and can better assess which period of the corporate life cycle it is likely to be in. You can never be certain of any company's future, but methodically disengaging your attention from the stock price is the best way to assess whether the next phase of a business is distinction or extinction.